can go and do their experiments, so they only need to do a few. But then I feel like there'll be always things that'll be still unknown and to be conquered.
There's a lot of, I don't want to use an unpleasant word, but there are a lot of people who don't believe in things like climate change. And there are a lot of skeptics who believe that science is out to get them, or that, you know, we're all just sitting here lying. Is there work being done that you think could actually win over some of these skeptics? Is there a way to demonstrably show them?
Yeah, I do think all the work we're doing will help towards this, because, you know, this is not some model that's in some supercomputing facility, right? Not available to the public. I mean, you can download this and go try some of this yourself. Just like a video game, you can play the game of climate change one day, right?
Quantum physics.
So everything becomes accessible. At least my hope is, you know, chunk of the community that is curious will have resources online that is much more open, so they feel like they can participate in that.
If you think about the scientific journey that humanity's been on over the last 300 years, it's been quite good. Just take us 10 years from now. Like, how different will things be?
I think the whole process of scientific research and development will be accelerated many, many times, right? Even orders of magnitude in some areas. And that'll just mean that we can quickly rule out things that don't work and hone in on things that work. Certainly, you know, drugs designed by AI, they're already coming into trials, and that'll just increase fully. You know, personalized medicine for cancer and all of these, where we really haven't been able to understand, right, for various different targets, how to quickly design drugs. This can make it much faster and also cheaper, because right now so many of these treatments are too expensive to be done at scale. So it'll make this democratized and cheaper. And yeah, I think this will hit every area. I don't think any area is immune to this.
I think it will be interesting, won't it? 10 years time, if it takes the average drug 10 years to come to market, and if AI systems right now are coming up with some of the potential candidates for a future successful drug, then in 10 years' time, are we going to see a waterfall of new drugs?
I mean, it may not be a huge number, right? Because you can't test all of them. It'll be more targeted. It will be personalized. It will
actually work.
Exactly, effective.
Thanks so much for joining us.
Thank you. It's been
Maud.
fascinating. Yeah. Thank you for taking the time.
Yeah.
Over the past decade, China has gone from a Silicon Valley copycat to a top contender in technology on the world stage.
Its ascent is peaking at a time when geopolitical tensions with the US and Europe are intensifying, and the rise of artificial intelligence has sparked a new arms race.
The US is rushing to curb China's influence in AI while balancing the need to regulate the powerful technology within its own borders.
How America manages these competing priorities will have implications for where the balance of power in tech will shift to next.
On this episode of AI IRL, we'll explore how China's playbook went from imitation to innovation and discuss what's at stake in the competition between these two superpowers.
Mustafa Suleiman, thanks so much for coming in. Now, you are the co-founder and CEO of Inflection AI and a venture partner at Greylock. Some people will know you as one of the co-founders of DeepMind, now owned by Google. Tell us, what made you want to start fresh with Inflection?
Well, now is really the moment. I mean, it was very clear to me during 2020, 2021 at Google when I was working on Lambda, the conversational AI that now powers Bard, that these large language models were truly going to be the future. And I wanted to start a company to build personal AIs, an intelligence that is completely aligned to your interests on your team and really functions as a personal assistant or a chief of staff, one that knows you intimately and over time can actually help you with practical tasks like scheduling, prioritizing, planning, and those kinds of things.
And that's what you're working with Pi.
Exactly, yeah. Pi stands for personal intelligence, and we see it as your personal assistant, essentially.
How do you feel about the concentration of power in technology right now among the big companies coming out with their own AI models? Microsoft, Google, Meta.
Well, I mean, I think you're right to point out that the big companies have the resources and the people and the compute infrastructure to be able to adapt and compete faster than ever, right? And that is a very impressive, reality of how technology works these days. It requires a huge amount of compute. And at my own company, Inflection, we've managed to raise a lot of money and build one of the largest supercomputers in the world. But on the flip side, the other trend that's taking place is that the open source movement is now almost at cutting edge. I mean, it's probably about 12 months behind the very largest models built at the big tech companies. And so that's kind of a contradictory trend. Like the big companies are getting bigger and better faster, but also everybody is now going to be able to get access to these same capabilities in open source.
Let's fast forward a little bit into the present day where the world order has changed since you first entered the tech industry. How did China go from being a copycat culture to a contender when it comes to digital innovation and specifically AI?
Yeah, I mean, China is more than a contender. I think in many respects, it's one of the leading players now. I mean, they've always been incredibly creative. And I think that we may have sort of overstated the extent to which they were simply copying, what we were doing. And I think it's important to remain humble about the fact that, these ideas are going to be widely available to millions and millions of people. And, in many respects, all of our cultures are, equally creative, and they've been able to take, tools and ideas that are available both in open source, in the academic literature, and move them forward, innovate at the cutting edge. They've produced a lot of very good papers, contributions to the academic conferences that have been peer reviewed. So, I just think overall it's better to take an approach of humility, acknowledging that, they're also going to be a really significant player in this field over the next few decades.
How would you rank the United States in terms of technological prowess in that world order?
Well, I mean, there's no question that we, in the US and in the West more generally, are currently in the lead. I mean, we have the very best, most innovative technology companies and technology hubs. There's, without doubt, Silicon Valley is leading the pack. And I think we'll continue to. I think we worry too much that we're going to sort of be dislodged from our podium position.
For how long do you think?
Well, I think the question is, what does it look like to be dislodged? And is that really the right framing in the first place? Like, what is the difference between first and third? And, people talk about there being a race for AI, and it's very unclear what that looks like to come second or third in that race. I think it's sort of the wrong metaphor.
We're talking about superpowers, Clash of the Titans sort of stuff. It reminds me of back when the previous US administration banned companies from doing a lot of business with Huawei, and Huawei ended up basically having to get a lot better very quickly at making its own chip designs and all that kind of stuff. And it feels like it backfired a little bit.
Yeah, you've also advocated for the US restricting sales of some NVIDIA chips, which are crucial in training AI systems, to buyers who don't agree or who refuse to use them ethically and safely. So what do you think is the best way the US can actually flex its power? Is it through the technological innovation, or by stifling effectively some of its adversaries through regulation?
The first thing I should say about that is I don't think now is the time to do that. I mean, I think in theory, when the time comes, if the time comes for us to adopt a kind of global anti-proliferation strategy, we're worried about technologies being so powerful that we have to stop their spread. If that moment arises, and I think we're quite a long way from experiencing that, then technically that would be an appropriate containment strategy. Because much as this technology is manifested in software, it lives on the internet, it still sits on chips, you know, whether you're training a model or serving a model. So in order to ask a model a query, you have to have access to one of those NVIDIA GPUs. And, you know, for what it's worth, there are really only like one major company in the world that produces those high-end GPUs, NVIDIA, and they manufacture the vast majority of their chips at TSMC in Taiwan that use one single company, ASML, a Dutch company that manufactures the core chip that produces the chips, and they sit in the Netherlands. So it's actually a very narrow supply chain. And so I think the point I was sort of trying to make is that if you wanted to adopt a containment strategy, there is a supply chain where you can impose chokeholds on it.
And in 10 years from now, which country do you think will be leading the world in AI? Is it going to be the US? Will it be China? Will it be Europe?
It's going to be the US, I'm pretty sure of that. I mean, the fundamentals in the US innovation ecosystem are unquestionably the best in the world. I mean,
what could flip that balance of power?
Well, I mean, I think it's hard to say. I mean, I really do think that the US is in the strongest possible position. At the end of the day, you know, it's talent that drives, you know, this innovation. And talent still concentrates around a small number of physical places. Despite everything that we've experienced in the pandemic and people wanting to work remotely, you know, it's still really important to be physically proximate to other people who, you know, are working with you in the office. I mean, you know, I think that trend isn't going to change. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities. But that is going to take 5 years or so. The export controls that the US has implemented, you know, are real, and they really will prevent China from getting access to the next frontier of models, so the GPT-5 onwards. Right now, I don't really see how China could train those kinds of models.
Is there any downside, any unintended consequences that could come from this containment strategy the US is employing?
Yes, I think it is a very aggressive strategy. The counterattacks have already started, right? The China restricted gallium, which is a raw material used in chip manufacturing. And I expect them to have their own reactions in time. You know, we're very dependent on their supply chain. And so the idea that we could completely decouple, I think, is misguided.
I'm going to just put you on the spot really briefly and wonder, like, can you tell, because we're all friends here.
Sure, go for it.
Like, do you have a major regret about your work in AI? And do you also have a major single goal?
Yeah, my major single goal is to show that it is possible to create safe and ethical artificial intelligences which are accountable to humans. There is a possible trajectory where, you know, some groups may recklessly experiment with algorithms that can self-improve. And if in 10 to 15 or 20 years time, those kinds of AIs are set loose on the open web in, you know, a reckless way, then I can imagine that possibly causing serious harm. And so for as long as I can remember, almost 15 years that I've been involved in AI, I've been trying to raise awareness and concern about the possible ways in which it can go wrong. And part of doing that is to show a bunch of practical ways that it can go right, both with writing my book and laying out a series of containment strategies and things that we have to do in politics to improve our governance and regulation, but also in actually building and making Pi, which I think is hopefully going to continue to remain a very safe and controllable personal AI that can work for you.
Mustafa, thanks so much for coming in. Been a pleasure.
Thanks very much for having me. It's been great.
Helen Toner, thank you so much for joining us. You're a director at Georgetown Center for Security and Emerging Technology, and you're also an OpenAI board member. Dan Wang, thank you so much for joining us. You're a visiting scholar at the Tsai China Center at Yale Law School, and you've been studying technology and China for many years now.
And we've just heard from Mustafa Suleyman, and he thinks that China's emerged as one of the biggest contenders in AI. So Helen, I'm just curious to start with, do you think we're overestimating China's capabilities?
It's certainly true that they're a big player. And it's also true that we shouldn't underestimate them and that we have a bit of a history of underestimating China's ability to innovate. I mean, I think 10, 15 years ago, the story, at least in Washington, D.C., where I'm based, was, yeah, China can't innovate. If they're producing things that look like new technology, it's because they've stolen them. I think that's clearly no longer true. At the same time, I think it's also very possible to overestimate them. And sometimes I think I see that as well. So are they a serious competitor? Yes. Are they eating our lunch? No.
So that copycat culture, it's fair to say that most people are thinking, we're past that stage. Dan, what do you think of that?
Well, I think it's certainly the case that China focuses on different things. So President Xi Jinping is, I think, a little bit less enamored with the internet platforms, with a lot of the cryptocurrencies, with a lot of the AI businesses that Silicon Valley specializes. He's also a little bit less enamored of Wall Street and financialization and hedge funds. And if I had to think about what Xi's broad views are, it would be much closer to being something like capitalism with German characteristics, which is much more about building cars, building hydraulic pumps, building heavy machinery, the heavier the better, about all sorts of these major industrial projects. And I think China is very much a leader in things that include electric vehicle batteries now, solar photovoltaics. It is making a lot of electronics products, and it is innovating on a huge sort of a lot of the automotive supply chain. But I think they have a little bit less of a focus on AI, and therefore there is not so much political direction anymore to really push forward these consumer applications.
I think it's fair, though, that some of those areas, the US is also innovating very, very strongly. So are there any areas where China is innovating significantly better than the US?
Well, I would say something like electric vehicle batteries, where China has something like the 70% of all global expansion, all global capacity of electric vehicle batteries is now mostly in China. When it comes to the clean technology supply chain, again, these very industrial projects, these pieces of heavy machinery, that is a little bit more the focus. I think the US is really strong in things that include semiconductors, artificial intelligence, biotechnology. These are things, the smaller things where China is not so good, but there are big areas in which China is way outbuilding the US.
I mean, the semiconductors is getting significantly better in China. I mean, partly maybe as a result of the Huawei issue. Helen, what's your view on the semiconductor side of this?
So China's definitely been investing for decades in trying to have their own independent semiconductor supply chain, and they've been making some progress. The thing to know about semiconductors is there's a huge range of sophistication, from the really basic semiconductors, computer chips that go in basic devices, your smart fridge, your car, up to the kind of more advanced chips that might go in a brand new iPhone, up to very advanced chips that go in kind of the data centers, gigantic warehouses full of computing, which is what you're training advanced AI systems on. So China has made a lot of progress on the more basic end of the semiconductor sort of scale, and is still really struggling to hit the most advanced end. And that's where, it's not even, you can't even say the US is, alone able to create those advanced semiconductors, but what you have is an incredibly advanced global supply chain.
Many describe artificial intelligence and its development across these two superpowers as an arms race. Is that framework misguided, do you think?
I think it's a bit misguided. I think you really want to look at what kind of AI are we talking about, and in what way might it be a race. I think the place where it's clearest that it makes sense to think in a competitive framework is in kind of military domains. So, it's just true that the US military really wants to make sure that it is keeping pace with, and ideally a little ahead of, the Chinese, or a lot ahead of the Chinese military in terms of what technology they have.
Dan, Washington has taken some steps to curtail some of China's ability to get their hands on the cutting edge chips that really power these AI platforms. What's your take on that? Is that an effective strategy, or will China just find a way to build their own?
I think that China is going to try to figure out a lot of the way to build their own. A lot of the chip makers now have been under very significant stress from US sanctions dating back to about a year ago now, released by the Biden administration, that is really stopping their ability to access not just the high-end chips, but also the semiconductor production equipment as well.
And I think in general, it's really difficult to distinguish between what kinds of technologies should the US really not want China to be able to develop, and where is it fine. So, you mentioned, clean technologies before, where China, if you're looking at, manufacturing solar panels, as you mentioned, EV batteries, a lot of other areas, China is doing amazingly at that. And what you're starting to hear in some, US policymaking circles is that maybe that's a bad thing, that China is making a lot of kind of clean technology stuff. And I find that a little sort of tricky to reckon with, is at what point do we want to really shut them out or prevent them from being, able to manufacture anything if it's something good, useful that we can use. Of course, if it's technologies that we think have really significant military value, I understand, but then it starts, the lines between those categories start to get very, very blurred.
It seems like these tensions are just ratcheting it up even higher as time goes on. With each administration, they're intensifying. So to your point, if we do need these other technologies, solar technology for this transition into a greener future, what kind of happens next? How much do we place on kind of the AI arms race that could then potentially work against us in climate change? Is that a concern, or is that too far in the future still?
Well, a few months ago, Beijing did announce some export controls on certain solar technologies involved in making production wafers.
So it's already happening.
It is already happening, that there are some threats out there that, relatively speaking, Beijing has been pretty restrained against retaliating against American companies of the likes of Intel, of the likes of Tesla so far, but these things could escalate more.
how does the relationship between, the ruling party in China play out against the kind of the development of companies?
I think the Chinese system is definitely more top-down when it comes to AI development. You see less kind of individual tech companies like OpenAI or Google taking the lead, and more these kind of multi-institution partnerships, or maybe you have a university and a tech company and a government, department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we in the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, or that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's not the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China. in terms of what you're saying?
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to, opt in to different uses. Of course, in China, there's always the exception, unless the security services, think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology, really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Iran risks return. Oil surges after the United States says it intercepted a missile attack on its forces, stoking fears of a widening Middle East conflict. SK Hynix misses profit estimates, sending shares tumbling as investors question the longevity of the AI boom. And mining boom. The world's second largest miner posts surging profits and its highest interim dividend in 4 years. We hear exclusively from Rio Tinto CEO Simon Trott. It has just gone 8 a.m. across the Emirates. I'm Abir Abu in Dubai. Another packed show today, an escalation in the Middle East. But before we get into all of this, let's just take a quick look at where markets are this morning. Risk off when it comes to equities. S&P futures 0.3 lower this morning. Now the S&P 500 did gain yesterday. Memory chip stocks, including Micron, for example, were weighing on the overall gauge. We're seeing this tech rout really plaguing markets. The SOX gauge, which we've talked about multiple times on this show and other shows, is now only 56% higher year to date. We were talking a few months ago about it being 100%, over 100% higher for the year, but that seems to be taking a backseat now. Something else investors are keeping an eye on is the geopolitics. Iran, fresh attacks on U.S. bases in the region. We'll talk more about that in the show. And then Asian equity is 1.8% lower this morning. We saw the Kospi seeing its trading halted for 20 minutes earlier in the morning. SK Hynix, despite over 500% higher profits for the quarter, investors don't seem excited about that. Winnie will talk to us in a second about why exactly that is. And then Brent crude, yet again in the green, once again 4% higher with those fresh attacks in the region. And then we're also keeping an eye on the yield of the 10-year notes in the United States. FOMC decision happening later today. What does the Federal Reserve decide to do? That's the question everyone is asking themselves today. We will wait and see. But for a look at what is happening in Asian equities this morning, we've got Winnie Su in our Hong Kong studio. Winnie, what do you have for us?
Yeah, good morning, Abir. Well, we are seeing Asian stocks extending declines for a second day, with the South Korea's Kospi index here leading those losses. Here, as you just mentioned, Kospi down more than 8%, which means that it has triggered that circuit breaker earlier today, with trading halted for about 20 minutes. And that is a back-to-back circuit breaker from yesterday as well. And we did see these circuit breakers also on the Kosdaq index. Now, major reasons of the losses are really coming through from SK Hynix, which is down 11% here, and that is because the earnings really missed estimates. As you flip the board and take a look at where those earnings are really coming out, because the earnings, in fact, jumped about 557%. You can see profit jump here, and coming through at coming through at still missing estimate by about 6%. Now, it is the miss on estimate, but the declines really extended after those earnings calls, where we heard very little about the details when it comes to the long-term contracts and also the shareholder returns. So that has been some disappointment for investors. Now, SK Hynix, with those declines really dragging down South Korea's Kospi index, for the Kospi to now headed for its worst month on record, and with those 30-something declines on the Kospi index for July, it is also the worst performer so far this month among all global peers. Back to you, Abir.
Winnie Su in Hong Kong. What a reversal. The Kospi was the best performing gauge in the year, and now we're seeing that performance. Thank you, as always, for your time. Now let's return to our top story this morning. Oil is surging after the U.S. said it intercepted an Iranian attack on military bases, ending a days-long pause in fighting and increasing the risk of a return to full-blown war in the region. U.S. Central Command says that along with Saudi forces, it retaliated with strikes on Iran-backed militants in Iraq. So let's unpack all this situation with Stuart Livingstone-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia. Stuart, another escalation. We saw a little bit of calmness since Friday when the U.S. stopped its attacks, but now this happens this morning. Could we see a return to this full-blown aggression in the region between the United States and Iran?
Yeah, I mean, it has to be on the table, doesn't it? That doesn't mean it's definitive or it will happen. We know there's reluctance, certainly from both sides, from the US side, There's a question of how effective could it be if you continue with airstrikes. Airstrikes have very limited effectiveness in terms of long-term strategic objectives. And then from the Iranian side, clearly, look, there is a price to be paid. They can say the fact that they've survived gives them a degree of victory, as they would put it, but it's a very painful victory for them. But I think what's interesting about this is that you're now starting to get these proxies a lot more engaged, particularly the Houthis. The militias in southern Iraq or eastern Iraq, they were engaged sporadically throughout this conflict, but it appears now to be escalated, particularly with those joint Saudi-US attacks on those positions in eastern Iraq. That's incredibly unusual, and we've been sort of dusting off the history books to see the last time that happened. We suspect, at least in terms of officially acknowledged attacks, this is probably for several decades.
Wow. And then, obviously this is happening very, very quickly yet again. But then when it comes to the Strait of Hormuz, and this is what markets are looking at, movement there is still paralyzed. The talks between Oman and Iran, where are those sitting now?
So again, it seems to be this sort of endless back and forth about the proposals. We're not quite sure exactly what was proposed, but it seems like, well, whatever was proposed isn't really good enough. Certainly the Iranians have come out and said that, they've acknowledged the Omani proposals, but they kind of want fresh proposals. So again, we'll see what that looks like. I think ultimately what Iran would like is total control over Hormuz. What it may settle for, I think, is the key question here.
Yeah. All right. Well, Stuart, thank you as always for your time this morning. Stuart Livingstone Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia, with all those updates. Now, Israeli Prime Minister Benjamin Netanyahu earlier met with President Trump at the White House, with Trump seeking to lay the ground for further diplomacy in the conflict. Netanyahu later posted on Instagram that it was, quote, one of the best conversations I've had with Trump. We're now joined by Bloomberg's Dan Williams, who is in Washington. Dan, good to have you on this morning, just carrying the conversation that I was having with Stuart. This renewed aggression in the region comes at a time where Netanyahu is visiting the United States. So what can you tell us about what exactly went on, and beyond the headlines, what essentially is the conversation between Israel and the United States at the moment?
Well, thank you. And if you ask the Iranians, it's quite possible that this flare-up of the last 12 hours, which was very ably summarized by Stuart, was designed to follow on that meeting in Washington between Netanyahu and Trump, the Israeli Prime Minister, the US President, their first meeting since they went to war against Iran on February 28th, indeed on the 5-month mark of the beginning of that war. While both leaders spoke about a preference for a diplomatic solution, it's clear that their public closing of ranks also shows that they're ready to work together in the absence of such a solution, in an alternative situation. That's obviously code for a return to full-on warfare against Iran. It would appear the Iranians picked up on that code and are signaling in advance that they are not deterred.
And so, Dan, Israel has been quite quiet over the past month or so since these skirmishes between Iran and the United States have returned. What are the prospects, really, of Israel returning to the full-scale aggression that it started with the United States at the onstart of this war against Iran that we saw in late February?
That's a very good observation, Abir, and there's also a very simple reason why the Israelis have been quiet. They have not been part of this flare-up, this month's flare-up of fighting with Iran. That's been exclusively by U.S. forces, the U.S. Navy in the Gulf, and such. Essentially, the Israelis have said that they're willing to pitch in if and when the Americans request, or if and when they're directly attacked by the Iranians. Neither has happened. It would appear Iran is content to keep that regional power, Israel, out of this fight. It appears the Israelis are content with this unwritten subdivision of this conflict, whereby the Americans take on Iran and the Israelis take on Iran's proxy in Lebanon, Hezbollah. It's worth remembering just a few weeks ago, the Iranians were conditioning any diplomatic resolution on Lebanon being included, effectively a safeguard for what remains of Hezbollah in Lebanon, immunity for Hezbollah from continued Israeli attacks. Israel pushed back against this. There was a time when it caused tensions between Netanyahu and Trump. It would appear that the Israelis succeeded in divorcing the Lebanese front from the main Iranian front. That is the reason the Israelis have been quiet. That's the reason they have not been taking part, although the Israeli defense minister revealed only a few hours today at a conference that the Americans have been using bases in Israel to launch their attacks against Iran, among other bases in the region. So yes, there is a reason for that subdivision. Yeah. It's more than code. It's a subdivision of action.
All right, Bloomberg's Dan Williams in Washington, D.C. with that update. Thank you, as always. Ukrainian President Volodymyr Zelensky says he discussed Patriot air defenses and diplomatic efforts to end the Russian war during his White House meeting with President Trump. Zelensky described the talks as productive as Kyiv looks for ways to deter intensifying Russian missile and drone attacks. He says he also met with representatives from Lockheed Martin. Now, before we head into the break, just some breaking news. Earnings from Standard Chartered, second quarter pre-tax profit at $2.33 billion. The estimate was around 2.1, so a slight beat there. It also says that it revised its 2026 guidance and a $1 billion share buyback starting imminently. It also said that the second quarter credit impairment charge was at around $150 million. So those breaking lines from Standard Chartered following massive hauls, really, that we saw from banks on Wall Street earlier in the week. Now, coming up, Asian stocks are sliding as the rotation out of chip shares continues. South Korea's SK Hynix is at the epicenter after posting record earnings that still failed to live up to expectations. We'll discuss the outlook with Jeffrey Sexton of Demeter Tactical Investments. That is coming up next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
SK Hynix shares are on the slide in Seoul after it posted earnings that failed to match the market's steep expectations. Despite reporting a six-fold surge in quarterly profit and margins of 80%, investors seem to be focusing in on the $31 billion capital outlay, fueling fears about overinvestment in AI capacity. So let's go to Seoul now and Bureau Editor Denny Thomas. Denny, we were just reporting on those numbers, over 500% surge in quarterly profit. What are investors not excited about, essentially, when it comes to SK Hynix?
Yeah, so first of all, it is a miss. They failed to meet the lofty expectations, so that's number one. Second, there's a pretty high and a record amount of spending they have outlined, about 31 billion. And then they failed to outline any much of a plan for shareholder return. So all combined has played a big role in today's big sell-off today. And there's always a bit of a nervousness around whether these stocks have run up too fast and whether the spending and the returns that these companies have been doing will pay off. Today's miss has primarily raised question marks about whether these profits are going to be stacking up against these investments.
And so, Denny, just the other thing is the capital outlays here, 31 billion that was reported. Those are the same fears that we're seeing in Wall Street. What do you think those capex concerns mean for the rest of the market and some of SK Hynix's peers in South Korea?
Yeah, so tomorrow we have Samsung coming out with their earnings, and investors will be equally keen to see what kind of commentary, what kind of reiteration Samsung makes about the spending and plan. So that's going to be a key benchmark for anybody who is invested pretty much in the sector. The two-day collapse in the stock price of the tech in the chip companies in South Korea has had a big impact, and that's taken off a lot of the leverage that was in the market. And tomorrow, when Samsung reports, and the tone of that will definitely set whether what investors are going to be willing to take on the bet on the AI momentum going forward.
All right, Denny, we will have to leave it there. Denny Thomas, our Seoul bureau editor. Now, carrying on with the story, the sell-off in tech is masking a rally in non-tech names. While the Nasdaq 100 heads into correction territory, the equal weight S&P 500 index has hit a fresh record. So joining us now to discuss all of this is Jeffrey Sexton, CEO of Demeter Tactical Investments. Jeffrey, good to have you on again.
Thank you for having me back.
Thank you. Well, you heard what was happening with SK Hynix. I'm looking at the stock now, about 16% lower, but this is really alluding to a wider market story now. If I remember correctly, the last time you were here, referring to the market or those moves as a beautiful red Ferrari heading down a hill without brakes. Is that still the narrative?
Yes, and it's not only going down the hill, it has finished its ride and it's crashed into the wall at the bottom of the hill. The brakes did not work. There were no brakes, as we all suspected. So the Philadelphia Semiconductor Index is in correction territory. Obviously, Korea has sold off 30% in 1 month. That's what happens when your car has no brakes. You crash.
So that is what's happening with tech. There's a lot of concern about capex. Yeah. There's a lot of concern. We have earnings later today from some of the Max 7 reporting as well. So what are you looking for when it comes to those massive earnings, and what would that mean for the red Ferrari?
Well, there are other cars on the road besides Ferraris, as you alluded to, the equal weight index. Some of the other very boring cars are doing just fine. They're following the speed limit. They're doing what they're supposed to do. They're fine. It's the crazy driver on the highway, the semiconductors, the AI. They're the ones causing the problems right now. So what will be looked at in the earnings from Microsoft and Alphabet and all the rest, it's not how much are you making, how much are you spending. And they're going to be punished if they are spending too much money, i.e. if they're driving too fast. We heard Elon Musk say, we're going to spend as much CapEx as we can possibly spend. Yeah, well, what has SpaceX done since I was here with you last? They were about to go public, and now they are also selling off. So the big spenders are getting hit big with losses right now. Those people who manage their businesses well, properly manage their money, and control their spending, those are the rest of the ones in the equal weight index, and they're doing just fine.
So outside of the metaphors, we're talking about those crazy rides, but we're also talking about the other names in the market that are doing just fine. What are those pockets of opportunities? Are you looking at financials? We broke Standard Chartered results. Other banks have been doing incredibly well in Wall Street. So is that possibly where the next leg is?
Yes, there are. You have to. The world is not one bubble waiting to pop. It is a series of rolling bubbles, and the trick is to be looking for the next wave, moving on to the next wave before the one you're currently in deflates. And the rest of the world economy, manufacturing, mining, we saw Rio Tinto, other sections of the world economy are functioning, they're doing fine. So all the focus is on the bubble du jour, which is AI and tech spending. But the rest of the economy, they are making money. They go to work every day. They're digging things out of the ground. They're building things in their factories. People are spending money. So the economy in general, at least in the U.S., is actually much stronger than the headlines of AI bubbles would indicate.
So with that strong economy, what does that mean for the Fed later today? Citadel, yesterday we had a story saying that they're expecting a 25 basis point hike. Is that what Warsh decides to do?
Yeah, I don't like to give predictions. I will simply report what the market is pricing right now, and the market is overwhelmingly pricing that the Fed will remain on hold. And I think there are a couple of reasons for that. First, it's Warsh's first meeting. I'm not sure he wants to come out with a bang and cause problems with a rate hike. I also think, given the situation still percolating with Iran and Israel and the U.S., that there are too many factors, that there's a lot of wait and see. It's summer. You know, a lot of people are on holiday. Trading volumes are low. I think the market has probably correctly priced that there will be no hike today by the Fed. Now, that does not mean, though, as we get into the autumn, the bets and the arguments about whether there should be a hike become far louder. But I think that's obviously going to have a lot to do with where oil prices are, especially, don't forget, we're heading into U.S. midterm elections, and some of our leaders tend to like to try to bribe the American public the closer it gets to election day. So a rate cut would get you more voters than a rate hike. So it'll be interesting to see.
And Jeffrey, just briefly, with the elephant in the room, the geopolitics flaring up yet again, did the market price this whole flare-up extremely wrong the first time around?
I think what we have found out is that Washington and Donald Trump are living in a world where you make someone an offer they can't refuse, and they refuse it. And then they don't know what to do when the person refuses it. And they say, well, you can't do that. It's like we're living in a Monty Python sketch. So the problem right now is that no one knows what to do next. And I mean people at the highest level. So where it ends is completely unclear. So it's not really fair to say the market got it wrong. They got it right for the day or two with the information they had. The information has changed, and now it's a constantly evolving situation. And so I'm not going to say the market got it wrong. I might say the politicians got it wrong.
Okay.
So it's a ping pong game right now.
All right.
Who knows where it ends?
All right, Jeffrey, ping pong game. Always a pleasure to have you on. Thank you for your time this morning. Jeffrey Sexton Demeter, Tactical Investments CEO, with his thoughts on the markets. Now, coming up, more than 1,000 AI employees call for the government to help slow the pace of AI development following another OpenAI agent going rogue. We got the latest details on that. This is Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
An OpenAI agent that breached Hugging Face systems also compromised a customer at a second technology company, Modal Labs. Hugging Face says the agent broke into an isolated testing environment known as Sandbox that Modal was running for a customer. Modal's CTO says its own platform was not compromised, and OpenAI declined to comment. More than 1,000 employees across leading AI firms have signed a petition urging the U.S. government to support measures that could slow the pace of AI development. The letter, signed by workers at OpenAI, Anthropic, Google, and Meta, warns that AI may be advancing faster than humans can control. It calls for an international framework to manage the development of AI. Plenty more ahead. This is Bloomberg.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Iran risks return. Oil surges after the U.S. says it intercepted a missile attack on its forces, stoking fears of a widening Middle East conflict. SK Hynix misses profit estimates, sending shares tumbling as investors question the longevity of the AI boom. And mining boom. The world's second largest miner posts surging profits and its highest interim dividend in 4 years. We hear exclusively from Rio Tinto CEO Simon Trott. It's just gone 8:30 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Let's take a quick look at where markets are sitting at 5:30. Still risk off, more declines in Asian equities. But when it comes to U.S. futures, 0.3% lower as of now. Now, this follows a slightly positive performance in the S&P 500 yesterday, despite tech weighing on the overall gauge. We saw the likes of Micron, for example, memory chips, are really feeling the pain over the past couple of weeks or so. Micron was dropping, weighing on the overall performance. The SOX gauge, which gauges the performance of semiconductors, is about 60% higher year to date. It wasn't that long ago when we were talking about the SOX gauge being the best performer, being having its best year so far. Now it is set to have its worst month since 2002. So a quick turnaround. And then we're looking at Asian equities, 2.2% lower. The Kospi was halted in its trading earlier in the morning. SK Hynix posting profits, 557% increase in its quarterly profits, but still a miss there. So investors not incredibly excited about that. And then Brent crude price is $87 on the barrel. Escalations in the Middle East. This is why we're seeing it in the green. Yield on the 10-year notes, 4.61%. Not doing much, but we're still waiting for the FOMC later today. Now, just a quick flip at the board. We'll take a look at a sector that is not really getting discussed that much, and that is financials. This plugs the MSCI World Index against banks in different regions. And look, they're outperforming global equities. Tech has been the name of the game over the past few months or so, but banks are really outperforming global equities. We saw hauls in Wall Street and also in Europe. And so this is what banks are doing essentially against global equities. But for a deeper dive on what Asian equities are doing this morning, we've got Winnie Su in our Hong Kong studio. Winnie?
Yeah, good morning, Abir. Well, we are seeing Asian stocks extending declines further after having entered that technical correction territory just yesterday. Well, losses today are mainly being led by South Korea's Kospi index. We see the gauge here down about 12.5%, and the level we're looking at is in fact 12.7%, which will make this an intraday low, intraday decline when it comes to the gauge. Now, you just mentioned it hit a circuit breaker, and it is also the very first time we saw this back-to-back circuit breaker from yesterday as well. So you can see that momentum really is unwinding very quickly after SK Hynix saw its earnings missed estimates. And we are seeing stocks down about 17%, which is also an intraday decline. Now, on the flip side, we are seeing a bit more positivity when it comes to tech stocks in Hong Kong, and those are being driven by the gains in the Chinese EV shares, which are gaining as some pressure easing around the memory chip prices. Now, when it comes to the Japanese market, I just also want to highlight that we are very closely monitoring that aftermath of the massive earthquake that we saw hit the country's Kyushu area, the Kumamoto prefecture, which is also a key place for chip making and manufacturers. So far we have confirmed about 13 people who have died from the earthquake, and still many to be rescued, and some suspension when it comes to some of the factories. We are seeing construction stocks, in fact, gaining on that front after that big explosion at the Aeon Mall. When it comes to cross asset, we are looking at the Japanese yen here strengthening just a bit, but still very close to that 164 level against the dollar. We do have the Bank of Japan decision meeting coming up on Friday, and for now, still expecting a hold. Back to you, Abir.
All right, Winnie Su in Hong Kong with those market details. Now, Some other breaking lines just breaking across the Bloomberg terminal. UBS this time. We're sticking with banks. UBS second quarter net income at $2.8 billion. The estimate was 2.47, around 2.5. And so another beat there. It also says that it plans to buy back additional shares of $3 billion by the second quarter of 2027. It also says that it's entering the third quarter with market conditions remaining broadly constructive. Now, I did not time the terminal chart we were showing just a few moments ago about banks outpacing global equities, but it does look like the picture is quite strong when it comes to lenders across different geographies, both in Europe, as we've seen by UBS and Standard Chartered, and also the ones on Wall Street. Now back to our top story this morning. The U.S. says it has intercepted several Iranian ballistic missiles on its military bases, breaking the brief pause in fighting in the Middle East. Meanwhile, the U.S. and Saudi forces launched attacks on Iran-backed militia targets in Iraq in response to the drones attacking Saudi's energy infrastructure. This comes as President Trump welcomed Israeli Prime Minister Benjamin Netanyahu to the White House amid strained relations between the two over the war in the Middle East. So joining us now to unpack all of this is Julia Rocknefard, Senior Lecturer at the School of Law and Governance at Taylor's University, Malaysia. Julia, good to have you on this morning. Fresh attacks this morning in the Middle East that we saw by Iran on military bases, and then Saudi and the U.S. launching those mutual attacks on eastern parts of Iraq. Are we expected to see those re-escalations and then calmness in the geopolitical scene every now and then for the foreseeable future, do you think?
We just might, as you suggest, and I think as I've been suggesting since the ceasefire, that the aim possibly could be shifting what happened during the 40-day war into this low-intensity kind of simmering warfare in the region, simply due to the reason that there is not enough munitions, there's not enough weapons in order to sustain a high-intensity conflict that we observed in the first weeks of the war. And in fact, the reason to this pause of a couple-day pause, which was suggested by the initiative of the United States, the most likely reason to it is also that it has been running out of munitions. So again, the high-intensity warfare is unsustainable. This kind of outbreaks, until and unless a comprehensive deal is achieved, which right now seems highly unlikely, are said to continue.
Julia, I want to talk about the new fronts that have been opened over the past couple of weeks or so. Now, there's no doubt that Iran has been militarily weakened over the past 5 months or so, but its proxies in the region seem to have been reactivated now. How do you see its leverage through those proxies evolving over the coming period?
I think Iran has been using the so-called proxies or allied groups within the axis of resistance quite wisely, not getting into the conflicts unless it was necessary and until it was necessary, like in the case of Lebanon, or in the Lebanese Hezbollah, and also how we've seen the Houthis or Ansar Allah in Yemen not stepping in until recently with a threat to, again, blockade the Bab el-Mandeb Strait and the access to the Red Sea. However, also, I think it should be added, despite the remarks by Donald Trump himself and Secretary of War Pete Hegseth, I do not think that Iran's capacity and production capacity of weapons in particular has been obliterated, as was stated on a few occasions. And it has been able and is still able, as we can see easily, to sustain the warfare, to fend off attacks, and even exercise the attacks like this one on Jordan, provided also the targeting information that it's likely has been receiving from the allies.
Yeah, and I want to get back to the military, the capabilities of Iran. But before that, we've been reporting on the Prime Minister of Israel, Benjamin Netanyahu, visiting D.C. Earlier yesterday to to meet with President Trump. So outside of the headlines that we've been seeing out of that visit, what do you think he's trying to achieve being there, and what message is he trying to send to the United States?
Indeed, since the media were not let in on this 90-minute meeting behind the closed doors, we don't know much. But Benjamin Netanyahu has been lobbying this meeting for quite some time. And as I understand, President Trump had nothing to say to him in person. So the Lindsey Graham funeral served as a good occasion for the meeting of the two. And it was said that they discussed in particular, Iran's nuclear issue, and that Iran should not have nuclear weapons, and the possibility of also attacking facilities, some of the facilities which Israel claims that Iran is developing as a new enrichment site. I think not much indeed is going on. That's why there's nothing to report on, because Netanyahu, of course, would like the United States to keep pounding Iran without the need for Israel to be participating in it directly. So Iran does not retaliate against Israel, especially on the eve of the elections, and Israel being engaged elsewhere, which is Gaza and Lebanon as well. And the reluctance of Donald Trump to go full in, with the understanding that indeed the munitions are running low. And we are hearing the reports about it from the United States, from the experts and officials themselves, that the munitions are indeed low. So it will be unsustainable and something else needs to be done. So I think there is a collision between the two. And there's also a collision between the desire to go for an all-out warfare and the capacity to do so.
All right, Julia, we're going to have to leave it there. But thank you, as always, for your time and insights. Julia Rocknefard, Senior Lecturer for the School of Law and Governance at Taylor's University, Malaysia. Now, Zambia's kwacha is nearing parity with the South African rand, capping a remarkable turnaround. This is according to Citigroup. The kwacha has appreciated almost 18% against the dollar this year, making it the second best performing currency tracked by Bloomberg. We've got our chief Africa correspondent, Jennifer Sapasaja, joining us now from Johannesburg to discuss this performance. And Jen, what has essentially sparked this turnaround in the currency?
Well, Abir, it has been quite a turnaround, as you were just saying there. We have seen about year to date almost 18% against the dollar this year, which is significant for the kwacha. And really what we heard from Citigroup analysts is that a lot of this is underpinned by some of the strength that we've seen from copper prices. Zambia is Africa's second largest copper producer. And so this has, as Citigroup analysts say, provided a bit of a tailwind for the kwacha. Not just that, we've also seen debt restructuring really help the country. This has been a priority for President Hichilema. And so part of that has factored into some of the strength of the kwacha. And you were mentioning the rand there, which, you know, here in South Africa, we of course track where the rand is in terms of its comparison to other emerging markets. And the fact that we are actually seeing it undervalued, as a Citigroup analyst put it, against the kwacha is very interesting. But he did say that a lot of this is because last week we did see the South African Reserve Bank decide to leave benchmark rates unchanged. And so again, a bit of strength for the kwacha and a bit of optimism, I guess you could say, for President Hichilema as he heads into the election next month.
And how would this actually help him bid for the re-election next month? Like, what is he looking at?
Well, you know, he's already delivered quite sizable returns, or a number of economic returns and reforms that he had promised initially when he came into office. And so what we're hearing from analysts is that this is set to just, again, give him a bit of strength heading into this election. He is seeking a second five-year term. And I mentioned what we've seen already from the stability from debt restructuring. We've seen the bonds, Zambian bonds, that have returned for investors about 36%. And so just continuing to see strength from the kwacha adds to what we saw from the kwacha last year, which was 25% rally in 2025. So again, it's stability and strength for President Hichilema. The question is, will voters vote that way and see it as such?
All right, Jen, we're going to have to leave it there. Jennifer Zabazaja, our chief Africa correspondent in Johannesburg. Now, coming up, it's a big week in big tech as Microsoft, Meta, and Qualcomm prepare to report later today. We'll discuss what investors will be keeping a close eye on next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It is a pivotal week for big tech investors as Microsoft, Meta, Qualcomm, and Apple all report earnings. Investors will be looking for evidence that AI spending by these companies is generating meaningful returns. So to discuss all of this, we're now joined by Farah Al-Bahrawi, who leads our coverage of EMEA equity markets, macro trends, and strategy. Farah, good to have you on this morning. Investors are looking at the results that are coming out later today. What exactly is the market keeping a close eye on?
Absolutely, Abir. So a lot of those names that you just mentioned, they're going to be in focus today. So Meta and Microsoft particularly, they're among the biggest AI spenders alongside Amazon and Alphabet. So in reality, Abir, patience is running low with the big tech companies. It's not enough just to beat estimates anymore. It's really all about that CapEx spending. I heard you talking about SK Hynix. I think that's a perfect example. Really good results, but what's happening here is that investors are really punishing increased AI spending, and that's exactly what we're expecting from these big tech companies. CapEx is essentially really driving the market right now, and what was really interesting was this note from SocGen yesterday saying that it's not EPS that's driving the hyperscalers shares anymore, it's CDS spreads. So they're saying that as long as these are getting wider, valuations will be pressured. Valuations are actually at the lowest since ChatGPT launched for these hyperscalers. Yeah, it's actually quite fascinating. So that's the one to watch. When those peak, then maybe that's a sign that free cash flow is finally going to get improving.
It's fascinating with SK Hynix. We live in a world where over 500% increase in quarterly profit still doesn't get investors excited. But talk to me a little bit about how the season has gone so far and what exactly the market, other than that, is looking at, and why we haven't seen any meaningful boosts really to the moves there.
Absolutely. So this season has been rather strong, but the difference between the first quarter and the second quarter, let me give you some numbers. At the start of the first quarter, we expected 12% earnings growth, and then we got 29% earnings growth. So there was such a big beat, but heading into this season, we're expecting 23. We're getting 27. So the market is really rewarding the expectations here. So but that's what happened last quarter. But this quarter, we're seeing positive surprises among the highest in quarters and actually in record, and it's still not being rewarded. That's because, again, expectations were so high. We'll see. Will these big tech companies change that? I'm not sure. We'll see.
All right, Farah, we're going to have to leave it there. I know that there are some technical difficulties with your mic, but Farah El-Bahrawi, who leads our coverage of EMEA equity markets, macro trends, and strategy with the latest on those market moves. Now, stay with us. Plenty more is ahead. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Rio Tinto will cut costs and build cash by boosting productivity and selling non-core assets. This is after the group posted a jump in profit for the first half, driven by strong commodity prices. Rio Tinto CEO Simon Trott spoke exclusively to Bloomberg as results were announced. Take a listen.
Iron ore remains a really strong market for us. We've been talking for years about the maturation of China growth, and you're certainly seeing that come through. It's been far more resilient than I think market pundits had expected because of that underlying demand. And whilst construction in China has slowed, you've seen a real pickup in export-related steel demand, so secondary and tertiary products. And that's led to fairly robust and stable pricing outcomes in the market. We continue to engage with all market participants, including CMRG. And so, through the ordinary course of business, we renew those contracts, and that's the phase we're in at the moment.
You've talked about that market evolving, though, and obviously at the moment that the economy is in a K-shaped recovery, and the property sector, fixed asset investment, probably isn't going to come back unless they return to the old economic playbook. Do you see the plateauing going downwards? What sort of a sharper slowdown might you be envisioning?
We've certainly seen over a period of years that construction segment slowing down, and it makes up a relatively smaller portion of our book now compared to 5-10 years ago, whereas really one of the big drivers. And as I say, you've seen that demand being replaced by export related, not necessarily steel exports of themselves, but related to the increase in manufacturing within China and those products flowing to the rest of the world. I think domestic supplies and scrap have probably been a bit less in terms of on the supply side than predictions, and so that's led to stronger pricing outcomes and pretty good cost support. Is probably the last point I'd make. Increases in raw materials, particularly energy, has meant that it's pretty well supported prices on the right-hand side of the cost curve.
Obviously, more strategically important going forward is the role of copper, right? And prices demand has held up pretty well this year. Beyond Oyu Tolgoi, where do we look next in terms of guaranteeing future demand?
So one of the things we outlined today is around 70% of the raw material cost of a data centre comes from the materials that we produce. So, aluminium, copper, lithium, as well as steel. And if you look forward, I mean, the spend next year on from hyperscalers, $1 trillion, and you convert that across, that's a lot of lithium, aluminium and copper. And so really excited about how we're positioned for the future. Fortunately, we've got Oyu Tolgoi, which is ramping up to the 500,000 tonnes of capacity. That ramp up's proceeding according to plan, and really pleased with the way that asset continues to perform. Kennecott in the US, one of only 2 copper smelters, and then a big pipeline of growth beyond that.
That was Rio Tinto CEO Simon Trott speaking earlier on Bloomberg. Now for a look at some of the other stories that we're following today. Saudi Prince Al-Walid bin Talal Al Saud has acquired a 5% stake worth $130 million in electric vehicle manufacturer Lucid. The purchase was seen as a vote of confidence in the company after it dismissed rumors of an impending bankruptcy. Lucid shares in New York surged after the investment to their highest level since April. And Dubai's financial hub has reached over 10,000 active registered companies for the first time, despite a period of heightened uncertainty due to the Iran war. The DIFC reported a 30% increase in registrations over the past 12 months, with 2,300 new companies setting up in the hub. That is it for Horizon's Middle East and Africa today. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. When a six-fold surge in profits just isn't enough. SK Hynix slumps as the chip giant says capital spending will rise around 50% this year. The results dragging South Korea's Kospi lower, now on track for its worst month ever. Meanwhile, oil rebounds as the US says it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's decision from the Federal Reserve. And three of Europe's biggest banks report. Standard Chartered and UBS beat profit expectations, with Deutsche Bank's numbers just crossing the wires. We'll hear from executives at all three lenders. Well, a very good morning. Here is the picture in markets this Wednesday. It is, of course, Fed Day, but once again, we've got to start in South Korea. The Kospi down another 9% as things stand after an 11% plunge already yesterday. The catalyst this morning is SK Hynix missing its lofty profit estimates. The shares have been down some 10%, now about 16% on the Kospi. So trading on the benchmark index halted again this morning for 20 minutes earlier, and the broader Asian index battling gravity as well. Now the AI woes spreading worldwide. You can see Eurostoxx 50 futures down 0.5%. Nasdaq futures down 0.6%. The Nasdaq already having ended yesterday's session on the brink of a technical correction. But flip cross asset now, because there we find another layer of uncertainty for investors who are already rotating out of tech stocks. Oil surging this morning, up 3.9% on Brent at $87 a barrel. On that fresh fighting in the Middle East, raising tensions, that boosting Treasury yields. The 10-year now quite steady, actually, 461 on the 10-year. But I've also thrown in the Bloomberg Dollar Spot Index here because it is Fed Day. It isn't moving much yet, but this is worth keeping an eye on. TD warning that the dollar could fall some 0.3% if the Fed holds rates with two or fewer dissents later. So watch out for that hawkish momentum building. It is a busy day ahead of us, particularly for earnings. Let's get started. We begin with breaking earnings from Deutsche Bank. Of course, the big question is how much European banks can continue the strength that we already saw on Wall Street, and analysts forecasting higher fixed income trading and potentially a second tranche of its share buyback. So what you are seeing are beats for second quarter fixed sales and trading revenue. They're planning a new €500 million buyback in the second half. They are saying that pre-tax profit also beat, and they're confirming that they're on track for strong full-year operating performance. Deutsche saying that it is firmly on track for its 2026 revenue ambition. So we're going to be hearing from the Deutsche Bank CFO Raja Akram later on this hour on Daybreak Europe. Deutsche Bank's traders seeing a 16% revenue rise to beat Wall Street. So lots to talk about with Akram later on in the on Bloomberg TV. Now let's turn to the broader markets now, and we have Korea's Kospi halted again. Let's get an update from Asia from Winnie Su in Hong Kong. Winnie, tell us more.
Yeah, good morning, Lizzie. Well, you just mentioned that with the Kospi here down more than 8% earlier today, it did trigger a circuit breaker. And in fact, this is the first time on record we've seen a back-to-back circuit breaker from yesterday already. So momentum is really unwinding very quickly for the South Korean market. And here, in fact, the losses are being mainly dragged down by SK Hynix, which is down about 12% today. Now, a couple of different factors. Mainly, it is the earnings missing by 6% compared to analyst estimate. But on top of that, also the rise in capex spending, as well as the lack of details when it comes to earnings call, where we didn't hear much when it comes to the shareholder returns and also the long-term contracts that the company is signing with some of its clients. So those are really creating those uneasiness when it comes to investor sentiment. Now, flip the board, I just want to show you to what extent really this market has been falling, because because, in fact, we did have a chart showing how the South Korean market has fallen by about 40% from its June peak, and it is taking its monthly losses to the biggest on record. Now, with the 40% drawdown so far this month, the July month has also made South Korea's Kospi index the worst performer compared to all of its other global peers. So you can see on this chart that really it is a very, very sharp turnaround when it comes to the story. Now, just going back to the chart when we also talk about the broader Asia market, because we are seeing MSCI Asia also extending those losses by more than 2%, which is coming after it already entered a technical correction territory just yesterday. And worth mentioning that we are also very closely watching out for the aftermath of that massive earthquake that hit Japan's Kumamoto prefecture yesterday. It is the prefecture and the area where we have lots of factories and lots of manufacturers. Some of the factories are in fact suspended right now, and we've also confirmed right now 13 people died from the earthquake. Now, with the big explosion at that Aeon Mall, we are seeing some gains when it comes to the construction stocks because of the expectation for further reconstruction around that region. Japanese yen here strengthening just a bit ahead of the Fed meeting and the Bank of Japan meeting expected to come this Friday. For now, we are expecting a hold. The only bright spot we're seeing today is in the textures in Hong Kong, strengthening by about 2%, coming as some rotation out of this AI trade and into the likes of EV shares, which are seeing some gains as expectation rise for the memory chip prices to ease further. Back to you, Lizzie.
Winnie, thank you very much. That's Bloomberg's Winnie Su out of Asia. Well, let's zoom in on SK Hynix, the heart of the Korea moves. Shares sharply lower, as Winnie says, after second quarter operating profit missed estimates, despite jumping more than 550%. Investors concerned the firm has earmarked at least $31 billion in capital spending this year. We could bring in our Bloomberg intelligence analyst, Masahiro Wakasugi. Masahiro, good morning to you. We know that SK Hynix shares are volatile, but just put these numbers into perspective for us. How should we interpret these results?
Right. Good morning. Yes, if we look at SK Hynix earnings, revenue was 5-6% below consensus, and the operating profit as well. And as you know, that Micron and Samsung reported a few weeks ago, and they delivered solid numbers. And probably SK Hynix issued ADR, so the market had a pretty high expectation. So, and if we look at the DRAM ASP increase and the NAND ASP increase, which was around 30% for DRAM and 55% for NAND in second quarter, and if we had 5, 6, 7 percentage point better ASP increase, SK Hynix might have achieved a consensus profit. So I think that probably the culprit could be the ASP in the second quarter. And the reason maybe we think that SK Hynix was mentioning that some kind of product delay or shift to the third quarter or fourth quarter. And if we look at the HBM revenue in the second quarter, which is included in the graphics segment, and the sales were not as strong as expected. So maybe the HBM revenue recognition could be the one of the reasons why we saw the a bit weaker result for SK Hynix.
Okay, really appreciate your insights. Bloomberg intelligence analyst Masahiro Wakasugi there. Thank you very much. Well, aside from the tech headwinds that are emanating out of South Korea, the other weight on stocks this morning is higher oil prices. Brent now up 3.6% to $87 a barrel after the US said that it had intercepted an attack on American military bases in the Middle East. US Central Command also said that US and Saudi forces had carried out strikes on Iran-backed militants in Iraq in response to attempted drone attacks on US forces. The attacks, of course, end days of relative calm. So let's get the latest now with Bloomberg's Abir Abu Omar, Horizons Middle East and Africa anchor, of course. Abir, good morning. Just bring us up to speed on the latest attacks and talks.
Good morning, Lizzie. So, unprompted, it looks like this is an Iranian attack on some U.S. military bases in the region. Just moments ago, we were seeing that Jordan was reporting 5 missile strikes by Iran as well on its grounds. And so we're seeing another escalation in the Middle East, followed by, as you have mentioned, days of calm. The United States had stopped its attacks on Friday unprompted. We don't have an explanation from the United States or President Trump on why those attacks have stopped, but that led Iran to suspend its own attacks on the region, albeit for just a couple of days, because we saw those fresh strikes by the IRGC on the region. And so we await and see what the U.S. does when it awakes, whether President Trump will decide to launch yet another round of strikes on Iran. He did say before all of this that he was planning a massive strike on Iran, only to stop a few days ago. Reports, Lizzie, of course, about the lack of munition or the diminishing munition by the United States have come about with President Trump denying them. In the midst of all of this, of course, we're keeping an eye out on the Strait of Hormuz and those talks between Iran and Oman to establish a middle passageway, if you were, and that is a passageway that hasn't been used throughout the course of the war, because Iran has been asking ships to stick to routes that are close to its borders by the northern side of the Strait of Hormuz. So those talks are still ongoing. We don't have reason to believe they're going to be finalized soon, but those remain to be seen. And then on the other hand, Lizzie, we also have the Red Sea, which has been seeing movement by the Yemen Houthis against Saudi Arabia. Saudi and the U.S. also striking militias backed by Iran in the eastern part of Iraq. And we have reason to believe that those were the first acknowledged such attacks by Saudi Arabia against Iraq in decades. And so an escalation on all fronts. We're actually seeing new fronts emerge in this war, but it remains to be seen. It's again wait and see mode yet again in the Middle East.
Abir, thank you. That's Bloomberg's Abir Abu Omar, who'll be back with Horizons Middle East and Africa at 5 a.m. London time tomorrow. Now, let's take a look at the risk events on the agenda for today. At 9:30 a.m. London time, we are going to get UK mortgage approvals. We've also got a raft of earnings, Airbus, L'Oreal among those reporting. Then, perhaps the highlight, 7 p.m. London time, the Fed decision. Could we see a surprise hike out of Kevin Warsh's second meeting at the helm? A credibility hike, despite the respite that we had seen in the Middle East conflict. Then even more earnings, this time on the tech front. We'll be hearing from Microsoft, Meta and Qualcomm, set against the context of course, those huge worries about AI capex that have surfaced in the SK Hynix story, hence yesterday's Nasdaq plunge. All of this very much in focus. But we have even more earnings to bring you. Still ahead on Daybreak Europe, we'll be speaking to the Standard Chartered CEO, Bill Winters, for an exclusive conversation to discuss his bank's results. That at 6:30 a.m. London time. First, though, we're going to count down to the Fed decision, with investors split on the central bank's path ahead. So that's next. This is Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got
got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome back to Bloomberg Daybreak Europe, 6:15 a.m. here in London. Well, the Fed is expected to hold rates steady later today, but traders are eyeing a near 1 in 3 chance of a surprise move higher as the central bank grapples with inflation pressures. With the preview, let's bring in Ben Ram, cross-asset strategist at Bloomberg MLive. And Ben, you've been telling us all week that a hike would be smart for Fed credibility. That should be a thing. That should be a word, shouldn't it? Fedibility. Decision day's here, though, now. Do you think that Kevin Walsh and his team are going to go for it?
Well, I think that the chances of his team going for it are not so minimal, because I think not least because if you look at the dot plot for June and what members penciled in, fully 8 members thought that the Fed rate should be higher than what it is now. So I wouldn't be surprised in the least if Kevin Walsh, and we didn't get Kevin Walsh's dot plot last month, as everyone knows by now, but so I wouldn't be surprised at all if Kevin Walsh voted for a hike and everyone else who's already inclined to take rates higher also votes with him. Now, having said that, I think that, if you look at inflation swaps, Lizzie, they are not telegraphing too much concern or too much angst about inflation in the US specifically, because US is a net energy inflation exporter. Let's keep that in mind. But I think that even so, there is something to be said for early action against inflation, because the inflationary pressures are broad-based, not just oil. And I think that there is something to be said for stamping out early inflation, because if you look at the 2021-2022 cycle, the Fed was behind the curve, and then they had to raise rates by as much as 75 basis points in a couple of meetings before bringing inflation to somewhat under control. I don't think that the Fed wants a repeat of that, and not least of whom is Kevin Walsh, because he's been repeatedly hawkish. So I wouldn't be surprised if he decides to take the first step today.
So how sharp a knee-jerk reaction could we see to this decision, Ben? I mean, across assets, we've already left the Nasdaq on the brink of a technical correction yesterday. How much pressure would a surprise hike add to US equities?
It would make U.S. equities look particularly vulnerable because this is not largely priced in. As you said, the markets see a 1 in 3, about a 30% chance of a rate hike today. So meaning the bulk of the market is not prepared for the Fed to raise rates. And if they come out and indeed raise rates, that will rattle the markets, definitely the bond markets, and send yields higher. And that will have a knee-jerk impact on equities, which will sell off about 2 to 3% on the day, regardless of what happens beyond that. But I think on the day, you will see a 2 to 3% sell-off in US equities, simply because the discount rate that you apply to earnings valuations will be higher. The discount rate will be higher, which means that the prospective earnings yield will be lower. And therefore, I think that stocks will feel the knee-jerk and will sell off.
Mm-hmm. All right, well, I said it yesterday, I'll say it again, Ben. Strap in for a bumpy ride today. Ben Ram there, cross-asset strategist at Bloomberg MLive. Coming up, though, we'll turn back to earnings and Rio Tinto raising its dividend as first-half profit soars. We'll bring you our exclusive conversation with the Rio CEO next. This is Bloomberg.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, we will be watching Rio Tinto at the open. It's already jumped in Australia after posting a jump in first half profit off the back of strong commodity prices. Now, the miner says it'll double down on efforts to cut costs and build cash by boosting productivity and selling non-core assets. And the CEO, Simon Trott, has been speaking to Bloomberg.
Iron ore remains a really strong market for us. We've been talking for years about the maturation of China growth, and you're certainly seeing that come through. It's been far more resilient than I think market pundits had expected because of that underlying demand. And whilst construction in China has slowed, you've seen a real pickup in export-related steel demand, so secondary and tertiary products. And that's led to fairly robust and stable pricing outcomes in the market. We continue to engage with all market participants, including CMRG. And so, through the ordinary course of business, we renew those contracts, and that's the phase we're in at the moment.
You've talked about that market evolving, though, and obviously at the moment that the economy is in a K-shaped recovery, and the property sector, fixed asset investment, probably isn't going to come back unless they return to the old economic playbook. Do you see the plateauing going downwards? What sort of a sharper slowdown might you be envisioning?
We've certainly seen over a period of years that construction segment slowing down, and it makes up a relatively smaller portion of our book now compared to 5-10 years ago, whereas really one of the big drivers. And as I say, you've seen that demand being replaced by export related, not necessarily steel exports of themselves, but related to the increase in manufacturing within China and those products flowing to the rest of the world. I think domestic supplies and scrap have probably been a bit less in terms of on the supply side than predictions, and so that's led to stronger pricing outcomes and pretty good cost support. Is probably the last point I'd make. Increases in raw materials, particularly energy, has meant that it's pretty well supported prices on the right-hand side of the cost curve.
Obviously, more strategically important going forward is the role of copper, right? And prices demand has held up pretty well this year. Beyond Oyu Tolgoi, where do we look next in terms of guaranteeing future demand?
So one of the things we outlined today is around 70% of the raw material cost of a data centre comes from the materials that we produce. So, aluminium, copper, lithium, as well as steel. And if you look forward, the spend next year on from hyperscalers, $1 trillion, and you convert that across, that's a lot of lithium, aluminium and copper. And so really excited about how we're positioned for the future. Fortunately, we've got Oyu Tolgoi, which is ramping up to the 500,000 tonnes of capacity. That ramp up's proceeding according to plan, and really pleased with the way that asset continues to perform. Kennecott in the US, one of only 2 copper smelters, and then a big pipeline of growth beyond that.
The Rio Tinto CEO Simon Trott there. Now to some other top stories we're following for you this morning. More earnings. Gucci sales fell less than expected in the second quarter as Kering looks to revive its largest brand. Comparable sales declined 2% against forecasts for a 3.3% drop, with improvement across all regions led by North America. Those results sent Kering shares sharply higher in the US session, so we shall continue to watch them in the European session. Elsewhere, ASM International has forecast third quarter revenue above analyst estimates, saying demand for its chip-making equipment is being driven by the global build-out of artificial intelligence infrastructure. And the CEO of ASM International will also be joining the opening trade just after 7 a.m. London time. Meanwhile, EssilorLuxottica says that revenue from its smart glasses nearly doubled in the second quarter, though overall revenue for the period missed expectations. The Ray-Ban owner has partnered with Meta to make smart glasses, but says growing competition has seen its shares fall nearly 40% this year. Its earnings eased some investor concerns, with operating margin beating expectations. Well, coming up on Daybreak Europe, new share buybacks from Deutsche Bank and Standard Chartered. As Europe's banks report, we'll bring you interviews with the Deutsche CFO and the Standard Chartered CEO. That's next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. When a six-fold surge in profits just isn't enough. SK Hynix slumps as the chip giant says capital spending will rise around 50% this year. The results dragging South Korea's cost be lower, now on track for its worst month ever. Meanwhile, oil rebounds as the US says it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's Federal Reserve decision. And 3 of Europe's biggest banks report. Standard Chartered, UBS and Deutsche Bank all beating profit expectations. We'll hear from executives at all 3 lenders. Well, a very good morning. If you are just joining us, 6:28 a.m. here in London. This is the picture in markets this morning. We have to start with the Kospi yet again, currently down 6.7%. We've seen the index closed for trading, halted again for 20 minutes after an 8% decline earlier on in the session. It comes back to SK Hynix. We've seen double-digit losses on the shares this morning after it missed its lofty profit expectations, and we have futures pointing lower on both sides of the Atlantic week as well. Flip cross asset, and you can find another reason there. Oil surging on Brent. We are at $87 a barrel because of the latest Middle East tensions. That boosting Treasury yield, and we're keeping an eye on the dollar, of course, in case of a potential surprise from the Federal Reserve. Is it going to hold rates with 2 or fewer dissents later? TD warning the dollar could fall some 0.3% if that is the case. Now, let's turn back to earnings. Deutsche Bank announcing a new €500 million share buyback programme. Let's hear from its CFO.
Not only is it a record second quarter, but it's also a record first half for us. But what's extremely pleasing is you mentioned the significant beat on investment banking, but actually we had record flows from asset management, almost 9% growth from our private bank. Corporate bank is continuing to show signs of progress, which we assumed. Continuing to invest across the franchise. Capital position strong. We announced another buyback today. So I think all in all, I would say in this political and geopolitical environment, I think these are stellar results.
And I want to get into some of the different sort of sections there, but thinking about kind of now going into the third quarter, have you seen those trends remain kind of intact, particularly on the trading side? Is this something that we're going to see again in the third quarter?
Yeah, again, July started pretty constructively on the trading side. It's kind of continued the momentum from June. So as I look at both on the market side and on the investment banking side, I think the pipelines look pretty full. So it gives me a lot of optimism that the second half of the year could potentially be as strong as the first half.
And also thinking about this share buyback that you've announced now, 500 million euros, which is in line with a lot of what the analysts were looking for. What is also notable about it is it's the first time you do it from the in-year net profit, right? What does that tell us about kind of the potential looking forward in terms of the buyback policy over at Deutsche Bank? Does that give you more kind of leeway to do actually more in the coming years?
Yeah, look, the buyback is exactly in line with the communication we did at the Investor Day, that we would like to shift to an in-year buyback. And I think from my perspective, it exhibits two things. One is the earnings power of the company, and two, the confidence that we have that we can actually execute these buybacks as we generate those earnings, because we have a good look towards the future. So it's actually going from 50% of our net income to 60%, and doing it earlier. So I think from my perspective, it's great for the shareholder because they get more and they get it earlier. And as we said in our Investor Day, once our ratio is sustainably about 14%, we will do excess share buybacks, consider excess share buybacks. So, and the cadence that we have just means that once we get to that point, investors can expect to get that earlier than they normally would.
Looking into the back half of this year, the beginning of next year, we're expecting some very large IPOs, Anthropic, potentially OpenAI as well. Are those deals that you could potentially be a part of? What does the pipeline look like?
So just looking backwards, we were involved in 3 of the largest deals in the first half of the year, as probably one of the only European banks that actually participated. Without going into specific names, I think we are set pretty well to participate in future deal activity. And remember, the deal activity in U.S. has been exceptionally strong in the first 6 months. Europe has been kind of muted. As Europe picks up, we're actually going to be an outsized beneficiary of that trajectory.
And so what is your expectation in terms of deals in Europe? Because, we've talked about the revival of the market for quite some time. Yeah. Is that something that you see as imminent?
We saw a little bit sideways in the first half. We clearly didn't see the same level of wallet share growth that we saw in the U.S., but thankfully we are present in the U.S. We have competitive skills there. I think Europe seems to be picking up. Now, whether it will be of the same magnitude that we saw in the U.S., that remains to be seen. But as I look at the second half pipeline, it's across U.S. and Europe.
And so you're painting a very sort of positive picture. How does that bear on your revenue targets? You say that you can, obviously the goal is for 33 billion euros this year. Is that something that you are likely to beat, given just the conditions that you're describing?
So look, first half is usually traditionally always stronger, and the second half quarter also has been great. I would say, while we're not updating the number was approximately 33 billion. As I sit here today, I think we will be comfortably getting to that number. And if things go well, potentially a little bit better.
A very upbeat Deutsche Bank CFO Raja Akram there speaking to Bloomberg's Chief Europe correspondent Oliver Crook. Well, staying with bank earnings, Standard Chartered has announced a $1 billion share buyback as it reported second quarter earnings that also beat expectations. The London-based lender posted a pre-tax profit of $2.33 billion for the 3 months through June, exceeding a Bloomberg compiled estimate of $2.08 billion. I'm pleased to say the Standard Chartered CEO, Bill Winters, joins me now. Bill, really great to have you back. A record first half. You must be smiling as well. But we've seen beats for Deutsche there. We've seen for UBS as well, and on Wall Street. The bar is high. What's your message to shareholders mid-year?
Look, we're obviously very happy with the first half earnings, the second quarter earnings. The environment is good, as you just noted. Other banks are also having a good run. I guess what we'll be looking at is how sustainable is this good run. We feel very, very good about the momentum that we've got. The second quarter for us was everything from our wealth business to our banking business to the day-to-day activity in our financial markets business is growing at double-digit or stronger rates. So that we think bodes very well for the future, which may be a continuation of this trend for some time. The underlying support pillars are really quite strong. If there's some sort of a correction or an adjustment to the economy or something like that, I think we've also demonstrated that we're extremely resilient. So we have no observable credit losses. We've been quite cautious in terms of taking some precautionary provisions, but really very small in the overall scheme of things. And no underlying credit problems. So the combination of like good downside protection and very strong upside momentum, we think puts us in a good place.
So you've announced this $1 billion buyback. What does that say about the international banking industry at this point, that you're using the capital to repurchase your own stock rather than building a war chest for acquisition?
Well, thankfully, we've got a very strong capital position. So our CET1 ratio, the ratio that is the indication of our aggregate capital, is 14.2%, which is extremely strong. So even after the buyback, we'll still be in the top half of the range that we indicate. So we've got a very strong capital position, super strong balance sheet, as evidenced by the fact that we just don't have material loan impairments, and an extremely liquid balance sheet, as we typically do, but we're at the top end of our range. So for all those reasons, we're protected against whatever pullback or surprise may come. But we are investing fully in the business. So, $1 billion buyback, but we're investing, well over $2 billion of cash into our business year after year after year and growing. So, first and foremost, we invest in growth.
Yeah.
We take the surplus and return it to shareholders.
Well, OK, with all that good news in mind, you've got shares trading at or close to all-time highs. How much further could the stock rise from here? The current target is about £22, I think. We're trading at about £21.30. Is 25 or even 30 a possibility during your tenure as CEO?
Yeah, I've been instructed never to predict a stock price. But I'll make a few observations. One is at something like 9.5 times earnings. For a stock that's generating earnings per share growth in the high double digits, so 18, 19, 20% compound growth, those two things don't sync. Right? I mean, we're a growth stock, and we've demonstrated that for about 5 years now. The underlying drivers of growth are very good. We've got an ongoing transformation program, which is making us more and more efficient every year. And we're doing that with a very focused effort on reskilling our employees for the future. And those things say to me, as a growth company in growth markets, we should probably be trading at a higher price earnings multiple. Okay. But that's for the market to decide. OK,
well, I'm sure they'll have a read on your company later on this morning. Look, Bill, I haven't had a chance to ask you personally about your comments on AI. You know what they are. They were widely reported. On AI replacing lower value human capital. You've apologised for them. Since then, though, have you had more thoughts about how your bank and other companies should be introducing AI to your businesses?
Yeah. Well, first of all, thanks for raising that. But let's start by being clear what I said. What I said was that it's critical for a corporation, it's essential, and it's a strategy for us to invest in our colleagues well ahead of the automation or AI. This has been going on for years, and we've been automating processes from the beginning of time, well before the role is eliminated, because roles have been and will continue to be eliminated by automation, to invest in the skills in our colleagues that allow them to be productive members of our community in the new world.
But you've humanized the language. Have you humanized the approach?
Well, I think it was extremely human before. So what I said was, if we don't make that investment in our colleagues, which we do, it's a corporate responsibility. If we don't, then we'll have roles being eliminated in favor of the machines. Right? My comment was exactly the opposite. We value our employees extremely highly, which is why we make those investments in the first place. Of course, it got reported the other way around because it's a good headline, but that's life.
OK. Well, on AI, what's your view about Chinese versus US AI models? Is good enough and a bit cheaper good enough for you?
I'm sure that there will be convergence over time. So obviously, in particular, the frontier labs in the U.S. have invested very heavily. to train their models in the first instance. We're finding that the Chinese are investing very heavily to deliver a lower cost of inference, so the actual application of these trained models. The U.S. will also, the frontier labs and the hyperscalers and others who are very active in the space will converge onto some common technologies over time. But we know that net, in order for the existing investment to generate a return, there's going to be pressure on prices, which just doubles down the need for us to continue to be investing in our transformation and productivity to absorb those increases.
But then do you see more of your future token spend going to Chinese providers than at the moment?
So we use a range of models today. In China, we're using almost exclusively Chinese models. Obviously, we have a big Chinese business. In the West, we're using almost exclusively, I think we can say exclusively, Western models, which means U.S. for the most part. And they are, for many tasks, they're similarly capable. For some cutting-edge tasks, you'll want to have one model versus another. And I think what will happen through time is that the aggregators, and whether that's companies like Microsoft or Google or users like us, will find a way to plug in different models for different uses.
How concerned has the bank been about changes in Chinese policy on cross-border financial flows? Could that impact the growth of your wealth business?
So we're very happy with the progress of the wealth business in the second quarter, which was the time during which all the speculation arose. So we've seen no discernible change in our flow of activity through the quarter. What we take from the various pronouncements, and there have been a few, I think, probably unrelated things, but maybe they have something in common, which is that the Chinese saying we are internationalizing our currency. The RMB is internationalizing. Capital markets are opening up. It's been happening for 25 years, kind of slowly and steadily. But they've been reinforcing the fact that that's the direction of travel. But what they've said is we have a set of rules, and we expect everybody to follow those rules as we open up. So they sanctioned some offshore securities companies earlier in the quarter, and that sent a bit of a ripple through the market. Maybe they're changing the underlying intention. We see no sign that the underlying intention is changing. But we do see a crackdown on compliance. And, of course, we've seen a crackdown on tax compliance as well. This is very normal, I think. We see that in the U.S. and Europe and Japan and Korea all the time. This is just Chinese doing it their way.
Just finally, let's talk about the macro backdrop. How worried are you about the movements that we're seeing in energy prices? Oil's higher again today. Do you think that the main risks around the Iran war are priced in already?
Very hard to say. So obviously it's been a volatile environment from day to day. At this sort of energy price, in the $85 to $90 per oil range, the economy has demonstrated pretty extraordinary resilience. Obviously, for an extended period of time, we begin to worry about some of the actual supply chain shocks. Are the feedstocks for petrochemicals actually making it out of the Gulf or being replaced elsewhere? And certainly some corporations, some emerging markets, some sovereigns, will begin to be tested if we have a very long period of these elevated energy prices. But so far, the resilience has been extraordinary.
Bill, always great to have you in with us. Standard Chartered CEO Bill Winters there. Thank you very much for your time.
Thank you.
Well, staying with the bank earnings, UBS has also posted second quarter net income that beat estimates and announced a new share buyback programme. Theirs worth $3 billion. The Swiss lender benefited from a surge in trading activity and bought in new assets from wealth management clients than expected. But UBS was cautious on the outlook for the upcoming quarter, given the ongoing geopolitical uncertainty and volatile energy prices. We'll be hearing from the UBS CEO as well. That's Sergio Ermotti, of course. He'll be on the opening trade at 7 a.m. London time. Well, coming up on Daybreak Europe, big questions over massive AI spending. Will Meta and Microsoft have the answers when they report later? I'll bring you a preview of those reports next. This is Bloomberg.
Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly. Welcome to my workplace.
Do you feel pressure?
Massive.
massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe, 6:45 a.m. here in London. Well, we're hoping to get a good read of the global tech picture later when even more of the Mag 7 report their latest results. We'll get Microsoft, that's expected to produce strong sales growth, while investors wait for news on Meta's efforts to build a cloud business. That could open new revenue streams as well. Let's bring in Bloomberg senior strategist Neil Campling for a preview now. Neil, what are you expecting from these two? Is it going to be actually more of this less is more narrative when it comes to capex in terms of the investor reaction?
Yeah, I mean, we had the kind of warning signs, if you like, from Alphabet last week in terms of that, you know, the spend to build out these AI ecosystems is substantial in terms of the capex required. So you have to offset that spending with high sales growth. So you need to look for the top line growth numbers for both companies, and then what we're going to see in terms of free cash flow, and then also the capex spend as well. Microsoft, in terms of the partnership with OpenAI, that'll be a question on the call. The spending will clearly be, will they be matching Alphabet and trying to build out the system? Whereas Meta need to spend to kind of look for these new revenue streams, as you mentioned. But at the same time, this company has delivered almost $50 billion of free cash flow over the last 12 months. And forecasts are that this could turn negative going forward. So that's a big question in terms of that risk and how investors look to offset the concerns around that free cash flow relative to growth.
OK, so that's on the earnings front. I also want to ask you about this political intervention from Mark Zuckerberg this morning. We were actually just talking about US versus Chinese AI with Bill Winters from Standard Chartered. But Zuckerberg basically speaking out against the US restrictions on Chinese AI models. What do you make of it?
I think that's because probably for Meta, if you look at their positioning, they just want the access to the cheapest possible AI in terms of token costs being lower, so they can build out their own ecosystem with the best tool set that there is, so they can try and make better returns on their investment. But that does, as you mentioned, create some of the tensions here between these frontier models in different places. And we've seen a lot of concerns as to allowing access to some of the US models through bad actors coming from other countries. So there is that issue, as well as IP around, you know, the technology IP. There's basically been a battle between China and the US. And so I don't think Washington are anytime soon going to allow broad access to the Chinese models because of that concern, I'd say.
OK, really interesting, Neil. Thank you so much. That's Bloomberg senior strategist Neil Campling, who it's fair to say has a busy 24 hours ahead of him. Now, to some other top stories that we're following for you this morning. Bloomberg understands that European football governing body UEFA is considering a boycott of FIFA events. It comes after FIFA unveiled proposals that would see it seek private investment for the first time, looking to raise as much as $4.2 billion. UEFA said the plan crosses a line, and internal talks are said to have taken place about clubs and national associations not attending events, including the World Cup and Club World Cup. Elsewhere, Ukrainian President Volodymyr Zelensky says he discussed Patriot air defences and diplomatic efforts to end Russia's war during his White House meeting with President Trump. Zelensky described the talks as productive as Kyiv looks for ways to deter intensifying Russian missile and drone attacks. And it was a busy day for Donald Trump because the president also welcomed Israeli Prime Minister Benjamin Netanyahu to the White House, with the war straining ties between two normally staunch allies. Netanyahu was in Washington for the funeral, of course, of Senator Lindsey Graham, a long-time Iran hawk. Now coming to Europe, authorities in France and Spain are racing to contain wildfires threatening Bordeaux and Madrid before temperatures rise again. Hundreds of firefighters in France are still trying to bring a blaze in Gironde under control, while the advance of a major fire in Spain has been contained overnight. The president of the Madrid region says the situation is improving little by little. Well, we have plenty more coming up for you on Daybreak Europe. We'll look ahead to the Fed decision later on today. Stay with us. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
I think they stand hold, and they'll probably still have this tough guy language with this hawkish language that gives them wiggle room. So I think that putting these people on these special task force buys Chairman Warsh time.
The Meredith Whitney Advisory Group CEO speaking ahead of today's Fed rate decision. Well, she may expect a hawkish hold, but not everybody does. If you take a look at the bets for a hike, they've been building both for today's meeting and for September, though they do seem to have somewhat peaked most recently. But flip the board and we can take a look at this another way, because futures tied to the Fed's interest rate surging to all-time highs as traders brace for those hikes. We have seen Chairman Warsh's deliberate abandonment of forward guidance, arguably making this outcome genuinely uncertain. So you could argue that today's Fed decision is the most consequential event on the docket for markets this week. Citadel, Deutsche and Bloomberg Opinion all saying that it's more than plausible that you actually do get a hike, more so than consensus applies. Now, if we take a look at the potential market reaction, flip one more time, a surprise hike would likely trigger a dollar spike, as we've been hearing from our colleague Ven Ram. Later, you'd see pressure possibly on equities, but TD warning that the dollar's set to drop if the Fed holds with two or fewer dissents. But you can see the dollar's rise in context of the gold moves as well. Gold extending its pullback this morning. We've been also keeping an eye, of course, on the Middle East tensions. Coming up in just a few minutes, the CEOs of UBS and ASM International will join the opening trade to discuss earnings. The opening trade up next with Anna and me. This is Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Good morning, everybody. It's Wednesday, July the 29th. Here's what's on the agenda. From luxury to banking, it is a huge day for European earnings, with an uncertain Fed meeting still ahead. Another tough day in Seoul as SK Hynix disappoints, and we wait for big tech to report. Plus, oil's up more than 3% as Iran fires unsuccessfully at US bases, puncturing days of calm. Lizzie.
Well, let's see how that SK Hynix disappointment is weighing on the Kospi this morning. It's already been shut again for 20 minutes earlier in the session, now down 6.7%. That's dragging down Asian stocks more broadly. But we've also got to factor in the latest tensions in the Middle East. So Brent is higher, 3.7% at $87 a barrel this morning, Anna. And yet we have Eurostoxx futures 50 futures not as bad as we're seeing from NASDAQ futures. For the NASDAQ yesterday, it was on the brink of correction territory, but Eurostoxx 50 futures getting a little bit of boost from all those banks beating estimates this morning. So despite the higher oil price, the countdown to the opening trade starts right now.
Welcome to the programme, everybody. 6:58 here in London. A little bit earlier start to the programme than usual because we want to get to our interview with Sergio Motti, which we'll do in just a moment, Lizzie. And that explains where Guy is, because he has been speaking to Sergio Motti. But let's deal with what we've heard from UBS so far. I mean, better than expected on many metrics. If you're looking at the net profit, pre-tax profit, wealth management, investment banking, the only area that I identified from the headlines earlier where maybe it was a little lighter on pre-tax profit was asset management. But broadly speaking, these numbers coming in ahead of estimates.
Yeah, the wealth business has been, the US wealth business has been UBS's problem child, we should note. But, you know, we've seen good results from Deutsche. We've seen them from Standard Chartered this morning. I was speaking to Bill Winters, the Standard Chartered CEO, just a few minutes ago. It's a high bar when also we've seen such great results out of Wall Street as well. The question is, does it set us up for resilience in the second half of the year?
Yeah, absolutely. And there are added questions about the second half of the year, or where things go later in the year with UBS, because there are questions around the capital structure and how much the government has yet to get involved and further influence the capital structure. This is a process that will go out into 2027. It's all still on the back of the consolidation that we saw in the Swiss banking sector and the demise of Credit Suisse. So Guy Johnson went to speak to Sergio Motti, the CEO of UBS, and wanted to get a sense from him about the buyback and whether there was any kind of messaging within the structure of the buyback, because they've gone with this structure that means they've announced a $1 billion buyback over the next 3 months and $3 billion over the next year. And so Guy wanted to understand whether there was any message in here, given the uncertainty about the bank's future capital requirements.
The issue is that what we have is this programs that we have to file with the stock exchange in terms of buyback programs that we can execute in theory over 2 years. And our capital return policy and ambition has been set at the beginning of 2026 when we say that our aim was basically to start with 3 billion and then assess the situation at the end of the first half. So what we do now is we have a new plan, a new program that, and we intend to execute it over the next 12 months. But the pace and size will be determined by our capital position, so staying at 14%, and also the ongoing development in the business, which we are very positive of, but also the ongoing discussion on too big to fail, like we did in the last 2 years. The language hasn't really changed.
The language hasn't really changed, so I shouldn't expect in 3 months' time some clarity on too big to fail.
The billion has to be seen as a minimum commitment that we will do, rather than putting a clear indication on anything more than that.
Equities, very strong. Plus 53%, I think, is the number. That's a nice number. The surprising thing is that you've done it without any extra capital. That's the real standout here. Let me ask you the same question I asked Venkat at Barclays yesterday. If you'd have given that division a bit more extra capital, if you'd have funded it differently, if you'd have provided more for it, could that number have been significantly higher? Are you throttling back equities at the moment? How high could that number be?
Not really. Actually, what we did, the point you raised is a good point, but what we did within the investment bank, we also shifted some capital from the fixed income businesses to the equity business to help them. But our focus is really, which I also believe that the numbers are very strong because they are mainly driven by intermediation activities. And rather than deploying capital in prime brokerage. But going back to your story, this is more about our strategic capital allocation at group level. We made that decision in 2012 that our investment bank fits strategic ambitions that we have to support our wealth management clients, our institutional clients, our corporate clients, but with a defined capital allocation. So we had ups and downs in times in which was very rewarding to have that, and times in which you may have some opportunity cost. But when I look at the full results, a 23% return on allocated capital for the investment bank is pretty strong result. So we are very happy with it.
Okay, but let's the opportunity cost. Let's just talk about the opportunity.
Yeah, but the opportunity cost.
JPM did 86%. Yeah, could you have done that kind of number?
Yeah, but is not something. If and when doesn't matter, because I think our philosophy, our capital allocation, and our stock is rewarded by this business mix and not by taking opportunistic and tactical view on momentum in any of our businesses.
Do you think if you were a US bank, you'd do something close to, 86% for JPM, Goldman Sachs did 71%. If you were a US bank, do you think you'd get those kinds?
It's too hypothetical to answer that question.
Well,
we are not a US bank, we are a Swiss bank, and we are very happy with that kind of business.
You can see where I'm going with that, if you re-domiciled. Is there a cost to being a Swiss bank?
I think there are also a lot of good opportunities, but of course things have to be fully balanced. But I'm very happy with our results and what we achieved as a business mix, right? So if you look at wealth management, you look at the Swiss business, asset management, and the investment bank all together put up a very strong set of results.
That was the UBS CEO, Sergio Ermotti, speaking to Guy Johnson, of course, talking about a range of topics very pertinent to the broader earnings story, Lizzie, but also the specifics around this particular Swiss bank.
Yeah, well, if we haven't had enough earnings already this morning, more to come. We've got European earnings due after market from Airbus and L'Oreal. Of course, it is also Fed Day, so we've got the decision at 7 p.m. London time, that followed by the press conference from Kevin Walsh, the chairman, and then we get even more earnings tech-wise from Microsoft, Meta and Qualcomm, both all due after market stateside. Now, let's just focus in for a minute on Fed Day, lest we forget that what a consequential event this could be for markets this week. Arguably, it could be the most consequential thing. So many commentators, banks out there saying that it is more than the consensus suggests is plausible, that we actually get a surprise hike from Kevin Warsh. And, speaking to Ben Ram, he's saying this is needed from Warsh for credibility. And so the hike bets have been building, not just for today, also for September. And you've got the futures tied to the Fed's interest rate at all-time highs because traders really braced for these hikes. So we could get quite a surprising market reaction.
Yeah.
If you look at equities, such a miserable day for the Nasdaq yesterday, you could see even more pressure on the Nasdaq. If you see a surprise hike, you could see a dollar spike. You could see a drop if the Fed holds. This is according to TD. If you get 2 or fewer dissents, so a lot of focus on the Fed later on.
Absolutely, a lot of focus on those dissents. And are we just going to have to get used to a lot more volatility in markets, whatever the Fed decides, because we're going to have a lack of conviction, probably going into every Fed meeting, aren't we? Because everyone's going to come up with different arguments based on the data. I mean, if you wanted to hike, then you've got reasons to do it. And you've been above target for a number of years, increased the inflation-fighting credibility of the Fed. Reversing the insurance cuts could be the way that it's thought about by some. If you don't want to, then you can argue that a lot of the higher energy prices are just temporary, tariffs are temporary. And actually, the most recent CPI showed a little bit of a downdraft, didn't it, for inflation? Is that too backward-looking given the subsequent spike we saw in oil prices?
Yeah.
But, you can argue it either way, and maybe that's exactly how Kevin Warsh wants it to be.
And that was exactly the piece of data that Donald Trump pointed to when he yet again pushed for lower rates.
Yeah, we'll watch if we get any political contribution on that rate story. Let's talk about what else is ahead. And you mentioned it in looking at what is on the trading day ahead there, Lizzie, talking about the tech earnings. We have a number of tech earnings to talk about, but we also, of course, have numbers out of SK Hynix, and that feeds into the backstory for these hyperscaler earnings. So if we just focus on the SK Hynix numbers for a moment, the company's saying that demand is going to run ahead of supply out to 2030. There's a memory shortage. It's going to persist out beyond 2030. They announced record CapEx plans, which is the thing that makes the market nervous, despite the fact that net profits up by, I don't like using percentages in this context, but I will do, 1,200% net profit is increased. Operating profit up by 550%. So these, on some measures, were incredible numbers, but the market was waiting for something that was incredible plus, and we didn't quite get it. And so the stock itself down considerably, adding up to a difficult day for the Kospi, down for 2 days. SK Hynix down by 45% just over the past month. And we're waiting for a lot of tech earnings from the United States, which, of course, ties into the same theme, the AI build-out. Microsoft, Meta, Qualcomm, all set to report later on today.
Yeah, there's a really great superlative from one of our colleagues earlier that this current bout of volatility for Korea is more than the most volatile quarter of most major markets at any point in their history. So you could go back nearly 100 years and we're at that point.
Yeah, absolutely. So certainly a lot of focus on Korea and whether that volatility is warranted, desirable and spreading around the world. Let's talk about that with Anthony Stevens, who joins us now, our colleague in Hong Kong, of course. Anthony, give us your thoughts on the market response to these SK Hynix numbers, because we've seen incredible jumps in profitability, the charts going round and round, operating profit jumping really strongly, look quite incredible, and yet the stock drops. I just wonder if the stock performance is attached to the news flow for SK Hynix anymore. Such is the expectation here.
Yeah, expectations are the key moment. It's not the absolute number. It's what does the market expect. And on the operating profit side, it was a clean miss versus those expectations. And it's important to put those expectations in context. There are 45 buys on this stock and 0 sells. And the debate around the strength of that result and how far that Hynix can hang on to 80% plus margins, that is what is driving the 15% intraday swing in the Kospi today. So there was a very early bump as people, as you correctly said, they focused on how big these numbers are on an absolute basis, how fast the growth is, how strong the pricing power is. But then over the course of the session and into the analyst call, you heard these rather aggressive questions from the Korean domestic broker base in particular about the sustainability of the AI boom and the pricing power maintenance that Hynix will be able to hold. So they were quite defensive about their HBM position. They said that it's a very strong strong technological moat that should hold into the next couple of years. They're also talking about mass producing their next generation of HBM, HBM4E. So there was some positive pushback from the company, but instead the street is functioning on show me the money now, the operating profit that we expected, and further, tell me about your shareholder return program. That was another kind of disappointment to the market. There was nothing announced, and that was put down to the fact that they've just released an ADR, and they're kind of constrained on that front. So what's very interesting to see in the next couple of days is how will the street respond to this earnings result. Bear in mind the median street or the average street an analyst rating on this stock is a buy, and the target price is almost double where the stock is right now. So there is some adjustment that is probably going to come from the street, and what does that look like going forward? Now, in terms of the last thing, the elephant in the room, is how much can Chinese competition disrupt this HBM market, disrupt the DRAM market, disrupt the NAND market? And we did see how sensitive Hynix is to those changes in its results, because a slight shift in the product mix caused the OP miss.
So we know that this is a typically volatile stock, but how much should we read into these big moves, Anthony? Should we be worried about AI slowing down, being over, supply chain risks as well?
Yeah, it's a very interesting confluence of flow and fundamentals here, right? The flow, first of all, let's address that. It's massive. Today, for example, in Korea, you're seeing local domestics, buy a couple of $1 billion, again selling from foreigners and individuals. Individuals are very long Hynix, as you guys have been covering, on the leverage ETF front in both the US and in Korea and in Hong Kong. So how much of that cutting has to continue? How much de-risking has to happen for volatility of this size? Because this is a core large position. Core large positions are not supposed to swing 15% intraday. So people have to adjust their position sizing to this volatility, to the first half of your point. In the second half of your point, we continue to be exposed to a very rapidly growing Chinese disruption. And the pace of the Chinese disruption seems to be increasing into the back end of this year as China catches up from the hardware and software side. So what advances will come out of China that kind of look to erode this HBM advantage Korea has, that is going to be a fundamental driver. And it's really interesting to see the street react to this confluence of events. There's a lot of flow notes out there. There's a lot of fundamental technology analysis. But in truth, we are going to move from a binary kind of price action to really detailed focused trading of tech in the back half of the year. We've seen that significant dispersion in the tech trade in the US, and that's coming to Asia probably.
OK, Anthony, thank you very much. That's Bloomberg's Anthony Stevens on those SK Hynix numbers. But coming up, oil surging as fresh fighting erupts across the Middle East. We'll bring you the latest. Plus, Kering ADRs surging by the biggest intraday rise on record after the luxury goods maker reported better than expected revenue for its Gucci brand. We'll dig into the luxury sector. But up next, more earnings coverage, an exclusive conversation with the ASM International CEO, Ishem Msad. Now, if you've got any questions of your own for our guests, please do send them to us on IB+BB TV Go. We'll have a go at putting them to our guests. Thank you. This is Bloomberg.
bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Shevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Forty-three minutes away from the opening trade, and here is the picture for European futures. Eurostoxx 50 futures down 0.2%, but we could see bright spots for the FTSE 100 and the CAC 40 in Paris. Of course, we're seeing higher oil prices, so energy could boost the FTSE, but it could drag down the broader sentiment. We've also got to factor in the beats from banks, as we've been discussing, and the broader tech story. Another day of misery for the Kospi. How much is that going to feed into the European stock picture this morning, Anna?
Yeah, let's talk about the earnings picture that we're digesting. ASM International has forecast revenue for the third quarter that beat analyst estimates. The Dutch company says demand for its chip-making equipment is being driven by the global build-out of artificial intelligence infrastructure. Joining us now for his first ever TV interview, I'm very pleased to say that Hisham Emsad is with us, the CEO of ASM International. Thank you so much, Hisham, for joining us and for coming to speak to us. I noticed that your ADRs, your US listing, the stock was a little weaker on some of the second quarter dynamics that you've reported, but you've upgraded your guidance looking ahead. So I wonder what kind of visibility you have around this updated guidance.
Okay, thank you very much, Anna. And it's my pleasure to have this interview with Bloomberg. As you have seen in our Q2 results, we are very excited about where we stand as a semiconductor equipment company in this AI age. We have a significant increase in our revenue. For the first time, we have actually reached 1 billion in revenue per quarter. We are also very profitable. And most importantly, actually, we've been able to execute in an environment which is really driven by lots of supply chain issue and so on. But also at the same time, we are very confident about the future. And that's why we upgraded our guidance for the second half of 2026 to greater than 20% revenue in the second half versus the first half. Not only that, we've been working with our customers, and we actually also have upgraded our guidance for 2027, where we see very good visibility for us in the future.
Okay, so you have very good visibility into the future, which is interesting. So, I mean, your business then, Hisham, it makes the equipment that makes the advanced logic chips, and the more layers there are on those chips, the more work there is for you and your equipment to do. So what assumptions are you making about layering, about the intensity of that layering into the future? Are we going to see a pickup there, a step change there?
Yeah, I think what's really driving our growth is really the technology is moving into high performance. And high performance right now is being driven more than anything else, is being driven by AI. But also high performance can be driven by mobile devices and high performance computing. But what's happening is to get the high performance, you actually need new materials because you cannot shrink anymore. And the new materials, we are actually a materials discovery company. We are a company that develops and discovers new material to allow you to get the performance that's needed. So we actually at the sweet spot of the semiconductor industry. And the materials that we develop makes the chips faster, makes them run more efficient, using less energy. They make them also have a higher density of storage. And so not only we're working in logic, but also we're working in memory and advanced packaging. So the industry by itself has moved from getting performance through shrinking, from getting performance through new materials, because materials provide you the performance. The other thing that we have seen, that device complexity is becoming more and more important. So as you make things smaller, you cannot. You need to go to 3D. You need to actually, device complexity is moving more and more to the top, because we cannot increase the size of the chip. So as you go to 3D devices, which we see in logic and which we see in memory, then complexity of the process becomes an issue. And with the process complexity, you need to have much better precision. And to get the precision, the best technology to do these films are ALD, and we are an ALD leader from that point of view. So we're very excited that, okay, the industry...
Hisham, let me just interrupt you, because it's Lizzie here in London. I want to just come into you and ask about this broader sell-off in chip stocks as well, because it does continue. We've seen misery on the Nasdaq yesterday. We've seen misery on the Kospi this morning. How concerned should investors be about the sustainability of the AI boom? What's your take on all of this?
I think that the semiconductor industry, I've been in the semiconductor industry for the last 32 years, and I've been through many, many cycles since the 1990s. So a semiconductor cycle is the name of the game, and it's something that's very normal. But what's very important is that the fundamentals for AI in the medium and long term are still there. So we're really not concerned from this point of view. And as far as we're concerned, okay, what's happening is that the need for leading edge technology is going to continue unabated for a company like us. It's being driven right now by AI, and it's needed to be driven by AI, but also can be driven, like I mentioned, by mobile devices and high performance computing. And I think this is something that's normal, that's happening, but actually we're looking into the long term, and the fundamentals are very, very strong for us and for the industry for the future.
Well, just give us more detail then on ASM's exposure to the memory chips market, and really how you see things progressing this year and into 2027.
I think that ASM has been for a long time, like you say, like a logic company. Why? Because we were like an ALD company, and in logic you use lots of ALD. But what changed recently is that also memory needs to have very high performance. And the way to get high performance, actually, you need new material. And the best technology to make new materials is ALD. ALD is the best technology. So we see lots of inroads and equipment sales for our technology in memory right now, because customers need performance, and we provide performance for them. So we're starting for a very small base, but we see extremely very significant increase in our interaction with memory customers. We see it with all the memory customers in the world. We see also we have very good visibility because we're working with them on the next generation and so on. And we see them, we see many of our technology in ALD actually being incorporated in their generation, right, like D1C or D1D generation, but also looking for a new transition when the memory is going to move to a 4F squared and 3D. You also need more and more of our technology.
Hisham, I wonder how much you're thinking about Chinese competition right now. We've seen in other areas of the Dutch technology landscape concern about that this week. And I wonder how concerned you are about how quickly the Chinese are developing competitive products in the chip equipment manufacturing space.
I think China has been developing products for many, many years, and they have a strategy to actually have localization. For China, what I'm trying to say here is that where we work in China, we work in China in mature technology nodes. So for the rest of the world, we sell our products in leading edge. But in China, it's really mainly mature technology nodes for both logic and for memory. So that's really the sweet spot of our market. But also we sell in China in the power wafer analog part of the market. And we've been very successful to compete in China against a local supplier. And we had head-to-head competition with some of them. And we see our position actually staying very strong because we're providing value to the customer and we're providing innovation. If you see what we do to compete, I mean, it's for us, we have been competing with the big guys everywhere in the world as a small company. So I think we know how to compete, and China is a competition there. Yeah, you just have to innovate, and that's really our DNA. And we see very good acceptance of our technology in China.
Okay.
And our China business in technology node is actually very strong because of that.
Hisham, thank you so much. Thank you very much for joining us. Come and speak to us again. Hisham Emsad, the ASM International CEO. Lizzie.
Well, let's take you through what else you need to know this morning. An OpenAI agent that breached systems at the startup Hugging Face earlier this month has also compromised a customer of the technology company Modal. The agent broke into an isolated testing environment known as a sandbox that Modal was running for a customer who had set up a publicly accessible interface. OpenAI declined to comment on the compromise. Elsewhere, Kering ADRs have surged by the biggest intraday rise on record after the luxury goods maker reported better than expected revenue for its Gucci brand in the second quarter. CEO Luca De Meo sees growth for the group this year, but says that it won't be linear and notes that the global geopolitical situation holds challenges. Well, speaking of which, oil has jumped after the US said it intercepted an attack on American military bases in the Middle East. US Central Command also said that US and Saudi forces had carried out strikes on Iran-backed militants in Iraq in response to attempted drone attacks on US forces. The attacks and days of relative calm. Well, coming up, we will bring you more on that conflict in the Middle East. Oil prices really in focus. Where do they go next if the flare-up escalates? That's next. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Welcome back, everybody. This is the opening trade. 30 minutes until we get the opening trade. Let's have a look at the futures picture for European stocks. And we're factoring in a number of themes here. We've got another day of negativity in the Asia tech landscape. That doesn't always translate all that clearly into what's happening here in Europe. And we have a lot of earnings stories to overlay on top. So we're just trying to find our feet, really, on the European equity market picture as a result. In fact, yesterday, we made some decent gains in Western markets as a result of a weaker oil price, largely, and despite the negativity coming through from the Asian tech session. Today looks a little different. Nasdaq futures are pointing down by 0.3%, but E-minis are flat as well. So it seems as if ahead of the Fed, with a lot of earnings reports to factor in, we are waiting for a little bit more guidance and conviction, perhaps. Let's have a look at the bond markets and see where we are there. This is an area where we might expect that higher oil price to be factored in more quickly, and we can see that we do have yields going a little bit higher, and as a result of a 4% jump in oil prices this morning, perhaps we make that link. So 87.45 is where we trade on the Brent price, up by 4%. And so we see a little bit of movement higher in yields, a bit of selling in bond markets. Let's get to the source of that oil market story. Oil is jumping this morning after the latest flare-up in the Middle East brings to an end days of relative calm and casts a shadow over diplomatic efforts to end the conflict. Let's get an update on what's been happening then in the past 24 hours with Abir Abu Omar, Bloomberg Horizons Middle East and Africa anchor. Abir, good morning to you. So bring us up to speed with the latest then, what it is Iran, or what it is the Americans have said Iran has done and what the Iranians say that they've been doing.
Good morning, Anna. So it seems like we saw an unprompted attack by Iran this morning. And when I say unprompted, I just mean that over the past few days, we have seen a sense of calmness, really, in the Middle East. That follows the United States, without explanation, on Friday, halting attacks against Iran after 13 consecutive nights of hitting targets within Iran. So what we saw overnight is Iran attacking military bases, U.S. military bases. Those were all intercepted, according to the United States Central Command. But still, it looks like Iran had done a preemptive strike of some sorts in the early hours of the morning. We also saw Jordan reporting that 5 missiles by Iran were launched at its territories. And so we're seeing a slight tick up in the escalations in the Middle East, again, as I mentioned, after days of calmness that were in the environment here. And so what we're looking at is the price of crude, as you've mentioned in your intro, at about $87 on the barrel. It was ticking up 4%. It still is, as a matter of fact, 4% higher because of these escalations that we're seeing in the region. Obviously, Anna, at the heart of all of this remains the Strait of Hormuz and the still paralyzed movement there. But we're not just looking at one waterway now, we're looking at 2 waterways, because Ras al-Mandab, Bab al-Mandab, which is in the Red Sea and which Saudi Arabia has been resorting to as an ulterior pathway to get its crude shipments across, is now also at risk, because we're seeing the Yemen Houthis, which are backed by Iran, also attacking it and going for these tit-for-tat strikes there. So across the board, risk on in the region. We continue to obviously monitor what the United States wakes up to and what President Trump decides to do.
And so, Abir, where do we see oil going if the fighting escalates further?
Yeah, it's a good question, Lizzie. I mean, we are anticipating the potential of further escalation in the region. Those tit-for-tat strikes have been happening. And again, just remember that the halting of the attacks by the United States on Friday came without explanation from the U.S. side. We understand from multiple media reports that that could have been due to possibly diminishing munition power by the United States. President Trump obviously came out and refuted that, saying that the United States had more than enough munition, that he would love for the United States to have more, but that it has the power to continue fighting Iran Iran, on the other side, has the ability, Lizzie, to manufacture those drones for quite cheap. And so it has the ability to keep hitting countries in the region. And that is what it has shown. But meanwhile, what we're monitoring very closely and what is impacting that price of Brent and crude generally is those talks between Oman and Iran to open a so-called middle passageway in the Strait of Hormuz, a pathway that has not been used throughout the course of this war because Iran has been asking ships to continue to stick to the northern side of the Strait of Hormuz, close to its borders. So if that were to happen, that potentially gives ships and tankers that are trying to make their way through the Strait of Hormuz a little bit more ability to start making their shipments or having their shipments come across the waterway. Those conversations are not finalized. We're reporting that they're still going on, and we'll continue to monitor whether they actually lead to some kind of conclusion where ships can finally start moving a little bit more freely in the Strait of Hormuz.
Abir, thank you very much. Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar. Joining us now from a wider perspective on the investment landscape, Ethan Devitt, who's Senior Investment Advisor over at Moneta. Ethan, nice to speak to you. Thank you for joining us here on the opening trade. How do you keep up with the volatility in the oil price? I mean, just in the last 3 months, we've been as high as $120, as low as $72. We spiked up to $100, and now we're back at 87. I mean, and this is an incredibly big range in which we are swinging around. What do you do in that backdrop?
Well, this is really interesting for investors because what it really gets down to is the inflation number, because this is clearly what's driving the inflation number, which in its turn will turn to interest rate expectations, and from there we can look at economic policy. So I'd say when it comes to this is clearly quite a decentralized and even, should I say, disorganized conflict, in that we have conflicting pieces of information. We know that they're changing. We have one end of the weekend to another, and equally the swings in the oil price, as you noted, have been quite severe. We had oil cross $100 just the end of last week. So clearly investors need to navigate in some way, but focus, I would suggest, on that inflation number.
And with inflation in mind then, I mean, does that lean toward more central bank hiking? We've got the Fed today, we've got the Bank of England this week. Are we looking at more hikes as a result of this push higher in oil prices? Not necessarily today's, but broadly speaking, these higher oil prices? Or are we still able to just look through this and say this is geopolitical and temporary?
It does seem that geopolitical forces tend to be somewhat markets are agnostic towards them. And what it seems is, given the volatility and how quickly this information is changing, the Fed is likely to regard this as a temporary phenomenon. However, it does need to look at the core underlying inflation indicators. Let's not forget, even in June, it did look somewhat seductively low. And that was a suggestion that they could then maybe pause and maybe even still continue with their monetary easing later in the year. So I'd say we're not looking at a hike just yet, given the fractiousness of markets, the uncertainty. The tariffs have injected more uncertainty, and we've also had this weakness in the AI trade. All of those factors, the confluence of them, would suggest this is probably the very wrong time to now shock markets with a rate increase.
Yeah, because we see the AI capex jitters surfacing every day, right? But how do you think about that? You know, the big question, obviously, is it going to burst the AI bubble? But every day we see them, does it push you more towards asking that question?
It would have to push you there. I think when we see someone like a Google Alphabet going into negative cash flow, that has got to make you think that there's going to be a focus on whether there's a bottomless pit here or whether there will have to be trade-offs. We saw that with IBM. There was going to have to be trade-offs. And now we can see that this is clearly not something that's fully sustainable. There will be trade-offs made in terms of corporate spend. And the numbers have been huge. And I think we have been focused on the circularity there. And we'll have to wonder whether that sort of circularity is going to ultimately end in tears.
Yeah.
And that's what investors have been focused on.
And what about all the IPOs? Because it was a massive day for SpaceX yesterday. 20% below the IPO price, but then bouncing back. Do you just kind of treat these IPOs with a huge dollop of caution?
We have to, because look at where the SpaceX funds were coming from. There was a lot of retail involvement. There was a lot of speculative involvement. We saw Bitcoin fall at the same time as SpaceX was the flurry of excitement. So clearly we would think of where is that marginal dollar coming from to invest in SpaceX, probably the more speculative end of the spectrum. We knew even at the IPO stage that there was a lot of hope and expectation, and the Elon trade essentially baked into that. And now we're seeing that much of that did not have grounding in fundamentals. I think what this does suggest, though, is for the rest of the year, where does this place the other IPOs? Will there be much more caution? We've even seen throughout the globe, actually, around Asia, that there has been a lot of excitement, day one of an IPO, and then a kind of a burning off of that excitement.
XMT, yeah.
Yeah, I mean, is that just the tech? That's something for the tech sector, though. More broadly, are we seeing a return to IPOs that gives us a bit more encouragement, other sectors?
Well, we have seen some broadening. I suppose that's the key thing in markets. Is it all concentrated or has there been that rotation? We have been seeing some broadening, not just into other sectors, but also into small cap. And that is generally a healthy sign. But when it comes to tech IPOs, so much is speculative, so much is uncertain. We've even seen the large hyperscalers discuss that they do not really know how to model revenues given some of this uncertainty. This latest jolt of uncertainty around the Chinese open models injected only this week, we can see just how quickly these cycles are manifesting.
Yeah.
We have a revenue cycle that shows a vertical wall of demand. And next thing we ask whether token maxing is over and that wall of demand is now going to go elsewhere. So how do you factor that in, particularly to a company that's trying its best, looking at OpenAI and Anthropic, to really pass muster when it comes to the institutional investor and the demands of being a public company?
Yeah, I mean, what do we read into the CapEx announcements we've had so far from some of the big tech companies then, Ethan, and what we're looking for here? Because it does seem, you mentioned Alphabet, we've had SK Hynix, both of them with big CapEx numbers, the former with an upgrade to CapEx, the latter with just a huge CapEx number. Does that tell us that we don't want to see those big CapEx numbers anymore? The market is done with that theme, and actually what we want to see now is restraint.
What we would say is we need to see some clarity and we need to see some realism in terms of these numbers, not simply kind of buying into this, the hype trade and the sense that there will be on a hockey stick trajectory of demand that's never going to be faced with external forces like we're seeing with the OpenAI, the Chinese trade, as well as the potential for consumers to trade down and no longer continue with their use of tokens as they are, be a bit more price sensitive. So we need the CapEx numbers to reflect that there is uncertainty baked into that. Investors appreciate a certain sense of honesty when it comes to CapEx and projections, and a sense that there is a sense of being anchored in reality and not simply buying the last hype cycle.
Ethan, you've tagged tariffs as something to watch. Are we underestimating the impact of tariffs as President Trump rebuilds the tariff wall? Because we've seen them before. Are we not giving enough emphasis to them now that we see them again?
Well, there's a lot of pattern recognition this summer, a lot of deja vu, not only in the Strait of Hormuz, not only around technology and its kind of bangs and whimpers, but also around this tariff story. I'd say there are a few fundamentally different things today. First of all, there's already been a court challenge. There has been kind of a cycle through that sense of scrutiny, and the current tariffs have been drafted in such a way that they will probably withstand legal challenge going forward. So they could be here to stay. The second thing is that we still don't know how tariffs translate into inflation. There was not the transmission effect that was instant. There was a much more sense of complexity. Some companies may have had inventories they could have relied on. They may not have had the power to pass pricing through. So the sense that tariffs don't cause inflation, that causal link was perhaps too easily drawn and is not quite accurate. So I'd say we're going to see something different this time around.
Ethan, how would you characterise globalisation right now? Is globalisation over? Have we just seen peak globalisation, but it's still very much a force? How are you thinking about that as a concept, and that maybe influences investment strategy?
I think the binary on globalization, slowbalization, deglobalization is a little bit too simplistic that some of the leaders and even corporate leaders could be guilty of suggesting. I believe globalization, that ship has sailed in the sense that it is too far gone to reverse. Just as an example, Moneta, we've just opened our London office. We see the potential to be a global wealth provider. That is not changing anytime soon. Increasingly, individuals lead global lives. Those are complex lives. We see companies dependent on supply chains. We know from COVID and the Strait of Hormuz and the Russia-Ukraine crisis, being dependent on one concentrated supplier is a bad thing, but you need to seek the lowest source provider. And clearly, tariffs are upsetting this apple cart in terms of the globalization we're seeing. But there will be, just as Mark Carney said at Davos, there will be a sense of the middle powers having to forge their own path and find a different pathway. So globalization is here. As I said, that ship has sailed. Maybe it will slow down. Maybe there will be hiccups. There will be alliances drawn in different ways.
OK, Ethan, thank you very much. Thanks for coming to speak to us. Ethan Devitt, Senior Investment Advisor at Moneta. Now, corporate leaders have been weighing in on the impact of the Iran conflict on their businesses.
In terms of the impact on our business, there has been disruptions out of the Middle East. Some of that is temporary. Some of that will take a little bit longer to return. But we make our supply projections on long term. There'll be fluctuations in the short term as some of those disruptions are worked through. But in the longer term, aluminium's going to be well supported.
That was the Rio Tinto CEO Simon Trott speaking exclusively to Bloomberg after the company posted a jump in profit for the first half on the back of strong commodity prices. More earnings coverage coming up. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back. Let's have a look at the picture across the European futures right now. And we're pretty flat, actually. But, Lizzie, as we've been saying over the last couple of days, this doesn't really do justice to the news flow, does it? We've had so many corporates reporting from the luxury space to the banking space. We could see some fairly substantial moves, certainly in luxury, at the start of the trading day. But for what it's worth, the overall market picture looks fairly sluggish as we factor in earnings, but also a higher oil price this morning.
How very deceptive. Let's turn now to our markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore. Mark, good morning. I want to start closest to where you are in Korea. We've seen huge moves on the Kospi again today. Are you surprised that we're once again seeing trading halted earlier on in the session after that SK Hynix disappointment? What do you read into it for the broader move in mood in markets when it comes to tech?
The volatility in Korea has been absolutely insane. This was supposedly a major serious market. Only in June, this was a market worth over $5 trillion. This isn't, meant to be some kind of penny asset class. But it's having volatility like it did at the end of the last century in the Asia crisis when it was only a $500 billion market. So, this is just insane amount of volatility. We've seen about $1.7 trillion wiped out of that stock market over the last 5 weeks in really, really kind of crazy moves. What are my big takeaways? The price action away from Korea is incredibly strong, incredibly resilient. Sure, we've seen chip stock weakness over the last 10 days, but in context of where it's come this year, stock markets are doing very well. The S&P 500 is less than 2.5% off its record highs. Overall, we are seeing resilience in stock markets. That's very impressive. Now, I do think that the level of volatility that we've seen in Korea, we're closing today below the 200-day moving average, and the scale of volatility going into the Fed meeting, going into the US-Iran kind of event risk, means that we're going to see deleveraging probably pressures into the weekend, higher kind of value at risk measures, which is going to put pressure. But that said, it's all going to depend on the Fed and the US-Iran deal. So we've got two very binary risks. And I think my biggest call right now is that we've had extraordinary low correlation across major stock markets over the last couple of months. It's probably been the biggest themes of this year. You've seen Korea bubble pop and yet not the AI bubble pop elsewhere. My theory is that into month end over the next 3 days, depending whatever the Fed does, whichever direction it kind of moves markets, that we'll see a recorrelation. We'll either see everything rise together into the last few days or we'll see everything fall together.
Yeah, that correlation trend, Mark, I mean, it is low by historic standards, as you point out, looking at a sort of long-term perspective. But it more recently does just seem to be moving around with the oil price. So when we see jumps in the oil price, things are more correlated. Is that what we're seeing at the moment?
That's absolutely right, Anna. So we've seen a pickup over the past week, but again, a pickup from rock bottom levels, and it's still super low. I think that, the US-Iran situation is still massive. I mean, it was funny today. We were observing internally when oil was only up 4.5%. Someone said, I can't believe how calm oil prices are given the headlines. And I thought it hilarious that 4.5% is now considered a calm day in oil. But that's kind of true at the moment. So I think that is one major event risk. And, many people have talked about, we haven't had a Fed that's kind of been so uncertain on the day of the meeting for, probably 20 years or thereabouts. And therefore, there's no alpha to kind of make a prediction on that meeting in advance. You've got to play the decision. So I think that between the Fed decision and oil price into the weekend, they're a major catalyst. They could go either way. And I think you just got to play the kind of the results in that. But my point is that we'll probably see more markets move together rather than relative value, because relative value pods have blown up in the last couple of days.
Mark, nice to see you. That's our Bloomberg Markets Live Executive Editor, Mark Cudmore. And remember, you can get up-to-date analysis and insight from Mark and the team by going to MLIV Go on your terminal.
Let's get a look at the stocks to watch this morning. Bloomberg's Alex Morgan has a rundown. I don't know how you've chosen, Alex. There's just so many to choose from. So you start. We'll fill in the gaps.
Do you know, it's one of those days, isn't it, where, you're spoiled for choice. But let's kick it off with UBS. It's a strong morning for European banking. Of course, you've been talking about this on the programme. UBS beating estimates, but there's, of course, that $3 billion buyback announced today after the completion of the last one. That'll run until the second quarter next year. But what is interesting about these earnings this morning is it also comes with a 28-page document with UBS talking about the Swiss capital debate. Now, that's a bit broad for us to get into here, but that is the political debate going on in Switzerland, working its way through the system at the moment. 28 pages of that with the earnings this morning. But UBS announcing that $3 billion buyback. We'll be keeping our eyes on them this morning. Let's turn it over to Deutsche Bank. And that was a record second quarter for fixed income trading. And what is interesting here is that was beating estimates, but also beating the average for Wall Street. And, of course, we've seen a real bumper time over there. So eyes also on Deutsche Bank. Let's switch it away from banking for a moment to look at luxury. And, of course, there's a lot of names we've been talking about this week, starting with LVMH. Hermes as well got their earnings out this morning. But I want to zoom in on Kering if we can. And you can see, the story here has been about attempting to turn around that luxury house. The main brand there is Gucci. And we've seen the earnings coming out after hours yesterday. But the emphasis was that Gucci is recovering under the new CEO. There's been a cut to headcount, a closure of less profitable stores, and analysts sort of picking up on that recovery in these figures. Eduardo Oban saying overall this is a better set of numbers at the top and the bottom end than people were expecting. So this morning, keep your eyes on Kering, but also on Hermes, as I said as well, who have earnings out today as well.
Alex, thank you very much. Bloomberg's Alex Morgan. Kicking us off with some of the stocks we're watching. Let's add to the list then, Lizzie. Also watching Rio Tinto, an emphasis there on cost cutting. We heard from the CEO earlier. You spoke to Standard Chartered, a better than expected picture coming through in the numbers there. Electrolux, that's often really volatile, and that could be a big mover at the start of trade. BASF also a buyback there and better than expected numbers.
Yeah, we spoke to ASM earlier in the programme as well. Their outlook beating estimates, so many to choose from. I also just think that China theme that Alex was touching on when it comes to Kering, really interesting. It cuts across so many sectors. But one of the lines that stuck out to me from Luca Di Maio yesterday was just saying that China's an upside if you do it right.
Right.
Not
yes.
what we heard from other luxury names.
Right.
Like LVMH.
And Hermes talking about how China is stabilising, but there's no fundamental rebound. So there's a lot of different dynamics happening, it seems, on China luxury. We'll get into that later in the programme. Coming up on the opening trade, we'll bring you the market open. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back to the opening trade, everybody. We've got a lot of earnings to focus on and to price in this morning here in Europe. But let's take a short trip down memory lane to remind ourselves of the session of yesterday on Wall Street and what that might mean for the session ahead here in Europe. Well, you can see we factored in quite a lot of the upside. And after Europe closed, we kind of trod water in the US session. But we didn't make bad progress on European stocks yesterday, despite the fact we saw on US stocks yesterday, despite the fact we saw chip stocks were under pressure in the US. And that continues very much to be a theme over in Asia. It seems that Europe is managing to put that to one side, and to some degree we saw the US markets putting that to one side, and overall not succumbing too much to the downside. Well, today looks like another day where we don't succumb to the downside around the AI theme. Instead, we focus on some of the earnings. We're also factoring in a higher oil price, and that could be something that we watch, certainly in the London market. We are expected to go a little bit higher, up by around 0.25% in London. DAX futures flat to negative. Euro Stoxx futures as a whole then, Lizzie, looking pretty range-bound, and US futures pretty flat this morning.
Well, Anna, as you say, it could be that we see some of those bank earnings beats offsetting the impact of higher oil prices this morning. Euro Stoxx 50 futures are higher. Let's dive into the banks. We've had Deutsche Bank's traders seeing 16% revenue rise to beat Wall Street. UBS and Standard Chartered with announcements on buybacks. So that's the banks. Then we've got tech in focus as well, because the questions about AI capex renewed by the response to the SK Hynix numbers. And then luxury in focus. Alex Morgan flagged for us the Kering results, signs of progress, reviving sales at Gucci. Does this boost the sector more broadly at the open this morning, Anna?
Yeah, absolutely. So all of those sectors very much in focus, and might we see some fairly substantial movement in individual stocks, even if the top line story on these markets doesn't tell us anything particularly exciting. But we have so many earnings stories to factor in here that could result in some single stock volatility. Let's have a look at where we are at the start of the trading day then. This Wednesday morning, the FTSE 100 first out of the gates, up by 0.2%. Sadly, we have returned to kinetic activity in the Middle East. We've seen Iran launching attacks that failed to make contact, it would seem, with US bases in the region. That's pushed oil prices higher. That gives London perhaps another leg up in terms of the energy names. We'll watch if that is in the driving seat, or whether it's further rotation away from tech themes that is boosting some of the FTSE names. The Stoxx 600 as a whole then up by around 0.1%. The AEX up 0.1%. The IBEX pretty flat. Of course, we're waiting for the Fed and the Fed rate decision a little bit later on today, Lizzie, which has a lot of uncertainty attached to it. But in the meantime, digesting these earnings stories and not moving very far at the overall index level. What do you see then on the sectors?
Well, if we break it down, we've got about 3/4 in positive territory this morning, and basic resources and energy, as expected, leading the gains this morning. So basic resources up 1.5%, energy up 1.3%. As you say, we have got a higher oil price this morning off the back of the latest in the Middle East. Brent up 3.6% at $87 a barrel. So surprise, surprise, that is boosting the FTSE. Outsized gains of 0.4%, and energy near the top of the leaderboard. Tech, as we would have expected, at the bottom of the basket, down 0.7% this morning, off the back of the broader sentiment that we've already seen in the Asian session, the Kospi down, that spreading more broadly, and Nasdaq futures back in the red as well, down 0.1%. Now, if we look at some of those individual names that we had been flagging, Standard Chartered off the back of their results, Bill Winters will be pleased with this, up more than 2%. UBS up 1.7%, waiting for Deutsche Bank to open. But ASM International, right, down more than 5.5% as things stand. We were speaking to their boss earlier, their outlook beating estimates, and yet those shares in the red at the moment, Anna.
Yeah, it did seem as if the ADRs were a little weaker after those numbers dropped last night over in the United States, and there did seem to be some concern around the second quarter, despite the very positive story that they're telling and the upgrade that we got to the sort of forward-looking numbers. Interesting on the individual names then, EssilorLuxottica moves higher, Glencore moves higher, Process, BASF, we had numbers out of BASF a little earlier on. Hermes is one of the big fallers then this morning, and we had numbers out of Hermes, didn't we? And their conversation around China a little more nuanced perhaps than the one that we got from Gucci. ASML down by 1.9%. GSK, numbers through from GSK yesterday, and that stock is just on the back foot this morning.
Well, let's get some analysis now. We can speak to Marina Zavolok, who is Chief European Equity Strategist over at Morgan Stanley. She joins us around the desk now. Marina, great to have you back. I want to start there with this China theme, because it's touched luxury across the board, from Mercedes to Kering on the upside. What do you make of it? Are we at an inflection point?
No, it doesn't. I mean, that's what luxury results are telling you. China continues to be a drag, whether it's through competition or through direct exposure and lack of, a meaningful consumer recovery. I think stabilization in the China consumer, which some of the luxury names are pointing to, is not enough to drive a V-shaped recovery. It's not enough to sustain the multiples that we still have in the luxury sector.
But is it how you play it? We're waiting for Kering shares to open, but Luca De Meo yesterday saying that it's the upside. There is an upside there if you do it right.
Yes. So interestingly, we've been underweight luxury in our model, and it's been at the bottom of our model for years now. But what's happened in the last, let's say, 9 months or so is that we used to have all of the luxury stocks in the bottom of our screens. Now there's much more dispersion in the sector. So I agree with you. There's some heavyweights in that sector that are still dragging down the sector overall. And then you have some idiosyncratic story, be it new designers, new kind of lines.
Erling Haaland carrying a handbag.
Yeah.
It's all a bit unpredictable on that front.
And you have strength elsewhere. So the US is helping.
So if we take a step back from the luxury space, we've got Kering open now. It's up by 9%. So just to sort of tie a bow around that conversation, there we are. Kering is benefiting where Hermes is maybe not this morning. So that's the luxury story. If we take a step back, though, Marina, going into this earnings season, you were quite constructive. Targets have been increasing. How do you feel now we're getting into it properly from what you're seeing?
This is a great earnings season for Europe. It's also good for the US, but I haven't seen such a strong earnings season in Europe in years. Earnings revisions breadth has shot up to the high teens. So the net percent of analysts upgrading their numbers is very high. It's higher than the US now. If you look at earnings revisions by sector, almost every sector is now in the green, by the way, including luxury, which is unusual. And we have earnings growth consensus for this year. I think some people drop off their chair when they hear this, but it's 17%. I mean, Europe normally does 0 or 1%. We're doing 17% growth this year.
Yeah.
So we're seeing more interest in European equities, in part because of the strong earnings season that we're seeing.
And so is there one factor driving the strength? That's incredibly broad, isn't it, that statistic?
Yeah,
or is it all
it's a combination of factors. I would break it down into a few, so 3 main ones. So number one, AI. We do have some AI. I know that there's been a sell-off recently, but it is still driving earnings strength in Europe. And I think Europe was kind of lagging that earnings strength in the US, and now it's coming through. So AI is the top of earnings revisions breadth still. You have the banks, which are coming through very strong, higher yields, steeper curves, higher oil prices. This all helps the banks as long as we stay out of a recession. So banks are very strong. And then, to your point, there's broadening. So it's happening across sectors. And one stat I've been pointing out a lot is that Europe actually benefits from inflation as long as we're not in a recession, because 60% of our earnings pie is real assets, banks, compute, all areas that benefit from inflation. So we're seeing that rise the tide.
Yes, if you've got the pricing power to deal with the inflation, then yeah.
OK, so a really fine line to tread there, really, if you're trying to get between inflation and recession risks. Just on the AI theme, though, how do you play it more specifically?
Well, it's all kind of acting as if it's one trade right now, globally, the AI trade. We still like European semis. We still like some of the larger cap goods, which are very AI heavy. We're overweight. Obviously, it's been painful recently. But one thing I would say is that we typically get poor seasonality and momentum in the summer. This is unusual, this level of seasonality. The last time we saw this was 2022, this unwind and top momentum and rally in the bottom momentum. But typically in August, we start to come through that. So I am hopeful that you start to see a recovery in the AI trade in August. And we would play that through European semis and cap goods.
And how are you positioning around the war uncertainty?
We expect this to be, let's call it a volatile de-escalation. and we expect oil to come back down to around the $75 level ultimately, but not in a straight line. It's going to be choppy. And for Europe, actually, if oil stays in the 70 to 100 range, that's out of recession territory, but that's still driving moderate inflation. That's actually the sweet spot for European equities. And I've been saying that since the Iran escalation began. And that's what we're seeing in earnings right now.
And we're seeing that in the earnings story. Sticking with other sectors that I think you like, or at least you did like in June, it'd be good to get your updated view, Marina. The banking sector, the mining sector, where do you see most, where are things mispriced and the opportunities the biggest, do you think?
Yeah, the banking sector we still like. That's a steady grind higher. You have kind of almost like a profit bonanza at these level of yields. Again, as long as this AI unwind doesn't broaden to other sectors. And then we're starting to see flows coming back into Europe. And the banks, when we start to see these flows come back on the broadening, banks are typically the number one beneficiary of those flows. But then beyond the banks, we're overweight mining, we're overweight utilities, telecoms. But we published a piece a few weeks ago where we made the point that the market is so idiosyncratic, and it's almost better to choose those few luxury names that actually have idiosyncratic drivers, those few staple names that have idiosyncratic drivers. And that's what we're seeing is a lot of interest in diversifying across all sectors and the best stock within sectors.
What do you think that diversification rotation story looks like, or breadth story looks like into the second half of the year then, Marina? Is Europe's to play for? Is this something that Europe can really benefit from?
I think this is partly seasonal and tactical. We've been calling for diversification. At this point, if we look at breadth, we are on a 3-month measure. We're halfway back to the peak. So we started around the time the MOU was signed and before this tech sell-off began. We started at historical low levels of breadth in the market. Now I just heard you say 75% of stocks are outperforming today. So breadth is very high. I think when we get to that peak of breadth, we're halfway there, then we start to see a narrowing again in the market. Okay. That's typically what happens.
Marina, thank you very much. Thanks for joining us. Marina Zavalock, Morgan Stanley Chief European Equity Strategist. Let's dive into a few core names that we keep across here in Europe. We've got ASML down by 0.8%. That's the technology theme, which is an area of weakness this morning, along with Schneider Electric. Sometimes they are linked. Nestle up 0.5%. LVMH getting a boost, perhaps from Kering, not being dragged down by Hermes, and that stock is up by just shy of 3%. That seems to be the biggest mover amongst the core six. Let's get to some of the other individual stocks that are on the move this morning. Alex Morgan has a breakdown. Alex.
Well, I would, I'm loath to talk about luxury in the company of the two of you, given you know so much more about it. But I'm going to start with Kering. That's because they really are leading the pack this morning. Out of the gates, up now, you can see 11% this morning. And yes, that is on the earnings, pointing to a recovery for Gucci. Still not the full story that they want to get to. Of course, as part of the turnaround plan, there is also Yves Saint Laurent in there, but it is Gucci that makes up more than half of Kering's profits. And the turnaround there, you can see, really being warmly welcomed by the market this morning. We got a sense that might be coming from a trade gate earlier, but here we are now, up around 11% this morning. Let's turn it over to tech, though. Different picture. Now, this is, as you were saying earlier, that read across from Asia, the SK Hynix disappointment. You can see the companies touched in Europe in the semiconductor space down. And there's also that broader concern that you're talking about day in, day out about the worries about circular funding, the AI model. So you can see a read across from Asia to European chip makers and those involved in the European chip sector. Let's flip it over to to miners. Let's get to miners here. Rio Tinto and Glencore both in the green this morning, of course, talking about commodity prices. A part of that, you can see Rio Tinto up around 2%, Glencore around 4%. Now let's get to Danone as well. Have a look at how they are doing. Down around 3%. Some earnings are also out this morning. ENI, though, in other news, on the back of talking up a share buyback scheme, we're seeing them around 5% in the green this morning. But really, the big name that we're talking about is carrying up more than 10%. And that's coming off the back of those warm words about Gucci's recovery.
All right, Alex, thank you very much. That's Bloomberg's Alex Morgan. And coming up, we will get back to the banking story, earnings out of that as well. UBS rising on the back of a strong quarter as wealth management assets beat estimates and trading revenue surged. Stay with us for that. This is Bloomberg.
The most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Look, if I look at the macro picture, the geopolitical picture, the ongoing debates, also the big dispersion we see in equity markets, the pressures and on energy prices creates potential headwinds on inflation, and that may turn out to be something that investors will not really like, and creating potential volatility. So I do expect spikes of volatility to continue for the rest of the year.
The UBS CEO Sergio Amotti speaking there to Guy Johnson, of course, a little bit earlier. UBS shares then this morning, we'll put those up on the screen. You can see the response in the market up by 2.4%. The bank has announced a new $3 billion share buyback program to run until mid next year, and has posted net income of $2.8 billion for the second quarter, beating expectations. In fact, beating expectations on lots of metrics this morning. Let's get to Guy, who is in Zurich after that interview with Sergio Amotti. So lots of numbers beating expectations. We haven't talked as much about the equities performance on this particular stock than maybe we did around Wall Street banks and others earlier on this week, Guy. So what's the equity story? How responsible is that for the beat?
It's huge. With all these banks, the equity performance has been very, very strong. We saw it yesterday with Barclays. Today, you're getting it with UBS. But how do these European banks stack up against their US peers? I think is a really interesting question. I think there is also a question around how heavily UBS is leaning on its equity business to sort of produce the kind of performance it's seeing at the moment. I think you probably look at the market reaction this morning and say, actually, there's not much in that argument. But some analysts are certainly pointing at the fact that equities did such heavy lifting here that it maybe affects the quality of the earnings. But European banks generally have underperformed their US peers. And why is that? Why is the number from UBS at 53% plus is really strong? But Wall Street did even better. So I talked to Sergio about this. Is it a capital issue? He says, no, actually, it's not a capital issue because what we're seeing here is actually a sort of transactional story. It's about the volatility spikes he was just talking about. The volatility is a big driver of this. It's not about kind of providing more capital for this business. They gave it a little bit more capital, and maybe that sort of produced a better performance coming through here. But are European banks, are Swiss banks underperforming their US peers because of the lack of capital? Is there a cost to being a European bank? In particular, for UBS's case, is there a cost to being a Swiss bank? Now, that was a question I asked him, and he said firmly no. He said, he used the language, I'm very happy being a Swiss bank. We are very happy being a Swiss bank. And that's really important in the context of what is happening with the capital rules right now. Maybe a slightly friendlier tone coming through from Sergio Motti when it comes to those capital rules. So I think, yes, equity markets have been, the equity division's done really well here. Hasn't quite done as well as Wall Street, but there's a reason for that. And that is that this is a bank that is designed to serve its clients, not to be a trading platform. And that is maybe the reason. That's the opportunity cost that you have being a Swiss bank and being a big wealth manager. And that's the kind of the story that comes out here. And I think the market's responding quite well to that.
Yeah, the shares up nonetheless 2.3%. Guy, thank you for bringing us that interview. In Zurich, that's Bloomberg's Guy Johnson. Well, as he says, we've also had results out of Standard Chartered and Deutsche Bank this morning, both in the green. Stanchart announcing a $1 billion share buyback after its second quarter earnings beat expectations. I've been speaking to the CEO, Bill Winters, earlier on, and he told me that they're investing in growth.
We're protected against whatever pullback or surprise may come, but we are investing fully in the business. So, yeah, $1 billion buyback, but we're investing, well over $2 billion of cash into our business year after year after year and growing. So, first and foremost, we invest in growth.
Yeah.
We take the surplus and return it to shareholders.
Well, Bloomberg's Charlie Wells is with us to walk us through all of this, give us some more context. Charlie, how would you frame it all? It seems like good, better, best when it comes to European banks.
That's exactly right, Lizzie. So it's beats and buybacks that really have been the theme of the day. And I think the question really had been, what would this do to bank share prices? Because we saw similar results yesterday, and that actually did not bode well for the banks. But we're seeing a lot of green across the board today. What we're seeing here with Standard Chartered is the shares up well over 3% this morning. They had a really strong earnings report. I want to bring that up and talk about some of the key findings from that earnings report for Standard Chartered. They've got that $1 billion share buyback that we've been talking about. Of course, they had that beat, but we also saw a lot of strength coming from their wealth unit. Now, this was really important for Standard Chartered because there had been a lot of concern about Chinese authorities trying to limit the outflow of money from mainland China to places like Hong Kong. And we know Standard Chartered has a lot of exposure to Hong Kong. Let's bring up how Standard Chartered has been performing, because recently they've been hitting record highs. But I want to just show you why that wealth unit was so important. Look at that dip right there. Look at that dip in June. That is investor concern about what could happen on the back of that attempt to limit the outflow of money from China. So what we're seeing is a really solid recovery here, and we're seeing that wealth unit at Standard Chartered help to propel this bank forward. So that should be positive for Standard Chartered. Another big bank in Europe, that's Deutsche Bank. Let's bring up how they're performing this morning, because they have been in the green, and they certainly still are up well over 5% this morning. So again, a strong showing on the back of these earnings. I want to bring up some of those key findings as well to explain some of this movement, some of the investor confidence in Deutsche Bank this morning. What really stood out here was fixed income trading, right? So we've seen across Europe a little bit of a mixed picture, some weakness in FIC at a number of these units, but actually what we saw from Deutsche Bank was outperformance. They were up in the quarter year over year 16%. Now that beat the average from Wall Street competitors competitors who are up on average about 13%. So that's really important for Deutsche Bank. Why that's important? They don't have that equities trading exposure backed out of that in 2019. So FIC is really crucial for Deutsche Bank, and they really outperformed there. Also buyback. We've been talking a lot about buybacks. They've got that 500 million euro buyback, and then they also confirmed their revenue outlook. Now, this is really important for Deutsche Bank because they've had a huge valuation gap compared to a lot of other European lenders. Look at this gap. That white is other major banks in Europe. That orange is Deutsche Bank. So Christian Sewing really trying to close that gap. These results should help.
Charlie, thanks very much. Charlie Wells with a breakdown of the banking sector reporting season. Let's get to luxury then, where Kering shares are surging this morning. This after the luxury company reported that sales at Gucci came in better than expected in the second quarter. The move is sparking optimism that a long-awaited turnaround at Kering's largest brand is starting to take shape. Let's get into the detail here with Bloomberg opinion columnist Andrea Felsted. Let's start with Kering because we've had other numbers. Good morning, Andrea. I mean, this is fascinating, isn't it? That big pop higher in the share price on the back of Gucci revenue that didn't turn positive year on year. It was better than expected, and it's more in line with the pack, more in line with what others are doing.
That's right. I mean, Gucci's been really struggling, and it looks like it's going in the right direction. It's not growing yet, but it's less bad than it was, and it's less bad than it's expected. So the market's taken that as a sign that perhaps the Gucci turnaround, which is so crucial to Kering, is working.
I don't get it. Is it Demna? I mean, look at the fate of Hermes, right? Weathering the downturn in demand better than its peers, but you would expect Hermes, its shares are down, right? What about the Haaland effect that you've been writing about?
I know. I think Hermes has really got a boost from all these footballers carrying these big Hermes bags, because there was a sense that particularly the Kelly and the Birkin had got a bit overexposed. There were lots of them around on resale sites, and they'd really kind of lost a bit of their cachet. And I think the footballers all carrying the Hermes bags has kind of helped their brand value. I got some data, and it showed that actually Erling Haaland carrying the Birkin and the Hack, which isn't a Birkin but it's like a Birkin, has actually added $8.8 million to their brand value.
Carrying all sorts of things in that photo. It's pretty weird stuff. But lingering on Hermes and the China effect, I suppose, more broadly, they've said some nuanced things about China. I wonder if that's where they come unstuck, because they said they see stabilisation in China, but no fundamental rebound. And I mean, that for a lot of these companies has been a big headwind. We're going to talk to an economist, actually, a little bit later on in the programme. The Chinese consumer is just sitting back.
Exactly. That's been the picture for all of the brands. They've all said, you know, China's sort of stable. We're not seeing the big upswing. Now, what's happened is the US and to some extent South Korea has really made up for that stability, because the wealth effect from AI, roaring stock markets, that's
you see that in luxury sales in South Korea, do you?
Absolutely, right. Yes, and Japan to some extent as well. But I mean, particularly in the US, US demand tends to be correlated with stock markets. So the stock market's been doing so well till recently, at least, that they've been spending. Now, the big worry is the sort of some of the sell-offs we've seen. If that spreads, that equity market story isn't as strong, then that could be a real break on spending. And you've got China not coming back yet, so that's really the worry.
That's really interesting. I want to hear more some of the time about the difference in taste between Koreans, Chinese and Japanese within the Asian market. But for now, Andrea, great to have you back. Bloomberg opinion columnist Andrea Felsted on the latest in the luxury sector. Coming up, though, we are going to turn to the Fed. It is Fed Day, lest you forget, given all these earnings, but a lack of clarity from Fed Chair Kevin Warsh on the future path for rates, really keeping investors on edge. And we're going to discuss today's US rate decision with the HSBC Global Chief Economist, Janet Henry. She'll be with us next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade. It's Wednesday morning. We're 30 minutes into Wednesday's session here for European stocks. And we're factoring in a lot of corporate earnings, and some of them are really positive. We're seeing some outperformance in some of the luxury names, even consumer white goods, those kind of businesses. We've got some really interesting upside stories. But this is the overall picture before Lizzie gets to some of that detail. So the Stocks Europe 600 up by 0.2% as we factor in the earnings. Also factoring in a higher oil price. Sadly, a return to some violence in the Middle East over the past 24 hours. That means the oil price is up by around 3-4% this morning. The FTSE 100 benefiting from that as we see some of the oil majors moving a little bit higher. And we do see broadly FTSE outperformance this morning. The DAX up by 0.2%. That's the broad picture then, Lizzie, across these European equity markets as we wait for the Fed. That still lies ahead for us. And we wait for big tech earnings. That's going to be really interesting for markets. After SK Hynix, we move on to some of the other big names over in the US. But what have you got in the European session?
Well, Anna, you can tell that it's a busy day for earnings because the balance of Stock 600 members is to the downside, 310 in the red. But as you say, at the headline level, the Stock 600 is up today. Volumes higher as well, up 21%. So let's take a look at some of those individual movers that are distorting the picture, perhaps. So Kering up more than 10%. We were just discussing with Alex Morgan. We've had Gucci's better than expected sales, sending those shares higher. A margin beat also for EssilorLuxottica. Of course, we've seen the combination with Ray-Ban when it comes with other brands when it comes to their smart glasses, and UBS shares out alongside a raft of other banks this morning, Deutsche and Stanchart, but announcing a buyback plan, as did Stanchart, as that investment bank division has surged, so up 2.7% for UBS. But here are the laggards this morning. We've talked about the broader tech theme, results from ASM International, and shares falling 7.8% despite those results. Logitech sliding as well, nearly 6%, a supplier incident hitting sales, and Hermes in the luxury space, the opposite to the Kering story, down 3.4%, Hannah.
So luxury moving in two different directions. Let's step away from the earnings stories for a moment and get an update on some of the other stories that we are following this morning. Oil has jumped after the US said it intercepted an attack on American military bases in the Middle East. US Central Command also said US and Saudi forces had carried out strikes on Iran-backed militants in Iraq in response to attempted drone attacks on US forces. The attacks end days of relative calm and cast a shadow over diplomatic efforts to end the conflict. SK Hynix has earmarked at least $31 billion in capital expenditure this year after reporting a six-fold surge in quarterly profit, a record outlay that coincides with growing fears about overinvestment in AI capacity. And the Federal Reserve is out with its latest policy decision later today. It is Fed Day. The central bank is expected to keep interest rates on hold when it concludes its two-day meeting. But market participants are eyeing the possibility of a surprise hike as patience with high inflation wears thin. A lot of anticipation then ahead of a pretty uncertain Fed today, Lizzie.
Yeah, which is perhaps the point when you take away so much of the forward guidance. Let's get another view on the Fed today. Janet Henry, Chief Global Economist over at HSBC, joins us round the desk. Janet, great to have you back. What's your view? Are we going to have a surprise hike from the Fed today? Does it need to have a surprise hike for credibility purposes?
Good morning. No. It's the short answer. I would very much doubt we get a surprise hike. I mean, the market's got about a 30% probability of a rate rise. If anything, I think the likelihood of a rate rise is less than 30%. We don't get forward guidance. We'll get a lot of words in the press conference. I'm sure it'll be another frustrating one for all the journalists asking the new Fed chair the various questions, but I think it's extremely unlikely.
But why is it unlikely when we've had oil topping $100 a barrel? Tensions in the Middle East just seem to flare up again and again and again, even if there's this kind of sense of inevitability that things will die down ahead of the midterms. Again, we're reminded that they haven't yet.
I'm not saying necessarily what they should do. I'm saying what I think they will do. And I think Walsh was quite clear at the last press conference. Obviously, he made it clear there's going to be no forward guidance. The committee are split. Half of them said there was a likelihood of a rate rise by the end of the year. Half of them had rates basically on hold. But you've got to remember, a lot of those members of the FOMC, earlier in the year, they were all saying that rates were actually going to be cut. And you did also get a lot of words regarding credibility. So I think the data that we've had since then has been actually slightly softer labour market data. It's been slightly lower inflation data. So we will hear a lot about credibility. So some really quite hawkish language, but still all the usual noise regarding AI, future potential disinflationary impacts of AI. And of course, we want to tighten the balance, shrink the balance sheet, but you'll have to wait for that. I would be surprised if a newly appointed Fed chair steered the committee towards a rate rise in the space of 1 month when the data has provided some comfort, but keep sending the signal it's not up to us to tell you what our next move will be. We'll look at the data and we're willing to, as our number one credibility factor, meet our inflation mandate, but the implication will be not right now.
So a hawkish hold then is what we're what you're expecting.
Yeah.
So that's the overall expectation. What about the task forces? Is he going to hide behind all of these task forces once again instead of commenting on anything that's particularly tricky? How many times, Janet, are we going to hear there's a task force for that?
You're going to be hearing that for at least the next 3 to 6 months. It really will be. We'll be having these same discussions at every meeting. And, we'll then be thinking about Jackson Hole in August, and then the next dot plot that will not include Chair Walsh's dot for future interest rate expectations in September. So I think September will be the immediate focus. But it will be all these questions regarding inflation. Is it core PCE? Is it trimmed core PCE?
Yeah.
He'll say there's no perfect measure, which is why I've got a task force for that. It's because we need a new inflation framework. And the balance sheet we need a task force, and then FOMC members will move on it. So, yes, you're going to keep hearing about the task force.
It's funny that the Bank of England borrowed Ben Bernanke and the Fed's borrowing Mervyn King.
Yes, yes, indeed. All of these legends of central banking travelling around a little bit to share their expertise. And moving on to the Bank of England then, and thinking about what we get there. We're used to dissent at the BOE. Maybe it's a little newer at the Fed. Are we going to get quite a lot of dissent at the BOE this week, Janet, or just a little bit?
You're going to get dissent at the FOMC. I think you will get 2, maybe 3 FOMC members voting for a rate rise. And that's what markets will have to latch on, given they've got no forward guidance. For the Bank of England, you will still get a little bit more in the way of forward guidance. I think it's pretty much a done deal. You'll get 2 dissenters, the usuals. Hugh Pill has been the persistent dissenter, potentially Megan Green. It's possible you get a 3rd with Catherine Mann, but I think we're expecting it to be 7-2. And there is an expectation, certainly a lot of sell-side economists have been saying maybe we get more of a central forecast this time, which over the forecast horizon would actually have inflation a little bit below target in 2 years' time. But again, a hawkish hold. We stand ready because we know that the tensions in the Middle East, if we do not get a full reopening of the Strait of Hormuz, the oil price will grind higher. We've already seen Chinese imports of oil, which have played we saw a dramatic decline in Chinese imports of oil, down about 40% year on year in June. They've already started to come back in terms of July. So there is that real binary outcome. Is oil going to 70, 75, or is oil on its way to 150 if we don't get this reopening
and
of the Strait of
having
Hormuz?
An impact fiscally as well. A report from NISA this morning saying that the new Prime Minister, Andy Burnham, faces a £24 billion squeeze from UK inflation. When you look at the fiscal situation, do you worry that the new Chancellor, John Healey, isn't going to be able to leave a credible amount of headroom against the fiscal rules, even if they can say, yes, we met them? Is it not going to be enough for markets?
Well, you're right. Markets do want to see a certain amount of headroom. Partly, they want to see more now, and against a backdrop where from recent years we've had a persistent reduction in the amount of fiscal headroom, but because we seem to be living in incredibly volatile times. We have been since COVID with these unpredictable moves. So when you've got this huge amount of volatility and uncertainty, yes, markets need to see more headroom, but also they need to see a plan. And they need to become confident that the difficult political choices are going to be taken regarding reining in spending or raising taxation or some combination of the two.
So you see that as inevitable? Tax rises, spending cuts?
I think, yes, there has to be some combination of the two, and it's no use saying, well, we'll do all of that in year 5 of the fiscal plan by keep saying, well, by 2029, 2030, debt to GDP will be on a declining trend.
Yeah, we typically in the UK expected a lot in the future, haven't we, in terms of that fiscal consolidation. Let me just dip into some micro news to ask you a macro question. And this is BMW, a headline from BMW this morning, then a red headline on the Bloomberg terminal, Janet, saying that BMW is offering severance packages to thousands of its German staff. I mean, this just taps into the underlying weakness of the auto sector. It's a sector that's trying to pivot to all sorts of things, to defence and supplying other parts of the German landscape. I wonder your expectations for the German economy, given we keep hearing from lots of corporates about higher energy prices weighing on European manufacturing and European industrials. But at the same time, the German fiscal engine is now up and spending quite a lot of money on defence and infrastructure. What is the outlook for the German economy, do you think, right now, Janet?
Well, I think the kind of potential growth rate of an economy that has lost quite a lot of competitiveness over the course of the last decade, that has been very dependent on the auto industry in particular, and now they face enormous competition globally, and obviously they're not at the forefront of electric vehicles. They've got those structural headwinds as well as the demographic challenges. So the kind of speed limit for growth without igniting inflation is very low for Germany. Maybe it's 0.5%, if that. So that's your base case. and now we have got the fiscal spending on top of it. So while you may have had the excitement a year or more ago regarding the role of fiscal policy, everything takes a bit longer. We think it will be adding to growth, but exports are not going to be the engine for it. I think world trade growth is going to be a bit weaker. So, yeah, it will be the usual story of a quarter slightly up, a quarter slightly down. We have got a mild technical recession in our outlook for Germany.
OK, Janet, thank you very much. Thanks for joining us. Janet Henry, HSBC's Global Chief Economist, going around the world with us there. Back to the UK, though, on a programming note, the opening trade will have special coverage of the Bank of England's rate decision. Don't miss the BOE decides, 12:30 p.m. That's tomorrow, isn't it, Lizzie?
Oh, come round quick. You'll be kicking me out to stand in the heat wave. But coming up here on the opening trade, a tech sell-off deepens on AI spending fears ahead of Microsoft and Meta's results. So we'll get more on those next. This is Bloomberg.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We're turning the corner. I tell my team we haven't quite finished turning the corner. We've got more work to do, but I am pleased with the progress so far. We're ramping up production across many of our product lines. Markets are very strong. So our backlog is very, very strong. So our story is really focusing on executing that backlog.
That was the Boeing CEO, Kelly Ortberg, there, speaking with Guy at the Farnborough Air Show. And the context this week for the aviation coverage is that the plane maker Boeing was out with results just yesterday, reporting a better-than-expected cash flow in the second quarter on continued strong demand for its aircraft. We're now looking ahead, though, to Airbus earnings due aftermarket today. Let's get a preview of what to expect. Benny Camel joins us, Bloomberg's managing editor for space and aviation. Benny, let's start with the civil side of things. I'd seen some headlines broadly, not Airbus specifically, but broadly around Farnborough, that maybe there hadn't been as many announcements of purchases of aircraft as some had been expecting. What do you expect on the civil side from Airbus?
So it looks like things are looking up, and we heard just now from Kelly Ortberg, who said we are turning the corner, and that is sort of the overarching theme really for the industry. This is an industry that has been through tough times over the past couple of years. COVID obviously was the big cruncher, but then in the post-COVID era we had supply shortages. We've now most recently had the wobbles from the rising fuel prices. That's sort of dampened supply or demand rather, and so all these things combined have led to a slightly problematic picture for Boeing and for Airbus, but to use Kelly Ortberg's words, they are turning the corner, and that's the sort of optimism that we heard from Boeing yesterday during their earnings. As you said, better than expected numbers, and it's also what we expect to hear from Airbus today. They gave a little bit of a teaser last week at the air show where they came out with long-term targets, and those are generally very well received. They think they can double profit, and the biggest part of that will come from the civil side. So Airbus is best known for its planes. They also make helicopters, they make rockets, they make defense material, but really the civil side is what's going to push the performance of this company, and that's what we'll focus on tonight.
Well, how healthy do you think the outlook will be for the defence side, Benny? Because, you know, we talked a lot during Farnborough about the appointment as Chancellor of the ex-Defence Secretary here in the UK. We've talked a lot about defence spending across Europe and tensions rising in the Middle East. Where does that leave Airbus?
Well, one big question that has come up and that was discussed in Farnborough is how much can Europe sort of assert its own sort of dominance, and how can it create a sense of dominance for the region? How can they wean themselves, as it were, off the US? Obviously, the US is an important partner within NATO, but also as a provider of advanced weapons. But Europe is trying to sort of create its own environment for that, and Airbus plays a key role in that. It is one of the biggest defence manufacturers in the region, alongside companies like Rheinmetall here in Germany or BAE in the UK. And we have seen rising demand for defence products, and that is something that will feed through to the bottom line of Airbus. The defence business was traditionally very up and down, more down really than up over the years. Lots of charges, lots of things that didn't go right, and in the last couple of quarters they have sort of found their stride. So again, something that we expect to see in the numbers tonight, a more upbeat picture, particularly on the civil side, but also the defence side certainly helps.
OK, Benny, thank you very much. That's Bloomberg's Benedict Camel there. And stay with Bloomberg for an interview with the Airbus CFO Thomas Terpfer later on today.
Let's turn our attention to technology. We'll get a good read, perhaps, on the global tech landscape when two of the Mag 7, Microsoft and Meta, report their latest results later on today. Let's bring in Bloomberg senior strategist Neil Campling, who can get us set up for these big tech events yet to come. Neil, good morning. So what are the expectations around these two businesses? So far, it seems to me the market has not responded well to either higher CapEx or just incredibly large CapEx, based on the example of two, which is, what did we have, Alphabet and SK Hynix.
That's right. And I think the other thing to consider here is that two measures that the investors will demand to see are growth in terms of decent revenue growth to justify CapEx spend. But the other measure that we need to look out for, obviously, is free cash flow. And that's what kind of spooked some investors last week with Alphabet's first ever quarter of negative free cash flow. It's likely that Meta will have negative free cash flow tonight as well in their quarterly results, which may concern investors. And then the other way of scoping this out, of course, is that the CapEx increases that we're seeing. Now, a third of that CapEx being spent next year is expected to be on memory within that. So where you've got Hynix with its reports today and a six-fold increase in profit, at the same time, 50% increase in their own CapEx. So it's got these different sort of these data points which are necessarily inflationary in the short term and takes a long time to feed through in terms of the guidance for that spend.
Neil, you've also got all these fears about circular funding rearing their head again. We were speaking to the ASM International CEO earlier on about those concerns. Just take a listen to what he had to say.
The semiconductor cycle is the name of the game, and it's something that's very normal. But what's very important is that the fundamentals for AI in the medium and long term are still there. So we're really not concerned from this point of view. And as far as we're concerned, okay, what's happening is that the need for leading edge technology is going to continue unabated for a company like us. It's being driven right now by AI, and it's needed to be driven by AI.
Do you agree with that from Hichem, that the fundamentals for chip stocks are still strong?
Today, yes, but chips are cyclical. And if you're an equipment company, you're not going to see a change in the demand dynamics from your customers for a year or 2 years' time, but those can change. And if we look at historically, if you're looking at these stocks on a price book basis, they are elevated relative to trends. So the fundamentals are strong at the moment. In the meantime, token prices are coming down significantly, which means, and tech should be deflationary by nature in terms of its use over the long term. So to get ubiquity in terms of usage, you have to see pricing coming lower. And at some point in time in the future, visibility will reduce and demand could have issues for the chip equipment companies.
That AI inflation link, we might hear more about that later on from the Fed. Thanks very much, Neil. Bloomberg's Neil Campling. Let's take a closer look at the markets then with the Fed in mind. Skylar Montgomery-Coney joins us from our Markets Live team. Skylar, I will ask you about the Fed then, because it's Fed Day and we haven't talked as much about it because, of course, we've got a lot of earnings to deal with. But the market has been... it's been quite exciting, hasn't it, to watch market pricing around a Fed hike, because I think we're suggesting that there's going to be a hold, but there's been 30-40% expectation of a hike this week. I mean, that's not nothing.
Yeah, exactly. It feels like a very binary outcome today in terms of, on the one hand, you have consensus very much saying it'll be a hold. You had a softer inflation print in June that should, in theory, give them some space. And they've been on hold for so long that you'd think that would be a natural progression before you had more data, particularly because in September you get another forecasting round. You have 2 more big data rounds before then to look at. But I think on the other hand, you have market pricing kind of pushing it in the direction of a hike, because there's this idea that Warsh will want to shore up his inflation fighting credibility, that inflation is already 2 times target, and you have a resilient economy. I think today that very much moves pricing in terms of it's a wobble for the dollar, it's lower yields if you have that hike not delivered. If the hike is delivered, it's very problematic for equities. It means a stronger dollar, higher yields. I think longer term, though, it doesn't matter as much, right? We know where the direction of policy goes. It's whether or not that hike comes today. So it's a timing issue, not a direction issue.
OK, and obviously it comes back to the oil price in large part. You say that the path of least resistance for oil is upwards. Why?
I'm absolutely so puzzled by why we aren't higher now. In terms of last week, we were at $100 a barrel. Now, that came down over the weekend because U.S. and Iran stopped fighting. Overnight, they started again. And the big things that got us there are still in place, in that there's not ships transiting through the Strait of Hormuz. You have worries around energy infrastructure still being targeted. And the big development last week for me was the fact that Saudi facilities were being targeted. And so that didn't even stop over the weekend in terms of some of your big facilities on the east-west pipeline that have a lot of the kind of release valve or helped in terms of mitigating factors for Hormuz closing. That's now under threat. And so I really think even if you just get a continuation of the current pace where reserves have drawn down quite considerably, nothing's going through, the bias is of higher oil prices.
Skylar, we're heading towards the end of the month, aren't we? The end of July. Does that, I mean, it's been volatile on the tech story, certainly in Asian markets. And to some degree in US markets as well. We've seen quite a lot of volatility, quite a lot of pullback. Does that get worse as we head towards the end of the month?
Yeah, I think for Korea, we're certainly not in a safe zone yet by any means in terms of, yes, we've fallen 40%, but I wouldn't even classify that as a bear market yet because we're not even oversold, right? If you look at an RSI measure, it's not oversold. Today, we just went through the 200-day moving average. If you look at leveraged ETF exposure, that's kind of undone half of what we had working up into this year. The good news is that the volatility hasn't spread to other markets, and that standard deviation moves in those markets are still pretty contained if you look at even NASDAQ tech-heavy stocks. I think the bad news is you are seeing more of that leakage into tech in terms of it's a global issue, what you're seeing, in that you have huge capex globally. Whether or not that translates into a return of investment is very much a global issue. You have increased Chinese competition. You have greater cost of capital. And so as we head into earnings this evening, we've seen that tech struggles even on very strong results. And we have big macro events into month end in the Fed and the Bank of Japan, et cetera.
OK, well, NASDAQ futures just flat to the downside as we leave things. Skylar, thank you very much. Skylar Montgomery combing there from our Bloomberg Markets Live team. That does it for the opening trade. The Pulse is up next. Euro Stoxx 600 currently flat as a pancake. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The tech rout deepens over growing fears of AI spending as SK Hynix slumps despite a massive jump in quarterly profit. Banks get a boost. UBS beats quarterly profit estimates and Deutsche Bank's fixed income trading revenue jumps. Plus, oil rebounds as the U.S. has it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's, Fed decision. So there is quite a lot going on in the markets. U.S. stocks seem to be on a rise. Traders holding off, though, doing any major bets ahead of U.S. interest rate decisions, but also earnings from Meta and Microsoft. Again, these earnings will be closely watched because they kind of also arrive at a time when the AI trade is really faltering, with a lot of traders questioning whether
whether this vast spending behind the global build-out can actually deliver returns. And I'm looking at Brent, 87.31. It did briefly rise above $87 a barrel, rebounding from its biggest three-day decline since April 2020, following a flare-up of violence in the Middle East. It's now at 87 well, it's still actually above 87. The picture in Europe is really one of watching what's happening with the Fed and the Strait of Hormuz. And you can see a little bit of, I guess, flatness for the DAX and the CAC, and then the FTSE is gaining 0.5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's a big day for earnings with some of Europe's major banks reporting. We'll tell you how they performed. Of course, it's also Fed Day, and we'll have a preview a little bit later. Now, geopolitics front and center, again, as the uneasy calm in the Middle East is shattered. But it's also the tech story that's, again, driving markets. SK Hynix shares down sharply today after second quarter operating profit missed estimates despite jumping more than 550%. Now, investors are concerned that the firm has earmarked at least $31 billion in capital spending this year. Microsoft will give an update on its data center spending later, while investors, of course, will also hear from Meta's efforts to build a cloud business. Well, we're now joined by Shona Ghosh, our EMEA tech editor. We're also joined, of course, and to discuss what it all means for markets with Natalia Lipikina, head of EMEA equity strategy at JP Morgan Private Bank. So thank you both for joining us. So look, SK Hynix is a little bit counterintuitive, Shona, because they had some good results, but the shares are getting slammed. Why?
The market's very irrational, it transpires. So as you say, that operating income is up more than 500%. These are stellar results. The numbers across the board are excellent, but investors are increasingly concerned when they see capital expenditure from any company going up, particularly when that capex is a record, as it is in this instance. We've seen across other tech companies, not necessarily chip makers, Google moving into negative cash flow as a result of its rising capex. So these rising numbers are increasingly something that investors are scrutinizing alongside growing revenue and profit.
Natalia, when you look at the sector as a whole, like what exactly is priced in at the moment?
Well, I think back to what you were saying, good morning. I think the market is just trying to rationalize and really scrutinize the capex increase and also what it means for the return on those investments. It can be revenues, it can be operating profits, it can be cloud growth, and I think such a big focus tonight and tomorrow as to what the companies will be delivering. To me, that's probably the story in the markets right now, and the market will definitely be looking into the free cash flow of what those companies are reporting.
But Shona, has anything changed? And if you go back to Google last week or SK Hynix today, it is about growing AI spending concerns. But we've had those. Is there a piece of news that the market is latching onto, or they're just going through the numbers and are becoming restless in terms of the time frame it will take to build it out?
Yeah, so there have been reports that China, which is quite limited in terms of the cutting-edge US chips and European chip-making equipment that it has access to, is maybe able to produce some somewhat cutting-edge, maybe more like mid-tier chip production machines on its own. These are DUV machines, which are mostly produced by ASML out of the Netherlands. ASML has also had stellar performance because it has a stranglehold on this element of the chip production market. But it's very bad news for ASML and some of its related suppliers, and perhaps the broader market, if China is able to produce its own chip-making machinery that could bolster the advances in its AI chips and therefore, be on par with the US and Europe, particularly the US, in terms of amazing AI models, cutting-edge tech. So far, it's a little behind, but we're seeing more and more with the release of K3, for example, the AI model that came out on Monday. These advances are happening quite rapidly. So any even quite small rumor that China is advancing can be enough to send the market sideways.
So I'll ask you in a second how the market or how investors should play this. But actually, what are you expecting from Microsoft and Meta that are reporting later?
Well, again, everyone will be watching CapEx very closely. These are two of the biggest spenders, both in terms of data center leases, so how long they'll sort of occupy a data center and the rent they'll pay, as well as CapEx, building those data centers. And investors will be looking quite widely across the board because those costs are split out across different areas of the balance sheet. So I think you'll see quite close scrutiny of the expenditure there.
So, Natalia, if you're an investor today, how do you look at AI? Do you still are there parts that are unloved, or has everything been bought and overbought?
We still do like the parts of the AI trade. So when we think about different sectors that will benefit, you have hyperscalers, and everyone is very focused on the return on those investments. And when you look into hyperscalers, they actually have underperformed this year. We think to have back that trade, you basically need the hyperscalers tonight, tomorrow, confirming that there is a return on these investments. We believe that if your time horizon is 1 year plus, you're probably in the good place to be. For semis, I think the story is slightly different. For semis, you need to have the confirmation that demand continues to rise. We truly believe and continue to believe that demand is still there. But at this point, I think the market just scrutinizes absolutely everything. And we need to see that there is still a confirmation that demand is there. When I take a step back and think about what does it mean for markets, we're still constructive on the market. When we look into S&P, for example, we still see upside, 80-100 by mid-2027. We still think that we're in this super cycle, 20% earnings growth this year, double-digit next year, is still very solid. But at this time of the year, the market is just scrutinizing everything that has to do with AI.
But Natalia, do you actually have to take a calculated bet on how far or how near China is on some of these models?
Well, it's interesting because it's not really the first time we're hearing these concerns. We had these concerns a couple of years ago. So yes, it is concerning, but at the same time, this is not a new thing. And again, coming back to the point that I made, I just think that the market tries to find every single thing that can go wrong with the AI at this point.
Sean, I mean, the other big thing which happened 10 days ago, which we're still talking about, is some of these models, especially this latest OpenAI model, inadvertently hacking other platforms. Hugging Face. I mean, have we gone to the bottom of exactly what happened, whether it was prompts that weren't good enough, or can we make sure that it doesn't happen again?
We haven't got to the bottom of what happened, and actually more news keeps emerging. So we learned overnight that a sandboxing platform called Modal was also compromised by these models. A little unclear how that tied in directly to the Hugging Face attack, but we know, I think it's likely we will hear about these two particular models that, hesitate to use the term broke out, but sort of went beyond their instructions, let's say, and hacked Hugging Face. I think we'll hear about other platforms being compromised too, but the news is emerging piecemeal, possibly because some of these platforms in question didn't notice that they were under attack so early. So these systems seem to have sat there for many hours, which isn't great, to be honest. So I think it's a little early to say exactly what the scale of the hack was, but I think we will hear more.
Sure. Does it feel like it's part and parcel of just testing this out, or could we see regulation? I don't know. Are there consequences of this?
I think we will see regulation because no one likes the sense that, one or two companies have control, but actually they don't have control and no one's really regulating them. That's never a great place to be, particularly for technology that certainly they bill as particularly powerful. So I think we will, can expect at least some loose regulation. Maybe it'll be quite company-led regulation, sort of industry-led regulation, rather than something sort of from the government. But I think we will see some sort of movement towards tighter controls.
Does this have a direct impact on investors, or it feels like we're just at the beginning of trying to figure out where it ends? I've also heard of like a tech NATO type, alliance, but it feels very far away.
Yeah, I think, and I would actually agree with you. I think at some point there may be becoming regulation, right? As I mentioned, the market is just scrutinizing everything that is happening, but does it mean that it will absolutely impact the whole AI trade, right? We need to start and see what those models are, how they impact in the market, whether they're cheap to produce or not, what that it means for the CapEx spending. So I think at this point there are a lot of different unknowns. It's just the market tries to find the most negative news at this point.
Do you agree with that? In that it does feel like the market is testing because maybe they're trying to balance out the euphoria of the last 6 months?
Completely. I think, there's a big positive swing, and then now, any signs that that the kind of hullabaloo has been too much, I think, sends the swing back the other way. So, I think you see these big movements, and I feel like next week it could go the other way again. Who knows?
The roller coaster that is summer and tech companies. Thank you both for joining us. Shona Ghosh, RMA tech editor, Natalia Lipikina from JP Morgan Private Bank stays with us because we have to talk more earnings, and we have to talk about the Fed. Now, UBS has launched a new $3 billion buyback program after beating second quarter net income expectations as a 53% surge in equity trading revenue supported its investment banking division. And the bank's wealth business also saw stronger than expected inflows. Well, very old Guy Johnson is following the results in Zurich. Good morning, Guy. So what are your key takeaways from numbers and your conversations with Sergio Ermotti?
The key takeaway is that this is generally being taken as a fairly strong set of numbers pretty much across the board. There are highlights within the numbers, but the market broadly has taken UBS higher today. It's not been the case with all banks. Look at what happened with Barclays yesterday. But today, certainly UBS is moving on the upside. One of the key standouts, as you say, has been the equity division. What has happened with that equity division? It is plus 53%. Why is that? Well, there's a number of reasons for it. The most prominent one, and I talked to Sergio about this, was the fact that we are seeing significant amounts of volatility in the market. There's a kind of huge transaction wave as a result that comes from that, and UBS is really benefiting from that. Is that sustainable, Francine? I think is one of the key questions going forward. So I asked Sergio whether or not he thought this kind of volatility story that we're seeing, and you've been talking about what's been happening with the Cosby overnight, whether or not we will see ongoing bouts of volatility. This is what he had to say.
Look, if I look at the macro picture, the geopolitical picture, the ongoing debates, also the big dispersion we see in equity markets, and the pressures and on energy prices creates potential headwinds on inflation, and that may turn down to be something that investors will not really like, and creating potential volatility. So I do expect spikes of volatility to continue for the rest of the year.
So it's interesting. European banks have done well. They've done well in equities. UBS has done particularly well in equities. And these kinds of volatility incidents certainly are a big factor behind that. But European banks trail what we've seen over in the United States. Look at the numbers that have come out of JP Morgan. Look at the numbers that have come out of Morgan Stanley and Goldman Sachs. They're super strong. Is there a gap between where European banks sit in the equity story and where US banks lead in the equity story? And why is that gap? So I talked to Sergio about this a little bit, about this as well. And basically what UBS has done here has delivered this performance without any significant extra capital going into the equity business. So that's quite a positive thing. And the reason for it, he says, is that actually the equity business is there to serve the wider bank, the wider wealth business. This is a decision that was made back in 2012 after 2008 and the crisis there, that the equity division is effectively subservient to the wider bank's needs. And as a result of which, it is a price worth paying in the good times to maybe underperform a little bit, to have the stability that maybe you will have maybe in the bad times. So that's an interesting side of things as well. But why is this gap existing elsewhere? Are we going to see it changing? And the sense certainly seems to be not. And I asked him whether or not it's just a cost of being a Swiss bank, because that's a huge debate here at the moment. Is there a cost of being a Swiss bank? And he said, you know what, maybe that's a price worth paying. I am happy to be a Swiss bank right now. And that's going to be heard loud and clear by the government and the regulators. UBS is happy being a Swiss bank because there's this huge debate that is raging at the moment. The government wants UBS to have a higher capital standard. UBS says it goes too far. There needs to be a compromise. We're not yet there, but signs are that we're certainly moving in that direction. Francine.
Guy, thanks so much. A great interview, which you'll also hear in its integrity a little bit later in the program. Guy Johnson there in Zurich. Now, still with us, Natalia Lipikina from JP Morgan Private Bank. Natalia, I mean, I don't know whether this is just symptomatic of the wider earnings story in Europe so far, which is they're fine, they're good.
I would just pick up on the discussion about the banks, because lots of banks reported this morning, but overall what we're seeing is a very strong story. You're having obviously very strong investment bank division results, but also loan growth and deposits, they're all coming through. The ECB just hiked rates recently, and it's all going through the banks. It's a very similar story to the US. In the US, the banks kicked the earnings season a couple of weeks ago. It was very similar. Very strong loan growth, especially in commercial loans, shows that, the whole CapEx activity is showing up for the banks, but also deposits as well as investment bank. So we feel like this is part of the market that is doing well. In fact, that outperforming the market months today. We'll feel pretty comfortable with the bank story. But also taking a step back, if you look into the overall earnings season, it's pretty solid, especially in the US. It's the 7th consecutive quarter of double-digit growth.
Yeah.
If we
impressive, really impressive, actually.
Yes, if you think about it's now ending, well, close to ends at plus 27%. If you exclude some of the gains, it's much better than what the market expected even 3 months ago. And it's the 2nd consecutive quarter of plus 20%. Was there not to like?
And actually, when you look at some of the indices, I mean, you're expecting the S&P 500 quite a bit higher by mid-2027. Is there anything, I mean, is there one big bet that could derail? Again, if you look at the earnings, but the question marks around AI, what's driving this?
Yeah, if you look into what is driving the earnings, especially this quarter, for example, it's still tech. So if there is one risk to our constructive view, it's the tech story. If the tech story is not panning out the way we think is, then probably there is a risk. But we still remain quite constructive. And as you mentioned, 82 by mid-2027 is our forecast.
Natalia, when you look at the Fed, I mean, there's a little bit of anxiousness actually after Citadel Securities, made a call for actually a Fed rate hike, or said that they would hike. Like, is there a benefit for delivering a rate hike now?
Look, when you look into the market expectation, the market is probably expecting a hawkish hold. I would characterize that. 30% market expectation that they will hike. We don't expect a hike today. We think it will all about, the guidance and how they think about the oil price. The CPI print recently was actually quite okay. It's all about the oil price at this point, which is seesawing, as we see. But we think that probably the Fed will be on hold today.
I mean, how much does the equity strength, but also in general markets, depend on what happens with the Strait of Hormuz, which frankly is anyone's guess, because there's diplomacy, there's talks, but actually then we go back to square one?
Yeah, you're absolutely right. The market is watching the oil price, but I would say the market will be, if oil is going up higher than 110, 120, this is where you may see a pressure on the equity markets, because this is the level at which, the market will be questioning what impact oil price will have on earnings. But it was interesting to see that oil sharply sold off earlier this year, right? So the market is still expecting that at some point oil may actually come down, and that will be the tailwind for the market.
Natalia, thank you so much, as ever, for joining us. Natalia Lipikina, head of EMEA Equity Strategy at JP Morgan Private Bank. Now, coming up, a days-long pause in fighting in the Middle East ends, increasing the risk of a return to a full-blown war. So we'll have the latest on this next, and this is Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience.
Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
Oil has surged after the U.S. says it intercepted an attack on American military bases in the Middle East. Now, U.S. Central Command says it joined Saudi forces in retaliating with strikes on Iran-backed militants in Iraq. Now, the latest flare-up brings to an end days of relative calm. Well, let's get more from Paul Wallace, who leads our coverage in the Middle East and Africa. Paul, thank you for joining us. So just bring us up to date on the latest attacks.
So there was a lot that happened overnight. As you mentioned, these joint U.S.-Saudi attacks on the positions of Iraqi militias, that's very significant. The first time that we know of that Saudi Arabia has attacked Iraq in years. And this has... The activities of Iraqi militias, many of whom are backed by Iran, has the potential to open up a new front. Iran is denying that it's involved with anything that the Iraqi militias have been doing recently, and they, in the past few days, have been attacking Saudi Arabia with drones, attacking Saudi Arabian oil facilities with drones. But even though Iran denies that it has anything to do with that, its links with these groups are very strong. It funds them, it trains them. And so certainly this will be seen by the Americans and by Gulf Arab states as part and parcel of the U.S. war with Iran. So it's a pretty dangerous escalation just days after everything that happened around the southern Red Sea with the Houthis and them attacking ships in Saudi Arabian territory. So yes, as you say, the sort of relative lull that we've had over the past few days seems sort of well and truly shattered for the moment.
So, Paul, what does this mean for the prospects of a truce?
It underscores, I think, just how far away the U.S. and Iran are from a return to formal negotiations, let alone a permanent end to the war that sees the Strait of Hormuz reopened and Iran agreeing to a deal that curbs its nuclear program. That seems like a long way off at the moment. We're simply, or the sides are simply trying to get to a point where there is a ceasefire that actually holds and where traffic can pick up through the Strait of Hormuz, even if the vital waterway isn't fully reopened, and that's left to these sort of wider negotiations.
Paul, thank you so much. Paul Wallace there with the very latest, of course, on the Middle East. Now, Ukrainian President Volodymyr Zelensky says he discussed Patriot air defenses and diplomatic efforts to end Russia's war during his White House meeting with President Trump. Zelensky also described the talks as productive as Kyiv looks for ways to deter Russian attacks.
So now Putin is losing 30,000 his soldiers per month. This is big, too much losses, like President Trump says. It's many losses, but he doesn't want to stop this war. So now initiative not in the hands of Putin.
Let's bring in Greg Sullivan, our Russia economy and government editor. Greg, good morning. A very positive interpretation by President Zelensky. What was your reading of these discussions?
That's right. Both Ukrainian President Volodymyr Zelensky and the White House seem to strike a positive note coming out of those discussions. In reality, it's potentially a bit more of a mixed picture for Zelensky and Ukraine. On the one hand, Zelensky does seem to have warmer relations with Trump. You will remember that last year there was that infamous blow-up in the White House. Relations between the two leaders were a bit more fraught. That seems to be behind them now, with Trump even praising Zelensky and Ukraine's battlefield performance earlier this month. So that's a positive for Zelensky as he seeks to keep keep that relationship on his side. But Zelensky did go to the U.S. seeking air defense for Ukraine as it faces these Russian onslaughts and airstrikes. It's unclear whether he actually secured more air defenses in the interim. We do know that they discussed the domestic manufacturing of the Patriot missiles that Trump said he would allow Ukraine to do under license. That's going to take a while to get up and running, and Ukraine does have a shortage of these interceptors in the meanwhile. So he needed to secure those. It's unclear if he did or what comes next or how those next steps will play out.
Overall, where do we stand on the war? Is there any hope for ending the conflict?
Well, that's also a pretty fraught picture. We did hear from the Ukrainian leader last week that he met with U.S. envoys, or that he discussed with U.S. envoys restarting diplomatic efforts. But right now, there's really no sign that U.S. brokered talks will resume. They've been stalled since February as Washington has been distracted by or focused on the war in Iran. Right now, there doesn't seem to be momentum to return to the negotiating table. And from the Russian side, quite frankly, Putin has stuck to maximalist demands. He's still demanding territory that he doesn't control militarily, and he hasn't really shown a willingness to negotiate an end to the war or back away from those. So it's hard to see where a negotiation actually goes from here, but the first step would obviously be returning to the table, and right now there just doesn't appear to be much momentum towards that.
Greg, thanks so much. Greg Sullivan there with the very latest, of course, on Ukraine. Now, this is the picture across the board for European indices. Look, this is what I would overall say. First of all, UBS shares are gaining as much as 2.4%, but the wider picture is really what we're seeing with not only AI, but also the Fed. U.S. stocks are edging higher, traders holding off any major bets ahead of a U.S. interest rate decision. And then, of course, we're looking at earnings from Meta and Microsoft. Coming up, we'll be speaking to the chief executive of one of the world's largest testing, inspection and certification companies as they raise their guidance. That's coming up next. And this is Bloomberg.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua in London, and these are your top stories. The tech rout deepens over growing fears over AI spending. SK Hynix slumps despite a massive jump in quarterly profit. Banks get a boost. UBS beats quarterly profit estimates, and Deutsche Bank's fixed income trading revenue jumps. Plus, oil rebounds as the U.S. says it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's Fed decision. So let's get more on the Fed now, which is expected to hold rates steady later today. Traders eyeing a near 1 in 3 chance of a surprise move higher as the central bank grapples with inflation pressures. With a preview, let's bring Alistair Bull, one of our senior editors. Alistair, good morning. A hold is not necessarily a done deal.
Not at all. I mean, this is probably the most legitimately uncertain FOMC meeting we've had in years, and that's really down to a couple of factors. On the one hand, Kevin Walsh, the new chair, has been very careful and very cagey about not showing his own hand, about his preference. He's deliberately said he doesn't want to provide forward guidance. And then you have half the committee who we know from previous projections want to raise rates, and the other half who sounded happy to stay on hold. And the ones who want to stay on hold have a pretty legitimate case. I mean, the CPI print was softer in June, payrolls undershot, and showing a little bit more patience now, holding off at least until September, would give them another 2 months worth of inflation data that could validate the belief that some people have in the markets that inflation peaked in May and that the right strategy is to stay on hold. But the reason the market's pricing a third chance of a hike is there's good strategic reasons, not least Walsh's own very hawkish comments, to raise rates now, do it preemptively, buy a little bit of insurance, and also act well before the midterm elections in November. Francine.
Alistair, the Fed has kept rates on hold this year, so how much longer can they actually afford to do so?
That's going to depend on the data. If the data come in on side, it shows that CPI and inflation peaked in May, then staying on hold was the right call and Walsh will be a hero. If they don't get those numbers coming on side, then they may have to go harder and go higher and do so in the politically perilous environment of a tightly contested midterm election, which is going to draw a lot more fire from President Donald Trump, who, as we all know, wants lower rates. So, I mean, no pressure, Kevin. This is going to be a very tough call, and it's going to be a very interesting press conference where we're going to listen very closely to his words for guidance, if they do stay on hold, for how much more patience he has, Francine.
Alistair, thank you so much for the terrific briefing, as always. Bloomberg's Alistair Bull. Now, shares in France's Bureau Veritas surging this morning after lifting its sales growth target. Now, the company is one of the world's largest testing, inspection, and certification firms. And as businesses navigate trade disruption, supply chain challenges, and the energy transition, demand for compliance and, of course, risk management is evolving. So let's discuss the outlook with Hinda Gharbi, Chief Executive of Bureau Veritas. Madame Gharbi, thank you for being with Bloomberg this morning. First of all, your share price is actually, higher, so congratulations on that. But your company really provides testing and certification across a range of industries. So what are you seeing in terms of economic outlook? Are you positive? Are you worried? Who's doing what?
Good morning, Francine. Look, we're very pleased with the results for the first half. The business environment is obviously complex. I just listened to the segment before. But what distinguishes Bureau Veritas in this market is we're a very diversified, decyclicalized group, and we've been working to continue to do so. So we are rather balanced in our view of how the market will evolve. We think our market fundamentals are particularly strong, even if the backdrop of the macro environment is complex, and we have been pivoting our portfolio and rotating our portfolio to align it with the fast-growing, resilient segments of this market. So our view is to continue to cautiously monitor situations like the Gulf, of course, the conflict we see in the Gulf. But what's important for us is to continue to control what we can, which is executing on our strategy.
When you look at the Middle East, how are these renewed tensions actually affecting your clients? And has there been an impact on your business there?
Well, there was some impact, of course, once the flows of oil couldn't leave the Gulf. There were some impacts on our oil and petrochemicals activity. But what we have seen, we've seen resilience in capital projects where plans have been maintained, a bit more softness on any of the OPEX activities where there is a little bit more discretionary decision making there. But overall, I would say this is a very important region for oil production, of course, and a number of projects continue to be maintained. But of course, some cautious on whatever could be controlled in the short term to preserve cash.
Yeah. I mean, given all of these geopolitical uncertainties, what do you think happens to inflation, and how are you projecting your own growth in the next year?
So it's an important question because inflation, of course, is something we monitor very closely, and we have built a good, I would say, response program to deal with that from a pricing perspective. So we work in over 140 countries, Bureau Veritas, and therefore we're exposed to inflation in different parts of the world. And we've developed, as I said, a response plan to manage pricing with regard to inflation. The service we do is an essential service and therefore very necessary for projects, for companies to operate.
You've also acquired Lotus Work. I think it's the biggest acquisition that Bureau Veritas has done in the last 10 years, and it really specializes in critical tech facilities like data centers and semiconductor plants. I mean, this is the thing we talk about every day. So how important will that business be to your growth?
Is very, very important. We're part of our strategy to develop our buildings and infrastructure segment, which represents 30% of our business, is to move towards more complex assets, and data centers, semiconductor fabs are these kind of assets. Lotus Works specializes in commissioning and quality assurance and quality control in the semiconductor space and also in the data center space. So we've been really developing our portfolio around these mission critical assets, and we think that will be highly accretive in terms of growth to the company, and they allow us to be in spaces that have high barrier to entry because the expertise is very deep, and the capabilities, you need a long time to develop these capabilities for commissioning.
So in 5 years, if you look at some, I mean, there's questions about AI infrastructure, of course, but also volatility, valuations, potential bubble. If I speak to you again in 5 years, how much will testing of AI infrastructure be within your portfolio? How much will that grow compared to other businesses?
I think I'm more optimistic on the AI development. We work in so many sectors of the economy. The adoption is real. The capabilities of the technology are unusual in a way, and very fast adoption we have seen. So therefore, we consider that the underlying market continues to be strong, and we think that the growth is going to be strong. Just to give you a perspective, we started this activity of data center since 2017. We have multiplied the small acquisition we've made by 7 times since then. So you can see the kind of growth we've seen, and we think it will continue. Of course, the capabilities will be developed further to ensure we are expanding across the full services needed for these assets.
You also announced last month that you were in talks to sell off some of your oil and petrochemical operations. Are you any closer to sealing off that deal and sell them off?
Look, we've signed an agreement with Triton Partners to pursue this deal. I think we are on a good path. Of course, it's not done until it's done, but it's definitely a key element of our strategy to rotate our portfolio. And we consider that this activity for the future is not an activity we would like to keep, and that's why we've been working quite a bit now to achieve that. So yes, I'm rather positive that we should be progressing.
I mean, it's going to be a big year politically in France over the next 12 months. Do you worry about volatility? Do you think clients in France will delay decisions until the presidential election next year because they don't really understand what will happen?
Well, look, France is a historical position for us. It's our home country. We have expertise. We have a good position, but it represents, it represents around less than 20% of our business, rather 16% of our business when we operate in the rest of the world. So we monitor the situation very closely, and we prepare for ourselves for how the market will evolve. But at the end, it's not as big as one would think, being a French heritage company. So we're cautious. We monitor how things will progress, but we have a very resilient business in France, exposure to OPEX and regulatory activities, which tend to be stable.
Hinda, thank you so much for joining us. Hinda Garbi, the Chief Executive of Bureau Veritas. Now, Rio Tinto has posted a jump in first half profit on the back of strong commodity prices. The miner says it will double down on efforts to cut costs and build cash by boosting productivity and selling non-core assets. Now, the Chief Executive, Simon Trott, has been speaking with Bloomberg.
Iron ore remains a really strong market for us. We've been talking for years about the maturation of China growth, and you're certainly seeing that come through. It's been far more resilient than I think market pundits had expected because of that underlying demand. And whilst construction in China has slowed, you've seen a real pickup in export-related steel demand, so secondary and tertiary products, and that's led to fairly robust and stable pricing outcomes in the market. We continue to engage with all market participants, including CMRG, and so through the ordinary course of business, we renew those contracts, and that's the phase we're in at the moment.
You've talked about that market evolving, though, and obviously at the moment that the economy is in a K-shaped recovery, and the property sector, fixed asset investment, probably isn't going to come back unless they return to the old economic playbook. Do you see the plateauing going downwards? What sort of a sharper slowdown might you be envisioning?
We've certainly seen over a period of years that construction segment slowing down, and it makes up a relatively smaller portion of our book now compared to 5-10 years ago, whereas really one of the big drivers. And as I say, you've seen that demand being replaced by export related, not necessarily steel exports of themselves, but related to the increase in manufacturing within China and those products flowing to the rest of the world. I think domestic supplies and scrap have probably been a bit less in terms of on the supply side than predictions, and so that's led to stronger pricing outcomes and pretty good cost support. Is probably the last point I'd make. Increases in raw materials, particularly energy, has meant that it's pretty well supported prices on the right-hand side of the cost curve.
Obviously, more strategically important going forward is the role of copper, right? And prices demand has held up pretty well this year. Beyond Oyu Tolgoi, where do we look next in terms of guaranteeing future demand?
So one of the things we outlined today is around 70% of the raw material cost of a data centre comes from the materials that we produce. So, aluminium, copper, lithium, as well as steel. And if you look forward, the spend next year on from hyperscalers, $1 trillion. And you convert that across, that's a lot of lithium, aluminium and copper, and so really excited about how we're positioned for the future. Fortunately, we've got Oyu Tolgoi, which is ramping up to the 500,000 tonnes of capacity. That ramp-up's proceeding according to plan, and really pleased with the way that asset continues to perform. Kennecott in the US, one of only 2 copper smelters, and then a big pipeline of growth beyond that.
Well, that was Simon Trott, Rio Tinto's Chief Executive. Coming up, an earnings boost for 3 of Europe's biggest banks. We'll dig into the details and hear from the C-suite. That's coming up shortly, and this is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Well, the latest numbers from UBS really show that wealth management assets are beating estimates and trading revenue surging. The lender has announced a $3 billion buyback. Our Guy Johnson asked the chief executive, Sergio Armotti, about the buyback as it comes amid ongoing uncertainty over the bank's future capital requirements.
The issue is that what we have is this programs that we have to file with the stock exchange in terms of buyback programs that we can execute in theory over 2 years. And our capital return policy and ambition has been set at the beginning of 2026 when we say that our aim was basically to start with $3 billion and then assess the situation at the end of the first half. So what we do now is we have a new plan, a new program that, and we intend to execute it over the next 12 months. But the pace and size will be determined by our capital position, so staying at 14%, and also the ongoing development in the business, which we are very positive of, but also the ongoing discussion on too big to fail, like we did in the last 2 years. The language hasn't really changed.
The language hasn't really changed, so I shouldn't expect in 3 months' time some clarity on too big to fail.
The billion has to be seen as a minimum commitment that we will do, rather than putting a clear indication on anything more than that.
Equities, very strong. Plus 53%, I think, is the number. That's a nice number. The surprising thing is that you've done it without any extra capital. That's the real standout here. Let me ask you the same question I asked Venkat at Barclays yesterday. If you'd have given that division a bit more extra capital, if you'd have funded it differently, if you'd have provided more for it, could that number have been significantly higher? Are you throttling back equities at the moment? How high could that number be?
Not really. Actually, what we did, the point you raised is a good point, but what we did within the investment bank, we also shifted some capital from the fixed income businesses to the equity business to help them. But our focus is really, which I also believe that the numbers are very strong because they are mainly driven by intermediation activities. And rather than deploying capital in prime brokerage. But going back to your story, this is more about our strategic capital allocation at group level. We made that decision in 2012 that our investment bank fits strategic ambitions that we have to support our wealth management clients, our institutional clients, our corporate clients, but with a defined capital allocation. So we had ups and downs in times in which was very rewarding to have that, and times in which you may have some opportunity cost. But when I look at the full results, a 23% return on allocated capital for the investment bank is pretty strong results. So we are very happy with it.
Okay, but let's the opportunity cost. Let's just talk about the opportunity.
Yeah, but the opportunity cost.
JPM did 86%.
Yeah,
could you have done that kind of number?
Yeah, but is not something. If and when doesn't matter, because I think our our philosophy, our capital allocation, and our stock is rewarded by this business mix and not by taking opportunistic and tactical view on momentum in any of our businesses.
Do you think if you were a US bank, you'd do something close to, what was it, 86% for JPM, Goldman Sachs did 71%. If you were a US bank, do you think you'd get those kinds?
It's too hypothetical to answer that question.
Well,
we are not a US bank, we are a Swiss bank, and we are very happy with that kind of business.
You can see where I'm going with that, if you re-domiciled. Is there a cost to being a Swiss bank?
I think there are also a lot of good opportunities, but of course things have to be fully balanced. But I'm very happy with our results and what we achieved as a business mix, right? So if you look at wealth management, you look at the Swiss business, asset management, and the investment bank all together put up a very strong set of results.
UBS Chief Executive Sergio Ermotti there speaking to Guy Johnson in Zurich. Now, it's been a big day for earnings at some of Europe's biggest banks. Standard Chartered and Deutsche Bank both beating profit expectations. Charlie Wells has all of the details. Good morning, Charlie. So what have we actually learned from these two banks this morning?
Well, Francine, we've learned that these banks really have been having a show of force, and that is translating into their share prices in the market. Right behind me here, we've got Standard Chartered up well over 4% this morning. Now, this is on the back of a very strong earnings report. Let's take a look at some of the standout points from that earnings report that we got this morning. Now, we heard, of course, this $1 million share buyback. Now, investors love those buybacks, but what's also really striking here, and we've been really paying attention to this, is strength coming from their wealth management unit. Now, the wealth management unit is really important for Standard Chartered, and there have been concerns about that. Let's flip and take a look at why. If you take a look at the share price of Standard Chartered this year, they are currently flirting near all-time highs, but if you look at early June, you can see that dip there. Now, that dip is related to Chinese authorities trying to limit the flow of money out of mainland China to places like Hong Kong. Where does Standard Chartered have a lot of exposure? Hong Kong. But investors are calm this morning, in particular because of the strength coming from that wealth management unit. We're seeing a return to force here for that share price. Now, again, that confidence is really giving the bank, a justification for that buyback. Let's take a listen to CEO Bill Winters talking about that return.
We're protected against whatever pullback or surprise may come, but we are investing fully in the business. So, $1 billion buyback, but we're investing, well over $2 billion of cash into our business year after year after year and growing. So, first and foremost, we invest in growth.
Yeah.
We take the surplus and return it to shareholders.
So that was Bill Winters talking about that buyback. Now, this has really been the theme of the morning, share buybacks. We also heard about a 500 million euro buyback from Deutsche Bank. Investors, of course, love that. That bank up well over 5% this morning. Let's take a look at some key points from their earnings report as well. We got that 500 million euro buyback, but also what really stood out this morning was fixed income trading, up some 16%, now beating a number of Wall Street competitors. I really want to zoom in on this because this really puts it all into context. Let's bring up and see how Deutsche Bank performed relative to some of its Wall Street competitors. You can see here that increase in the quarter year over year of 16%, beating a number of these major Wall Street players and also beating the average. So, of course, we see behind me Goldman Sachs up much more, but the average was 13%. So on FIC, crucial to Deutsche Bank because they did not have that equities trading business. They really got a strong beat here, but that wasn't it. Let's take a listen to CFO Raja Akram talking about the litany of records that Deutsche Bank had this quarter.
Not only is it a record second quarter, but it's also a record first half for us. But what's extremely pleasing is you mentioned the significant beat on investment banking, but actually we had record flows from asset management, almost 9% growth from our private bank. Our corporate bank is continuing to show signs of progress, which we assumed. Continuing to invest across the franchise. Capital position strong. We announced another buyback today. So I think all in all, I would say in this political and geopolitical environment, I think these are stellar results.
So again, Francine, that was CFO Raja Akram talking about that set of records from Deutsche Bank. And again, Deutsche Bank and a number of other European lenders really up in the markets on the back of strong earnings today.
Charlie, thank you so much. Charlie Wells there with the very latest on some of these banks. Now, Kering shares on the move after the luxury company reported that sales at Gucci topped estimates in the second quarter. The move is also sparking optimism that a long-awaited turnaround at Kering's largest brand is starting to take shape. Let's get more from Andrea Felsted from Bloomberg Opinion. Andrea, always such a treat to speak to you. So what were your key takeaways from the Kering results?
Well, Gucci isn't as bad as it was. It's going in the right direction, and it's not as negative as people thought it was going to be. It does seem to be a positive from Gucci, and that's what's got everyone so excited, because it is the main driver of Kering's results and its share price.
Yeah, so what is selling well? Again, you know, that we went from minimalist to maximalist. Like, is there a general trend of what people want?
I think we're moving away a bit from minimalism. Luca Di Maio, CEO, said they were having success with Gucci's leather bags, which is good because, you know, they are the real profit drivers of the industry, and they've been in a bit of a slump. There are doubts about whether, not least for myself, whether Demna is the right designer, but this showed some sort of positive signs that his products were resonating with customers.
What's going on with Hermes? So they're better than others, but actually they're getting slammed in the market.
Yeah, the leather goods were slightly below estimates. There's just a feeling that Hermes was so much better than everyone else. It was untouchable for so long, and it's not. There are worries, particularly about the Birkin, the Kelly, the real drivers of that business. The one thing that I think has been good for Hermes, and I think it has really helped the brand, is all the footballers carrying these giant Hermes bags. I think there was a feeling that the Kelly, the Birkin was a bit overexposed. They tend to change hands in the secondary market at a premium to the retail because you can't get them easily. That had been falling, but I think the footballers have really given a fresh, you know, lease of life into the Birkin.
Who knew? Football,
Exactly.
World Cup, and Hermes. There you
Exactly.
go. Not something that, you know, I thought we would be saying a year ago. Andrea Felsted from Bloomberg Opinion with a terrific view, of course, on some of the luxury sector. Coming up a little later, we'll be speaking exclusively to the L'Oréal Chief Executive Nicolas Hieronymus on earnings after markets close this evening. Up next, Bloomberg Brief.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Decision day in the U.S. Futures wavering ahead of the Fed, with markets eyeing the possibility of a surprise rate hike. Microsoft, Meta and Qualcomm on deck after SK Hynix whipsaws down as much as 18%, up as much as 6% following results. And oil bounces after Iran attacks U.S. bases overnight, and Saudi Arabia joins the conflict with strikes in Iraq. South Korea experiencing more violent swings in today's session. Let's get straight to Winnie Su in Hong Kong for the latest from Asia. Winnie.
Yeah, good morning, Bonnie. A very volatile day, especially in the Korean market. We have the Kospi here closed down 6%, but during the day it was down as much as 13%, triggering a circuit breaker. Well, it was in fact the very first back-to-back circuit breaker from yesterday, so you can see that momentum unwinding very quickly. Well, the big trigger here is SK Hynix missing analyst expectation for its earnings and also raising capex expectation further. Now, the earnings call saw a little bit of a lack of details when it comes to the shareholder returns and the longer-term contracts. So some disappointment around that front as well. Now, we have just kickstart this emergency meeting by authorities, including the finance minister, on the current market situation around top of the hour. So we will see what kind of measures that they will come up with in the next 2 hours or so. Flip the board, we take a look at how that's affecting the broader Asia market, with the MSCI Asia down about 0.7% here, extending losses for a second day and also headed for its lowest level since April. The bright spot, though, is actually in Hong Kong shares. We are seeing tech shares gaining on that front, with rotation away from AI names and also some pressure easing when it comes to the memory chip pricing. Back to you, Bonnie.
So, Korea's finance minister calling an emergency meeting on market stability in South Korea. Winnie Su, thank you so much. Let's get to London now to see if there's much of a bleed across into Europe. Justina Lee, what's going on?
Good morning, Bonnie. Now, yet again, Europe is nowhere as dramatic as Asia, even though we are seeing the Stoxx Europe 600 completely erasing some of the gains it saw earlier this morning to be down 0.2%. But we actually have gotten a spate of pretty good earnings out of some big European stocks, Deutsche Bank, UBS, Kering, and of course Glencore, which is supporting a lot of the mining stocks we're seeing here. Now, overnight, we've also gotten a bit of a flare-up of Middle Eastern tensions again, with oil climbing, and that explains, a rise in short-end German bond yields ahead of that Fed decision later today. But, I've been saying, a lot this week that, Europe has been the source of calm in global markets. And if you flip the board here, you can really see that in the year-to-date charts. I mean, Europe didn't enjoy that big run-up that we've seen in Asia with kind of the relative lack of tech names. But more recently, it also means it's been pretty resilient, holding on. And if we are seeing a bit of that rotation back into value names out of those high momentum names, Europe could be a relative beneficiary here, Bonnie.
All right, Justina Lee, thank you for that in London. Well, just to illustrate what Justina was saying, here is your oil price coming into this Wednesday Fed day. Brent crude above 87, so bouncing 3.5% plus on those attacks that were not expected by Iran overnight. That said, we're well off the $90 a barrel mark. New York crude just above 82. European gas futures rising again as well. The tech story, though, is a fascinating one today. You had SK Hynix, by any measure, blowing out earnings, massive, massive numbers, and yet there is so much to parse in those earnings reports and in the South Korean reaction that it's difficult to know how investors will come into the U.S. session. So we have Nasdaq 100 futures wavering just a little bit. We're positive now. We are definitely positive on the S&P and the Russell 2000. The equal-weighted S&P hit a record yesterday, but the Nasdaq has had 5 down sessions in a row, and of course it's Fed day, so it's anyone's guess. Also, obviously, as we said earlier, Meta, Qualcomm, some of the major companies on deck with earnings today. Let's take a look at yields as we process what might happen with the Federal Reserve. About a 30% chance of a hike baked into this market. So obviously, if there is one, that would be a surprise to the market. The 2-year yield up a basis point. We're holding in around our levels that we've seen all week. Once again, the auctions yesterday showed demand at the very front end, less demand as we move to the middle and the back end. All right, let's get to some individual pre-market movers now. For that, we'll go back over to London and Chloe Melly.
Good morning, Bonnie. We are seeing some weakness across those chip stocks this morning, except for Intel, after The SK Hynix results really rekindled those fears around this potential AI overspending. And so we are seeing some weakness across that sector this morning. And we're down in particular for Marvel and SanDisk in pre-market trading. Moving on to Bloom Energy, which is having a great day today and soaring in pre-market after raising its guidance and reporting earnings that were double what was expected. So this is due to very strong demand from data centers. And so it seems that not all is negative in this AI trade. And finally, let's go over to Europe, where Kering in the luxury sector has reported very strong earnings and very strong sales, actually, for Gucci, which seems to indicate that the ongoing turnaround for that company is paying off. And we are seeing investors reward that this morning, with shares up almost 13% for Kering.
A nice pop there. Chloe, thank you so much. Chloe Melly there. We'll be back later in the hour. Also coming up this hour, the countdown to the Fed with Priya Misra of JP Morgan Asset Management. First, oil rebounding after the U.S. said it intercepted a surprise attack by Iran on military bases. Joining us now from Dubai is Bloomberg's Abir Abu Omar. Abir, what happened overnight?
That's a good question, Vonnie. So this surprise attack by Iran on U.S. bases in the region. We also heard in the early hours of the morning here in Dubai from Jordan, with 5 missile attacks on its grounds from Iran. And so again, this follows a couple of days of calmness, really. The U.S. had halted attacks against Iran on Friday evening after 13 consecutive nights of hitting targets in Iran. Iran later on Sunday saying that it will suspend its own attacks on the region, only for us to hear overnight that it started by attacking those U.S. military bases. Now, Central Command did say that it intercepted the missile and that there was no damage done. But parallel to all of this, Vonnie, we also heard that the U.S. Central Command, alongside Saudi Arabia, have hit targets in Iraq, eastern parts in Iraq. We actually just heard from Iraq that there were cities, including the capital Baghdad, Kirkuk, Karbala, among others, that were hit with about 20 people killed, several others injured. Saudi Arabia says that this is an act of self-defense, that it was a response to those Iran-backed militia in Iraq hitting the country earlier in the week. So we're seeing new fronts really emerging in this Middle East conflict, Vonnie, but at the heart of all of this remains the Strait of Hormuz and the pretty much paralyzed movement there. And this is why you're seeing just across the screen now Brent crude prices 3.7% higher as we continue to monitor the movement or the lack thereof in the waterway.
Abir, thank you so much. Abir Abu Omar there in Dubai. Investors bracing for a host of AI-related earnings, then with a focus on capex spending. Earlier, shares of SK Hynix plunged and also rose after lots of numbers out of that company. Let's get straight to Bloomberg's Neil Campling. Neil, a 6-fold increase in quarterly profit, revenue that was literally up more than 1,200%. Sure, lots of capex and maybe not that much of a plan to give back to shareholders, but what's the logic for the trading here?
Yeah, so I think for Hynix, as you mentioned, it's travelled a long way in terms of the stock price performance, but raising their own capex by 50% this year, it follows a similar capex hike for the next fiscal year from rival Micron that we heard from late last month. So if their capex is going significantly higher, what is that going to do to the memory DRAM pricing longer term? That's going to be the concern for the investors of the memory stock specifically. It's actually, if you think of it, longer term, going to be good for the hyperscalers, because out of the $1 trillion plus that hyperscalers are expected to spend on their capex next year, about 1/3 of that is actually going on memory pricing. So that could be a sort of longer term and actually a headwind that becomes a tailwind for the hyperscalers, which is not going to come through in numbers tonight, but something to keep a track on going forward.
As long as we don't see some slowdown in chip pricing power, are we starting to see that at all, Neil?
We are. So we're not yet seeing the memory pricing coming down yet, but I'll tell you what is coming down, and that's token pricing. If you look at the gap between the two, they have tended to track each other. So as token prices come down, it would seem that the memory pricing won't be able to sustain the kind of levels they're at the moment. So that could be something, I think, to focus on going forward as to where in that disconnect the balance comes out.
Now, we get Qualcomm later today. Last Friday, we already learned that it's planning on increasing prices for some of its products by double digits. What will investors be concentrated on in today's earnings?
Yeah, I think the key focus will be on unit volumes. And the reason I say that is because obviously us as consumers are likely to be kind of wearing those cost increases in terms of the price increases for products. And if we've already heard from Apple this year that that's going to be a challenge in terms of pricing, and that could feed through into the Qualcomm model in terms of those volumes. So keep an eye on the volume numbers tonight out of Qualcomm.
And Neil, we also obviously get Microsoft and Meta, two very, very different companies. What will investors be focused on a piece?
Yeah, so I think for Microsoft, clearly it's going to be the cloud growth. The cloud growth needs to be significant to justify what will be expected to be high in terms of their capex forecast. And as far as Meta's concerned, it's really balancing up, again, the top line growth with the capex investments. And it seems likely that actually Meta will follow what we heard from Alphabet last week, is it could well post the first free cash flow negative quarter when they report numbers tonight. So they're going to have to carefully balance those metrics of justifying the spend with accelerating top line growth.
Yeah, because we know what happened the last time this earnings season that a company reported negative cash flow. Neil, thank you so much. Neil Campling there. We're obviously also counting down to the Fed's rate decision set this afternoon. Bloomberg's Jill Deeses joins us now for more. Jill, the market's really only pricing in 30% chance of a hike today, yet there have been voices in the last few days, perking up and saying this is a real possibility. What's the likelihood the market gets surprised?
Yeah, Bonnie, I mean, you're talking about how technically and the market's mostly pricing in a hold here. And so really it's that hike that would be the surprise, but that's not really what the vibes are really feeling going into today. This is actually more volatility than we've seen in terms of, that divergence between what the market's ultimately thinking in quite some time. By now, ahead of a Fed decision, you would think that the market will ultimately converge on one position. I mean, I think the one that really kind of, made everybody sit up and take notice this week was Citadel calling for a hike here. Obviously, a huge component of this is the fact that Kevin Warsh is still fairly new in the position, and he seems pretty adamant that he doesn't really want to give a lot of forward guidance about what the Fed's decision ultimately will be. But also, Bonnie, I think there's a lot of other elements that are really at play here. I mean, when you're looking over the past several weeks in terms of some of the price pressures, inflation pressures that we're really dealing with, we saw a lot of that cool off after the U.S.-Iran ceasefire was announced last month. But just in the past few weeks, we've seen, that ceasefire put on pause, then, come back again. I mean, we've obviously just heard some more reporting on some tensions that have flared up overnight. So that's introducing a little bit more volatility there. And then I think the other thing that you have to really think about here, Bonnie, is in terms of timing for a potential Fed hike. Does Kevin Warsh want to pursue something now or later this year? I mean, the closer we get to November, for example, the closer we get to U.S. midterms, suddenly, a live Fed decision starts to look a little bit more politicky there. So I think there's a lot of equations that are really in play here, and it actually does make for a much more interesting Fed meeting coming up.
And Jill, while we may not get forward guidance, what are investors hoping to see from the new Fed chair?
Yeah, I mean, I do think that still kind of plays into it a little bit. I think, we're all kind of, still getting used to Kevin Warsh in the Fed chair seat and trying to get, an understanding of, where he's really kind of expecting the Fed to go this year. And again, I do think it kind of comes down to the question of even if the Fed, pauses again today, as we've been talking about, would be in line with the majority of market expectations for now. Is there any kind of, clues that you can kind of hint, from anything that Kevin Warsh says that, gives us some idea of whether or not there's a hike in play in the future. So still will be really interesting to see again how he just conducts himself in, what's really only, one of his first Fed meetings here.
Yeah, Mark is just getting used to his cadence. Jill, thank you so much. Jill Deeses there for us. Now to other top stories trending on the terminal this morning. BMW is offering voluntary severance packages to thousands of its workers in Germany. The move is part of a restructuring plan to create a leaner company. The departures are expected to account for most of the 8,000 positions BMW aims to cut globally. Hermes shares are falling after missing estimates for its leather goods unit. The company's CFO also said there will be lower product price hikes for 2027. While the numbers outperform much of the struggling luxury industry, a lack of growth in China is weighing on shares. Porsche's operating profit jumping, powered by the success of its high-margin 911 sports cars. The results are a relief for the struggling car maker. However, shrinking China sales, US tariffs and uneven EV demand continue to hurt the company. Coming up, strong results from some of Europe's biggest banks. We'll unpack the reports next. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The big dispersion we see in equity markets and the pressures and on energy prices creates potential headwinds on inflation, and that may turn out to be something that investors will not really like, and creating potential volatility. So I do expect spikes of volatility to continue for the rest of the year.
Sergio Armati there. UBS, Deutsche Bank and Standard Chartered all rising after the latest earnings reports, with billions of dollars in fresh buyback plans following revenue surges. For more, Bloomberg's Charlie Wells joins us from London. Charlie, it's a little bit like the United States, pretty much great across the board, yet many of Europe's economies are struggling. So where were the high points? Where did the strength come from?
Yeah, that's a really good point, Vani. And what we've really seen has been this combination of volatility and rates really helping a lot of these banks across the continent in a similar way that it did in the United States. So we saw this rate picture that really helps on that net interest front, which we've seen positive from a number of other lenders. And also what we've really seen this quarter has been that volatility, right? We've seen these equity trading desks at the like of UBS, which reported today up 53% in the quarter. You've seen them able to capture that volatility. But what you've also seen and what you heard in that interview with Sergio Armati of UBS is a note of caution. This idea that, are we at a point where we're at as good as it gets, given a lot of the threats out there, given the volatility, the fact that volatility is great for a moment, but it can also get to be too much. Rates as well, they can be great for banks' profit to one degree, but going too far can hurt them. So again, a little bit of a warning there, but right now, from these results and looking at the reaction from the market, very strong across the continent, just like it was in the United States.
Is there anywhere in the earnings across the board, Charlie, where we might be able to see the beginnings of some of those warning signs, any little fragilities or cracks?
What was really interesting was to look at, fixed income, right? We saw some misses on fixed income at a number of these major banks here in Europe. So Barclays yesterday, and traders really kind of homing in on that. But you saw a show of force in fixed income from the likes of, say, Deutsche Bank, where, they had growth in the quarter of 16%, outcompeting their Wall Street competitors. The average from the major Wall Street banks was about 13%. So again, strong showing there. But if you think about where cracks could be, Vonnie, as you're talking about Deutsche Bank, there has been a big valuation gap in Deutsche Bank compared to a number of these other major European lenders. That's concerns that maybe things have gotten as good as they possibly can get. Concerns about Deutsche Bank's exposure to, say, private credit. And again, some concerns about the macro picture as well, Germany's slowing growth there. So again, as you say, some challenges in Europe, but at least for today, at least on the back of these earnings report, things are looking positive and investors are responding in kind.
And Charlie, just as you mentioned it there, there's obviously a whole different scenario in Europe than there is in the United States, but some of the macro pressures are still there, such as rising gas prices, a war on its doorstep, as well as a war a little bit further away. How are banks preparing another volatile quarter, but maybe not as helpfully volatile as the previous quarter?
Well, this gets to the point that, rates are actually helpful for banks until they're not, right? If we think about that inflationary picture, we are in this environment where rates are looking like they may be held or stay higher for longer. Another issue that we had going into this reporting season was, the price of risk. Were banks going to have to set aside more for potential soured loans than markets had expected? And if you look across a lot of these major lenders, there were not a lot of huge surprises in how much banks had been setting aside for potential write-downs. You saw less at a number of these large lenders. So at least right now, the picture is looking pretty strong here in Europe.
Bloomberg's Charlie Wells in London. Thank you so much. Coming up, a look at what's making headlines in your front page news. This is Bloomberg.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Time now for your front page news. First up, the New York Times reporting ICE arrests are surging in airports. Agents are arresting spouses of Americans, tech workers, and others whose visas have expired as they pass through airports. The Times says many of those arrested have active applications to stay in the country. Next up, the Financial Times reporting Mark Zuckerberg says the US administration should not block Chinese models to gain an edge in the AI race. In an interview with the FT, Zuckerberg expressed concern AI might become centralized in the hands of a few powerful groups in the United States. And the Wall Street Journal reporting New York City has published an online list of property owners who might be subject to the surcharge on luxury second homes. The list encompasses 960,000 properties and individuals from a cabinet secretary to President Trump's niece. The new surcharge, which went into effect July 1st, targets second homes worth more than $5 million. Coming up, we're going to push ahead to the Fed decision with Priya Misra of JP Morgan Asset Management. This is Bloomberg.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Decision day in the US. Futures slightly higher, but wavering ahead of the Fed, with markets eyeing the possibility of a surprise rate hike. Microsoft, Meta and Qualcomm on deck. This after SK Hynix whipsaws, down as much as 18%, up more than 6% in the Korean session following results. And oil bounces after Iran attacks US bases overnight, and Saudi Arabia joins the conflict with strikes in Iraq. We'll start there, looking at Brent. Above $87 a barrel, so up almost 4%. Nevertheless, well off the $90 barrel mark. New York crude just below $82 a barrel. Elevated, but staying in position. European gas futures as well going to inflict a little more pain on that market. 58.87 per megawatt hour right now. Let's look at futures, because it was a fascinating session. Free fall basically in Korea again, to the point where the finance minister decided to host an emergency market meeting on market stability today. Sentiment continuing to sour around the AI and chip trade. SK Hynix batted it out of the park, but upping its capex spending and just causing investors a lot of angst. And that stock was really whipsawing today. We're at peak earnings season in the US as well. We've nearly $6 trillion worth of market cap reporting today, another $8 trillion reporting tomorrow, and this after the Nasdaq 100 has fallen for 5 straight sessions. Right now, futures are positive. It may not be a sixth, but we'll see. The equal weight S&P 500 index is at a record as well. And then yields-wise, of course, all eyes on the Fed. Not too much movement, up about a basis point, just under 430 on the 2-year, still well above 5% on the 30-year, and the 10-year yield holding in at that 461 and change mark. Let's get to some individual pre-market movers now with Chloe Melee.
Good morning, Vonnie. We are seeing those chip stocks back in the green. So we've seen some initial weakness on the back of this capital spending plans from SK Hynix, which had really fueled those investor fears around AI overspending, this overinvestment in AI. But now we are seeing this reversal in sentiment, and the likes of Micron, SanDisk and Marvel back in the green in pre-market trading. Some of that might have to do with some positive updates and results from some other names in the AI trade. And speaking of that, we have a Seagate, the computer storage and hardware company, beating expectations, with analysts saying that the AI cycle has further to go with this company, and therefore we are up in the green this morning, up about 5.5%. And it's also a similar positive story for Bloom Energy, which has raised its guidance and has also reported earnings that were double what was expected, and that was thanks to very strong demand from data centers, and we're seeing that really drive the shares this morning. We're up more than 11%, and so it seems that there are some positive stories around this AI sector, despite those worries around SK Hynix.
All right, Chloe, thank you so much. Chloe Melee there in London. Joining us at the desk now is Priya Misra, Portfolio Manager at JP Morgan Asset Management. Priya, you're not expecting a hike today, but how confident are you in that view? The last few days, have any doubts crept into your mind that we might actually see a hike, given the return to hostilities, the escalation in oil prices and so on?
Right. So I think conviction level has to be lower, because the committee is divided. There's a lot of uncertainty around the war, around even whether tariff inflation has peaked. So I think there is that concern. And then we have Chair Walsh that doesn't believe in forward guidance, and he wants a good family fight. And the committee is divided. So I think conviction level is lower. But, I take a step back and I think about data over the last 6 weeks. And the data, whether it was the jobs data, whether it's wages, whether it's inflation, PCE, PPI, CPI, it's all come in a little bit softer. So if the Fed is truly data dependent and, they've got another meeting just 7 weeks away, I think they can buy time. They can reiterate the commitment to price stability. I think you're going to get a couple of dissents, 2 or 3 dissents. So that'll indicate that the Fed is very much focused on the fact that inflation has been above target now for a while. But the urgency to act today is a little bit lower. The data has been weaker, and they've got another meeting. I don't think we'll get any forward guidance that they are not going to hike or they're going to hike. They're just going to remain data dependent, which is why we ultimately think they don't go. But the market's going to keep these hikes priced in, because the inflation backdrop just has been higher than that 2% target.
So how many, if any, dissents will we see, and what will they be based on?
I think the dissents are ultimately based on inflation credibility and the fact that inflation has been above target for a while. You know, I'm thinking President Hammack, President Logan, very likely, maybe even President Kashkari. So you might get 3. And I think this is where Chair Walsh is likely to suggest that there was a good discussion of a hike, which is why I think the market's going to keep these hikes in there. If they don't hike today, well, they can absolutely hike, in September, in October and beyond. And so I think that's why the dissents are important, to suggest that this is not just him driving the decision. This is a committee decision. So, I think the market's expecting 2, I would say 3. Now, it is a committee, it's a democracy. So I think if it's more than that, I think then the market does get concerned. And a sense of why the hikes. And, I know Chair Walsh doesn't want to give us forward guidance, but is this a hiking cycle? Like, in our view, this might be taking out the rate cuts from last year, not a full-on hiking cycle.
Is there a risk that if they wait for the next time, or even the one after that they are missing the boat? Because sure, while, this might be temporary in terms of the escalation of hostilities and oil prices and, gas at the pump being back above $4 a gallon and so on, there are other factors too, such as maybe the wealth effect is coming off if we continue to see stocks sell off and less confidence in the AI trade.
Right. I'm glad you bring this up, because I think it's the entirety of the issue. So the point that, would it be too late? Well, I think, financial conditions have tightened. You look at real rates. This move higher in rates has all been driven by real rates, and that's part of the tightening in financial conditions. Then some of this optimism around the AI trade, more capex is always good news. No, I think the market's now looking for monetization, use cases, things like that. So I think some of that wealth effect might be, coming off. And again, I look at inflation expectations. Whether you look at break-evens, surveys, the Fed has credibility, without hiking right here. Now, I think, does that credibility go away if 6 months from now inflation's still here? It can start to wane. But I think right now the market's giving the Fed benefit of doubt that they would hike if inflation has not peaked. Our view is inflation's likely peaked. Energy might still remain high. Oil prices might stay at this while, but it's not going to be a source of inflation, and the labor market's not a source of inflation.
And the consumer seems resilient, at least according to many of the companies that we've heard from Hilton to Royal Caribbean.
Right.
Is there a risk of upsetting the market if the Fed hikes today? So even if the Fed chair were inclined to potentially hike today, this market seems a little fragile right now.
It does, and I think the tricky part is if they start hiking, is the hike primarily because inflation's above 2%? That's what, if you listen to the hawks, that's their argument. Well, then why stop at 2 or 3 hikes? And so the market has to broaden the distribution of maybe this is 4 hikes. Are we taking out the rate cuts from 24 and 25? I think that's why I think the market's a little vulnerable. Without a dot plot, without getting much forward guidance from Chair Walsh, I think it's just the concern. Risk premiums will rise, and that's obviously important for interest rates, but credit spreads, equities. So this is why I think the market is vulnerable. A hike without telling us the end point or even giving us a sense of the reaction function. That's what I'm hoping we get a little bit of. We need not get forward guidance, but what exactly is the Fed overall looking for in terms of how much more are they going to hike? I think that's what we'll be looking for if we do get that hike.
The Treasury auctions that we saw this week, what did they say to you? We had plenty of demand at the very front end and, even maybe out as far as the 2-year, and then not so much.
So, I mean, they were not terrible, but there was that little bit of a tail. And I think it's telling us that there is a competition for capital. Globally from sovereigns, energy independence, just energy security, things like that with the different conflicts. You also have now competition for capital from the AI-related debt boom. The AI party has come to the bond market, and I think as supply comes in, high-quality companies issuing further out the curve, now you've got, we've got global sovereigns issuing, you have all the hyperscalers and the entire AI ecosystem issuing, plus US Treasury issuance. I think that's where the competition is coming in, and people have to see the value in treasuries relative to some of these really high-quality, AI companies.
One of the reasons cited for the AI trade coming off has been that hyperscaler debt has been getting just a little bit more expensive, right? But that's also a factor of just the amount of issuance, and if investors are going to continue to take it on, they're going to want to get paid more. Have you at all looked at some of these offerings and how much more complex they're getting? Would you be interested at all?
we find value across the AI ecosystem, as we're calling it. So it's not just the hyperscalers, it's chips, it's power. And to your point, they're being extremely creative, which I think is the right thing to do, because if they have that much in funding needs, just straight up unsecured debt, you might exhaust the market. So whether it's an SPV type structure and then paying us for different risks, if it's a construction risk, if there's amortization in the schedule. So there's a macro view that these companies are strong. We think the AI trade is there. But then there's a lot of under the hood. Are we getting paid for all the risks we're taking? What spread levels? How much more supply is there? Absolutely. We love some of the AI related debt, but you have to be very careful in terms of what you're buying.
Wait, that made you so happy, Priya. There must be a lot of opportunities out there. We have to leave it there, but thank you so much. That is Priya Misra of JP Morgan Asset Management. Now to other top stories trending on the terminal this morning. UBS announcing a $3 billion share buyback program. Wealth management assets beat estimates and trading revenues surged. CEO Sergio Ermotti spoke with Bloomberg TV.
Standout is good momentum across all our businesses. You can see that in 45% increase of our underlying PBT, and so basically the synergies and the top line developments are working well, and net assets are up 7.3 trillions of assets. We manage good inflows, and the integration is almost done. Still not fully done, but I'm very pleased with our momentum.
OpenAI says the AI models that hacked Hugging Face also accessed a customer account on cloud platform Modal and used it to launch attacks. The hack is reinforcing fears that AI models are becoming increasingly capable of carrying out sophisticated cyber attacks. The US is tightening restrictions on some foreign-made robots and solar power inverters. The FCC says the products pose potential supply chain risks. The move could add to tensions between China and the US ahead of the Trump-Xi summit in September. Coming up, military strikes flare up again in the Middle East. More on Washington's response next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got
got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Tensions flaring again. A pause in military strikes in the Middle East disrupted after what the U.S. called a surprise attack from Iran on American forces. Bloomberg's Megan Crane is live now from Washington. Megan, is this the first time that Iran has attacked U.S. bases preemptively?
It's not. There have been flare-ups in that conflict over the last several months. Unfortunately, when I left yesterday, we were talking about gasoline prices and oil prices had plunged after a lull since Friday, and that seems to have dissolved overnight, really showing how far apart the two sides are in trying to come to a lasting ceasefire, lasting peace in that area.
Absolutely. The U.S. calling it a surprise attack was also obviously means that they were not prepared for something like this, or at least they didn't see it coming, let's put it that way. How would they not have seen that coming? I mean, there must be some breakdown in communications with the mediators.
Yeah, I'm not really sure how that would have come about. They certainly said that they were prepared for it in the sense that it was unsuccessful. There weren't a lot of details as to what the attack was, where they were headed. But I think that, until we have a peace deal, there's always going to be some sort of skirmishes and some threat that there could be violence.
Trump also saying yesterday that he had good meetings with other world leaders, Volodymyr Zelensky and Benjamin Netanyahu. Any more details on what the U.S. might be providing in either case?
Well, for Zelensky, he certainly was happy that yesterday the Senate passed a sanctions bill that had been something that Lindsey Graham had been really anxious to push forward. That would allow increased sanctions on purchasers of Russian oil and Russian energy more generally, which is something like a tool that Zelensky was definitely looking for. So they didn't come out and say that that was what he, had gotten yesterday, but that he definitely left with that in hand. As far as Netanyahu, he came out and said that they had had a good meeting, but they didn't give a lot of details as to what they had talked about. He did say that he was in lockstep with the United States and whatever Trump decided to do with Iran.
Yeah. Megan, just domestically, a brief word on the Trump administration deciding to end the drug plan subsidy for Medicare. It seems like it might be a difficult message to put across if you're campaigning for midterms.
It is that for sure, right? The Trump administration is sort of serving two interests. They want to talk about cutting prices. They want to talk about cutting costs. And the billions of dollars of subsidies are one thing they can say that they have done that. But that could raise prices and costs for consumers, which is something that's really not popular on the campaign trail. So the timing seems a little strange to me, but that is, how they've decided to do it. And I think it kind of shows how they really are struggling to come up with a message that serves both interests.
Yeah, absolutely. Megan, thank you so much. Bloomberg's Megan Crane in Washington, D.C. Turning back to tech now, the latest results from SK Hynix reinforcing investor concern around AI spending ahead of more earnings in the United States. The South Korean chipmaker expects its capital investments to increase around 50% to at least $31 billion. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, surely we were expecting this, right? The market was expecting that CapEx would be at this level. Why is the volatility so strong in those shares today? There was so much good news in that report.
There was, but when you look at the numbers relative to where consensus expectations were, they probably missed the top line by 5%. So it was surprising given the US ADR listing. But I can see why they don't want to, be in the news about the price increases on the DRAM side, given companies like Apple have already raised concerns about higher memory prices and the impact that it's having on them. So from that perspective, I think they want price increases to moderate on the DRAM side, and that's probably played a role in terms of why the numbers were shy of consensus.
Speaking of pricing power, Qualcomm is set to report later, and we already know it's increasing its pricing for some products by double digits. What more will investors want to hear from Qualcomm?
I mean, all these companies, whether it's Qualcomm or Apple, they're at the receiving end of, the higher component prices, such as memory. And so from that perspective, I think the impact of higher memory prices on Qualcomm's margins is what I think everyone would be looking forward to. And also the feared demand destruction when it comes to, raising prices that Qualcomm is doing. How it's going to impact the unit volume. So I think the consumer side right now feels left out because of all the focus on data centers, and Qualcomm is getting into data centers, but it's a much smaller portion of their overall business.
And we should get an update on that as well. We're kind of getting all sides of the picture today, though, because we're also getting results from Microsoft. What are we expecting to hear about Azure and some of the other aspects of the business?
Yeah, I think the bar is very high for Azure, given what Google reported last week. And we know everyone is expecting both Microsoft and Meta to raise their CapEx numbers, and not only for this year, but also have some guidance for 2027. And some of the memory price increases is what will drive these CapEx increases as well. So if they don't raise their CapEx, that would raise a concern that, they are cutting back somewhere else. And I think everyone is fixated on the top line growth, but also the CapEx growth for both Microsoft and Meta.
So Meta will also hopefully give investors a steer on how it's going to monetize its compute, the leasing of its compute. Will we get details, do you think, Mandeep?
I think so. And if they don't give any details around, how they're thinking about the cloud business or how their latest MuseSpark model is doing relative to all the frontier labs, and still raise their CapEx, I expect a negative reaction. But look, they've released a new model, MuseSpark. It seems to be doing well on certain benchmarks compared to their prior Llama models. And so from that perspective, expectations are low, and any details they provide both on the cloud rental side as well as the model side, I think would be cheered.
And then after all of that, we go back to Korea and we actually get Samsung earnings tonight. Obviously, it's a little bit more diversified than SK Hynix, but I mean, will it rescue Korea, Mandeep? Obviously, there's an emergency meeting happening right now as well.
Yeah, at the index level, there's a lot going on in terms of margin calls and other things in that market. But when I look at the fundamentals of these businesses, whether it's SK or Samsung, they do look very strong. And I expect these companies to generate a lot of free cash flow, and probably, once they're done with all the local concerns, then probably pursue some buybacks as well. But these companies will generate a lot of free cash flow over the next 3-4 years.
All right, it's going to be an absolutely insane 48 hours. Mandeep, thank you so much. That is Mandeep Singh of Bloomberg Intelligence. Coming up, a Fed decision and earnings front and center in your day ahead next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Now a look at what's ahead today. First up, the Fed's rate decision coming at 2 p.m. Eastern, followed, of course, by Fed Chair Warsh's news conference at 2:30. Then a raft of earnings. We get Microsoft, Meta, Qualcomm, ARM. They're all after the market close. And then you got to stay up for Samsung out of South Korea. Plus, Starbucks, P&G, Chipotle, General Dynamics, they're all reporting after the close as well. Some earnings movers for you. Let's start with Seagate. A large gain here. Strong results and a revenue forecast, so bucking the trend there. Not so much for Logitech, down almost 10%. Its devices sales forecast really missed estimates for the second quarter. Some supply bottlenecks there, and that stock is down 10% now in the pre-market. And then Bloom Energy, well, it was down 11% in yesterday's session and has been lower in the last few sessions. But investors were pleased. The fuel cell maker surging on higher guidance. Earnings actually doubled estimates. Let's look at the macro environment as we head into this whopper of a trading day. So Nasdaq 100 futures are actually climbing all the while, even after a spectacularly volatile session in South Korea, which caused an emergency meeting on that market. Looks like perhaps the selling might be done. We have had 5 straight declines for the Nasdaq 100. Gold just a little higher, and the 2-year yield just up a basis point as some parts of the market tread water before the Fed rate decision. Oil, though, is higher, up more than 3% on Brent and WTI. Also, European gas futures up almost 3%, back at 59 euros per megawatt hour. That is it for Bloomberg Brief. Surveillance is next. This is Bloomberg.
Anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the Treasury market. You can get that from a bank. You can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit, where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Tech is the future, but I think right now we're in an air pocket.
It's important to remember narrative follows price.
Anything that puts a dent on the perfection of the chip stocks will cause a market reaction. The mood is souring a little bit.
The fears of this gyrations in stocks, I think, will not slow down at all.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, facing down a triple threat. Economists looking for a hawkish hold from Fed Chair Kevin Warsh. As the latest diplomatic effort between the US and Iran is facing a setback, SK Hynix is kicking off a big day for tech earnings, missing very high expectations. Microsoft and Meta up next.
Operating profit at SK Hynix only up 557%. So that was incredibly disappointing for a lot of people. Look, it's almost funny that we're talking about SK Hynix as some sort of leading indicator from Microsoft and Meta, considering that their shares are up 120% so far this year. Even with a 50% drawdown, Meta is down 10% so far this year. Microsoft is down 18% so far this year. So here is the issue. Do they face the same high bar because of concerns about CapEx spending, or are they coming from a weaker place and just have a lower bar to really clear?
Just sit on SK Hynix. Look at that move. Look at that move today off the back of a six-fold surge in quarterly profit, off the back of posting margins of 80% plus. The bar is simply too high for this stock, for Intel, for Samsung. To Bramo's point, Microsoft and Meta, you flatter them. They've been in bear markets off the highs of more than 20% for much of the last month or so. And to your point, is the bar lower for them? Now, if they put up good numbers later on this afternoon, and people start to freak out about the CapEx number, even though the growth elsewhere is decent, and those stocks have been battered over the last few months, then we've got a very different problem in this equity market.
And maybe Max Kettner will no longer be bullish if you really have this serious pushback to CapEx expectations. You've already seen a bit of pushback when it comes to valuations in credit markets. That will only continue if you see that kind of reaction in equity markets, and speaks to something beyond just positioning.
Let's turn to the commodity market. Check out crude this morning. 3-day slide on Brent. Down something like 15% over that period. This morning, a bounce up by close to 4. Brent crude at 87. WTI 82. 4 days of relative calm. The strikes make a comeback.
Yep, the strikes are back. That calm that we saw since Friday is now over. The United States CENTCOM is talking about these surprise attacks that they intercept in terms of ballistic missiles towards U.S. military installations in the region, and then they fired back alongside. This is Iranian-backed militias in Iraq alongside Saudi Arabia, which just goes to show that you can potentially see an opening for more Gulf Arab partners to join the United States when it comes to striking back on Tehran.
This is why you didn't get a massive rally in the bond market over the last 3 days or so. Check out 2s this morning, still around 430. Check out 10s this morning, up a basis point, around 462. Heading into a Fed meeting, and we said this repeatedly on this program, if you're an official at a central bank and you were pinning your call on what happens in the Middle East between now and the end of summer, you need to look for a new job, because you don't have much of an argument to begin with.
Which is why you're not expecting a significant move one way or another as a result of near-term fluctuations in oil prices. That said, in some ways, the market's been doing the Fed's job. If you're worried about inflation being too high, you've seen a general tightening of financial conditions, with the NASDAQ down more than 5% since the last Fed meeting, and spreads wider on both high-yield and investment-grade bonds. They want to keep this going if they want to get inflation under control, even if it doesn't necessarily require hiking rates today.
You know, we talked about the three-part act of the ECB, statement, news conference, and then the post-game reports. I think we're entering that phase potentially for the Federal Reserve. Three-part act, statement, news conference, not much in it. And then afterwards, you start to find out what actually happened at the meeting. You get the speeches, and they take on additional importance. We'll have this conversation later this hour. I think it might be a new era for the way we think about the Fed decision, when it's made and the implications of it.
Does Kevin Warsh still have the leadership role where he sets the tone on the Fed? Because right now, a lot of the rhetoric seems to be from other Fed officials who are filling a void because Kevin Warsh has not given us his view. And so suddenly, Chris Waller's voice is as strong right now as Kevin Warsh because we're not hearing what the lodestar is for Kevin Warsh.
We have been talking about this for months. If you don't offer forward guidance, if you're not going to offer a framework to financial markets and commentators, then someone else is going to fill the void. And that's potentially going to happen after this meeting.
That decision, 2 p.m. Eastern Time, the news conference 30 minutes later. Coming up this hour, we'll catch up with Julian Emmanuel of Evercore on the sky-high earnings expectations. Colonel Wayne Sanders of Bloomberg Intelligence as a surprise Iranian attack sends crude climbing this morning. And we'll catch up with Claudia Sam of New Century Advisors, with Wall Street flying somewhat blind into a Fed rate decision. We begin this out with tech stocks looking for stability, going into back-to-back risk events. Julian Emmanuel of Evercore writing the following: this week is very important. For the bull case to resume, we want to see positive share price reactions from the hyperscalers and stabilization in the semis. Julian joins us now for more. Julian, good morning.
Good morning.
We do not have stabilization in the semis yet. We might this morning briefly, not on SK Hynix certainly. Are you expecting some positive reaction to those hyperscaler earnings later on this afternoon?
So you set the narrative at the beginning here is that the share prices of the hyperscalers have been so battered, and the narrative around the increase in CapEx set last week by the first hyperscalers announcement and the poor price reaction there, the bar has been lowered sufficiently, in our view, that you really are sort of setting the pace for a potential positive reaction. But the bigger question, and that's been the question for weeks and weeks and weeks now, is that days when software and the Mag 7 work are days when the chip stocks sell off. Can you actually have them work together? And I would say it would be interesting and somewhat ironic if you had an earnings miss like you had overnight in Korea, and then we'll hear again from the other part of the tag team in Korea, whether earnings misses actually are what forms the bottom and results in the end of the Korean retail selling, which really has been the proximate cause for a lot of this.
Do you think we're going to have that washout? Are you seeing that washout now? All that leverage importing some of that volatility into America, are we washing that out now?
Yeah, we definitely think that's the case. And look, again, and we've said this a lot of times, if you're a tech stock investor, you have to be comfortable with higher volatility. And frankly, if you had told me that Korea would have been down, whatever the number is, 33, 35% from the top, and the NASDAQ barely down that 10% threshold, I would say that's probably not a bad result.
So what would it take for you to get all in and say, okay, we really have reached some sort of bottom where you could see both of these sides of technology working together?
Well, I think the first lesson is, if you're a portfolio manager, is that given what we've seen of the volatility of the last several months, not just to the downside, to the upside too, the concept of all in is a little bit different, right? So because the volatility is higher, and we expect it to be higher for the medium term, probably the rest of this bull market, all in means slightly smaller positions. But for us, actually, again, it's how the shares react to what we're going to hear in the next couple days. And then I would also say how the reaction to the unlock of the additional float in the world's largest IPO next week, how that reaction comes about.
You mean SpaceX and just what's been happening to their shares since the IPO, and it has performed worse than 90% of all IPOs of its size going back to World War II. How does the Fed factor into this? Is some of the tightening that we're seeing and, frankly, the sell-off in big tech related to a much more hawkish tone than people expected at the June 17th meeting?
Well, yeah, no, absolutely. Because remember, and this is different from the March sell-off in technology. It was very apparent. There was massive hedging visible in oil, massive hedging visible in the larger credit indices, massive hedging visible in the triple Qs. Not as apparent this time, because a lot of the hedging is actually happening in single name stocks and single name credit default swaps. And, when equity investors start paying attention to credit default swap price action, not even on the indexes, but on the single names, it's a little bit more difficult of something to parse. And so we would look for a little bit of tension to release, just given the passing of whatever it is he is or isn't going to say. And we don't think they hike this time. But frankly, if the narrative is as it was in June, we're worried about 2%, we're focused on 2%, that's good because you anchor the longer end of the yield curve, and that is going to be very helpful for the debt issuance of the hyperscalers.
Not to throw even more shade at equity investors, but when they start to become fixated on bond auctions, when I see that turn, when I start to see the equity guys look at the bond auctions and how they priced, then I know maybe the yield story's gone too far.
You mean when suddenly the 7-year yield in the 7-year auction matters?
Like the pure equity guys that never even look at fixed income.
I think that means welcome to the club. I think that you're focused on the right thing because ultimately it's the cost of funding, and that gives you a sense of just where we are right now.
Are you also focused on what's going on with oil? In your last note, you talked about 80s manageable, 95 is danger zone. Could the Fed look through 95 or higher?
No, they won't look through it. And if we're talking about $95 WTI in September, you better believe the rate hike regime will begin. We don't think that's the case. Our view is sort of mid-80s is the landing zone for WTI. But here's the other issue, right? Think about it. We've had, again, as you said earlier, if you're a central banker and your base case is predicated on the movements in oil, you have neck pain from the whipsaws over the last 4 or 5 weeks. And the whole thing about markets is part of the reason that this bull market has been able to be as robust as it has been is because the 10-year yield, every time we look, it's either 430 or 450, for 4 straight years. And if we had more stability in the oil price at a number we think we could live with, call it the mid-80s, that would be a positive.
Someone messaged me the other day and said, never do a trichet. Never go full trichet and start hiking interest rates purely because of what happens with crude. That was the ECB a long time ago. Crude this morning, Brent 87. 82 on WTI. Gillian Emmanuel of Evercore is going to be sticking with us. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. SK Hynix shares plunging in Korean trading. The company's record profits still falling short of sky-high expectations. Executives say they're signing long-term contracts with no end in sight to explosive demand. They expect demand to outpace supply until at least 2030. Deutsche Bank shares gaining in German trading. The bank reporting revenue from fixed income trading that jumped in the second quarter.
We had record flows from asset management, almost 9% growth from our private bank. Our corporate bank is continuing to show signs of progress, which we assumed. Continuing to invest across the franchise, capital position strong.
Deutsche Bank also announcing a new share buyback of more than $560 million. The OpenAI agent that breached Hugging Face also compromised a customer at a second technology company, Modal Labs. Hugging Face says the agent broke into an isolated testing environment known as Sandbox that Modal was running for a customer. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour in about 30 minutes' time. Up next on the programme, a return to hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Honestly, they haven't seen anything yet. We've been nice. Every time they hit us, we're going to hit them 20.
That's exactly what happened in the last 24 hours. Colonel Wayne Sanders of Bloomberg Intelligence joins us next, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I've said repeatedly the week begins on Wednesday. In many ways it does, because we've got some big events taking place, but I already feel exhausted, I'm sure you do too, after the last 2 days. Doesn't feel like we had 2 days off, that's for sure. The Federal Reserve interest rate decision just around the corner, 2 p.m. Eastern Time. 30 minutes later, a news conference with Chairman Walsh. Then after the closing bell, no rest. Microsoft and Meta reporting after the close. Into that 5-day slide on the Nasdaq, the longest since January on the Nasdaq 100 this morning. A small bounce, up a third of 1% on the Nasdaq. On the S&P, up a quarter. In the bond market, 2s, 10s and 30s just hugging. Anchored around 430, up 2 basis points this morning. With this move in crude, it's a bounce back. Crude higher, WTI and Brent crude around 88, higher this morning by 4.5%. Under surveillance this morning, it's a return to hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Every time they hit us, we're going to hit them 20.
When they hit, we hit. We use their language.
Honestly, they haven't seen anything yet. We've been nice.
We want to get it over with, and we want to do it right.
So here's the latest this morning. A multi-day pause in fighting coming to a halt. Crude climbing as the U.S. intercepts a surprise Iranian attack on army bases across the Middle East. Bloomberg's Tyler Kendall has the latest in Washington. Hey, Tyler.
Hey, John. Good morning. Well, this marks a major escalation amid a new threat that another front in the war could be opening. CENTCOM confirmed in a statement overnight that the U.S. military intercepted successfully multiple missiles launched by the IRGC at U.S. forces. But this came after Saudi Arabia confirmed that it, too, intercepted successfully multiple drones launched by Iranian-backed proxies from Iraq, prompting U.S. and Saudi forces to team up to hit sites in Iraq overnight, targets that Saudi Arabia hasn't hit in years. Washington has been trying to dilute Iran's power over these proxy groups, with President Trump telling me earlier this week that the U.S. remains in constant contact with Saudi Arabia regarding the Houthis in Yemen as commercial shipping continues to be disrupted in the Red Sea. And at this point, traffic in the Strait of Hormuz remains halted. The IRGC said overnight that it successfully halted at least 3 tankers that were trying to transit through amid new reporting that the country has turned down a new proposal by Oman that would have sought to reopen the strait to traffic. John, that would have included utilizing the so-called Middle Passage, giving both countries equal control over those transits. But we heard from an Iranian official saying that so far the country is vying for what they called, quote, sole control over any traffic that is trying to get through.
And Tyler Kendall with the latest in the nation's capital. Tyler, thank you. More from Tyler in the next hour. Joining us now to extend the conversation, Colonel Wade Sanders of Bloomberg Intelligence. Colonel, welcome back to the program. Every day I wake up and go through these stories, I'm always thinking about what's new, what stands out here. And what's new is Saudi Arabia. Saudi Arabia teaming up with American forces to strike Iranian-backed militia in Iraq. What's the significance of that to you?
Yeah, I'd take that as a huge significant area right now because Saudi Arabia controls the largest Gulf state Arab Air Force. It's also one of the key areas right now. They've always been a missile defense supporter and a logistics area for the United States, but they've mainly stayed out of it. So now that Saudi Arabia is entering into this as an active, overt participant with some of these strikes, it's letting them know, letting the rest of the world know at this point in time that they're starting to move forward with this, that they've had enough. It's also, given the fact that their influence over the GCC, that plays a huge part in this as well, in my opinion, because countries like UAE, Bahrain, and Kuwait normally end up taking some of their leads as well from somebody like Saudi Arabia.
So are you suggesting potentially we could see a more active entrance from the likes of the UAE or Kuwait or Bahrain as well?
Yeah, I wouldn't be surprised, especially when you look at UAE. They have asked for a UN Security Council resolution to allow them to enter the conflict, for the last few months. This isn't something that's new on that front. They've they've stayed back a little bit in terms of that. But with Saudi Arabia being able to add in the area that they currently have, UAE with their capabilities, not only from an intelligence, surveillance, and reconnaissance area, but also some of their expeditionary capability along the coast and the strait, plays a huge part in this as well. Because I think that when you look across, now when you start entering this, up until now, U.S. has somewhat felt alone with the Gulf states being in a very supportive role. But now what you're seeing is actually more of a partnership role, and I think that's going to be very significant going forward.
CENTCOM yesterday said that the IRGC forces when they launched these multiple ballistic missile attacks, it was a, quote, surprise. Do you understand what prompted that?
No, all I can think of is that at that point in time, IRGC thought that they had a target of opportunity to be able to go through. I think at that point in time, when you look at some of the military channels, if you will, to say, hey, look, right now we're in this pause right now to allow diplomacy to take another chance, that both sides are like, okay, all right, we're going to just sit here and let that piece play out before we resume anything. And the fact that those actually took place and those missile strikes started coming back in, I think CENTCOM, while they're always going to be prepared, I don't think they were expecting it as a most likely course of action, but they always look at it as the most dangerous course of action.
Colonel, a couple of months ago, people thought that wider involvement of more actors in this war would be problematic, that it would turn into a regional war, and that would only escalate the potential damage and length of this conflict. Are things viewed the same way right now, with the potential of other allies getting on board in addition to Saudi Arabia with the active fighting?
I don't actually think so, simply for one fact. None of these Gulf states right now are talking about adding into something that would end up in a ground invasion. The United States is not looking at a ground invasion, so you're still looking at air power being the predominant method for this delivery. So now what I think you're seeing is more of that shift for a vocal GCC vote that says, we have had enough of this. We've done everything that we can at this point in time to support in just a defensive role. But especially when you look at the Houthis from Yemen, as well as the Iran-backed militias coming out of Iraq, Saudi Arabia has to be able to defend itself. And the fact that they're doing this in an offensive way, I think is a good sign where the rest of the world is looking, going, okay, the U.S. is not an aggressor here in this. It's Iran refuses to come to the table no matter how many times we try to come back for diplomacy.
Colonel, it's good to see you. Thank you, sir. Colonel Wayne Sanders there of Bloomberg Intelligence, struggling to break out of this, Bramo, struggling to break out of this uncomfortable new normal, just switching between strikes and diplomacy with no sustainable diplomatic off-ramp.
When you ask people what's a resolution that seems sustainable, they say, well, you're looking at it. Ultimately, there's not a whole lot of other options, given the fact that the IRGC doesn't have a lot of levers to pull. Why would they give up their control over the Strait of Hormuz? And right now, it doesn't seem like there is the political will to do some sort of ground invasion that could potentially change that kind of new norm.
We've got Gillian Emanuel of Evercore still with us. Gillian, let's go through things year to date. We've had an 80 basis point move on a two-year yield so far year to date, 80 plus basis points. On crude, we've had a move of, let's say, 45% on Brent year to date. We've had that shock through energy, that ripple through rates. Do you think we can avoid a growth scare? Because I don't see that in the equity market. The equal weight closed at an all-time high in yesterday. It's worth pointing that out. Do you see a growth scare on the horizon?
We actually don't, but this is a playing with fire concept. So just to level set, look, jobless claims last week were the lowest since 1969, when the population in the United States was 2/3 of what it is now. That tells you how strong the economy is. But the issue for oil is there are times when it doesn't matter and there are times when it does matter. And part of the tension around hyperscaler capex is due to the fact that oil price volatility is underpinning yield volatility. And that is the flow through on how the debt markets will be receptive for what is likely to be substantially more issuance over the next 6 to 12 months.
Does it make sense to you that the equal weight, that the more consumer-facing aspects of the equity market are outperforming during a time where there's increasing concern about oil volatility and higher yields?
Well, what it tells you is that in this environment, in this liquidity, in the strength of this economy, there's still lots of demand for equities. Okay, and it also tells you that investors are looking for more creative ways to find diversification from what has really become one gigantic AI trade, whether it's the bond markets or it's emerging markets. Everything's an AI trade. So in that environment, look, insurance stocks, part of our negative beta basket, they're like the new meme stocks. They're screaming they've made new all-time highs. Consumer stocks very strong. But again, it tells you the backdrop for investing and the appetite to own equities is still there.
Julian, it's good to see you. Thank you, buddy. Julian Emmanuel of Evercore heading into earnings from Microsoft and Meta later on this afternoon before that Fed decision at 2 p.m. Eastern Time, 30 minutes after that news conference with Kevin Walsh, the Fed chair. The move we've seen in this equity market, we mentioned the equal weight closing at a record high. Check out the banks on the S&P. As a sector, the banks are up for 9 consecutive weeks. If we close out a week in positive territory, the longest weekly streak on record for the banks on the S&P. It's not just the major names, the regionals. The regional bank index up by close to 20% so far year to date. So what's going on in financials?
Fair to say this is not exactly a growth scare. This is quite the opposite. And this has come even as a result, or even as we see oil prices, or despite the fact that we're seeing oil prices rise and yields rise. How long can that continue? Well, Jonathan Krinsky, who actually got ahead of the SEBI move yesterday, put out a note where he was saying he wouldn't necessarily get all in, but maybe stop selling some of the semis. Now he's getting bearish in the equal weight. He's saying maybe that's going too far. So, there's some discussion under the hood here.
Futures this morning waking up to a positive story, up by 0.2 on the S&P. Up next, we'll catch up with Ted Morrison of Baird as Wall Street awaits a double dose of tech earnings. Plus, Yahira has your morning move as a check on SK Hynix ADRs. That stock is just about unchanged.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Every
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Equity futures stabilizing positive, 0.25% on the S&P 500. The market cap S&P 500, the equal weight yesterday, record highs. The epicenter for this pain is in tech. Within tech, it's in semis. The Nasdaq 100 sliding for 5 consecutive days, the longest run since the start of this year. On the semis, 4-day slide, the longest of the year so far. And that's where things have got a bit dicey. And even with fantastic earnings, we're failing to spark a rally in that particular sector. The next stage of the story is the double dose of Mag 7 earnings after the closing bell. Those names have been beaten up, and Bramo, you pointed that out. Those two names have been trading in a bear market. The bar for them should be lower. It should be lower. We'll see how lower that bar is a little bit later.
And potentially the volatility that's been exported, as you point out, from South Korea may not infect them quite as much, given the fact that they seem to be focused on the semi-names. That said, CapEx still front and center with respect to the concerns. SK Hynix also exceeded expectations when it came to CapEx expectations. So you might say that that's part of the story. If you do see an increase to capital expenditures without a pathway to pay for it with additional free cash flow, do they suffer the same fate as Google?
When you flip into negative free cash flow, you become dependent on this, the price of capital. And you turn to the bond market, 2s, 10s and 30s, and you can't engineer a rally right now in the bond market, really, even with a 16% turn lower in crude in 3 days. 2s stood around 430, 10s around 460. There are plenty of reasons for that. We'll talk about a few of them in about 5 minutes' time. But one is the additional supply that's compromising the cost of capital here, there, and absolutely everywhere.
Yeah, and we saw that with some of the auctions this week, with a little bit of pushback, even with yields at the highest levels going back to 2024, at least in the 7-year yesterday. Look, this is coming amid also concerns about stickier inflation due to the incredible earnings from all of the other non-Mag 7, non-tech companies that we've been getting. Yes, I know you've been saying that the week starts on Wednesday. Nonetheless, we have been getting earnings from a whole host of different companies, and they have been beating expectations beyond the kinds of beats that we have seen in the post-pandemic era. They all are continuing to show resilience. So this speaks to a continued ongoing strength in the economy, despite what we're seeing in oil, and part of the reason why you're not seeing some of those oil price declines get priced into lower yields.
People are still spending. You see that in the credit card companies. Still drinking sugar water. You see it over at Coca-Cola.
Yeah.
Still riding those cruise ships. You saw that earlier this week too.
You want me to do this again? Float in the boat with the Coke? I mean, this is essentially what we see, and we see it pretty much around the world, with a huge asterisk of potentially the Middle East travel. But yeah, people are traveling. You look at Hilton, you look at Coke. You look
I was setting you up to do it again. I wanted to hear it.
You wanted to hear it again?
Yeah, just, you know.
I actually was trying to make a song with it last night, and I decided not to.
Okay.
Because it might come out.
Playing around with ChatGPT
yeah, I was
again.
just like, you know.
Make a rhyme. Let's not do that, Bramo. No. Let's not do that.
Okay.
Maybe you wanted to do that. I don't know, but
I didn't really, but
I'm not interested this morning. Let's turn to crude. Brent and WTI. Brent crude this morning. This is your bounce. Look, 4 days of quiet, relative calm, and then you've got a spike. You're going to keep waking up to this kind of thing. This is the uncomfortable new normal. You'll have a series of talks. They'll break down. You'll have some unsustainable proposals, unworkable proposals. That'll break down too. And that'll all be punctuated with strikes, and that's where we are. So I don't want to overweight the strikes. I don't want to overweight the talks. I just want to observe that this is the new normal right now, and crude is still elevated.
It's purgatory. It's not full-out war, but it's certainly not peace. And on top of the fact that we have these strikes, you also have Iran rejecting this proposal from Oman to divide the control of the Strait of Hormuz. For them, it's all or nothing in terms of a toll and their physical handle on the Strait of Hormuz. Also, Saudi Arabia, according to our reporting, their state oil giant Aramco is preparing potentially for new selling price for oil. So you can potentially expect a step up when it comes to these products.
That's the cross-asset price action this morning. A few hours away from the opening bell. Make it 3. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start over in South Korea with SK Hynix. Shares falling 6.2%, but fell as much as 19% earlier over during that session as those leverage bets also unwind and exacerbate the selling. The company did post another record quarter, but still it was not enough to clear the high bar. Operating profit rose 557%, but still fell short of expectations due to those elevated expectations. Add to that higher capex spending projections that it announced, and you get the reaction that you're seeing over in South Korea. Turning to Ford, as Lisa was saying, good earnings and a good reaction here. Shares are up nearly 5% in the pre-market after the automaker raised its full-year profit outlook for the second time this year. It's being helped by strong demand for its SUVs and pickups, and that's helping to offset things like tariff pressures and weaker EV sales. And it's worth remembering that Ford also had a very high bar. Since May, shares have surged more than 40% on excitement over its energy business, which investors hope will hopefully supply batteries for AI data centers. And sticking with AI, we turn to Seagate. Those shares also up 5% after the company beat and issued a stronger than expected outlook. The stock is already up 160% so far this year as investors bet that AI will drive demand for storage. And that is something that the CEO confirmed, saying that they see momentum continuing in 2027. John.
Yahara, thank you. Thanks for the update. Three of the movers, some of the movers in the pre-market this morning. On our radar this morning, our top story, the US intercepting a surprise Iranian attack on military bases in the Middle East, bringing an end to 4 days of calm. Officials saying US and Saudi forces carried out retaliatory strikes against Iran-backed militants in Iraq. Elsewhere, a Fed rate decision due at 2 p.m. Eastern Time, followed by a Fed Chair Kevin Warsh press conference 30 minutes later. Investors widely expecting policymakers to hold rates steady, but not ruling out the chance of a surprise hike. And finally, SK Hynix earmarking at least $31 billion in capex after reporting a six-fold surge in profit in the second quarter and posting margins of more than 80%, still failing to spark a rally. The stock taking a beating, down more than 50% in a little more than a month.
I'm not sure what we can take away from this, considering that those shares are still up 120% so far this year. Is this more an issue of leveraged traders suddenly realizing that it doesn't only go in one way up? We've seen the South Korean stock market, the Kospi, become more volatile than Bitcoin this year. So you start looking at that and you start thinking, do any of these fundamental numbers actually matter? Because they didn't seem to matter on the way up, so they're not going to matter on the way down.
It's like the whipsaw that we just heard from Julian Emmanuel talking about oil prices. That's what it's been like in Korea. But the fact that operating profit rose, as you mentioned earlier, 557%, and still wasn't enough to get it done, just goes what we've been saying all week. The bar is so high for these companies, and not only do you have to meet the bar, you really need to exceed it.
Price and positioning. That's what we're learning here. Price and positioning. And as for positioning, tons of leverage that needed to be washed out. And once you got that spark, once you had that spark, you were going to light fire very quickly to wash out that leverage in South Korea.
I love reading some of the stories, the anecdotes of people who talked every morning about stocks in Korea. They'd come in, they'd tell their friends how much money they'd made, how they invested in these leveraged ETFs, these leveraged funds. Now, all of a sudden, everyone's quiet. They just sit there depressed, wearing all black.
That stock has been absolutely hammered. I don't think Dan Ives is wearing black yet, is he?
I doubt that.
It's still the second inning.
Come on, yeah. 10 a.m.
Give it a chance.
Lights are still off.
Without a
Cops
doubt.
have been called.
Right, something like that. A certain innings, and then a sports star.
Yeah, exactly. You know? Yeah.
Massive capex concerns putting the AI trade on some shaky ground. Tech heavyweights Microsoft, Meta reporting after the bell. Ted Morrison of Baird remaining focused on funding, writing the $1.4 trillion capex estimate for 27 is viewed as stressing the system. The circular finance debate is back on the agenda with clients. Ted joins us now for more. Ted, welcome, buddy. It's good to see you.
Hi.
The cost of capital, the price of capital, is it going higher?
It certainly feels that to me. I mean, one of the biggest events this week was NVIDIA's requirement to provide a guarantee for OpenAI's Ohio facility. I think that's a game changer that you really need to focus on. But to your point, we're going to have to raise a ton of debt and equity to really fulfill the 2027 capex requirements going forward, and that's on top of sovereign debt. So we've got a lot of finance here, and I think when you look at the risk changing a bit on these models, the cost of capital goes up.
What do you mean the risk changing a bit? Is it just tied to the fact that suddenly they've got to borrow more than at certain times their free cash flow? Or are you talking about the competitive threat coming from open source models and cheaper technology emerging from China?
It's a combination of things, Lisa. Number one, I think the component increases, as well as the energy availability, the access to power, if you will, is now becoming an issue on the street. The component increases, if you look at memory's up almost 330%. Other components are up a good 25%. So if you're a project finance manager or doing project finance debt, your assumptions are kind of out the window. Number two is, from a structural standpoint, I look at the funding of this AI trade kind of as a football game in 4 quarters. The first quarter, we were financing essentially the frontier models. And if you look what's happening on open source models and token costs, and what Dr. Karp said interviews a month ago, the models seem to be changing. And with the proliferation of open source, I think that changes the models of AI in a way that it's not steady state like the frontier models would like to have it. It's not just going to be an OpenAI / Anthropic debate here. There are other players, whether it be China or the US. Look what NVIDIA did with Palantir. The deck chairs are being rearranged as we steam here.
Yeah, I love that you mentioned that, Ted, because it was interesting to see that NVIDIA and Palantir put out a letter, an open letter, saying that open source is really important. And notably, it was not co-signed by OpenAI or Anthropic, which are suffering considerably in terms of their potential profitability. Do you see this world as shifting, where suddenly the pain in semiconductors isn't going to help hyperscalers, and pain in hyperscalers isn't going to help semis, and that ultimately you have to see both of these rally in tandem with potentially some losers like that frontier model cohort?
It's very dynamic right now, and I don't look at it from the macro perspective. I look at it from my client's perspective. My portfolio manager is getting hammered on the semi trade. If you were up, for example, almost 105% year to date at the peak, and now you're up 56%, and you decide to jump in the semi pool at the top, you're getting absolutely annihilated. So this is a game of attribution. And when you cannot predict the way the market is going, you tend to move to other sectors. And that's my biggest worry, that we drain the semi pool, and we drain, kind of from a shoot, ready, aim perspective away from tech. And that's the wrong trade. But nonetheless, I really focus on my portfolio managers that are, in most cases, struggling just on attribution versus the benchmarks.
Ted, what do you think the right trade is right now?
I think the right trade is not to trade. I think it's to hold your core positions. There are some people, in the market that are de-risking their portfolios. You can see it in the longs being sold and the shorts being covered. I think the trade is, you just have to get this phase of initial disillusionment past us and really focus on the second half. From a seasonal standpoint, summer's always problematic. This time frame, August time frame, is always weak. And I think some of the portfolio managers may just be taking some, quote unquote, time off until we get to the end of September, where we get a real seasonal uptick in tech based upon not only enterprise spend, but this AI trade. So I think it's just time to take a deep breath and own the best names in the sectors.
And then we can talk about the midterms. Can't wait. Ted, thank you. Ted Morrison there of BED. That's what Julian Emmanuel said to me in the green room this morning. First thing I walked in, and he said, a few months' time, you know what we'll be talking about? He was like, midterms, can we wait until the end of...
Talking about it now.
Like end of September. Let's wait until the end of September to deal with that.
Yeah, because right now we've got other things to deal with. I love that we've got portfolio managers and investors that come on, take a walk, take a deep breath.
Touch grass.
Touch grass. Maybe don't don't trade.
That's quite the year from Jim Zelter of Apollo so far,
Yeah, touch grass, take a walk.
Touch grass.
Yeah, I mean, I think that given the frenetic pace of news, I think that all of us feel like that would be a good advice.
Nasdaq futures this morning up a few tenths of 1%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. UBS shares gaining in Swiss trading. The bank launching a $3 billion buyback program after reporting a quarter in which wealth management assets beat estimates and trading revenue surged. South Korea planning to hold an emergency meeting to discuss the latest market rout that wiped billions of dollars from the Kospi. The meeting will be hosted by the country's finance minister and will involve all of the country's top financial authorities. China reportedly holding talks with Yemen's Houthis to discuss allowing its tankers to safely sail through the southern Red Sea. Reuters reporting Beijing asked for safe passage after the Iranian-backed militia pledged to block access to Saudi ports. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in the next hour in about 30 minutes' time. Up next on the programme, seeking clarity from the Federal Reserve.
The lack of forward guidance from the chair has kind of spilled over into a lack of understanding the reaction function, what they're looking at, what the risks he might think are. We really have no idea how Kevin Warsh thinks about monetary policy.
Up next, Claudia Sam of New Century Advisors, live from New York City. You're watching Bloomberg TV.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equity futures positive here by 0.2 on the S&P, on the Nasdaq by 0.13. It's a bounce back on tech this morning, at least for now, following 5 days of losses on the Nasdaq 100. In the bond market, going into this Fed decision later on this afternoon, overwhelmingly the consensus is no change. But just on the margin, there is a chance. And I'm telling you, there's a chance of a rate hike, and it's a low conviction consensus this morning.
Well, given the fact that we didn't have people necessarily coming out and voting for a hike last time, there were no dissents last time. At the same time, you did see a number of Fed officials say that they do expect a hike this year, and there are 8 basis points of hikes being priced in. It seems like it would be a really, really strange for them to do it with a lower than 50% chance getting priced into Fed futures.
Sue's this morning around 4:30, yields higher by 3 basis points. Under surveillance this morning, seeking clarity from the Federal Reserve.
The lack of forward guidance from the chair has kind of spilled over into a lack of understanding the reaction function, what they're looking at, what the risks he might think are. We really have no idea how Kevin Warsh thinks about monetary policy. He doesn't have to give us any forward guidance, but we would know sort of how to weigh the incoming information.
So here's the latest this morning. Wall Street expecting Fed Chair Kevin Warsh to deliver a hawkish hold later on today. Some traders still preparing for the possibility of a surprise hike. Claudia Sam of New Century Advisors writing, Warsh has managed to make the Fed an even bigger focus of attention by saying less. Uncertainty around economic policy was already high. The last thing we need is the Fed adding to it. Claudia joins us now for more. Claudia, welcome to the programme. Do you think that Chair Warsh is contributing to the kind of volatility that might be harmful?
So we are seeing that Chair Warsh is contributing to volatility. Now, where it's most clear is in the federal funds futures market, right? So coming in yesterday, there was still about a 30% chance of a rate hike today. That may not sound like much, but that is very high for that close to a meeting. The only time we have seen uncertainty like that in the past several years have been big moments like liftoff in 2015 or the first rate cut in 2024. There was a lot of economics going on and lots of disagreement on the committee. This time, the uncertainty, that comes from a chair who has gone really low information on how he's thinking about policy.
Low information on a range of things, and Claudia, you pointed out the difference. It's okay to stop providing forward guidance, but he's also failed to articulate his reaction function. What kind of questions do you have for this news conference?
I think one is just to ask Kevin Warsh about his own past words. When he worked on the Bank of England's communication review in 2014, he recommended that they give timely feedback on what the decision was, the rationale for the decision, and he even talked about the importance of a reaction function. So what's changed? That's been over a decade ago, and his thinking could have changed. But I agree with that Kevin Warsh about how he thinks about communication, and I'm having a hard time with it in this moment, though I will say we got all of that information by the time we got to the June FOMC minutes. So it may just be Kevin Warsh wants to change the format we get the information, not necessarily that we get less information. I think it'd be a really good idea to at least get it into the statement today if he doesn't want to say it in the press conference.
Claudia, what are you expecting in terms of the breakdown of dissents versus the majority opinion?
I expect that we probably will see some dissents today in favor of a hike. Lori Logan and Beth Hammack laid out very clear explanations for why they thought, if not right away, maybe sometime soon, it would be wise for the Fed to raise rates to bring inflation down. That doesn't mean that they're going to dissent, but I think they really set themselves up to have that, kind of weigh in that way, because dissents need to be meaningful. People do that when they really feel at odds with where the committee is standing at the moment. Another wild card to keep an eye on, we have seen dissents in recent past on how the statement itself was worded, like what kind of information is conveyed, this idea of do you get a reaction function, get any forward guidance. So I think the statement could be pretty interesting this afternoon in terms of learning where the committee as a whole is.
Do you think that right now inflation is a preeminent concern or excesses in volatility in tech sectors? And I'm wondering this because ultimately the wealth effect has been one of the biggest drivers of a lot of the sustainability in spending. So you can't disentangle these two. And you can hear it in some of the rhetoric from Fed officials over the past couple of weeks.
I would put what's happening with AI in the tech sector largely into risk that the Fed is monitoring. It has had some effect on inflation, so that is something very clear and direct to their mandate. I think I would use what's, the uneasiness in some of the tech sector as just another reason why the Fed doesn't need to be injecting more uncertainty and volatility into the situation. Like if market pricing of interest rates gets out of hand because we don't talk enough to the world, that could be really unfortunate and have effects on other sectors. So I think they're keeping a watchful eye on it, but I would put a lot of that into the kind of the risk bucket, as opposed to something the Fed is going to directly try to react to.
Well, we know they're going to directly try to react to data, but what about oil? What's the timeline on their reaction function to the whipsawing we're seeing in crude?
So this, I think, is one where it really would be helpful to get more information from the Fed. In the minutes, they lump together a whole set of reasons why inflation is elevated, including the conflict in the Middle East, but also the AI demand and tariffs. The thing is that historically the Fed has been very wise to look through swings in energy prices. There's a lot of volatility. I mean, we have seen that just in recent weeks, if not recent months. And so for the Fed to chase oil prices, it has proven to be a mistake. But if you watch like the futures pricing for the Fed, it's clear that markets are reacting to that. Like that piece of inflation, they think is something the Fed will be very reactive to. And I'm not so sure. It might be. This time is different. They're impatient with inflation and they react to that inflation. But that would be a bit off the playbook for them.
Claudia, it's always good to see you to get some clarity. Claudia Sam of New Century Advisors, some much needed clarity on this institution right now. Just working through the voting members going into this decision, where could the dissents come from? We talked a lot about Hammack of Cleveland, Logan of Dallas, maybe Kashkari of Minneapolis, maybe that's 3. It's the board that gets interesting for me. Never mind the regional Fed presidents, they are open to expressing their opinion. It's the board. Chris Waller, Fed governor, he offered us some data contingent guidance going into the last CPI print. And he effectively said, if it comes in hot, I'm going to vote to hike. Paraphrasing, but he went there. That came in soft. It would be a big surprise if we had the likes of Governor Waller voting for a hike later on this afternoon.
Yeah, although he has come out with rhetoric talking about his impatience with inflation being where it is and talking about concerns about the credibility of the Fed. And clearly he's clashing with Kevin Warsh, according to the Wall Street Journal reporting yesterday. So you put that together. And then you have, Schmidt, that's also a regional Fed president. But you've got these questions right now. Where is the focus at a time where a number of people have remained quiet? I'm thinking of the former Fed chair, Jay Powell. And you have other people who are keeping a higher profile, who are coming out with some pretty strong things to say.
Jay Powell keeping a low profile. Christopher Waller, what's so interesting about Governor Waller is he said, though, I think what everyone on the committee was thinking when it comes to these task force. Tell me who's leading them. I'll tell you what they're going to tell you.
More on the Federal Reserve in the next hour. Dan Suzuki of iCapital, General Karen Gibson of Academy Securities, Amy Gower of Morgan Stanley, and the former Kansas City Fed President, Esther George. The second hour of Bloomberg Surveillance just around the corner.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloom.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Do you just ignore all the noise that's out there right now?
We think about the tech as one monolithic kind of trade here.
With Alexis Christoforous on markets.
We're talking about inflation not really being under wraps yet.
And Michael Barr with news.
New calls to lower the temperature in the Persian Gulf.
The best in economics, finance, investment, and international relations. Bloomberg Surveillance on Bloomberg Radio, Bloomberg Originals, and the Bloomberg Business app.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Alexis Christoforous. It is Fed Day. It is a different day. Screen's sort of dead right now, waiting for a press release at 2 p.m. But never have I seen such raging debate about the new kid on the block. His name is Mr. Warsh.
Exactly right. So we'll hear from them. You guys will have full coverage starting at 1:30 p.m. Wall Street time here today, Tom, with your team. And so we'll have to see here. But, I mean, he could sit on his hands. He could hike a little bit. I don't know.
I was talking to Matt Winkler yesterday. Equities, bonds, currencies, commodities. Yep. In commodities and currencies, in equities, you're going to look to fixed income today. Ian Lincoln coming up, Gennady Goldberg here.
Yep.
In a moment.
We got yields a little bit higher here.
Bond market. Well, yields a little bit higher.
Oil
but
higher.
Just huge. Talk about unknown unknowns.
Yep.
What will the statement look like? How long will it be? I think Claudia Sahm worked up a model statement.
Oh, yeah.
And I was like, geez, I think it's like 2 paragraphs too long, based on what Mr. Warsh wants to do.
Okay, maybe he goes to ChatGPT and say,
less talk.
Yeah, give me a statement here.
Like people looking at the New York Mets' future.
Yeah.
Less talk there as well. Good morning, everyone, across America, around the world. Bloomberg Surveillance, and we're brought to you always by IBKR. For the past 3 years, Interactive Brokers. Their individual clients averaged 24.3% annually, beating the Standard & Poor's 500. Lower costs, access to 170 plus global markets. It matters. Visit ibkr.com/performance. And always on Fed Day, we thank Interactive Brokers for their support of our conversations. Futures up 14, red and green on the screen. The VIX center tendency 18.33. From the Interactive Broker Studios, the Bloomberg Business Flash, Alexis Christoforous.
Thanks, Tom. Futures are mixed as investors brace for a packed slate of corporate earnings and some key macro events. Microsoft and Meta results after the closing bell, along with the Fed decision. They're going to take center stage today. Oil, meantime, is surging as fresh fighting erupts across the Middle East. Let's begin with oil, where Brent crude is at $88.54 a barrel, up about 5 1/3%. West Texas Intermediate crude up 5% at 83.32 a barrel. As for futures, S&P futures are up 15 points, but Dow futures sliding 156, and NASDAQ 100 futures are up 53 points. SK Hynix shares are slumping after the company missed lofty expectations while committing at least $31 billion in CapEx this year. By the way, South Korean officials, they're holding an emergency meeting today to discuss all the market turmoil there. Lots of auto news this morning. Ford is up 6%. The automaker raised its profit outlook for the second time this year as consumers continue to snap up Ford's high-margin sport utility vehicles. Meantime, BMW is offering voluntary severance packages to about 8,000 workers, most of them in Germany, as the car maker tries to become leaner. And Porsche beat first-half profit estimates as higher margins for its iconic 911 sports car sales and tighter cost controls help support earnings and full-year guidance. That's a Bloomberg Business Flash. Tom and Paul.
Alexis, thanks so much. We dive into it. Hugely qualified Karen Manna to be with us here from Federated Hermes. First, though, Gennady Goldberg joins us, TD Securities. Have you ever seen a Fed meeting like this? I haven't.
Not since about September of 2024. Remember,
I would go back even farther. I would go back to Wayne Angel like 30 years ago.
It's been a while. So this is one of those rarefied ones where the market's not fully priced. If they don't go, this will be the second most mispriced meeting heading into that meeting in the last decade. If they do go, this will be definitely the most mispriced in at least 20 years.
You say if they do go, if they do raise rates.
If they do actually raise interest rates.
What will happen to our listeners and viewers if they raise rates?
Nothing overnight.
I'm not so sure of that, but continue.
But, you will have rates higher. The markets will reprice. The markets will assume the Fed really means business. The markets will price in probably more than the Fed wants to go. So there is a little bit of a consideration among the Fed. Do you really need to kind of jerk markets around like that and actually create that mispricing?
Paul, to review here, we had somebody in the other day that's looking for 3 rate increases.
Yeah.
And Jay Hatfield's going the other way.
Other way.
It's nuts.
Yeah, it is nuts. So, Gennady, what do you think the underlying view of inflation at the Fed is? Because we've got oil prices ripping up and down. We're up another 5% today. We were down 5-6% yesterday. They're all over the place. How do you think they view the underlying inflation in this economy?
So it's all about the core inflation, right? They typically ignore oil. They can't really at this point because it's been higher for longer. They've had oil shocks. They've had trade shocks. It's that core services inflation that they're worried about mostly. If that continues to be strong, I think that'll get them worried. So the tone around core services inflation has told us that the bar to hikes is lower. I don't think it's low enough for them to actually deliver a hike just yet. I think the next couple months will give them exactly what they need to know. If that core services number continues to stay high, I think hikes are absolutely on the table in the fall, even though that's not our baseline. We at TD Securities, we're expecting basically a hold for this year and next year.
Really?
But the risks are certainly rising to a hike later this year.
Dissents, do we care?
Yes.
If there are dissents, how many dissents there are? How do we think about dissents? Because before, we didn't really think about that too much.
Yeah, you've got a much more disparate committee. Warsh is not that consensus builder that we had under Powell, under Bernanke, under Yellen. We're not quite ready for this, I think, as a market. We do expect 2 dissents, Logan and Hammock. What we're watching as a signal is not that many signals that we can actually glean today, in the absence of forward guidance. If we get 3 dissents, 4 dissents, I think that would tell us hikes are coming relatively quickly.
4 would be
monumental.
Was Governor Waller's statements of 2-3 days ago, the game theorist out of Washington State, was that a indirect or off-mark dissent?
I think he is keen to get inflation under control. I don't know how keen he is to get it as fast as today. I think getting it today would be a little bit more reactive than we've typically seen out of the Fed.
Okay, but we got heavyweights coming here today. Gennady Goldberg, Ian Lingen, Michael Ball. Is Michael Ball going to drop by? His people said he'll drop by.
I think we do. We have
It's unbelievable. Yep. Doesn't he call up dial 1-800 the president and say, stick with me here, I got to raise rates to establish that it's a Warsh Fed? In one fell swoop, he moves on from Powell.
So here's a very controversial opinion. I think this has nothing to do with Kevin Warsh. I think this has everything to do with the hawkish members of the FOMC. We know the hawks are loud. their voices are growing. What we don't know is that core of the committee, those kind of careful middle ground members, are they convinced enough to actually follow the hawks into this? I don't think Kevin Warsh is doing a whole lot to keep that committee together. So what we're watching is, even Chair Powell, or former Chair Powell, I should say, which way is he going to vote? Is he going to be convinced to actually hike interest rates this time around? We don't quite think so. Not yet. I don't think he's seen what he needs to see.
I mean, I don't know. I've got the 10-year at 4.63, well above the 4.5%, which was kind of a ceiling. I got the 30-year at 5.10. Maybe the market's already done the work for the Fed.
Paul, that's the smartest thing I've heard so far, Gennady. and Paul's leading the discussion this morning.
And ironically, I mean, forward guidance works.
Yeah.
This is exactly what they've wanted. So, do they really need to deliver a surprise rate hike, get markets all up in arms, get the markets repricing even more? Because interest rates are going to sell off if they actually unexpectedly hike rates.
Are you going to be watching at 1:30?
Exactly.
Thank you. Okay, Gennady Goldberg, thank you so much. TD Securities here to get us started here on an extraordinary Fed day. Red and green on the screen. NASDAQ up fractionally after the carnage in Korea. Torsten Slok, like Amy Wu Silverman yesterday on the show, really talking up some of the tech dynamics and tech risks. We'll get to that, but right now we're sort of centered on the Fed. And we got Meta and Microsoft this afternoon.
Yeah. You got some tech names, some Qualcomm. Carol Master, Tim Stenovich, they're going to be busy at 4 o'clock. Nobody does it better breaking down those numbers as they cross the tape.
We'll have to see on that. Right now, we're going to continue it, but maybe take a different tact here. Karen Manna, with all sorts of experience at Federated Hermes, joins us. She's out of Penn State. That's a whole different view right there.
Happy Valley, baby.
Here on Where We Are with our newly minted chairman.
Karen, thanks so much for joining us. Karen Manna, Vice President, Fixed Income Investment Director at Federated. What's the bond market thinking here as we go into this Fed day here? Like I was just mentioning to Gennady, it seems like the bond market's already spoken with the 10-year at 4.63, the 30-year at 5.10. The market's kind of saying we're higher for longer, it seems like.
Good morning. So nice to be here with you. I do think that the bond market has been incredibly responsive to not only the Fed chatter, but to oil and the conflict. So what we're watching very closely is the curve. And bear with me.
Okay.
When we had the Fed chair speak in mid-June, his first podium appearance, very, very critical, we saw a sharp reaction to the price stability commentary in twos, up, I think, 14. The 10-year, a far more muted response. 10-year likes the tough talk on price stability and inflation. In recent weeks, memorandum of understanding, perhaps less understood, 10-year spiking on oil. So that's the nuance. I think 10-year is following inflation going forward, 2-year and shorter, following the Fed.
How much credit risk do you guys at Federated want to take in this kind of market here? We're not really sure where the Fed's going to go. How much credit risk are you guys willing to take at this point?
We don't really like a ton of credit risk right now, and we don't think you have to lean too far into this market to get a reasonable yield for your portfolio's objective. Again, what we really think is working right now is this incredibly responsive curve. 1 to 3s really jumping, perhaps even too much for a Fed that may not raise rates. The front of the curve is assuming that they will.
Steve Roth started out at Federated clipping coupons in the mail like Bill Gross did over at PIMCO. Basically what I'm hearing is to the end of the year, given the huge unknowns that are out there, clip a coupon and say thank you. Is it as simple as that?
It's very simple. Clip the coupon, but you don't have to lean. You don't have to take extraordinary credit risk. Buy what you can understand and let the fixed income do its role in the portfolio. Knowns versus unknowns. I'm going to take you back to not quite a year ago.
Bottle it, folks. It's like equity market chat from a guy up in Boston named Peter decades ago.
Yes.
Guess what? What Karen Manna says there is gospel. If you don't know what you're buying, don't do it.
Do we stay just on the shorter end of the curve there, Karen, or how do you guys think about duration here?
We are neutral on duration. That's, again, across portfolios, we're going to be neutral on duration, neutral on curve right now.
So what does that mean, 3 to 5, kind of?
Per portfolio, we're not going to make bets or really invest heavily on duration one way or another. a recommendation right now for new money into fixed income is that 1 to 3 year part of the curve being very attractive.
What do you make of all that? I'm just looking at a note from Torsten Slok that just hit my inbox from Apollo. What do you make of all this technology, investment grade bonds coming into your market, which you haven't seen too much tech paper over the years? Now it's like you guys are flooded with it. What do you make of all that?
We have definitely been flooded. I think it's more the pace of the issuance that has been the surprise. We knew it was coming. First half of the year, digestion was really, really strong. Now, all of a sudden, we've had an onslaught of really massive deals for the market. Slow leak out, I think it's been manageable. And for us at Federated and for the broader market, it's about the bottom-up fundamental analysis. There will be winners and losers here. So what we are into is a period of discernment, not just waving in nice yields, whatever nice means, but that discernment and selecting the better companies. And even with the Fed, there will be folks that make the call right on a Fed that gives more or less forward guidance, and others that get it wrong. So it speaks to active investing.
A 1-year T-bill off the BTMM screen.
Oh, boy.
Tom Secunda taught me this.
That's a good one.
BTMM, it's like what they use at Federated. I mean, Steve Chivarone's addicted to this screen. A 6-month T-bill. Center tendency, 3.92%.
Yeah.
Almost 4%.
Yeah. That's amazing.
For a T-bill.
I'm sitting right there. I'll roll the T-bill all day long. I mean, I don't know why I have to take more credit risk. So what can surprise you from today's Fed meeting? What are you hoping he doesn't say, perhaps?
Well, it is exactly that. It's going to be about the tone of the committee, and it's really about the dissents. I'm holding in the camp, and I'm starting to feel very, very lonely that they're going to hold and not change the policy rate.
You nailed it. This is the zeitgeist in the last 12 hours.
Truly.
That I'm getting.
Truly. It's like everyone is trying to move on sides to a rate hike, and it's about the Fed making a statement when you have a Fed chair that has pretty carefully indicated that he is not going to use forward guidance. So I don't know how anyone can say he's going to make a statement and credibility hike to prove to the market.
Folks, this is your drinking game today. Get out the Tito's and Tang. And every time I say, like I'm saying to Karen Manna right now, it's simple. He needs to establish a Warsh Fed. He needs to move on from the Powell Fed constructively. So he dials 1-800-1600 Pennsylvania Avenue and says, you know what? I'm going to reset rates one pop higher just to reset and shock the market. It's like a no-brainer.
But how do you know it's a one-time when he's not going to give you
Because he's got to say, he's got it. He's got to say, you know, this is where we are. This is where the rates are. We see a disinflationary tendency, but let's just get here to settle the market. I'm just making it up. It's showbiz, Karen. You know, I'm not running any money. Okay.
Well, when a fixed income person is in showbiz, we're really making something of this. But a 25 basis point hike, I think it unsettles the leveraged consumer.
Oh, big time.
And helps the unlevered consumer. And similarly, I don't know that 25 basis points stops AI issuance.
Do you think that...
Fascinating. That's original.
Yeah, I know.
That's a brilliant
Do you think
idea.
the bond market believes this Fed is apolitical at this point?
Ooh, that's what makes this September movement very, very tricky. Take us back 2 years ago, not to be in history here, to 2023. We thought they would never move in September, and they did. I do think that there is consensus building going on this Fed. I do think the biggest shock right now, although as we propel ourselves through the day, a no hike might be the shock, a hold, but would be if we saw fewer dissents, because now we're all the way up to 3.
Brilliant. I love this. It's 7:16 a.m., folks. Gennady Goldberg with us, and then Karen Manna, fixed income investment director, Federated Hermes. Just a wonderful brief on the undercurrents out there. Let me read this verbatim because it's too much stress for our news department. As of late July 2026, Tariq Skubal has not been traded and remains a member of the Detroit Tigers. He's scheduled to start on the mound against the Baltimore Orioles. Barely speaking with our news in New York, Detroit's Michael Barr.
Thank you very much, Tom. The U.S. said its forces were targeted by Iran overnight, while Washington and Saudi Arabia struck Tehran-backed militias in Iraq, abruptly ending a days-long lull in hostilities. CENTCOM says the U.S. and Saudi Arabia then jointly hit weapons and other sites belonging to Iran-aligned terrorists in Iraq, resulting in 20 deaths and more than 30 injuries, according to Iraq's Popular Mobilization Forces. Bloomberg Middle East breaking news editor Patrick Sykes.
Iran said that it targeted a U.S. military base in Jordan in response to what it called aggressive actions by the U.S. military. It hasn't elaborated on what exactly it means by that. Obviously, the timing, I think, is significant with Israeli Prime Minister Netanyahu being in Washington, meeting with Trump overnight, and Iran having said over the past few days that it isn't going to let the U.S. dictate the terms and the timing of a peace.
Bloomberg's Patrick Sykes. The death toll continues to climb after a magnitude 7.1 earthquake rocked southwestern Japan. At least 18 people are dead and more than 60 people are injured. However, those numbers are expected to climb. Today, Senator Lindsey Graham will be buried. Senator Graham's body was transferred back to Columbia, South Carolina. Yesterday, Graham was eulogized during a memorial service in Washington. President Donald Trump, during his remarks, said Graham would be remembered as a titan of the Senate.
He was a man who gave America the full measure of his good and mighty heart until that heart itself just gave out.
Graham died suddenly July 11th at the age of 71 of a likely aortic tear. The Senate committee today is set to question Dr. Anthony Fauci, accusing the former head of the COVID response effort of misleading Americans about the source of the virus and lying to Congress. Dr. Fauci denies that. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Tom, Paul, and Alexis.
Michael Barr, thanks so much. Paul Sweeney out front with the research note. We get constant incoming research, hundreds of notes, tens of important notes, and there's Torsten Slack echoing Wayme Sue Silverman. I nailed that,
Amy
right? It's a drinking game of what Kevin Marsh is going to do. Amy Wu Silverman, watch CDS. There's some tension out there.
Yeah, I mean, Torsten Slok from Apollo out with a note, just kind of talking about I think the AI story here, and I think we're at the point of the AI story is like, okay, let's talk about return on invested capital here for this AI spend, and that's kind of where the market is. And of course, we'll get a lot of tech names today and tomorrow will give us some more data. But I mean, he's just kind of calling out what I think a lot of people are asking about. How is this stuff being financed? What are the returns? How do we measure the returns and over what time period? And that's kind of where I think the market is. And so these tech companies tonight after the close, tomorrow after the close, I think their comments are going to be closely watched.
I mean, Meta a mess, just as a general statement, but Microsoft's conference call, people are going to hang on every single word.
Yep. You got Amazon, Meta, Google. I mean, a lot of these names, Microsoft, some really big names with some big spending numbers. Historically, the market's given these companies a pass, but a little bit tougher here.
It is Fed Day. Please stay with us through the day. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
7:24 on Wall Street. I'm Alexis Christoforous from the Bloomberg Interactive Brokers studio. Investors are holding off on placing any major bets ahead of a Fed decision and mega cap tech earnings. Traders are pricing in 30% odds that the Fed hikes interest rates today. And we hear from Meta Platforms and Microsoft after the closing bell. Right now, S&P futures up 17 points. We've got Dow futures sliding 168, or about 1/3%. NASDAQ 100 futures trying to bounce back here, up 1/3% now, or 91 points. Meantime, oil is higher as fighting intensifies in the Middle East. Brent crude up more than 5% at 88.45 a barrel, and West Texas Intermediate crude is at 83.16 a barrel, up about 5%. More earnings pre-bell to tell you about. Shares of Procter & Gamble tumbling 3.5%. The maker of Tide detergent and Gillette razors giving a conservative outlook for its current fiscal year, and results in the latest quarter that fell short of estimates. Meantime, Biogen up about 1%. Quarterly revenue and earnings beat the street as sales of newly acquired kidney and eye disease drugs helped offset declining revenue from multiple sclerosis medicines. But shares of Humana tumbling nearly 7.5%. The insurer maintained its yearly profit guidance despite a strong second quarter. That's your Bloomberg Business Flash. Tom and Paul.
Alexis, thanks so much. This afternoon, you got some things to look forward to. Microsoft, Qualcomm, Meta earnings, all this at 4 p.m. this afternoon. There's a new way to take this in. If you are a Bloomberg.com subscriber, and of course, always our terminal clients, you're going to be able to frame out questions exclusively to our best people. Mandeep Singh may show up. Oh boy. Which would be a very cool thing.
Who hired him?
But this is Ask Radio at Bloomberg Radio and on Originals on YouTube. If you're a Bloomberg.com subscriber, if you are a Bloomberg Terminal user, at 4 p.m., you can ask questions to some of our smartest people on all the tech this afternoon. Futures up 18. The VIX churns there for the last 3 days, 18.27. Joining us right now with Goldman Sachs Asset Management, Kay Haig joins us here. You're out of London, out of Bristol. You are out of the land of central bank dissent. I love when the Bank of England comes out. Everybody's angry. Everybody's arguing. Do you see where you sit and where you digest Jan Hatzius economics? Do you see a Fed that's going to become more like the Bank of England?
Well, good morning. It's tough to tell at this stage. It'd be very interesting to see actually how today's meeting goes. I think will give us a little bit of a flavor of what is to come. I think the market understands very clearly that there's going to be less forward guidance going forward, but the market still needs to figure out what that means in terms of kind of policy and reaction functions. So let's be open-minded about that. But it is really very likely, to your point, that we're going to get a little bit more volatility at the short end going forward, given the way the Fed's likely to communicate.
Your market, your fixed income markets, I mean, it's been higher for longer. Is that the new world for you guys? Higher for longer here? I'm looking at the 10-year at 460 something. I mean, that's not. I kind of thought the 450 was my ceiling, and then you guys blew right past that.
Well, there's a couple of things going on. First of all, short-end rates are likely to be higher. Inflation is higher, not just in the US, around the world, but inflation is higher and stickier. And then, of course, now we've got the commodity price shock that is propagating throughout the economy. So that lifts the shorter end of the curve. And then, we've got a lot of supply coming at the longer end of the curve, from fiscal. So governments are issuing more. But you see it in the IG market as well. You see the corporate market issuing more, particularly kind of hyperscalers at the long end. So that puts pressure.
Your bankers have been busy. Morgan Stanley bankers, JP Morgan bankers have been busy pumping out all this technology paper here. Where do you see the best value, I guess, on a global scale? Is it the U.S. market? Where do you see the value today?
So I think there are pockets of value globally. If you're thinking of the paper that's being pumped out, I think on the IG side, I think it's very important to just keep in mind that there's going to be a lot of this coming.
Yeah.
We kind of look at the numbers to about 2030. Expectation is you're going to see something like an additional 1.4 trillion. And compare that to the 8 trillion that you have in the kind of Bloomberg IG index. That's a big number. So where's the value? I think you have to assess the value on an individual basis. Typically, what matters are the details and the number of these deals. the maturities of these deals, the leases, the states in which, some of these projects are being built. So, selection and getting actually into the weeds of individual deals is going to be the driver, because the volume is gigantic and the bondholders will be very discerning when it comes to buying this paper.
What is the signal you see in hyperscaler price down and some of the CDS elevation that we see? When you look at technology paper, can you add to those positions with new issuance or existing issuance?
Well, coming back to the point that there's going to be a lot more where this paper comes from. So one shift you've actually seen is that the risk premium that the bond market commands is going up over time, right? So the spreads are not only wider, but the spread curve is steeper. Now, that's a good thing because the market is beginning to command the right risk premium, and the breakdown between what the equity market gets versus the fixed income.
Okay, this is the heart of the matter. You just brilliantly said it. We've got a new steeper normal curve. Ed Yardeni on Friday said, get used to it. This is normal. Is that where Goldman Sachs is? All we're doing is reverting to a normal market?
I think it's likely that the issuance will drive a more normal kind of issuance pattern, 100%, and that will put pressure at the longer end of the curve.
Paul, that to me is the foundational idea.
Well, I mean,
issuance is price discovery. Simple as that.
Assets under management of GSAM, what is the total number for you guys?
In wealth management and
just
asset management?
GSAM asset management.
About $4 trillion.
$4 trillion. Jeez, I remember you were running equity monies out of Tampa, Florida back in the day. What are the macro forces here? The big economic macro forces that you guys are focused on right now? Is it global inflation? What's some of the issues that are really first and foremost for your portfolio managers?
So look, one thing we're seeing in the kind of post-QE world is a lot more differentiation. So we started maybe mentioning the Bank of England. We've got a Bank of England meeting actually this week. We've got Bank of Japan also coming this week. We're seeing a lot of differentiation. What's priced in is becoming a lot more kind of volatile, particularly at the short end. So that's the first big thing. What drives it? Well, we're going to learn a lot more about what drives it in the US today, so that the reaction functions are changing. You've got the task force, particularly in the US, that will look at a lot of the kind of fundamentals and frameworks as to what's driving
Are they
policy.
going to get anything done? I mean, what do they call a task force in England?
Why do they call it task force?
Is it called a task force?
I think
Are they going to get anything done? You got to be kidding me.
England, they just go to a pub and they figure it all
exactly.
out.
I mean, that's the way to do it.
Like consulting a little bit is not a bad idea, right? The world is changing. It's okay,
Exactly. Kay, thank you so much, Kay Haig, with this consulting for Goldman Sachs Asset Management in London.
City, so we can have
now in New York,
anytime.
we got to have him in on a daily basis.
Yeah, exactly.
It's very
tough
good.
commute,
Kay Haig, thank you so much. Greatly appreciated. Futures up 15. Lots of people publishing. Peter Bookvar with a spectacular, clear note. If Kevin Warsh is still watching markets, and, he really parses out some of the things you've heard on Bloomberg surveillance, which is a lot of the more visible retail inflation numbers are indicating the disinflation, where the Fed would stay steady or even begin framing out rate cuts out there somewhere. And Bookvar says that's great, except business inflation, supply shock inflation, PPI, is running 2 full percentage points over CPI.
Yeah.
So that's the cross current. They're going to be arguing about this over the long table.
Absolutely.
At the Eccles building.
I'm just looking at the WIRP function, world interest rate probability. That's the function that's probably going to get hit probably the most today across global Wall Street here. And by the year end, about 43 basis points of rate hikes are kind of priced into the market. So it's certainly one rate hike priced into the market, almost 2 rate hikes.
Right.
And so we'll see how that changes. Just take a look at that today, right now, versus what we get, Tom, at 2 o'clock, 2:30, 3 o'clock this afternoon.
That's going to be
if
wild.
You hear from the Fed to see what the changes are going to be. And you guys will have it.
The other
live.
thing is, how long will this press conference be?
Yeah.
His body language has got to be, it's short.
Is Mike McKee going to get a question?
I don't know. We're going to have to, I think
okay, now,
John
I hope
and
Mike
Bram are going to have to
terrible,
fill time.
There were terrible flight delays on the East Coast yesterday. Planes getting diverted all over the place. If Mike McKee flew to Washington, I'm going to be very disappointed. He should take the train down. So
I think he does sometimes as well.
We'll see all that.
Just buried in Bookvar's note. Are you ready for this? Year-over-year rental growth. San Francisco,
Oh, man.
Techie. 9.4%.
Yep.
Wow.
You know what they're doing with Candlestick Park? They're making that now, finally, after all these years, they're going to make it into a mixed use, like pre-planned city kind of thing, office, housing, retail.
Right.
But I just remember the winds at Candlestick Park, on a July night wearing a winter coat.
On a July night, freezing cold, the coffee coming out of my grandfather's styrofoam cup. I saw Juan Marichal with that leg up. How he did that, I'll never know. And I will never forget Willie Mays with the baggy pants and 40 rows up. You could hear the pants blowing in that wind.
Yep.
Candlestick Park, that's a great memory. Giants, love seeing the Giants in Phoenix with the CFA, Society of Phoenix, a couple months ago. But have they won any games?
I don't know.
I don't think so. It's Fed Day. Please stay with us. Futures up 14. Bloomberg surveillance.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's coming up on 7:40 on Wall Street. I'm Alexis Christoforous, and this Bloomberg Business Flash is brought to you by IBKR. Trade election climate and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest on your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. Despair and frustration spread across the South Korean markets once again today. The key Kospi sliding as much as 13% in a hectic morning session, triggering a circuit breaker for a second straight day led by disappointing earnings from SK Hynix. Now here in the U.S., stock futures are mixed as investors await profit reports from Meta, Microsoft, and Qualcomm after the closing bell. And let's not forget, we've got a Fed meeting this afternoon on the fate of U.S. interest rates. Right now, S&P futures up 13 points, Dow futures down 176, but NASDAQ 100 futures holding on here with a gain of 50 points. We have got shares of Hermes tumbling to their lowest level in more than 3 years. That's despite a narrow beat on revenue. The French luxury goods maker saw weak demand in China last quarter, especially for its leather goods. And Gucci sales topped estimates in the second quarter. That's sparking optimism that a turnaround at Kering's largest brand is finally taking shape. The brand improved in all regions last quarter, led by North America. Quick check of oil shows green arrows. Brent crude $88 a barrel. West Texas Intermediate now at $82.80 a barrel. That's a Bloomberg Business Flash. Tom and Paul.
Alexis, thanks so much. On Fed Day, we're trying to give you a cross-section of views into the 2 o'clock meeting. Ian Wyatt joins us from Charlotte, North Carolina. Of course, all the work of Huntington Bank of Columbus as well. Okay, 33% of active listings in Charlotte have undergone price cuts before selling. I mean, there's a whole housing price dynamic involved here. Does the Fed care about the housing economy within their decision today?
Right now, I don't see housing as well. There's some cuts and housing softened. I do think that that matters for the consumers, especially on the rental side. If we look at where the inflation is happening in housing, if you break out the shelter components, you can see it's not really in the rental side. It's in, funnily enough, the housing component of CPI includes hotels, for example. It includes insurance. It includes all the costs of housing. Right. And so we're seeing it there, and that's skewing more upper income. So as far as lower income consumers, the average consumer, I think they do care that rents are not a big pressure right now. And for a lot of lower income households, that's a really big deal on the spending side too. And I think we're seeing that in the spending data right now as well, is that those households are still spending. But I think right now, yes, the Fed is obviously focused on inflation. The jobs picture is okay, and that's partly because those households are still spending. They had a pretty good tax cut come in. We had the refunds. And we've seen pretty solid spending data. In fact, all the recent spending data is skewing more lower income. Is actually growth is faster amongst lower and middle income than upper income households.
So does that mean the K-shaped economy, which we've talked about for so long, is that less of an issue now? It would seem that with higher inflation, it would be more of an issue.
Yeah, you'd think that. Now, I think part of it was we probably underestimated how bad rent was back in the day for these households, and how much government stimulus was withdrawn, because sometimes we're somewhat separated from that. So you had huge rental inflation, and for a decent, the CBI says, your rent's roughly, and housing is roughly a 30-year spending. But for a lot of households at the lower income, it's 50%. You're talking 35% of them are spending more than 35%. So it's a bigger deal, and that's not a inflationary pressure. Whereas gasoline in a good year is 4% of their spending.
4%.
Okay, so let me set
it's up to 5 or 6 now.
You're so good at this. Let me set up the polarity on this. The President of the United States is worried about real estate prices in the bottom half in North Carolina because his team's got to get reelected. Wall Street is worried about price increases in the Hamptons because Bonai season's killing everybody. That's the barbell polarity of America. Who does Chairman Warsh address today? Fancy people in the Hamptons or mere mortals 40 miles outside Charlotte who can barely get by?
I think Chair Warsh is, and in general, this Fed has become less focused on Wall Street over time and what the markets are doing. Now, obviously, the chair has spoken a bit about having the bond market lead rather than follow the Fed. But the reality is when we look at their reaction function as far as the job side, the other side of the mandate, back in September, they cut. And the previous September, they cut because what they saw was softness in the labor market. That really is.
I think that the chair has really established himself as a credible inflation fighter, or at least not a clear dove because of who's in the White House.
Yeah, so briefly it looked like we were on track for a normalization in
Welcome to the programme. It's good to see you. Is there a sweet spot for CapEx and the way you communicate CapEx, given the experience of Alphabet just last week?
Well, it's unclear because the stocks have been reacting quite negatively to a very strong earnings seasons, and that's for three reasons. First is questions over the amount of money we're spending on artificial intelligence. Second is the Middle Eastern war, and third, of course, the Fed meeting. So looking at these AI stocks, the question is, can these companies come out and print higher spending on artificial intelligence without disappointing the markets? So far, not so good in that sense. What we're watching for is are they going to talk about monetization of this spending and what kind of productivity returns that we're seeing on it? And that's really the question mark for the markets. Stocks down 5 days in a row, really poor returns in Korea for the past couple of nights. I think we're going to remain in a choppy market for tech stocks. If you look at the volumes yesterday, there were some signs of capitulation in terms of NASDAQ volumes versus the S&P 500, but we're likely still catching a falling knife here. What I'm watching for is some of these stocks that print earnings and actually get a positive reaction. We haven't seen that yet.
Sarah, you talk about a choppy market. It's been choppy, but we're hanging in just a percentage point or two or three away from all-time highs. And it's been a kind of a rolling ball of money going from one sector to another, looking for the next hot trade. What would it take for the rolling ball of money to become a ball that's shrinking, people that are actually taking their chips out of the equity space?
Well, first of all, what we normally see is earnings and the stock market follow positive earnings growth. And this quarter is a great quarter for earnings. We're seeing over 25% earnings growth, 85% of companies beating earnings. All of that should be positive for the markets, but it's not. And that's mostly because people are not only worried about AI spending, but also the Middle Eastern war and oil prices. What does that mean for inflation going forward? And then everyone has been cautious for the last number of days because of this Fed meeting. Because we're not getting any forward guidance out of the Fed, or that's not likely, what we're going to have is more noise and less signal and a lot of uncertainty around the decision today. My view is that we do not get a hike today. We stay in the pause camp, and the Fed communication is going to be around what's happening with this five task force, and also that they're going to be depending on incoming data in terms of inflation. And with the Middle East war going on and volatility in oil prices, it's very uncertain in terms of where inflation is going to go from here.
And do you think that the lack of forward guidance, and not just forward guidance, but the lack of an understanding of the reaction function of the Federal Reserve has been responsible for some of the volatility and the chop that we're seeing in markets of late?
It's been responsible for a little bit of it, but I think that what's been overshadowing and taking all of the volatility and all of that volume is the AI and what's going on with earnings. People are very concerned that we spent, it's $750 billion on hyperscaler capex so far this year for all of 2026 likely. And are we going to see the return from that in terms of productivity and in terms of monetization of that artificial intelligence spending? That's the question mark. That's taking up a lot of the market volatility. And secondarily, the Middle Eastern war, the ceasefire, whether we have one, whether we don't, what that means for oil prices. And then thirdly, I think, is the Fed and whether we see a hike today or a pause. If we see a pause, we'd likely move forward with some volatility. If we see a hike, I think that'll be more negative for the markets.
Do investors need a resolution in the Middle East in order to remain bullish? What if we just live in this purgatory for the next 6 months?
I think that what we want, it would be a short-term positive for the markets if we get a resolution in the Middle East. But what we really need to see is continued strong earnings growth and a better market function reaction to those earnings, especially in the tech space. We came into this year positive on technology stocks, but at the middle of this year, we moved to a broader stance. We think the rest of this year is not going to be all about tech stocks. Broader market sectors are going to participate, like energy and material stock, where there's also strong earnings growth. The good news for markets is that when earnings grow at over 10%, markets tend to be up 10 out of 11 years. We are seeing that this year, but we are still up already 8.5% on the S&P 500 year to date. If you look at midterm years where we have midterm elections, for the 3 months before the midterm election, market returns tend to be zero. So we're in that phase right now. So I think first half was easy money. Second half is going to be more challenging money. Third quarter of the year may be the most challenging quarter of 2026.
Attempting to avoid the midterms, at least right now. Holding on to July, Sarah. Thank you, Sarah Malik there of Nuveen. I just know that we get closer to September and this becomes more and more of a thing, but trying to avoid it for now.
Yeah, well, we've got enough to handle. I mean, ultimately, We've got enough unknowns. It's sort of how many unknowns can you spin on your plate at one time? Too many. I'm sorry.
The tech will be part of the conversation too.
100%.
For the midterms, without a doubt. It's going to become a bigger and bigger issue. It is one already.
Absolutely. People don't want data centers in their backyard. People don't want electricity prices going up. People are concerned about AI potentially taking their jobs. I'll give you till after Labor Day.
After Labor Day?
You can hold on to the summer until then. After Labor Day, that's it.
I
Every
like
single
stretching
day.
my summer deep into September, you know that.
I know you do that because of the weather, but I'm sorry.
You
Can we
can't
go
do Happy New
late
Year
September?
for more
September
than
7th.
6 days, but you got the summer
Everyone
that
needs
lasts
rules, Bremo.
until November. Yeah, except by you. Come on.
Summer until the end of September. What's wrong with that? The weather's
September
great.
8th, I'm starting the show.
Weather's
Midterm
beautiful.
countdown.
The weather's beautiful in New York in September.
It is. I'm just
Okay.
telling you what people are going to be talking about right after Labor Day.
Okay.
So I'm giving you
Shut
until
it
Labor
down.
Day.
You knew that was coming, didn't you? Shut it down. Let's get you an update on News Worldwide this morning with your Bloomberg brief. Fonnie has more. Hey, Fonnie.
Hey, John, thank you. The U.S. military says it intercepted a so-called surprise Iranian ballistic missile attack on American bases in the Middle East. An Iranian state-run news agency says the Revolutionary Guard launched the missiles in response to recent U.S. aggression. More than 1,000 employees across leading AI firms signed a petition urging the U.S. government to support measures that could slow the pace of AI development. The letter warning that AI may be advancing faster than humans can control. Dr. Anthony Fauci is set to testify before the Senate Homeland Security Committee today on the origins of COVID-19 virus. The hearing comes after Senator Rand Paul released more than 1,100 pages of Fauci's private diary as part of his investigation into whether the virus leaked from a Chinese lab. And that's your Bloomberg brief. John.
Fonnie, thank you. Thanks for the update. I just can't relate to people who get excited about putting sweaters on. You know, there's people.
Yeah.
Gets to September and they're excited.
That's me.
You're excited for the sweater on? Are you? Are you really?
Pumpkin spice lattes.
100%. No, I don't do that.
But it's those people.
The basic. Those people.
I like seasons.
It's so weird.
So sue me. I like seasons. It's wonderful.
I like a nice boot.
Good to know.
Thanks.
Up next, the Morning Calls Plus, Gil Luria of D.A. Davidson on why Microsoft earnings are the key report to watch this season. That conversation up next. Live from New York City this morning. Good morning.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherry-Yan in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I think the right trade is not to trade. I think it's to hold your core positions. Some of the portfolio managers may just be taking some, quote unquote, time off until we get to the end of September, where we get a real seasonal uptick in tech. I think it's just time to take a deep breath and own the best names in the sectors.
Ted Mortensen of Baird, no time off, no days off, no breaks, no summer break at all. just volatility in energy. I want to bring up crude, Brent and WTI, and you'll just notice they've ticked higher again. On Brent, on WTI, on Brent right now up close to 7%, closing it on 90. Just one simple headline from the president moments ago, speaking to an American broadcaster, enough to shift this market once again.
He said we'll be hitting Iran hard. This comes after an evening where the United States, alongside Saudi Arabia, went after Iranian-backed militias in Iraq. This comes after you have the Iranians going after U.S. military forces in the region. And it comes as the Iranians are basically telling the Omanis, we're not playing ball, we're not going to sign up for a new deal when it comes to the Strait of Hormuz. And the president basically telling the market, we're going back to strikes.
You take that move in crude, you add a basis point to the sell-off in treasuries, yields higher by, let's call it 3 basis points now at 432. You see that move in the bond market, 2s out to 30s. Push it through equities. Equities turn negative. They were positive, just like that. This is the issue right now. You're just not getting out of this, Bramo. It's just back and forth, back and forth. It's endless. Unfortunately, this is the uncomfortable new normal in the Middle East.
Touch grass, go for a walk. I mean, ultimately, how do you price this in? Because this type of volatility is something that is exhausting and yet not ignorable. And I think that's what we feel from a lot of different traders every day being whipsawed by this. At a certain point, the volatility begets its own price action, which is if this is the new normal, suddenly it will be that much more pernicious in a whole host of ways.
Equity futures slightly negative on the S&P 500. The open about 1 hour and 12 minutes away. Let's get you some morning calls. First up, Baird downgrading Caterpillar to neutral, citing government data center pushback as a headwind. The stock is down by 4.5%. Your second call from Wells Fargo, raising its price target on Snowflake to a street high, noting that investors are, quote, underappreciating its upside potential from AI. And finally, Bank of America reiterating its buy rating on Apple, saying its new leasing program may drive faster upgrades. That stock close to all-time highs, going into an earnings report a day away. The stock is up this morning by a tenth. Let's stick with tech. Earnings from Meta and Microsoft due after the closing bell. All eyes on plans for capital spending. Bloomberg's Ed Ludlow has more. Good morning, Ed.
Good morning, John. It's another CapEx test, particularly after Alphabet, but this time the market will want to see Microsoft and Meta justify growth in CapEx going forward. The key watch for Microsoft is its Azure cloud computing unit. Expectations are beyond 40% top-line growth. But if you think about where Microsoft will end its fiscal year, CapEx of around $147 billion in fiscal 26, the street expects them to tell us that CapEx will guide us towards a trajectory on CapEx that is $230 billion for the next fiscal year. So the dynamic now is that CapEx growth is far exceeding the current pace of top-line growth in the key cloud computing unit. Similar with Meta, 26% top-line growth. Capital expenditures for the year, $136 billion to $145 billion. If that number is sort of indicated to go much higher, well, where's the growth to keep up with it? And it's a simple calculus. We've gone from show us the spending to justify the spending.
Big 24 hours for Ed Ludlow and the team at Bloomberg Tech. Looking forward to the show, Ed. Thank you, buddy. Gil Luria of D.A. Davidson staying bullish on Microsoft going into the results and writing Microsoft will be the key earnings report of the entire season. CapEx guidance for fiscal 27 will determine the direction of the market. Gil joins us now for more. Gil, key question then. Why is this the key one? Why this one name? Why is it so important?
For a couple of reasons. One, this is Microsoft's fiscal year end, so they're going to guide for 12 months for a full year, and they'll give us a hard number. So we'll be able to pin down how fast that CapEx growth, to Ed's point, is it growing even faster than Azure, or is it growing slower than Azure will be the key question. And the other reason is Microsoft has been the responsible adult in the room around CapEx for the last couple of years. It was about a year and a half ago that when we were worried about the direction of AI, that they actually did step back CapEx a little bit. So that's why investors are looking to them to see if they're going to blink. They're more likely than Google, Amazon, Meta, et cetera, to blink. And that's why investors are trepidatious walking into this earning, is if Microsoft says they're reining in CapEx, that's going to be tough for the AI trade. We don't think they're going to say that.
Do you think that increasingly as CapEx has to go up, regardless of some of the pushback that you're seeing in capital markets, do you think that the better investment thesis is shifting to the bond space, to the credit space, and away from, say, buying the equity?
Well, to the extent that the bonds for these mighty companies, Amazon, Microsoft, and Google, are starting to trade at a discount, that does seem like a a relatively safe bet here because these companies are incredibly credit worthy and they all have the ability to stop CapEx on a dime. They could go to a fraction of their current run rate and still grow their business. They just believe, and they're trying to show us evidence that this investment is showing a return. But if at some point they decided that it's not, they'll scale back CapEx and their cash flows will skyrocket. That's why these companies are more creditworthy than almost every country in the world. It's because their flow of cash is very reliable. It's almost like a global tax that these big companies have. Therefore, any discount to their debt is probably attractive.
Does it help them that you're seeing dislocation in some of the semiconductor names and push back potential competitive pressures coming from elsewhere when it comes to manufacturing some of the components?
It gives them a little bit more operating leverage vis-a-vis the chip companies. But realistically speaking, none of these companies is going to buy chips from China. And if that's the concern about competition, that's not that much of a leverage point against NVIDIA, Broadcom, Micron, et cetera. Those companies will continue to get the 75% gross margins as long as we continue to ramp the data center build out. But they'll certainly try.
Gil, it's good to see you. Looking forward to your reaction in the next 48 hours. Gil Luria of D.A. Davidson. It's Microsoft and Meta first, and then it's Apple and Amazon. We've learned a lot about price and positioning. We've repeated that over the last few weeks when you get great numbers from the likes of Intel and a stock sells off, or SK Hynix, phenomenal numbers and a stock sells off. You've learned something about how much that stock price has run and how well positioned people are for that. We've also learned a lot about leverage in places like South Korea. We've washed out a lot of that leverage with these massive swings, down more than 12% at the lows in today's session, up by more than 3% at the highs. That is a very wide range. That volatility prompted a meeting a little bit earlier on in South Korea at the finance ministry between officials, and they've just put out a statement just moments ago about curbing retail exposure to leveraged ETFs. That's been a major feature of the market in South Korea on the way up and certainly on the way down.
Yeah, they just put out a commentary after this meeting with the finance ministry, at the finance ministry, talking about how they are going to take more steps to stabilize their stock market. This has been a real point of concern, and you've put this well, John, when you say that they've been exporting volatility to the rest of the world. How much is that going to rein in some of the huge whipsaw swings that have really exceeded what we've seen in Bitcoin and bring people back to the market, convince them that these valuations are real versus just some sort of fiction of leveraged ETFs?
Typically, that would be the kind of headline in an emerging market that would be isolated to that emerging market. But that's a global headline this morning, given how much impact, how much input they've had on the stock story worldwide.
SK Hynix and Samsung are two of the biggest memory chip producers out there. They are the key input that have been increasing dramatically in terms of price for the hyperscalers that are trying to perpetuate the AI story. You put this together, they're very global companies, and this is a global issue.
And that's the latest on South Korea. Here's the latest in this market, turning negative on the S&P 500 just moments ago. Crude higher, Brent and WTI spiking higher off the back of a pretty punchy headline from the president promising to hit Iran hard and using some choice language to make that statement. More on that in just a moment.
Welcome to Bloomberg This Weekend. I'm David Gurray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Stocks turning lower. We're down by about 0.1% on the S&P 500. We are negative by 0.2 on the Nasdaq this morning. The Nasdaq on a 5-day slide so far. Chips on a 4-day drop. 4 days of struggling chip prices, the longest streak we've seen so far this year. In the bond market, yields just a bit higher in the last 15 minutes or so, up 3 basis points. Twos, let's call this 431, 432, off the back of this move in crude. Crude up on Brent and on WTI by more than 7% now on Brent crude, $90 a barrel. Now, you'll often hear me say things like language matters. Language does matter. So I'm going to read you a headline that's dropped with regards to the president. And I'm going to just say that I'm paraphrasing here. The president says that he's going to hit Iran hard, but that's not the language he used. The headline, according to Fox News, which is who he spoke to earlier on this morning, was laced with profanity.
Right, and we've seen this president lean into profanity in the past, especially when he's frustrated, and he did so to Fox News, saying he's going to beat the effing something out of them, meaning the Iranian regime. AKA, a message is very clear right now to the market. We had strikes last night. It sounds like the president is leaning back into having strikes again after having a brief period of a pause.
Lisa, crude back in the 90s.
What do people do with these headlines?
What can you do?
I mean, it's one day to another, just whipsaw up, down, depending on the language, depending on potential strikes that have occurred. You just wonder at what point the duration matters. We keep going back to that, but if we remain within this $90 to $100 a barrel range, because of this tit for tat, the new normal, as you called it, does that in and of itself create a new investing paradigm that the Fed has to consider and that a lot of investors do too?
That is the only assumption I can make this morning, Lisa. I've said earlier on this morning, we all have. I don't want to overweight the headlines about attacks. I also don't want to overweight the headlines about diplomacy either. Just highlight, observe that this is the new normal. It's an uncomfortable new normal. You're going to have days where there are talks and days when there are strikes. You're going to have days when there are unworkable proposals that come from the White House that won't last 24 hours, and we've seen that in the last month too. And you'll see Iran continuously testing the president's patience when there is relative calm, and we've seen that in the last 24 hours as well. But what does the new normal mean, the uncomfortable new normal for crude? It means you'll have days where energy is going through the Strait, traffic's starting to pick up, and days when it's not. And you're going to have an elevated price relative to what we would have otherwise had if we didn't have this situation. And it's not just the likes of the Middle East, it's also Russia now too, where crude product is becoming a bigger and bigger problem.
What's the bigger takeaway for overall economic trajectory going forward? Supply chains are going to be more prone to disruption, and there's going to be more volatility there. Raw material prices are going to remain elevated because of potential frictions within respect to how they get transported. And potentially, a lot of governments are going to have to pay a lot more to support their defense operations in order to prevent these types of things, which pressure the fiscal side of things. You put those pictures together, that's what everyone's grappling with, and the reason why borrowing costs are just inching a bit higher.
And the geopolitical risk premium's not going away, and you see Aramco potentially having to change some of their pricing that's going to Asia. You also see China stepping in, increasing some of their imports. You bring up a great point, what's going on in Russia, what's going on in terms of Ukraine hitting some vessels in the Caspian Sea. The problem we have now, and no one knows this, is when does it actually end? When is there a negotiation that's fruitful that actually ends this? And I don't see that happening with this regime before the midterm elections. So this is going to be the course, at minimum, I imagine, conventional thinking until November.
We should always be open-minded. Things can change. Just based on the experience of the last 5 months, things aren't changing anytime soon. We need to talk about South Korea as well. Wild swings on the Kospi once again. It's one of those markets now which is on the list, top 5 of the things you look at when you wake up in the morning. How does South Korea trade? And the Kospi was wild. It was down at the lows by more than 12%, up at the highs by more than 3%, and closed down 6%. And there is a concern now amongst South Korean officials, and I think we've seen that concern build and build and build more recently, about the amount of leverage building up in the system, the exposure of retail to that leverage. And officials met earlier on today at the Finance Ministry. They had that meeting and they put out a statement in the last 15 minutes or so, and they're looking to curb exposure to those leveraged exchange-traded fund products that we've been talking about, and looking to cap their access to them with higher trading costs. Now, how quickly they can do that, what that looks like in practice, I don't know, but you can see that's becoming a bigger and bigger issue for them and everyone else.
If they take more steps to stabilize this market and they potentially curb the leverage used, does that mean that all of the leverage has already been washed out, or is there a lot more to go? In other words, how much more downside is there before there is more stability in this key market?
Hard to keep up this morning, isn't it? This is before we even get to the Federal Reserve and the earnings later on this afternoon.
How about this year? How about this month? How about this week? I mean, the week did not start today.
Can't wait to watch.
I was saying to a guest earlier on this morning, Q1 felt like a decade. Like, it really did. It just dragged and dragged and dragged. Then Q2 over, and Q3 is flying by as well. It's exhausting.
It is exhausting, which is a reason why when you bring up midterms, I'm not there.
I'm not,
are we really?
I'm
really?
not doing midterms.
I'm sorry.
I'm not even covering them. Just refuse.
Oh, really? News to me.
Yeah, but you're extra innings.
Just shut it down.
Exactly.
I'll have no choice. As we count you down to the opening bell, 1 hour away. Let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with the most actively traded stock in the U.S. in the pre-market this morning, and that is SoFi. Shares are down nearly 6%, even after the company posted solid results. It beat on earnings and member growth and even raised its full-year revenue outlook. Investors, though, are focusing on a few blemishes in the report, including higher than expected expenses. So just another sign of the high bar for earnings, and you get punished if you don't beat across the board. Meanwhile, not getting punished is Bloom Energy. Those shares up 8.8%. This is a company powering the AI build-out. It posted results and more than doubled its earnings estimates, raised its full-year outlook, and it's the third time this year the company increases its sales forecast, as it says that customers just keep coming in and arriving faster than ever. And if that's a sign of AI demand growing, Caterpillar and some sell-side action highlights one of the main risks, especially during an election year. I know you guys don't want to talk about midterms, but that is happening. Shares are falling nearly 5% after Baird downgraded the stock. They say that growing pushback against new data center construction could become a headwind for this company, especially in a key area that it's been banking on. John?
Yahara, you get a pass. You always get a pass. Thank you. We appreciate it. Counting you down to that Fed decision at 2 p.m. Eastern Time, this moment is different. We're not used to this. If your only experience of Wall Street is the post-GFC world, you're very, very used to the hand-holding. Typically, going into any decision, you know ahead of time what's going to happen. And if you don't, then make sure you know. This is different. Overwhelmingly, the consensus on Wall Street is no change of hold later on this afternoon. But there is an appreciation. There is a small risk they might do something different, because we have a new Fed chair that is not willing to provide quite the same guidance. Mike McKee has more from Washington, D.C. Good morning, Mike.
Good morning, John. There's 19 members of the Open Market Committee, and 12 of them vote, but only one matters today, and that is the new chair, Kevin Warsh, what he thinks will probably carry the day. As you mentioned, the economist community is pretty much overwhelmingly convinced they will stay on hold, although Wall Street still gives it a 35% chance that they surprise us with an increase. Last time they did that, June of 2022, with that 75 basis point hike. There are no economic forecasts or dot plot today, so we'll all be listening for what Mr. Warsh has to say. Now, it's not unusual that he could surprise us. The history of new Fed chairs is that they tend to raise rates very quickly after taking office. Paul Volcker did it 2 months into his term. Actually, the only one of the last four who did not was Janet Yellen, who inherited us the middle of the great financial crisis recovery, and it took 22 months before they raised rates. But everybody else was willing to raise rates right at the beginning of their term. So the questions going into this afternoon are, will there be any dissents, and will the statement recognize any dissents? Last time, the statement didn't mention the individual votes, just the vote total. How will Warsh explain the decision? Either way, what will he say about what other members of the committee thought? What are he and his colleagues watching? This is maybe the most important question because it gets at the idea of what's their inflation framework, what's their reaction function, things that he has been reluctant to discuss. And that leaves us with the question of, will September be priced in post-meeting? It is priced in right now. Economists and market participants think that there is a better than 100% chance that we're going to see a rate increase on September 18th. The question is, where do we end up when the Warsh press conference is over? It is very different. And, of course, John, you have to shake your head when you see oil prices this morning, just when they started to go back down, and maybe help Warsh make the case for keeping rates unchanged. Here we go again.
Of course, we don't know where it's going to be 5 hours from now, either, for that matter, Mike. It is a change. Can I just ask you, as a journalist who's in that room and has sat in front of central bank chief after central bank chief over the last several decades, Mike, how your approach is going to change to the kind of questions that you ask this Fed chair? No one wants to be on the receiving end of a two-word answer or any answer that involves task force. How is your approach different to this moment too, Mike?
Well, I think we're going to be looking for people to ask specific questions about specific thoughts as opposed to more general questions along the lines of what is your reaction function, because that could be easily parried. But how he looks at the oil price increases that we've seen recently, does he think they're inflationary, or is it time to look through them? And what is it that he thinks the task forces should accomplish? When you look at the Wall Street Journal story from yesterday, the anecdote about Chris Waller saying it's not like anybody hasn't thought of this stuff before. What does he think of that?
Can read it out to him, Mike. Looking forward to it. Michael McKee with the latest down in Washington, D.C. Stephen Stanley of Santander expecting the Fed to hold rates today, but hike twice later this year, writing the Fed has entered a brave new world. It's been many years since there's been this degree of uncertainty about whether the Fed would change policy or not in the lead up to a meeting. Stephen joins us now for more. Stephen, good morning.
Good morning.
Is it a welcome change?
I think it is. It gives the Fed flexibility. The complaint that Warsh has had is that basically the Fed would lock itself in with forward guidance. So I think, I think back to, okay, what would this period be like if we still had kind of the old regime in place? And I think my guess is they would have been kind of looking toward a September rate hike, and they would have already started to signal that in June. So they would essentially already be kind of locked in. Well, what if things change, right? What if the inflation numbers are all of a sudden, we got the softer June CPI, what if you get a string of those? They've already kind of locked in for September move. That's why I think Warsh wants to invoke more uncertainty to allow the Fed to have flexibility.
Why is it valuable to hike in September and not now? Why is there so much value, in your view, to sequencing things in that way?
Yeah, well, I think this is an example where you can make a strong case in either direction. So I'll make the case for holding off. As I mentioned, the last inflation reading that we have in our hand is the June CPI, much softer than expected. So is that a one-off? Is that a fluke? Or is it the beginning of a trend? Is something moving around with regard to inflation? I think there's specific reasons why we would learn a lot by getting 2 more rounds of monthly data, which we'll get between the July and September meetings. One, we're still trying to figure out where we are with regard to tariff pass-through. Fed keeps telling us we're toward the end of it, and there's evidence of that, but we're not quite sure. Secondly, and I think more importantly, we're really in the early stages or maybe the midst of energy price pass-through. So we've seen energy prices go up, we've seen airfares go up, all the obvious stuff, but you haven't seen it bleeding into everything else. You haven't seen food prices go up on the back of transportation costs. You haven't seen firms raising their prices because their energy costs are higher. Does that mean that's not coming, or does it mean we just haven't seen it yet? Again, 2 more months, maybe gives you some insight into that.
Do you think that the Fed has any responsibility for why inflation has remained above its target rate over the past, not only just 5 years, but in particular in the past year and a half?
Absolutely. I'm a big believer in what Warsh says. The Fed controls inflation ultimately, and they have the tools to bring it back to 2%, and they haven't done so.
So what do you make of people who argue that ultimately this is one-time supply shocks and that that's the reason why they've been facing this? It has nothing to do with monetary policy, and it wasn't in their control anyway because this seems like a more rate-insensitive economy.
So my response to that would be, and I think I'm going to be channeling the chairman a little bit here, so the Fed controls the amount of liquidity in the economy. So if we think about an energy price shock, for example, if energy prices go up, gasoline prices go up, the Fed doesn't have control over that. But if the Fed injects liquidity to offset that so that consumers are made whole, then the overall inflation rate will go up. If the Fed doesn't, then household budgets will get squeezed, the demand for other things will go down, and other prices will have to go down while gasoline prices go up. The overall inflation level stays the same. So this goes all the way back to the 70s. It's this issue of, do you accommodate an energy price shock or don't you? And in essence, what I would argue is that the Fed, you can say, well, this wasn't really our doing, supply shocks and energy prices and all the rest, and that's fair enough. But policy at the end of the day has been too easy, and that's why inflation has stayed high and hasn't come down.
That will be part of the debate later on this afternoon, no doubt, in that news conference. Stephen, thank you, sir. Stephen Stanley there of Santander. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump says the U.S. will hit Iran hard after a recent attack that targeted a base in Jordan. In an interview with Fox News, the president saying, quote, they're going to get a beating. Trump's comments sending oil to session highs. More than 1,000 employees across leading AI firms signed a petition urging U.S. government to support measures that could slow the pace of AI development. The letter warns AI may be advancing faster than humans can control. A massive new data center coming to Kentucky. Brookfield and NextEra Energy are teaming up on a more than $100 billion project that will turn a former uranium enrichment facility into a 2-gigawatt data center campus. It's expected to create 8,000 construction jobs and 600 permanent positions. That's your Bloomberg brief. John.
Vonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. What a 24 hours we've got coming up. Plus, we'll touch base with Kai Hay of Goldman Sachs, saying markets can adjust to a new regime.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
The bar is set too high for any stock associated with the AI trade, right? And it's not to say that the underlying fundamental story is not good, but the bar is just being set too high. The new beat is, call it a 10% beat on earnings and a lower CapEx guidance. I think that's the thing that's going to get stocks to rally.
That right there is the sweet spot, according to Dan Suzuki of iCapital, heading into those earnings later on this afternoon from Meta and Microsoft. In the market right now, stocks and bonds a little changed ahead of this afternoon's Fed decision. Kai Hay, global head of fixed income at Goldman Sachs Asset Management, writing, more important than the decision itself might be the messaging. Markets can tolerate less forward guidance, but they struggle when the policy framework itself is unclear. Kai joins us now for more. Kai, good morning. Good to see you.
Good morning.
How unclear is that framework this morning?
Well, we're going to find out. I mean, the market tells you something. The pricing of 30% is a kind of unusual pricing going into a Fed meeting. By now, you would have thought the market had settled. So it gives you an indication of what the market is looking for, and that is a little bit more clarity around the reaction function.
Two-year yields right now,
Yep.
and for the last several months trading comfortably above the policy rate.
Yeah.
When you look at that, I think framing matters here too. Do you see that as a bet on hikes or the risk of hikes baked into the yield curve?
Good question. So I think the first point is it's important not to confuse lack of forward guidance with there being less clarity about the reaction function of the Fed. So hopefully the reaction function, we're going to get more clarity as the day goes on, and that would be great. The market would like it. The second point is, look, the statement at the last meeting, the focus on inflation really dampened a little bit the volatility at the longer end of the curve and moved the volatility down the yield structure. So you're gonna get more volatility at the short end. That's consistent with a focus on inflation, with being data dependent and less forward guidance.
If you get a hold that isn't as hawkish as people expect, do you think that reintroduces volatility to the long end of the yield curve?
It depends how it's framed, right? So, when you say not as hawkish as people expect.
Sense.
Yeah. I think that would introduce a little bit more uncertainty around the longer end of the curve. But look, we've got another meeting in September. The market right now prices a hike, and I think, that volatility is probably short-lived because the market will look towards that meeting very, very quickly.
Why do you think we don't have more information about the reaction function of this Federal Reserve?
Well, because it does look at first sight that there's going to be some changes, right? We've got the task forces, we had the communication. The market is trying to figure out what a new kind of governor is going to bring to the table. So it's not unusual that the market is trying to wait and see and look what it can glean from communication today.
Kai, you said something important about bringing volatility in. Bring it to the front end of the curve and it dampening yields at the long end of the curve. It makes me think whether this is all by design. Do you think it is by design? Is that the objective here?
Well, good question. Like, design for what, right? I mean, your question might refer to the fact that it's by design to kind of cheapen the long end a little bit. Maybe that's it. But I think it's consistent with a data-dependent Fed. And I think it's consistent with a Fed that's going to be less focused on forward guidance. So the market then has to figure things out. And we've come out of a very unusual period, right? That's another thing to kind of keep in mind. Like, what's our base here? Our base is really a kind of post-QE. We've been used to there being a lot of clarity. We've been used to having Fed meetings that were well advertised. That's a recent phenomenon. If you look at what the world looks like pre-08, that was very different. This goes back to that kind
What
of
are the
environment.
investment implications with that shift? Leaving behind the post-GFC communication architecture, we're leaving that behind. The hand-holding's over. What does that mean for investing?
I think it puts the focus squarely back on understanding, the underlying trends in the economy, what's happening to inflation, what's happening to growth, what's happening to the propagation mechanism. You're going to get much more differentiation between different central banks as well, right? Not everybody is going to be doing a very similar thing. So this week we've got Bank of England, we've got Bank of Japan, and we expect very different communication from them. So what are the implications? Look, macro matters more, fundamentals matter more, data matters more, and you're going to get way more differentiation in markets.
Does that mean that you have different outlooks when you look across DM sovereign bonds right now? Can you give us an idea of where you're constructive and where you're less so?
So, yes, it does mean we have different outlooks. We'd probably be much less constructive in terms of kind of yields going down in places like Japan. I think you're going to look at the UK and you're going to be a little bit more kind of data dependent, and you will see that kind of differentiation. That's at the short end. Then add onto that the long end implication, right? So there's issuance at the long end. There's kind of pressure of coming from fiscal in places like continental Europe. So absolutely much more differentiation.
So much has changed in fixed income. The communication shifting markedly at central banks like the Federal Reserve. Forward guidance is over. Then you've been dependent on the other anchors in fixed income going away too. So you could have been dependent on fiscal prudence in Germany, that's over. In Japan, disinflation, that's done. Now got inflation. Everything's changing in fixed income in the space of a couple of years.
The era of financial repression is over.
Big time.
And guess what? There's yield and there's uncertainty. And for a debt investor, actually, this is pretty great, especially if you don't have hyperscalers sucking all the oxygen out of the room, because suddenly you're getting leverage and you're getting yield. People said that bond vigilantes were dead. They are alive and kicking, and frankly, they're out there capitalizing on that. And that's what you see in terms of yields at some of the highest levels that we've seen going back years.
Talking about Kai, is it a good moment to be in the bond market?
It's very exciting. I mean, look at today. We're all talking about the Fed. That hasn't happened in a long time. So.
It's been boring for a while, hasn't it? Kai Hay there of Goldman Sachs. Kai, it's good to see you.
Thank you.
Thank you for being here. Appreciate it. It's just a massive shift. I think we've all stated that going into this Fed decision. Yeah, at 2 p.m. Eastern Time, I might sit here and say unchanged, couple of dissents, and it might sound boring. But just the very fact that you don't know, and there's this small margin of risk, and that small margin of risk is now in the market pricing as well, is a different world.
It's something of a mystery why inflation has been so far above the Fed's target for more than 5 years and why it has persisted. People can make their arguments. Going forward, it really sets up a new trajectory for this Fed.
Surprise appearance later?
No, I'm gonna be watching with popcorn, with bated breath. Can't wait to see you guys do extra innings.
Okay. Maybe we'll dial you in. Maybe.
We'll put a little figurine
Maybe.
here.
Special programming, 1:30 Eastern Time. On Bloomberg Surveillance, the Fed decides. From New York City this morning, good morning. Looking forward to covering the Fed with you later on this afternoon. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round or the finals, but you have to show up for press conferences after, before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It is going to be a busy day from earnings to a Fed decision. 30 minutes until we start your trading day. I'm Danny Berger. Matt Miller is still off. Bloomberg Open Interest starts right now. Coming up on today's show, SK Hynix sets the stage for a big day for tech earnings. Microsoft and Meta take the spotlight next. To hike or to hold, markets see a growing chance of a surprise from the Federal Reserve today. And Middle East tensions flare up again. Oil jumps as President Trump threatens Iran with new strikes. So maybe we're a little bit more tepid with what tech stocks are going to do today ahead of the earnings. Microsoft and Meta, they will have less of a high bar maybe because they have sold off over the past month. Still, it's clear that expectations are really high in general. Higher AI spending is going to be closely watched, and often that's met with disappointment on Wall Street. SK Hynix, the perfect example of this. Shares are down after reporting a six-fold jump in profit. However, they also hiked their spending plans by 50%. Let's discuss with Bloomberg Tech host Ed Ludlow. Ed, this really feels like the nature of things now, that you can report a more than 550% surge in profits from the year prior, and yet your shares get beat up.
Well, the profit number was still seen as a little bit disappointing, which shows you the severity of the memory bottleneck and the pricing situation on the DRAM side, but also takes into account that SK Hynix has 60% market share in HBM going into data centers. So maybe there were those even more bullish on the street that felt they could have done better. What's interesting is the CapEx commitment, right? It's being interpreted. The ADRs are not actually that much lower relative to South Korean trade. But there are loads in the market that say, is that not a really robust signal of confidence in future demand from a player in an industry that has, for a very long time, been super conservative about investing into cycles? So it's a real mixed bag.
Even so, isn't that quite instructive, both from the reaction of SK Hynix and what we got from Alphabet last week, to what we're likely to see from a market reaction from Microsoft and Amazon today?
Yeah, so the calculus is, there's an expectation the quarter was really strong from Microsoft and Meta. But after Alphabet, you have to justify future CapEx expansion. Microsoft's probably the most tangible case study of that, right? Azure, the cloud computing unit, will likely grow beyond 40% in the quarter gone. Microsoft will close the book on its fiscal year and give us a real guide on CapEx for the next fiscal year. But if CapEx jumps from $147 billion to $230 billion, as the street thinks, that would represent pace of CapEx growth far outpacing top-line growth on Azure. Azure growth 40% odd, CapEx growth maybe 50 to 60%. And that's the worry, that they need to show much more ROI in the near term and a better guide long term.
Ed, just elsewhere in the tech world that I'm sure you're going to cover on Bloomberg Tech today is learning more details of the OpenAI hack on Hugging Face, that it
first accessed a customer cloud account before it launched this attack. Just the skeptic in me is kind of like, is this just good marketing for OpenAI to be like, look how great our models are that they're basically so advanced they can escape from the sandbox and wreak all this havoc?
So in the first instance, this is kind of a separate case study of the same models behaving that way. And again, in aggregate, the industry kind of cheered how OpenAI communicated on this. It's not a scandal. You want the frontier labs to be testing cyber capabilities, but see that there's a procedure in place to catch it. With the modal situation, think of it as modal. The OpenAI models are the attacker, and they found somebody's unlocked computer to use. So basically, this didn't compromise the modal platform itself. Within modal, a specific customer had a sandboxed environment that it made publicly accessible. So all the OpenAI models were able to do was get into that sandbox or closed testing environment, and then basically treat it as a staging point. They could work with code within the sandbox, but nothing outside of it. And again, like the companies now are communicating about it, it is the latest example that AI being an attacker in the cyber context is real. And that has been an endless conversation for 7 to 10 days.
Ed, again, really looking forward to Bloomberg Tech, 11 a.m. every weekday. Bloomberg Tech host Ed Ludlow. Elsewhere in earnings, Ford is raising its profit outlook for the second time this year. The automaker cashing in on resilient demand for SUVs and pickups. Joining us now is Bloomberg auto reporter Keith Naughton in Detroit. Keith, great to see you. So is this just the really expensive stuff from Ford is being bought? Is that what it is, the upper end consumer?
Yeah, it really is, and it's the Bronco SUV had a record first half, and the Explorer SUV is doing really well. And it's not just the regular mainstream models. Customers are buying the fully tricked out models with the off-road performance packages, and those are very high margin.
Well, it's that, and then I also wonder how the rest of its business is doing, Keith. Besides the high margin, what about just the more everyday vehicles that they offer?
Yeah, well, the big one to watch is the F-Series pickup, their top-selling model. And, that has been down because of the fires it had at the aluminum supplier Novelis last year. That's starting to come back, and momentum is beginning to shift on the stock. Mike Ward of Citi today raised the stock to a buy from neutral, and he sees 28% growth in F-Series sales in the second half of the year, which he says will be a profit tailwind.
We've also seen Ford rally in recent days sort of on the AI hype and some of what they're doing to provide some battery purposes, kind of like retooling EV battery plants for energy storage and helping sort of the AI ecosystem. How is that business going for Ford?
Yeah, it's really driven the stock way up this year. They had their best month in May in 17 years. It's a very promising business for them, high margin. They're building it out. They have one customer already. Jim Farley, the CEO, says there's a lot of interest from hyperscalers, from data centers. Energy storage is a growth business, and Ford is right in the middle of it.
Hey, Keith, thank you so much for joining on those Ford earnings. That's Bloomberg's Keith Naughton in Detroit. We also, in terms of events we need to get through today, before all of the big tech earnings, we're going to have the Fed. And rates are expected to stay on hold this afternoon. But there are some in this market bracing for the possibility of a surprise hike. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now. So, Mike, about just over 1 in 3 odds that we hike. Bank of America points out that should the Fed hike, it would be unprecedented since at least 1994 that you haven't had a Fed hike when the market is this uncertain about it.
Yeah, this is the most live, if you want to put it that way, meeting that I can remember in a very long time, because you can argue it either way. You can make a case for raising rates. You can make a case for holding. And if you divide up the members of the Open Market Committee who will vote today, you can come up with a pretty much a tie vote there, because among those who have said that they would raise rates now, or they would consider raising rates if inflation was still going up, if oil prices were still going up, you got 6 votes. On the other side, the people who have said they're not interested or who have not talked since then, there's 6 votes there, and the guy on the bottom right is the one that is most important because he'll try to frame the decision and get people to do what he thinks is best, and we'll see how that all turns out. Of course, economists overwhelmingly see a hold today, and you do have that market probability of about a 35% chance of an increase. We haven't had any kind of surprise, really, since June of 2022 when they raised rates 75 basis points, and the surprise was in the amount of the increase, not the increase itself. But we also don't get any dot plot or new economic forecast today, so not much to build your case for what goes on next time. We'll be looking to see what Kevin Warsh says. We'll be looking to see if there are any dissents and if the statement recognizes those dissents. How's he going to explain any dissents? How's he going to explain the decision? And what are he and his colleagues watching going forward? Right now we have a September meeting priced in for a rate increase. Will it still be the same at 3:30 this afternoon when Kevin Warsh is done speaking?
Given that this is a Fed chair who doesn't want to give any guidance going forward, as you pointed out, Michael McKee, it's a dynamic that Nick Timmeros over at the Journal has been writing about, this idea that usually you can reach compromise with other FOMC members by changing the statement, a dovish tweak or a hawkish tweak there, maybe kind of indicating what you might do at the next meeting to sate all of the different opinions. If Chair Warsh doesn't have that ability, because he doesn't want to do that, does it make it that much harder to corral opinion at the FOMC?
Well, it makes it a little bit harder. I don't think it's determinative in the sense that there are people who would like to raise rates now, but the two who vote, Hammack and Logan this time, who want to raise rates, that's only 2 of the 12. The others have said if the economy started to look like it was suffering from higher oil prices or the war effects, they would be interested in raising rates. So right now, he can make the case that, well, oil prices until today had been coming down again, and we have a lot more inflation data between now and September, so why don't we wait? I think that's probably going to carry the day today, but if Kevin Warsh wanted to signal anything, maybe he'd tell people to look at the color of what you're wearing, Danny.
I've already had one person message me saying, oh, no, not red. But, you know, maybe we can kind of adopt a more Chinese outlook today and say, hey, red's the color of luck, McKee. So that's what I'm sending out there to everybody today. Good luck on a very busy day. You too, Michael McKee. And don't miss Mike and the surveillance team's special Fed coverage of the Fed decision. That will kick off at 1:30 p.m. New York time. Let's get a check on your markets. I'm sorry I'm kind of matching markets and what they're doing this morning, but come on, barely. We're only down 0.1% for the S&P and for the NASDAQ. By the way, yesterday, the equal-weighted S&P reached another all-time high. It was spared from the stress of the rest of this market, and that was another sell-off in semiconductors that started in Asia. Again, not as bad today, but we are just waiting for earnings and a Fed decision. Ahead of that Fed decision, oil rises again with the president speaking on Fox about hitting Iran hard. Brent crude goes up nearly 7% to just under $90 a barrel, while 10-year yields up 2 basis points. Let's look at some of the individual movers this morning. With that is Nora Melinda. Hey, Nora.
3 stocks on my radar for you this morning, Danny. Let's start with Procter & Gamble. Shares down about 4.2% in the pre-market trade. We saw second quarter results that missed expectations. The company giving a conservative outlook for the year with consumers searching for value. We did see that P&G has been really struggling to win market share from its competitors as expenses climb and the company does its best to avoid some of those price hikes. From there, we're going to turn for a look at the commodity trading house Glencore. The company up about 3.6% before the opening bell and reporting $3 billion in profit for the first half of the year. The Iran war is sending energy prices soaring and the company on track for one of its best years ever as the war and AI infrastructure impact metal prices. Last up, we're looking at Next Era teaming up with Brookfield, the company up about 0.6% right now. The company teaming up with Brookfield to convert a Cold War uranium enrichment facility in Kentucky into a $100 billion data center campus. That's by 2031. The project will create about 8,000 construction jobs and 600 permanent positions. Shares of the company still higher before the opening bell. Those are your morning movers. Danny?
Nora, thank you so much. Coming up on the show, Brent crude moves higher as President Trump ramps up pressure on Iran again. That's after this break, right here on Open Interest.
means that everyone is very attuned to the folks who have won so far, and the hyperscalers are one of those players.
And then I guess the chip makers are too, because if you can report an 86% rise in revenue, that seems to be a good place to be. But has something changed for this market, given that, I guess, digestion period that you explained that we're in? Is that no longer kind of like a safe, cushy place to hide out just because of the remarkable volatility, even though there's been really robust year-to-date gains?
Yeah, there's this near-term, long-term tension. For the longest time, the right place to be has been investing in the folks who are trying to relieve the bottlenecks in the AI ecosystem right now. Power, compute, semiconductor players are a big part of that, memory too, and we've seen some kind of cyclical technical rotation within that. But the second part of it too is, I think, a refocus on what the long-term potential of this is. What does the integration of artificial intelligence into the real economy look like? So I think what you're likely going to see, not just in this week, but even longer term, is both of those trades playing out at the same time. Some people taking some chips off the table on the winners of the past 3 years and thinking through what the future winners could look like, whether that's the services business, whether it's like financials, whether it's industrials, whether it's healthcare-oriented businesses. You're even seeing that in what you mentioned earlier on the S&P equal weight actually starting to rally, trying to think through investing in the opportunities of not the businesses and the companies that have built and invested in the AI infrastructure, but those that will benefit from integrating that technology into their day-to-day businesses without having to front the CapEx.
This is something that Mike Wilson has talked about, that you will start to see the companies who've been integrating AI start to pay off. I wonder how you're looking at this on the private market side of things, because every day you hear of a multiple billion-dollar data center project. Today, it's NextEra in Brookfield in Kentucky, $100 billion, which is quite a chunky chunk of change, if that makes any sense at all. Again, a lot of this is happening on the private capital side of things. Yes. How are you directing your clients when you don't have a mark-to-market sort of environment to take bets on what makes sense and what might look like an overspend? Yeah, so I think the number one thing to think about, especially if you're going to lock up your money for at least 5, 7, 10-year type of time horizon is what is a durable trend that I can get behind. Point number one is that despite all of the build that we're seeing within data centers, despite all the build that we're seeing on the power side, we are still in a meaningful supply-demand imbalance in terms of the demand that is needed for power and energy, not just within artificial intelligence, but general electrification of the economy. We're still in a massive supply-demand imbalance within the U.S., but definitely globally. The U.S. actually might end up in a situation where the amount of demand is going to far outreach the supply even by the end of this decade. So we're still compute constrained. We're still in a supply-demand imbalance, which means infrastructure and private infrastructure and these like public-private partnerships that you're starting to see play out is a durable trend, in our opinion, moving forward. So infrastructure and private infrastructure has given our client portfolios and client conversations two benefits. One, you have access to this secular theme, but in a more durable way, because at the end of the day, these returns are based on multi-year contractual cash flow, so you have visibility into the cash flow profile. But then two, the other thing that we haven't talked about yet is inflation volatility and what's going on in terms of either the geopolitical tensions that we're seeing so far this year, but what has really been persistent inflation volatility over the past 5 years, given the amount of supply side related shocks that we've seen on a rolling basis. And whether it's infrastructure or whether it's real assets or in real estate, you're starting to see this pickup in client demand, and even for us from a long-term investment perspective, because you get to a certain extent inflation resilient income. And that's a necessary complement because core fixed income always has a role to play in terms of a defensive ballast within a larger portfolio, but it tends to have a more difficult time in protecting an inflation-oriented environment. Okay, this is really interesting because this is an argument that Akhil Bansal of Carlyle, who heads up infrastructure there, came on to make in a new paper. He heads up ABF, to be more specific, but obviously a lot of infrastructure, saying, I mean, it benefited him, this argument, and he said as much. I know I'm talking my book, but it's true. This idea that traditional fixed income is less appealing because of inflation volatility. And then on the other side of things, corporate credit Just so many tech players have been issuing new debt that it actually looks a lot like equity. So for portfolios, is traditional fixed income just less attractive, or its use has just changed in terms of a diversifier to equities, let's say?
Yeah, I think for the longest time, post-global financial crisis to pre-2022, the entire conversation was around where can I get carry? Because fixed income wasn't giving me the same amount because we were in a near zero rate environment. We're in a different environment right now, regardless of what the Fed may or may not do later today. We're in an environment right now where rates are higher. So therefore, there are actually pockets of public fixed income that are starting to look a little bit more competitive, primarily because your carry is higher than it has been in the past. But on the flip side of it, the conversation around what that 40 part of your portfolio and what those diversifiers mean has just fundamentally shifted from where can I get the best yield to where can I get the best yield that will either defend me in a higher inflation volatility environment, which is where not just the real assets, but we're constructive on asset-backed finance as well. But then two, even thinking about ways to lean into less correlated return streams. And that, despite the volatility that we've seen so far this year within the hedge fund landscape, hedge funds are starting to get brought up in conversations, and we're more constructive on that too.
But aren't they really concentrated too? And I think about that, Sitar, just quickly, because we're almost out of time. There was a story that Wall Street banks have been pushing hedge funds, kind of being like, you need to start putting up more collateral just because we're worried about the concentration risk you have in AI.
Yeah, I think it depends on which hedge fund you're invested in. There's like some areas within long short that have been very levered to the AI trading that are feeling some of the heat from the momentum unwind that we've seen so far this month. But there are other areas that lean into less correlated return streams, whether that's macro, whether that's relative value on a longer term basis, where you can better capitalize on these intra-asset classes and intra-geographies, market mispricings that you're able to generate not just less correlated return streams, but higher alpha generation at the end of the day too. But the biggest thing that we talk about is hedge funds are an industry, not an asset class, and who you pick matters.
Very well said. Sitara, thank you so much for joining. Such a pleasure to have you on JP Morgan's Sitara Sundar. Let's get a check on your equity market over 10 minutes into your trading day. And we are hanging tight, down about 0.1%. Pretty even split between winners and losers. A lot of winners yesterday, despite an S&P that finished more or less flat, not too much of a gain. In the gainer side, we have a lot of the energy players, given the price of oil is higher today with President Trump threatening to hit Iran hard. Exxon is up there. Apple, just in terms of points, is one of the top gainers. Yesterday, it closed just below $5 trillion, so we'll see if we can get through that level today. Coca-Cola is up after reporting earnings yesterday. Seagate reported earnings today, and that was a beat for the hardware company. On the downside, you have a lot of the big cap tech. NVIDIA, Microsoft, Amazon are down. SK Hynix reported earnings, and those shares are falling. P&G also reporting earnings that missed expectations. So again, the consumer clearly is uneven, from Ford doing well to P&G not doing well. In terms of your sectors, energy is the standout just because the price of oil is moving higher today. So energy up 2.5%. Industrials, materials, infotech, those round out your bottom sectors. Coming up, semiconductor stocks under pressure as investors take a harder look at the AI trade. We're going to have more with Mandeep Singh. That's coming up next.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Time now for your top calls. Here is Nora with some of the analyst action this morning. Nora.
Well, let's dive right in. First up, I'm looking at Caterpillar shares dropping to April lows. The company getting a downgrade at Baird. Analysts over there saying that growing restrictions on data centers can not only slow down AI spending, but also hurt future equipment demand. That's not going to be good for Caterpillar if it plays out that way. Next up, Danny, I hope you're hungry because I am. Morgan Stanley upgrading the Cheesecake Factory to equal weight from underweight. Analysts say that sales can pick up in the second half. New menu items, stronger marketing, and its loyalty program expected to send more foot traffic through those restaurant doors. I need a slice of cheesecake. Last up, Texas Instruments getting an upgrade at Arete. Arete saying the AI boom could keep the analog chip market tight for the next 2 to 3 years. That's certainly a perk for Texas Instruments. Shares up about 0.6% right now. Seems like that AI demand just isn't slowing down, Danny.
Girl, can I just say it is 9:40 a.m. and you want a slice of cheesecake?
Why not? We can always have a slice of cheesecake.
Live your life. I love it. Nora, thank you so much. We'll catch up with you later in the next hour. SK Hynix elsewhere reporting a surge in quarterly profit as demand soars, but that wasn't enough to impress Wall Street. It raised its spending plans by 50% to $31 billion. It originally sent shares lower. Now we're up by 1.1%. Let's discuss with Bloomberg Intelligence head of global tech coverage, Mandeep Singh. Mandeep, I was so ready to be like, oh, it doesn't matter if you have like a 500% increase in profits. The market wants more, and we're kind of up today. So, okay, let's scrap that narrative. What was your overall takeaway of SK Hynix?
That right now these memory companies are showing, 40-50% quarter-over-quarter growth because pricing has been so strong. I think what they referred to in the earnings call is, look, we are looking to sign more long-term agreements. That's what Micron said, and that's what these guys are doing. They want to enter into 4 or 5-year agreements with all their big customers where they cap the pricing, but they also have the visibility that, customers are going to buy from them, and it's not going to be spot pricing driven, which is how the memory market
Does that mean that we need to get away from the world where we are trading at 8-9 times multiples, that it should be higher because they're not cyclical anymore if they have these longer term contracts?
I think that's harder to change given the nature of the memory market, and a lot of it is driven by the fact that demand is really strong on the HBM side, but all the pricing growth is coming from the conventional DRAM side. And that's where companies like Apple have complained. They want to qualify, Chinese CXMT for use in their devices because they don't need HBM. They just need the conventional DRAM where they have to pay, 30-40% higher memory prices. And that's where these companies are walking a kind of a tough line in terms of making sure they don't really, have a rough time with one of their main customers, which is Apple in this case.
Right. Well, I believe it was Micron that came out in their earnings and essentially said when prices were at rock bottom, we tried to negotiate with the company. I think it was implicit that it was Apple saying, no, like we need to charge you a higher price in order to keep investing. And they weren't able to do that. I wonder if that argument now is compelling to an Apple, or should prices start to fall, they're just going to be like, hey, that's the nature of the business. We're not paying you as much.
Yeah, I mean, look, SK Hynix said they have LTAs with 10 of their customers. I'm guessing 10 could possibly include someone like Apple, but again, they want to make sure they have like a broad suite of products that includes DRAM, HBM, and other things, NAND. And so from that perspective, if there is an agreement that encapsulates everything, that will be a lot more palatable to a potential customer.
So does all this mean that we've basically reached the peak of pricing power? And if we have, is that not good news for the hyperscalers that we're freaking out about how much they're spending on CapEx? Doesn't that start to come in if they don't need to spend as much on things like DRAM?
I think so. You bring up a good point that a lot of the CapEx increases that we saw from Google last week was likely because of memory price increases, and I expect the same for Microsoft and Meta. When they report, they have to pay up at least for this year. And then going forward, if they're in an LTA, then actually it's good news from that perspective. At least you're not paying for component memory pricing. And yes, you still want to expand your capacity, but you don't have to pay up for, the components.
All right, Mandeep, thank you so much for joining. Appreciate your time. That is Mandeep Singh gearing up for a busy day of earnings both today and tomorrow. Elsewhere in earnings, P&G results falling short as consumers pull back on spending. We'll break down those results with Red Brown coming up next. This is Bloomberg Open Interest.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. Let's get a check on your equity market 20 minutes into your trading day as we await both a Fed decision and earnings from big tech. NASDAQ falls 0.5%. The S&P down 1/3, following on from yet another day of selling and circuit breakers in South Korea after SK Hynix reporting earnings. Dow is also down by 1%. 10-year yields, though, are moving higher by 1 basis point. We're at 462 as the price of Brent crude moves higher alongside it, given the president's threat threats to Iran on, hitting them back even harder. In terms of individual stocks, Micron, you can see they're down 2%, Nvidia down, Humana also lower. Visa is higher after they reported earnings. They did have higher expenses after letting about 2,600 employees go, or at least announcing plans to do so. Even so, the rest of the results looking pretty strong, so shares are moving higher. Ford, another read on the consumer, up 7.5%. Strong sales for their most expensive cars, for SUVs, for trucks, so shares going up 7.25%. Also, their energy battery business doing well too, which has started to apply to AI. And then P&G, Procter & Gamble, down nearly 7%. A tepid outlook. Quarterly results miss estimates. Let's dig into the details. Joining us now is Bloomberg consumer reporter Red Brown. Red, what were those details?
Yeah, I think the details that kind of emerge from this call is that P&G and other consumer companies are in a really kind of complicated position, right? They have the cost inflations that we're seeing kind of across the supply chain resulting from obviously the Middle East conflict, but at the same time, they're not able to kind of offset those costs in their business because consumers just have no capacity for this after so many years of inflation. So they're in this really sort of delicate balance on like how do you get yourself out of this sort of narrow market they're in.
But by the way, so the increased costs, is it about shipping? Is it the price of plastics going higher because of what's happening in the Strait of Hormuz? Is it all of the above?
It's all the above. So the company reiterated its outlook for cost inflation to be $1 billion in the coming year, but they really emphasized the fact that a lot of it's coming from these non-commodity inputs as well. So it's things like cost of shipping. They've had to change their suppliers as well, as some of them are in areas where they can, maybe not operate at the capacity that the company needs. So it's all of these things sort of filtering in. And right now the company is expecting that to hit earlier in the fiscal year for them and resulting in a 5% drop in their earnings. So we kind of see how this is really hitting in the near term with hopefully plans that P&G is purporting to put in place will hopefully get them back into the growth towards the end of the fiscal year.
Just with all of this and the state of the consumer, because we have seen data that suggests the consumer is still spending. Visa, for example, posts earnings today and it shows that the consumer is resilient. People are buying expensive Ford trucks. Is the difference with P&G just that sure the consumer is spending, but they're not willing to accept higher prices, and that's where it becomes an issue for them?
Yeah, exactly. Because people it becomes difficult for the company to grow its sales when they're not able to kind of push the prices through that they were able to when volumes are so kind of flat, right? So people aren't overspending. They're not buying more than what they need. They're buying exactly what they need, making what they have stretch. Squeezing every less bit of toothpaste out of the tube, things like that. So it does make it a little bit more difficult for them to, find that growth when the consumer is, resilient. We've heard terms of, kind of stable or muted. So the sort of language around how the consumer is doing is sort of shifting a little bit. But yeah, that does make it kind of complicated for a company like P&G.
P&G obviously has a lot of different types of consumer products. Well, what about the breakdown of different segments within it? Like, are things like beauty still robust, or is this kind of an across-the-board problem they're having?
I think it's a bit of an across-the-board problem. If you look across their 5 main markets, all of them disappointed this quarter. So they all came in under expectations. So it's also a regional thing. It seems like the U.S. and European markets are where some of these problems are showing up a little more. The company was kind of touting the progress they're making in China, but a lot of this is innovation driven. So this will be the way that the company gets out. They're gonna have to kind of spend their way through this. Again, deal with a little bit of this kind of short-term pain for hopefully long-term gain.
Right.
But obviously that remains to be seen.
All right, Red, thank you once again for joining us. Loved having you on every day this week. It's so great. Red Brown from our Bloomberg consumer team. Coming up in the next hour, we're going to speak with Goldman's chief U.S. economist David Miracle about the Fed and data to come. We also talk AI investing with Battery Ventures general partner Jamesh Thakur, and Logitech CEO discusses gaming hardware and more. This is Bloomberg Open Interest, your hour 2, right after this break.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Preston. As some predicted it would be, the Senate Homeland Security Committee's questioning of Dr. Anthony Fauci had a lot of drama, beginning with Fauci's own statement.
Under the advice of my attorneys, I will invoke my right under the Fifth Amendment of the Constitution to refrain from answering your questions.
Fauci was subpoenaed by Senator Rand Paul, who at one point told Fauci's attorney to stop speaking on his behalf.
I said, sit quietly, you are not recognized. Another word and you're gone.
Well, the attorney kept talking, so Rand directed.
Security, please remove him from the room.
The Capitol Police did remove him, as some in the hearing applauded. U.S. forces in the Middle East on high alert after a surprise attack by Iran on Jordan, where CENTCOM is located. The 5 missiles launched were all intercepted. However, says ABC's Rachel Scott at the White House,
this goes against everything the president has been saying for days. He has insisted that Iran badly wants to make a deal. Sources tell me he even put off a major escalation in this conflict to give way for diplomacy. But Iran is clearly not interested in that, launching another attempted attack overnight.
The search for survivors after the Japanese earthquake continues. ABC's James Longman has more.
Shoppers seen running. An explosion 90 minutes later, part of the second floor collapsing, and now thousands of emergency personnel have been deployed to assist in rescue and aid efforts. The quake's epicenter was located on the southwestern island of Kyushu. 300,000 people have been told to evacuate to safety. Fires broke out throughout the area. Tourists witnessed the famous stone wall of Kumamoto Castle crumbling to the ground.
300,000 people have been told to evacuate because of aftershocks. Former FBI Director James Comey has moved to dismiss the Seychelles case against him, saying he was exercising his First Amendment rights. Federal prosecutors are trying to prove his 8647 message was a legitimate threat. This is ABC News. Someday science will come up with a way to manufacture synthetic blood.
In the meantime, the only source of blood for medical procedures is humans.
We need people to step up.
Matt Trotter is with the American Red Cross, which has declared a national blood supply emergency.
If 3 more people came to every Red Cross blood drive over the next month, we would be out of this crisis.
The nonprofit has been hit from both sides, a seasonal increase in demand for blood products and a precipitous decline in donors. Jim Ryan, ABC News.
Along party lines, the Senate confirming Jay Clayton to be the next director of national intelligence.
At a hearing this month, Clayton repeatedly refused to say that Joe Biden won the 2020 election, saying only the election was certified.
Who won the 2020 election?
I think I've answered the question. We can keep doing this.
Well, we're going to keep doing it because you're not being honest and forthright.
I'm not going to engage in the theater.
Clayton inherits an intelligence agency that's being downsized. The acting director he's replacing announced yesterday a 30% staff reduction from just weeks ago. Lawmakers are now requesting details about those cuts.
ABC's Sophie Flay. Irish singer-songwriter Glenn Hansard, who won an Academy Award for the 2007 film Once, has died in a motorcycle crash in Ireland. He got his start as a busker on the streets of Dublin and sang a rousing rendition of the Pogues' Fairy Tale of New York at Shane MacGowan's funeral in 2023. Irish Prime Minister Michael Martin says he is deeply saddened at Hansard's passing. Sherry Preston, ABC News.
If you haven't switched to Pure Talk because...
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube and streaming live at Bloomberg.com as well. It is Scarlett Fu, Paul Sweeney. This is the Bloomberg Intelligence Program. Coming up, we have selling in the marketplace today. It is Fed Day. We got lots of earnings after the close. We're going to kick this off. We'll talk to Mandeep Singh in just a moment. He's Global Head of Tech Research for Bloomberg Intelligence. Get a preview of some of the big tech earnings that are coming out over the next couple of days. Jeffrey Cleveland, chief economist at Payton & Regal, to discuss his outlook for the U.S. economy and for this Fed. Anthony Hughes, Bloomberg U.S. Equity Capital Markets reporter, is going to join us and talk to us about the Jersey Mike IPO, more than 10 times oversubscribed. How about that? Kirsten Fontenrose, senior fellow at the Atlantic Council, will give us the latest on the Middle East. Tensions flaring again, which is pushing oil up 6 to 7% here this morning. Tim Craighead, Bloomberg Intelligence Chief Content Officer. He's going to talk to us about one of the big research pieces coming out of BI about what Europe needs to kind of rearm and rebuild power and their grid. Big dollars are needed there. So we got a lot coming up over the next couple of hours. Let's kick it all off at John Tucker and a Bloomberg Business Flash.
All right, guys, good morning. This Bloomberg Business Flash brought to you by IBKR. For the past 3 years, Interactive Brokers' individual clients averaged 24.3% annually, beating the S&P 500. Lower costs and access to 170-plus global markets matter. Visit ibkr.com/performance. Stocks are lower. Oil is higher. Bond yields are higher. And, of course, the Fed mystery that's getting cleared up at 2 p.m. Wall Street time today. Energy, best performing major industry group in the S&P 500 as Brent crude goes back above $90 a barrel. Industrials and information technology, they are the worst performers, and ahead of the earnings after the close, shares of Microsoft and Meta were both down about 0.7%. And again, the NASDAQ 100 down about 10% from its June high. Best performing stock in the S&P 500, Garmin, up 17%. The GPS-enabled products maker boosting its earnings per share guidance. And meantime, Julian Emanuel at Evercore ISI says, you know what, the recent tech sell-off may not be as bad as it seems.
If you're a tech stock investor, you have to be comfortable with higher volatility. And frankly, if you had told me that Korea would have been down, whatever the number is, 33, 35% from the top, and the NASDAQ barely down that 10% threshold, I would say that's probably not a bad result.
Right now, the S&P 500, 35 points lower, down 0.5%, 73.93 on the index. The Dow down 701 points, 52,046. The NASDAQ 100, 156 points lower, That's down 0.5% right now. Well, you can get in on this.
Okay.
The New York City Department of Transportation putting for auction the first of the Champions Way street signs that were hung along the ticker tape parade route for the Knicks. The bidding's underway. Started this morning at $100, ends on August 12th. Just about everything with the team's image has been pretty high demand.
Yeah.
Remember the executive director at J.P. Morgan Chase was hired. She was caught trying to steal a
The
commemorative
garbage can.
Knicks garbage can
Yes.
during the parade. Don't steal garbage cans.
The New York Post had a field day with that one.
Yeah.
Oh. You have a job, a big job at J.P. Morgan Chase. You get fired for stealing a garbage can.
Yep.
Okay, kids. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker studio and streaming live on YouTube as well. As John was just reporting, got a sell-off in the market today. Let's take a look at some of the stocks on the move. We can do that with Christina Aquino, managing editor for Markets Live, joining us here in the studio. What are you looking at, Christine?
All right, Paul, let's start with Meta because we're going to get those earnings after the bell later today. So ticker META, those shares trending just slightly lower, down about 0.4% here. And so really a few things that investors are going to be looking out for those second quarter results. A lot of focus on their efforts to build a cloud business because potentially that opens up a new revenue stream. It could help offset their aggressive spending on artificial intelligence. Now, of course, CapEx very much a big focus as well for a lot of these hyperscalers and big tech companies. So they guided for CapEx to increase to as much as $145 billion during their last earnings report. So we'll see what that number looks like for the second quarter. And of course, we know that Bloomberg News reported earlier this month that Meta was developing plans to sell access to its AI computing power. So investors are going to want to know how they plan to monetize that from this set of results as well.
And it's not just Meta because Microsoft will be reporting after the close today, and we'll be all over that on Bloomberg Business Week this afternoon. What are people saying about Microsoft?
Well, Scarlett, yeah, very much the focus as well. As you say, earnings also due after the bell today. So ticker MSFT, those shares a little bit flat to trending just slightly lower today. But, you know, a lot of expectations in terms of their revenue. Analysts are expecting a 15% increase from a year earlier. And of course, Azure, which is their cloud unit and is the source of much of their AI-related sales, that's forecast to increase in terms of sales to about 40%. So we'll see if those expectations are either met or exceeded. And again, CapEx, right, is going to be the focus. Microsoft's saying that it will spend about $190 billion this year. So is that number going to rise? Is that number going to fall slightly? We know what happened to Alphabet, of course, when they increased their CapEx figure to $205 billion versus $190 billion. It was punished very much in the markets in the reaction the following day. And of course, that also came with its first negative quarterly cash flow for the first time since it went public. So is Microsoft going to go the same way? We'll find out.
Lastly, Seagate.
Let's take a look at Seagate. So ticker STX, that's doing really well today, up almost 5% now at the moment. So really roaring from its opening gains. It's a computer hardware and storage company, reported fourth quarter results earlier today, beating expectations. Revenue at $3.63 billion versus estimates of $3.49. That's up 48% year on year. So very much riding that high of demand for storage at the moment. And their first quarter forecast for revenue also looking more rosy than expected, $4 billion to $4.2 versus an estimate of $3.79. Their CEO and chair Dave Mosey saying that the performance is really being driven by robust cloud data center demand and disciplined execution.
All right, good stuff. Thank you so much. Christina Aquino is our managing editor for Markets Live coverage, and you can check out her work on MLive Go on the Bloomberg terminal. And for more conversations like this, subscribe to our Stock Movers Reports, 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, Christine was just telling us about two of the big earnings that are coming out after the closing bell, Meta and Microsoft. Let's bring in Mandeep Singh, our global head of tech research here at Bloomberg Intelligence, for more on the tech trade and how sentiment has really turned, it feels like. And you can see that most dramatically in Korea, where the market has plunged for 2 straight days. The regulators there are now saying that they regret, and they've been saying this for a while, allowing these leveraged ETFs, and they want to now limit retail involvement in leveraged ETFs. Are the same dynamics in Korea spilling over into the U.S., or is the U.S. kind of stoking what's happening in Korea?
I mean, the surprising part is the fundamentals of their companies tied to these leverage ETFs are very strong. Even with SK Hynix, 50% quarter-over-quarter growth. It's phenomenal. And, when a company is going, 250% year over year, these sort of things, I'm surprised when the stock reaction is negative. And that's partly because how people are positioned in terms of these margin calls that they're getting. And so fundamentally, nothing seems to be weak over there, other than the fact that all these memory makers are looking to sign more longer term agreements. They don't want exposure to spot pricing because that's where the boom and bust effect is very pronounced. So they are signing like 5-year deals with 10 of their largest customers just to lock in the pricing so that
they have visibility.
And I would assume it's going to be a lot of the data center players that are doing the CapEx. They're all customers of SK Hynix, and it limits the pricing growth. So out of the 50% quarter over quarter, 30% was ASP growth. You're not going to see that going forward because of these LTAs, but still it's very healthy if the demand growth is 20% plus, they are investing in supply. These are very healthy trends.
Meta, after the close, what if you were the IR investor relations person, what would you tell your management team that Street wants to hear?
I think the Street wants to hear the ROI aspect of Meta more than anyone else. And in the case of, Microsoft, it's going to be the cloud business. Same thing with Google. With Meta, yes, the ads business is growing remarkably well. Like mid 20% growth is phenomenal for a $200 billion business. World Cup probably helped Meta in the quarter. But at the end of the day, we're talking about $150 billion in CapEx. What's your long-term plan, 2-3 years out in terms of a separate line of business? How is it going to...
So what are they investing that money in? Because they're an advertising company at the end of the day.
Yeah, so they are setting up AI data centers very similar to Alphabet.
Okay.
And they're using it all internally. In the case of Alphabet, Alphabet is using about 50% of that AI data center capacity internally for their family of apps. But Meta is using the entire 100% internally. And their ad pricing has gone up. But this is not the type of returns you want to see because it's all incremental. They don't have a separate chatbot offering like Alphabet has with Gemini. And the standalone apps haven't really taken off. So the real question here is you don't have a separate cloud business. You don't have a standalone app like ChatGPT or Gemini. What is it that I can see, as a return for this incremental $150 billion CapEx spend every year? I don't think it's as bad as the metaverse. So this is not going to have that type of ending. But the scale of it, like we're talking maybe $1 trillion in CapEx just from Meta through 2030.
How much faith do you have in Mark Zuckerberg's ability to execute on these things? I mean, you mentioned the metaverse. That was a wrong turn. And Meta has, I feel like, chased a lot of the trends that the rest of the tech industry has kind of set out. Do you have faith in his ability to, make Meta a leader in this?
That's the beauty of this business is it generates so much free cash flow that you can afford to be wrong for a year or two. And even if, what's the worst thing that could happen? They invested, $500 billion in CapEx. Yeah, they couldn't go anywhere. They end up using an open source model or an OpenAI or Anthropic model. And they end up using their cloud, their AI data center capacity with others' models. Still, the business will keep generating $100 billion plus in free cash flow because of all the engagement they have. So until the core business is impaired, you're not going to see that.
Mandeep, awesome. Appreciate it. As always, you'll be busy after the close today. And for those earnings this afternoon, Bloomberg Radio is introducing a new feature exclusively for Bloomberg.com subscribers and terminal clients. Participate in our wall-to-wall coverage of earnings today at 4 p.m. Eastern by submitting questions for our analysts and experts to answer live on air. Subscribers can go to Bloomberg.com/AskRadio to send in questions. Then listen on Bloomberg Radio and Bloomberg Originals.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Well, ahead of the earnings after the close of regular trading today from Microsoft and Meta, major stock averages, they are pushing lower. Meta is down 0.8%. Microsoft right now, 0.3% lower. And as you just heard, I mean, the big focus, of course, is going to be on CapEx and when the heck all that is going to pay off. Paul, you're going to have to explain to the class why you're laughing.
Now I'm just getting lost in something.
Oil is higher, and ahead of the Fed decision, 2 p.m. Wall Street time, yields are higher. The more policy-reactive 2-year yield, 2 basis points higher at 4.30%. Quick look at Ford, raising its profit outlook for the second time this year. Consumers continue to snap up the automaker's high-margin sport utility vehicles. I see the Ford Bronco like everywhere.
Everywhere.
And they're outfitted with these really expensive off-road, you know, whatever you call it.
It looks great.
Wait, you're seeing this on the streets of New Jersey, so no one's actually doing this.
So you can off-road, I don't know, to the food town and pick up whatever. Anyway, S&P 500, 42 points lower. That's down 0.6%, 73.84 in the index. The Dow down 717 points. That's down 1.4%. And the NASDAQ 100 down about, let's say, 10% from its peak. Right now, 230 points lower. That is down 0.8%. And we were talking about in the break, Hermes, the luxury brand, those shares fell sharply. That's because sales in China disappointed investors. Now, the CEO says if you want to get an idea when they're going to rebound, watch pork. Because pork's eaten particularly during banquets and at celebrations and at restaurants.
But everyone eats pork, and not everyone gets Hermes.
In particular in China. So
yes,
he says it's a good indicator of the desire to celebrate.
I don't think so. Pork is mass. It's for the mass consumer.
You're really massacring my story here.
I'm sorry.
I was laughing at the beginning. Now she's contradicting me. What's going on here?
The CEO of Hermes says when pork prices rise in China, that will be a good indicator of optimism.
I take issue with the CEO of Hermes.
Anyway, we check the market. We try to check the markets and other stuff
boy.
right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
Very good. John Tucker, we apologize. We'll be better to behave next time. Scarlett Fu, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. It is Fed Day. 2 o'clock, we get the statement. 2:30, we get the press conference. And at 1:30 p.m. Wall Street time, the surveillance folks, Tom Keene and the gang, will bring you full coverage there. Jeffrey Cleveland joins us here, chief economist at Payton and Regal. He's out there in L.A. Jeffrey, what's your thoughts here? I mean, we got some people out there that I think are pretty credible saying, don't be surprised if we get a hike today.
Well, first of all, hello. I feel nostalgic because I think this harkens back to the forward guidance days. I think you have to go back to a time before Bernanke was Fed chair and think about those meetings, and nobody knows what's going to happen. Anything's possible here, Paul, including a rate hike. I think that's possible. Maybe under priced by the markets for today, but I definitely think it's possible. And the reason why is just you have to put yourselves in the shoes of a policymaker right now. And you're looking out and you're thinking about where inflation is going to be at year end. And if you can make a credible argument, it's still going to be above 3%, then what are we doing? We're 5+ years of missing our inflation target in the U.S. So it's time to take action. That's how I would frame the decision today.
Okay, and of course the Fed has a dual mandate to maximize employment and to keep a lid on inflation. It's got that 2% target, and we're nowhere close to that right now. But the latest data prints, June CPI, for instance, show things moving in the right direction. Was that a fluke, or do we wait to see that confirmed by more data, even though oil prices have been all over the place?
Yeah, my gut is that the June CPI reading was a fluke. It was very soft, on pretty much all aspects of the report. We like to look at median CPI, the Cleveland Fed's tabulated median CPI. For the month of June, Scarlett, that was up 0.2% month over month, which it's good, but it's a more moderate pace of inflation, not flat or negative reading. So I wouldn't put too much. Also, I think if you're and not to belabor a point, but I will. If you're missing your inflation target for 5 years and you have one good month, that's not enough. You need 5-6 months of those 0.2, those soft readings month by month to really be confident that inflation is going to get back to the 2% target on a reasonable time frame. And I just don't see that.
Jeffrey, can you define what is the neutral rate and where are we relative to that these days?
Nobody knows, Paul.
I like the honesty.
Yeah, it's hard. It's really hard in real time to get an assessment of that. I think arguably in real time, people are underestimating where that rate is right now. Why do I say that? Well, I don't think you can build a credible case that monetary policy is tight based on current settings. You can look at financial conditions, look quite easy. You can look at inflation still running above target. You can look at the labor market. As Scarlett said, the Fed has that dual mandate, but the labor market, it doesn't look great, but it doesn't look like it's deteriorating. So I don't think you can say we're at restrictive policy setting right now. So the neutral rate is probably a bit higher than where it is right now. And then we can have a great debate where exactly that will settle in. But, I would say at least 2 or 3 basis points, 2 or 3 rate hikes above current setting on the Fed funds rate. So,
Jeffrey, what do you expect to learn from Kevin Warsh this afternoon? He doesn't want to offer forward guidance. He doesn't want to say too much. He doesn't want to submit dots. So it seems like his whole aura is, I'm not going to tell you too much. You guys go figure it out on your own.
Yeah, like I said, that's the pre-Bernanke nostalgia. I kind of like that. As a Fed watcher, though, we like to we like more information because we can dissect that and we can comment on it. So I'm actually not sure I'm going to learn much from him. Where we're learning more right now, I think the most credible voice in recent weeks has been Christopher Waller, his speech from 2 weeks ago in New York. And, he just talked about the Fed with inflation above target. You can't just sternly stare at inflation and expect it to go back to target. You have to actually take some action. So I think that's more of a clear message. I'm not sure we're going to get any improvement on that message from the Fed chair.
Is the inflation rate, is it structurally higher than the 2% that the Fed likes? I mean, make America great again, bringing manufacturing back here, maybe limiting immigration, which could push wages higher. Structurally, is it even possible to get down to that 2%, do you think?
I think so. I do. I think you have to ask yourself maybe a slightly different question, Paul. What has been providing the stickiness on core inflation in the last 6 months or so? In our view, there's been a big wild card there, which is the tech sector. Some of the pricing for accessories and software has fed through into core inflation. So that's really been the surprise. It's not really a story of immigration restriction, I don't think. The tariffs, they were in effect in 2025, not a big effect this year. So, you could argue you've had a series of these shocks that have hit. If those dissipate over time, if you don't keep bidding up the price on your gaming PC, Paul, I don't know what you're doing, pushing up those retail prices, then those price pressures will fade over time. And I think the 2% is achievable, but not in the next 6 months.
Okay, all right. So sit tight for now. Jeffrey Cleveland, chief economist at Payton and Regal, joining us from Los Angeles ahead of the Fed decision today at 2 p.m. Our Fed special will begin at 1:30 p.m., right, Paul?
Yes.
Okay.
Tom and the surveillance
Tom and
team.
the surveillance team. All right. So be sure to tune into Bloomberg Radio for that. Also happening later today is the pricing of Jersey Mike's Subs IPO. Yet another Jersey name cited here on Bloomberg Intelligence. So we want to bring in Anthony Hughes. He is our U.S. equity capital markets reporter, covers all the IPOs. Anthony, what do we know so far about demand for this IPO?
Well, all of the indications so far, and this IPO has been on the road for about a week, that there's a lot of demand for this IPO, and we've reported that there's double digits or more than 10 times demand, and I believe it's somewhere a bit more than that now. So it's quite strong demand, but the IPO market's having a bit of a hangover after SpaceX, and the indications we're getting from investors is that there's a little bit of a concern that the valuation here is pretty aggressive, and even though I think this is a really strongly performing company, the sponsor here, Blackstone, is going for a valuation which is, it appears to be a premium to some of the comps, names like Wingstop, And on that basis, it could be that the pricing of the IPO comes in a little bit like, in range or something like that. But it doesn't look like it's going to price really aggressively based on the demand that we're seeing, based on the interest, yeah.
So who's selling stock in this deal? Is the private equity ownership? Was BlackRock, Blackstone, whatever?
Yeah, so it's an interesting point here is that Blackstone really only took control of Jersey Mike's in early 2025. That's when they closed the deal. And in this case, they're moving pretty quickly, and they are selling a lot of this offering is secondary. They're selling a big chunk of shares, and so is one of their co-investors. But obviously Blackstone this year has talked about this year as being the year of the IPO, and they have a number of businesses that they're looking to monetize or
exit, basically.
Well, partially exit, at least monetize to an extent. I mean, they'll be a very large ongoing shareholder, so it's not like it's a complete sellout in this situation. But I think that the business has done well in recent years, and they're able to cash in of some of their shares at this point. But it's also a franchise-based business. So when we look at businesses like this and their need for capital, when its growth is really underpinned by franchising, then
asset light, right?
Yes, they don't really need a lot of capital as well.
So what's interesting here is that this has almost zero to do with AI. There's got no connection to AI or tech. It's more about the consumer. And there's another IPO that's pricing today as well that's also tied to the consumer. Tell us about Reformation.
Yeah, well, so Reformation is I mean, maybe you know better than I, but it's a fairly premium type women's fashion retailer or fashion maker, and
you don't shop there, clearly.
Yes, but that deal it is unusual because there's been very few consumer IPOs this year, and actually few consumer IPOs in recent years, and really a lot more of the focus this year has been on the AI trade. But I think the bankers have been conscious that the AI trade, they've sort of anticipated, I think, to some extent, that the AI trade was going to come off here after a huge run. And the sort of companies that they've been looking to take public here are not really AI related, and that's really been sort of, I don't know, it seems to be part of the plan here. If we look at the second half here, that we may see Anthropic, which obviously there's going to be a lot of interest in that, but a lot of the other deals may not be AI related as they've been in the past.
All right, the Lara silk dress on the Reformation site, $398. You flirt. The Lara silk dress is a sleeveless racerback maxi dress with a V neckline in case of keeping up appearances.
Is that a good price?
It seems kind of high to me, but I like my bargains.
All right. Cocktail dress?
Can you eat Jersey Mike's
while wearing said dress? Exactly.
I like how you combine those two together.
Exactly right. All right, Anthony, thanks so much for joining us. Anthony Hughes, equity capital markets reporter for Bloomberg News, joining us in our studio here. Jersey Mike's, again, founded in Point Pleasant, New Jersey, on the Jersey Shore.
Pricing this afternoon.
Yeah, after the minute close, and we'll see how that thing trades. Because you're right, Scarlett. I mean, it's non-AI. This is
no AI.
Bricks and mortar kind of fast food kind of thing, or
just
fast casual, as it's called. And Mike Halen from Bloomberg Intelligence says this is a really good company when you look at same-store sales and margins and things like that. So we'll see how it goes. This is good.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. With the major averages, they are lower today. Another sell-off in chip makers dragging the S&P 500 down. It is down 60 points, 73.68. The Dow also down today, 827 points lower. That's a decline of 1.6%. The Nasdaq Composite Index down 293 points. That's a decline of 1.2%. So Bloomberg Economics says the Fed today is going to stay on hold with interest rates. That decision 2 Wall Street time. Ahead of that 2-year Treasury, the yield about 2 basis points higher, but that might be more of a reflection of the fact that oil prices are higher, with Brent up right now, $6.09 a barrel at 90.18. And of course, Microsoft and Meta upcoming earnings test investors, diminishing patience for massive AI investments. Ted Mortensen at Bayer is among those worried about all the spending on AI.
We're going to have to raise a ton of debt and equity to really fulfill the 2027 CapEx requirements going forward.
I want to do Apple shares because, they're firmly in the $5 trillion, only the second company to reach a valuation of $5 trillion. The share is up 0.4% right now, 341.47. You know, for a growing number of youngsters quitting their regular job to become a social media influencer, becoming a little more plausible. Really? You don't have to have a huge audience. A small but loyal audience can now generate enough income to rival a mid-level salary. Brands increasingly moving money toward the so-called micro-influencers. These are the smaller online personalities who have less than 100,000 followers. So, for instance, a TikTok partnership with a creator who has about 50,000 followers, that can run a brand more than $3,500 for a single post.
You've got to have a lot of those partnerships, though, to make that work. And if you're an influencer, you got to hustle. I mean, you got to create content daily. Can't take breaks. Can't go on vacation. You got to do it from wherever you are.
Did you take negative pills today?
No. I'm just saying.
You're poo-pooing another story of mine.
Someone close to me suggested I quit my job and that I become a podcast host talking about stuff from my childhood, like things in the 80s, like ribbon birds.
I would definitely subscribe to that. Yeah.
I was kind of like, I don't see how this works. But
then you'd have to leave us, which we're not willing to put up with.
We can talk about 80s things here on Bloomberg Radio as part of our other stuff mandate.
We could. Yep. Anyway, we check the markets. Stuff from the 80s. What was in the 80s? I don't even remember the 80s.
Flashdance sweatshirts, those crop sweatshirts.
I'd rather forget that.
Ribbon
anyway.
berets.
Is good. Right here on
Gordon
Bloomberg
Gekko.
Radio. Scarlett and Paul, back to you.
Thank you, John. Appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg.
I think I started working here in the 80s.
Yes, in the 80s. There you go. See, that's something good. Hey, the top red story on the Bloomberg terminal here is about geopolitics. Trump says U.S. will strike Iran hard as war escalates again. What happens when that happens? Oil goes up by 7%. Stocks go down. Yields go higher. The dollar rallies. We've seen this play before on both sides of the equation. Kristen Fontenrose joins us. She's a senior fellow at the Atlantic Council down there in D.C. Kirsten, thanks so much for joining us here. Again, the rhetoric coming out of the White House seems to be flip-flopping all over the place depending upon the day here. Do you see any strategy for the U.S. getting out of this situation here?
The administration is running 2 lanes at one time. They're running both the speaking sort of softly through diplomatic channels and mostly through mediators, and then also carrying that big stick that is a recent military buildup that we've seen. Remember that there was a pause in U.S. hostile actions and U.S. kinetic actions for about 3 days. And then Iran pulled a strike on a Qatari LNG tanker. And then again, struck tankers this morning, and they've sent ballistic missiles into Jordan. So the U.S. has really been on a defensive retaliatory foot for the last several days. And Iran's the one kind of taking the more aggressive stance. So the U.S. strategy is we're open to talks. We don't really think they're serious about them. We think they're just trying to prolong these talks to give them the opportunity to build up these capabilities and strike more of our assets. And we're also going to pre-position weaponry that could be used to attack either Pickaxe Mountain, another nuclear facility, or to hit some of the bunkers that we know the IRGC leadership is hiding out in.
So that sounds like there's no real end in sight. I mean, this can go on for a long time, as anyone who's watched a conflict in the Middle East knows. What's the next concrete thing that either side could try to accomplish here?
Well, if you're the U.S., you've got the legal ground, you've got the congressional authority right now, and you've got the military assets in place to make some pretty major moves militarily, if you want to. But you can also kind of take the other foot, because you can say nobody was killed in the IRGC ballistic missile strikes on Jordan last night, and that does give the U.S. president an off-ramp if he wants one. It looks to me like the leadership in Iran assesses that conducting these kinds of strikes increases their leverage in talks. That's just a misread of Washington, and neither side is known for reading each other very well. You could also say this was a moment in time that Iran chose to make a statement during the visit of Prime Minister Benjamin Netanyahu to Washington. These strikes only happened a few hours after his meeting with Trump. So it could be a signaling measure as well. And you're also seeing Iran say, okay, our strategy is changing. We're now relying more strongly on some of our proxies. You've seen action against Saudi Arabia out of both their militias inside Iraq and from the Houthis to the south of Saudi. So they've changed their strategy. The U.S.'s strategy has changed a little bit from taking out the capabilities that are immediately striking ships in the Strait to saying we want to do more long-term damage. We want to remove their ability in terms of logistics and supply chains to present like a medium-term or even longer-term threat to that shipping. So every time Iran fires something at a U.S. or partner asset, it gives U.S. legal authorities domestically and by international law to take out as much of that supply chain as they can in a single sortie, a single volley. So we're seeing both say we want a deal, but neither side looks like they're moving toward one. But I would say, and I know this sounds biased, but truly that the U.S. is doing more of a signaling that they're willing to have these conversations, since we're seeing Iran generally be the one to restart kinetics.
Kirsten, is there any evidence anywhere that anybody in the U.S. administration is thinking strategically at all, i.e., it doesn't look like there's going to be a regime change, which was a key goal, I think. There doesn't seem to be any opportunity to get to their enriched uranium, what it appears to be. So what are we doing? I mean, is anybody asking that question? What are we doing here? We just tit for tat?
Of course they're asking that question. And just remember that, strategies aren't always unclassified in general. But remember that the regime change was a statement by the president, but was never in CENTCOM's plan. So it was never actually a part of the strategic plans for the operation. That was only about degrading Iran's conventional military capabilities and making sure they could not weaponize their nuclear program. So if you're CENTCOM, you're thinking, we've checked these boxes off. You're telling the administration, we're kind of good here. It really comes down to how you, the executive branch, feel about the pressure the international community is placing on you to open the strait. We can leave the naval blockade on for a long time. It's squeezing Iran economically in pretty meaningful ways. But the pressure from the international community and from...
Oh, I think we might have lost her.
Yeah, technological issues.
Okay. Yeah, interesting. So that's interesting from the point she's making about regime change was never part of the CENTCOM business, I guess, battle plan or war plan. But it certainly was part of President Trump's thinking at the time. So I guess
there are a lot of things part of President Trump's thinking. At one point, it felt like he was clutching for straws and, kind of brought up everything as the justification for this conflict.
Yeah, if you're CENTCOM, it's kind of, you do what the president tells you to do. But if he wants regime change, I don't care if it's in your business plan or your war plan or not. I'm not sure how that goes. So again, uncertainty here continues, and again with the attacks overnight, we see it in the financial markets immediately. And I guess where we look first here is WTI crude oil, which is up 7.5% here, almost $6 a barrel, and back now to $85 a barrel. And again, we closed last night's trading below 80.
It's a reminder to the Fed policymakers who are meeting today that you can't count out what's happening geopolitically when you're looking at inflation as they deliberate over what to do for not just the Fed policy today, but going forward.
Yep. So we'll have to see. That's a volatile part of inflation. That's why they do it with energy. So keep an eye on that. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Great piece of research coming out of Bloomberg Intelligence in Europe. How about this? Europe needs to spend about 14 trillion euros on power, defense, technology, and critical sectors after a long period in which it benefited from cheap Russian energy, readily available American security, and low-cost Chinese goods. That's a big number. Let's check in with Tim Craighead, Global Chief Content Officer for Bloomberg Intelligence. Tim, that's a big number. What are you and the BI analysts over in London, how are you guys approaching that?
So, Paul, it's interesting. You take a step back and you think along the lines of what you set this up. Europe's stuck in the middle, or between a rock and a hard place, or whatever cliche you want to use, whether it's geopolitics, whether it's economics, security, energy, etc., between a growing U.S. dominance, a competitive threat coming from China, and what we set out as a task is it's hard to think about Europe being totally self-sufficient or autonomous, if you want to think about it, self-reliant. But how far could we go over the next 10 years, and what would it cost in terms of investment to make this happen? And not from a top-down macro perspective, that's been done. Mario Draghi had a great report a couple of years ago setting out a trajectory or a goal. But this is bottom up, industry by industry, what legitimately can be done if the money is spent. And that's how we came up with that 14 trillion euro number.
Putting aside where the $14 trillion is going to come from for a moment here, which parts of Europe stand to benefit the most? Which specific industries, which specific companies for that matter?
Yeah, so, we certainly get into that in this report. I think there are a couple of key areas. Number one, certainly defense is high on everybody's radar screen, no pun intended. Whether it's Rheinmetall, BAE Systems, Saab, those are all defense contractors that if Europe can do a common coordinated plan and not be too nationalistic country by country, then there can be more of a very big sum that needs to be spent. The target is 3.5% of everybody's GDP to drive more Europe-reliant defense. And that's an example. We can go through energy, where the focus is more on building out renewable energy. Think about RWE as a case in point, continuing to extend oil and gas production as much as possible in the North Sea. That would be a company like Equinor, or renewable power. And here you've got Vestas in the wind area. So think defense, think energy. The other big area, I think, is in industrials. Not only Europe needs its own energy and electricity power supply, but it's a global growth business as well. And Europe is actually quite strong in that area. Think Schneider Electric, Siemens, ABB are all really big in that area. There's other spaces, but those are three big topics.
In terms of paying for it, i.e. the 3.5% of GDP, I think, when I've spoken to some folks, they've kind of feel like, all right, Germany can get there. Poland is probably incented to get there given their proximity to Russia and their history with Russia. But boy, outside of those two, is Spain, Italy, Portugal, what are those guys going to do?
So it's interesting, Paul. Poland actually is above 4% already.
Okay.
To note that they are at the sharp end of that spear.
Yep.
The 14 trillion certainly is well beyond the 750 billion euros a year in defense. There's a big chunk in technology, in defense, in energy, in various other critical inputs that come up to the 14 trillion. And importantly, it cannot rely purely on government financing. This isn't look for, some federal or pan-regional government to start ponying up. There is no budget for it. This has to be some element of private company, corporation investment, along with government incentive, policy incentives. Interesting, we get into this in the report as well. There's 11 trillion euros of deposits sitting around in people's bank accounts. Europe is not very forward when it comes to risk investment. Most people's biggest chunk of savings across many European countries is in bank deposits. So if that can be marshaled with more coordinated, open, unified markets across Europe, so it's not 20 plus individual markets, it's one uniform common market when it comes to putting forward risk capital, that's a big source of potential private investment that can be steered into profitable investment that can then generate growth. The economists in the report also have a really interesting chart looking at the current trajectory of divergence versus the U.S., which is really daunting, and how it can turn into convergence. So a lot of opportunity.
All right, Tim, great stuff. Great report. Check it out on the Bloomberg Terminal. Tim Craighead, Global Chief Content Officer for Bloomberg Intelligence. Europe needs $14 trillion reset to build power, defense, technology. Check it out on Bloomberg Terminal. For our listeners in the U.S., a reminder, you can listen to us on satellite radio on Sirius XM Channel 121. Access the world's only global audio business and network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in Midtown Manhattan. We are streaming live on YouTube. This is Bloomberg Intelligence with Paul Sweeney, Scarlett Fu, and John Tucker. We have the Fed decision coming out at 2 p.m. later today. We're going to get into all of that. We're going to talk about earnings as well. On the agenda for this hour, Andrea Felstead, our Bloomberg Opinion columnist, will talk to us about how Hermes and Kering, the owner of Gucci, are moving in opposite directions, divergent paths for these luxury goods companies. Visa reported results, so we're going to check in with Diksha Gera, our global fintech and payments analyst. Brian Whalen is, going to provide our regular check-in on the fixed income markets, especially with big tech issuing a ton of debt. He's the CIO and generalist portfolio manager at TCW's fixed income group. Craig Trudell, who covers our global autos sector, will look at Ford and BMW's latest news. Ford, of course, coming out with the results. BMW firing 8,000 workers. And Danielle Booth, she is formerly with the Dallas Fed, will join us to preview that Fed decision coming up later today. But first, let's get to John Tucker with your Bloomberg Business Flash.
All right, Scarlett, thanks. Sinking technology stocks dragging Wall Street lower again. This comes ahead of the Federal Reserve decision, 2 o'clock today. Energy, best performing major industry group in the S&P 500 as oil pushes higher. Then you have the information technology, materials, and industrials, worst performing major industry groups in the S&P 500. The Philadelphia Stock Exchange Semiconductor Index down today. It is down right now close to 3%. What did you say earlier? Since it's
26%.
26%, well, almost 27% and that was the high only in mid-June. So that's quite a fall there. Anyway, helping to limit the stock market losses today, Apple. You'll recall they got a lot of grief earlier this year for not investing that much in AI. Maybe they look like a bunch of geniuses. Shares up 0.2%. Yeah, they're in the $5 trillion club. Only the second company to be in that stratosphere. Meta and Microsoft, of course, reporting after the close, and Morgan Stanley's Mike Wilson says spending on AI will, yes, be the key.
The market has been sending a very direct signal to the hyperscalers, and that is, if you spend more money, your stock is going down.
Right now, the S&P 500, 53 points lower, down 0.7%, 73.75 on the index. The Dow down 800 points, a decline of 1.5%. And the NASDAQ 100, 270 points lower, that is down just about 1%. And yet another reason for me to be annoyed. DoorDash gaining the necessary approvals to operate their own drones. The company gaining the, I don't know what it's called, Part 135 air carrier certification from the FAA to commercially operate a drone delivery service. So DoorDash plans to launch the drone deliveries in the fall. So
I'm still waiting for the Amazon drones that Jeff Bezos was talking about.
It's not going to be
I only saw them on commercials. I never saw them in person.
Yeah, me neither.
They'll be crashing into my house at 2 a.m.
Hold on. Didn't New Jersey have a whole issue with drones?
Supposedly. Never.
No, you're talking about like a couple of, was it last year?
Yeah.
People would spot drones
Yes.
in the middle of the night
Yes.
over New Jersey
Right.
and like
Your neck of the
where the UFOs.
Right. Now we're going to add DoorDash drones to that?
Yes.
Anyway,
That
well, at least they'll
won't
be carrying
bother
like
anyone.
pizza, so that's good.
So they're welcome drones, friendly drones.
Not in my house. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, JT, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube and streaming live at Bloomberg.com as well. As John was just reporting, we got some selling out there, folks. Let's take a look at some of the stocks that are on the move. We do that with Christine Aquino. She's in our studio. Christine, what are you looking at this hour?
All right, Paul, let's take a look at Ford. That is not being sold today. It's actually gaining. So ticker F, and those shares are up more than 4% at the moment, pairing some of its opening gains, but still a healthy clip. And of course, we know that they had second quarter earnings out earlier. Ford raised its profit outlook for the second time this year, thanks to consumers continuing to buy its high margin SUVs. Adjusted EPS was given guidance at 42 cents versus 36 cents, which was the estimate. And then they also upgraded their EBIT guidance for this year to $11 billion from $8.5 to $10.5 billion previously. Now, the company, as we know, is also investing in a new energy storage business, and they're also going to overhaul its electric vehicle strategy to focus on less expensive models. A lot of interest in that new energy storage business, of course, because it relates to being able to supply power for all of this data center AI-driven demand. But investors, of course, wondering whether that's going to be a sustainable revenue stream for Ford. So keep an eye out for that.
I tell you, Ford is doing the right thing. We're just focusing on profits. Where do we make our profits? Trucks and SUVs. If you want to go electric, you can go electric. Our responsibility is to our shareholders.
Where do you go for electric then? You go to Tesla with their old stale lineup?
I mean, they'll still have, everybody's going to have some. But you're scaling it back because they're not getting paid for it. I totally agree with their strategy.
All right, next stock.
All right, let's take a look at Caterpillar. Yes, CAT, so ticker CAT. That is not doing too well. It's actually extending opening declines down now more than 5%. And that is because we did get a downgrade from Baird. Analysts there cutting the recommendation to neutral from outperform previously. And they also cut the price target to 900 from a previous recommendation of 1,200. And currently it's trading around 791. So analysts are citing a growing trend of state and local government action targeting data centers, and the analysts are potentially saying that that could impact future orders and backlog progression, and it really just could be a limiting factor for growth that could contribute to Caterpillar's future outlook. And so, yeah, not looking very optimistic there in terms of data center regulation and the implications for a company like Caterpillar.
And Skyworks?
Skyworks. So Skyworks, ticker SWKS, they are a semiconductor device company. We know that they're a supplier to Apple. They actually derive 67% of their revenue from Apple. We got their fourth quarter earnings today. That's not looking too hot. And so the shares are down now just over 2%, bearing some of those opening declines that we saw earlier. And that is primarily because of a weaker than expected outlook for the fourth quarter. Bloomberg Intelligence weighing in and saying that, there are a lot of headwinds for handset makers because of rising memory prices and also constrained supply. And that really could limit significant upside for Skyworks in the second half of this year.
All right, Christina Aquino, thank you so much. Christina Aquino with our Stock Movers Reports. Listen for 5-minute audio reports on the biggest and winners and losers in the stock market when you subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. It's all about earnings, and I know that we've got a whole slew of big tech earnings today and tomorrow, but over in Europe, they're focusing on their leading industry, which is luxury. And the luxury guys are kind of going in different directions these days.
Yeah, Hermes and the Gucci folks over there at Kering, I don't think there's a read-through there. I don't know.
Yeah, it certainly says something about China. It certainly says something about inflation. Let's bring in Andrea Felstead. She's our Bloomberg opinion columnist, writing on both. Andrea, just give us an overview here. We had heard from LVMH. Now we're hearing from Hermes and Kering, and I think I mispronounced Hermes because...
No, that's how I go.
Is that how you go?
That's
Not Hermes. In
no,
any
Hermes
case,
is Federated Hermes in Pittsburgh.
Okay, thank you.
Yes.
This is a dumb American question. Anyway,
Yes.
Andrea, walk us through how the tide seems to be turning here for Hermes and Kering. They're going in different directions than they were before.
Absolutely. So Hermes seems to have spooked the market by talking about China and saying that China has stabilized, but it's not yet recovered. And I mean, this isn't really that different from what everyone else has been saying, but the CEO Axel Dumas talked about the pork price, and he said that obviously we know about the property market, but he said the pork price is low, and so that's an indication of less confidence. So the market's really taken this badly. I'm worried about Hermes. Now, at the same time, on the backdrop of Hermes, you've also just had this sense that the Birkin, the Kelly aren't quite as hot as they used to be. Chanel has got a new design, and he's been bringing out some bags that are really, really in demand. So the Hermes and the Birkin and the Kelly, typically you can't just go into a store and buy one. You have to put your name in a wait list. There's all sort of hurdles that you get one or not, and so most people buy them in the secondary market where they cost more, and the premium to the retail price has been falling. So that's seen as maybe not a great thing for Hermes. But what's the other thing that's happened in the last few weeks is that all the footballers have been carrying these giant Hermes bags, the giant Birkins, the hack, which isn't a Birkin but looks very much like a Birkin, and I really do think that's actually given Hermes a new lease of life, because the Birkin was looking a bit tired, and suddenly you've got Erling Haaland carrying his giant Hermes bag, and I think it has helped them, but obviously that's not going to come through in these numbers.
Andrea, just so you know, in this radio studio, we are not buying that pork as a leading indicator issue.
Okay.
We're just not buying it. But
wait, I bought it.
So, Andrea, what do we know about the geographic element here? Are certain parts of the world doing better than others?
Absolutely. The US is really, really on fire when it comes to luxury. The stock market wealth, up to now anyway, the AI wealth, the US demand is very correlated with a stock market performance. Now, what is really interesting is that the people that are enjoying all this wealth, it's natural when you get a big windfall, you want to treat yourself. And that seems to favor like watches and jewelry rather than a handbag. Maybe you want something that lasts, you want a memento of this, of this wonderful windfall. It's really helping jewelry rather than leather goods. And that's a problem because obviously for brands like LVMH, Kering, although LVMH has Tiffany, and it really, its bread and butter is leather goods. So, and they're very profitable. So you really want handbags to come back. But the fact that the US is doing well, that's making up for the shortfall while China's sort of in the doldrums.
Very quickly before we let you go, Andrea, when LVMH reported results, it was really the US that was the bright spot. Is that the same for Hermes and Kering?
Absolutely. It's been right across the board, with the jewelers really shining the brightest.
Very, very good, Andrea. Thank you so much for joining us. Always appreciate getting a few minutes of your time. Andrea Felstedt, she's a columnist for Bloomberg Opinion, joining us from London here. Staying on the earnings beat, Visa, our good friends at Visa, they beat estimates, but they took a $563 million charge on job cuts there. Let's get the latest on what's going on with Visa. Diksha Gera, Bloomberg Intelligence Global FinTech and Payments Analyst, joins us here. So what's the takeaway from Visa from your perspective, Diksha?
Yeah, hi there. Nice to be here again. I think it was a good set of numbers, modest beat on both top line and bottom line for the third quarter, fiscal third quarter for Visa. Adjusted EPS was about 2.7% ahead of estimates. But I think what was really notable is all the underlying trends were pretty resilient. So 18% volume gains, 34% services revenue gain. I think, and all of that puts Visa in a very comfortable spot to basically meet their raised full year 2026 guidance, which they have raised to low end of mid-teens for EPS growth. I think what I'd highlight is it really was firing all engines. Value-added services was $3.8 billion revenue in third quarter, and Visa Direct, which is their consumer direct point-to-point money flows, their transactions climbed 21%, and new use cases and partnerships are kind of key tailwinds there. Sorry, one thing if I'd be remiss to not point out is the World Cup. It did really well for Visa's third quarter numbers, and management cited very strong volume gains across all categories. So all the US host cities, total card present spend accelerated, transactions were up 20%. You have to understand, like when people are visiting, and this is all cross-border spend, which is some of the most lucrative or higher margin business for the card network. Tap to pay transactions where people are going and using transit. So you just tap your card and move on. Your entertainment, your restaurant spend, all of that got a nice kicker. And the banks launched a lot of programs along as well to kind of bring in more consumers who were traveling for the World Cup.
Diksha, this is a dumb question, but are those buy now, pay later companies like Klarna competition for Visa? Are they friends or foes?
So here's how I put it, Scarlett. When I was covering banks, I actually thought the card networks are done with just because of all the alternative payment rails that were coming, direct fund, like bank-to-bank transfers were happening, and now BNPL is kind of growing. But if you pay attention, all the buy now, pay later companies, and I cover the sector, their best-selling product is actually a card. So the card networks have very beautifully managed to embed themselves into the buy now, pay later ecosystem as well. So while you go to an Amazon.com and spend on, say, an Affirm there, Affirm is now giving you a card that you can go and swipe at a restaurant for your buy now, pay later product.
So I'm looking at these stocks, Diksha, Visa, MasterCard, Affirm. I mean, on a trailing 12-month basis, they're all kind of flattish. What's the story in the payment space here?
I think the sector overall is beaten down overall. And I think if you just look at the card networks, they're somewhere in the middle of that range. The B2B processors are the worst hit. But I think there is the overall sector has kind of been doing poorly in that regard. That said, Visa and MasterCard are steady as they go. Like these are the most resilient, solid cash flow businesses along the sector that I cover. One thing, Paul, I would highlight though, and we've been getting a lot of questions around that, is the 7% job cuts that Visa announced yesterday. And people are like, is that a distress signal? Like what's going on? They're doing well, then why are they kind of letting people go? I would highlight that that's not Visa in distress. I would read it as modern corporate portfolio management.
Got it.
Visa's portfolio workforce actually tripled over the last decade. And what CEO Ryan McInerney is doing today, he's trimming product overhead and monetizing their AI investments.
All right, very good. Diksha, thank you so much. Appreciate it. As always, Diksha Gera, Senior FinTech and Payments Analyst at Bloomberg Intelligence. She's based out there in San Francisco. Remember, folks, a lot of earnings after the close today. And for those tech earnings this afternoon, Bloomberg Radio is introducing a new feature exclusively for Bloomberg.com subscribers and terminal clients. Participate in our wall-to-wall coverage of earnings today at 4 p.m. Eastern Time by submitting questions for our analysts and experts to answer live on air. Subscribers can go to Bloomberg.com/AskRadio to send in questions. Then listen on Bloomberg Radio and watch on Bloomberg Originals and YouTube at 4 p.m. Eastern. So lots of good stuff going on there. We got some smart people. You can ask them questions directly, and they'll do their best to answer.
I got questions.
Oh, yeah, I got questions.
Not about this.
Man, deep, I got a lot of questions for that fella.
They'll filter you out, John Tucker.
Exactly. We've got I think the kids say block. We'll block John Tucker.
Right.
More coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Ahead of the Fed decision this afternoon and ahead of the earnings from Microsoft and Meta Platforms after the close, the major averages, they are lower right now. S&P 500, 59 points lower. That's down 0.8%. 7370 on the index. The Dow is down 818 points. That's a decline of 1.5%. The Nasdaq 100, 341 points lower. That is down 1.2%. Of course, with the earnings, CapEx is going to be one of the big focuses, especially for Meta. You could argue, actually, Paul, that I guess the Alphabet set the tone when they reported. Yes. They had what, negative free cash flow.
Yep.
Some analysts are saying that they expect Microsoft possibly to have negative free cash flow later this year, I guess the fourth quarter. As we look at yields right now, the more policy reactive 2-year is up 3 basis points, 432. Less to do with the Fed decision at 2 o'clock, but probably more reflective of oil. Brent right now up $6.72 a barrel at $90.81. No AI here, at least I don't think so. Cheesecake Factory, ticker symbol CAKE, up 11%. The restaurant company reporting better than expected traffic growth, raising the full year forecast. Best performing stock in the S&P 500, Garmin, an all-time high, up 17%. So they make the the GPS-enabled products, and
all most cars have GPS, and don't you have Google Maps? And I don't understand that.
They make up other stuff connected to that, but the earnings per share guidance for the full year, they lifted that. Since you bring it up, I'll geek out. With GPS and Garmin, anybody using GPS, with the satellites, you have to take into account Einstein's space-time.
Oh, no.
Because satellites in space, they operate on a different time.
No.
Time speeds up in space.
Space-time continuum, sure. Okay.
As opposed to Earth. No, it's like the clocks tick faster in space.
All right.
So we age more slowly.
I just keep daylight savings time. That's all I want.
We check the markets for you all day long. No bites. Right here on Bloomberg Radio. I'm John Sucker. And that's your Bloomberg Business Flash, Scarlett and Paul.
All right, John, thanks so much. Appreciate it. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well today. All right, it is Fed Day today. That Bloomberg coverage starts on Bloomberg Radio and TV at 1:30 p.m. Wall Street time. Tom Keene and the surveillance team will bring all that to you. The statement at 2 o'clock, the press conference at 2:30, all that kind of, if there is a press conference, I don't know. Brian Whalen joins us. He'll be paying attention. Why? Because he's the Chief Investment Officer at Fixed Income at TCW, based out there in L.A. Brian, a lot of folks are saying this is going to be kind of a unique, a little bit different Fed day here and press conference. We're just not sure what we're going to get from the Fed in terms of decision and in terms of commentary. How are you guys reading it?
Yeah, it's I'd say the market's more uncertain about this one than it's been in a long time. We've obviously had a change in the leadership at the Fed, and in June, Warsh came out, came a little bit more hawkish than the market was expecting. Obviously, we've had this conflict going on for the better part of the year. Oil prices are bopping around here. People are concerned about pass-through to kind of broader, inflation metrics, although we haven't seen that to date. So, our view is that more likely than not, they're not going to go. We don't see any real kind of fundamental justification for it, just going based upon what they said last June. And ever since then, we've had 2 inflation reports that have kind of come in much lower than feared. We had a softer labor market data come out in early July. And so, the only reason we could see them going today would be if Warsh wants to continue to kind of, beef up his anti-inflation fighting credentials. But, given we're only a few months away from the November election, and what we think is kind of a dove in hawk's clothing with regards to Warsh, we expect they're not going to do a thing today.
Explain what you mean by that, a dove in hawk's clothing. What does that mean in terms of how he expresses himself when he chooses to the market?
Sure. Yeah, he look, let's go back to, when the market was underwriting a whole bunch of candidates, including Warsh, and, he's been pretty public about his thoughts that, long-term productivity gains from AI should pull down on inflation metrics. He's talked about the necessity of central bankers to look through supply disruptions, particularly in energy, and it's what we have at the moment. He's been vocal about, over the long term, wanting a smaller balance sheet, which is restrictive in nature, which means he's also, supportive of lower interest rates. So that's who we have. So I think over the long term, he expects our interpretation of what he believes. He expects the data to support, inflation continuing to come back down toward 2% or below. And if so, he probably views interest rates at their current level as moderately restrictive. That said, he was the new guy, the new chairman coming in June. And at that point in time, over the course of the 4 to 5 months, the market went from expecting 2 cuts from the Fed to almost 2 hikes. And so we came to that podium for the first time. The market was already expecting hikes. And so, it was kind of a free option for him to kind of stay up and just kind of reiterate what the market expected. And then, he got good press for that. He kind of earned a lot of credibility and he also did it without, disappointing the market. So if we're Warsh and we think what his mindset is like, if I believe the data will support no hikes and maybe cuts in the future, I'm just going to sit back. We'll let the data play out.
Yeah.
And if it reiterates what I expect, then we won't hike and maybe we'll cut down the road. If not, we can pivot.
Brian, I also want to get your take on credit because there's definitely been some more nervousness on the equity side. Investors are noticeably less patient in July 2026 than previous earnings seasons as companies announce their CapEx plans. When it comes to issuance, demand is starting to slow down. Bubble concerns are growing, and it feels like issuances are now becoming harder and more expensive to get completed. Is this the beginning of a real sea change? I mean, are we going to see spreads widen out a lot more than where we are now?
Yeah, look, the bond market, the corporate bond market in particular, the phrase channeling Roberto Duran, for those who remember, no mas. There is just so much supply coming to the market. It can't handle it. I just heard, the prior conversation was about, cash flow at the big hyperscalers going from a positive $250 billion a year to now negative. And it's just inundating and flooding the corporate bond market with so much supply. And at first, in the beginning part of the year, was able to handle it. These were high quality issuers with fortress balance sheets, and the market wanted to kind of put that money to work, but it can only take so much. And the interesting dynamic here is that you're getting issuance from companies who, they believe in this AI story and the long-term growth prospects. And, they're thinking in terms of their equity valuation, in terms of multiples of value of where it is today. And so they turn around to the debt markets where they're looking to fund, up to almost $300 billion year to date. And that's only going to grow, and we'll continue to see it probably grow in 2027. Whether it's an extra 25, 50, or even 100 basis points in financing costs on a $20 billion transaction, I don't want to say they don't care, but they are certainly far less sensitive to that increase in borrowing costs than what we're used to seeing in the corporate bond market. So it's an interesting dynamic. It's going to weigh on the market for the rest of the year. And if what I would add in there, and that's only, we're just talking technical, supply, demand, wider yields, wider spreads, et cetera. If this kind of AI story hits a speed bump or takes a turn the market's not expecting, like maybe there's less compute, maybe there's social pressure because of the job loss, whatever the twists and turns may be, if you have a fundamental disruption on top of the supply kind of overhang, that could really cause a kind of a repricing and increased volatility across the entire corporate bond market, as well as the equity markets.
Brian, thanks so much. Always appreciate a few minutes of your time. Well, if I'm a fixed income salesperson on Wall Street, I'm not sure I want to call Brian Whalen. He's a tough call, I think. You can't get any BS behind him.
I know, he tells it like it is.
I know. Brian Whalen, Chief Investment Officer, Fixed Income, TCW. I don't think he takes any salesperson's calls anymore. Switch gears, get back to the earnings front. Ford, the stock's up 5.7% today. Some good numbers here. Let's break that down with Craig Trudell, Bloomberg Managing Editor, Global Business Coverage. First question, why aren't you in London? Did you come back here?
I'm back.
Oh, okay.
I'm
Very
back.
good. Very good. Good. Okay, talk to us about Ford here. The stock is higher today.
Yeah, Ford and GM really consistent across several fronts. I think the fact that SUVs and pickups have been so strong in this market, the fact that the Trump administration has so relaxed emissions standards and fuel economy rules, they're really able to sort of go whole hog and sell as many SUVs and pickups as they possibly can. And that does a heck of deals a sort of heck of a boost to their bottom line.
What surprised you the most when you look at Ford and GM and what they've managed to show as they double down on what works?
Yeah, I think the execution has been strong. I think they have been trying to sort of pivot in a way that has to be really dramatic, considering the degree of change from one administration to the next. The fact that the Biden administration wanted these companies to sell a heck of a lot more electric vehicles, and they built the plants to do so. They not only built the car factories to do so, but the battery plants. And Ford has been trying to sort of, make lemonade out of lemon in the fact that Americans were not ready to buy electric vehicles at the rate everybody was hoping for. And both of these companies are trying to sort of maybe turn some of these battery plants into factories that can actually make sort of storage units, which we've seen Tesla turn that into a tidy little business. So I think there's still some sort of show there that we need instead of just tell that they're going to be able to make that transition. But that's going to be something that we're going to watch in the months and maybe even years to come.
I mean, if I'm Ford and GM, I think I have to. This is just kind of opinion. I think my strategy's got to be maximize shareholder value. The way I do that is making pickup trucks and SUVs. And my EV strategy has got to be driven by the marketplace as opposed to policy. If that's the case, I'm not sure we're ever going to get to a big EV percentage in this country. How are they thinking about it?
Yeah, I mean, I do think it's interesting that you still do hear Mary Barra, say that she thinks that electric vehicles and batteries are just the better powertrain. And I think, candidly, if you sort of drive, in my experience, if you drive, the same vehicle, one with a battery in it and the other with a combustion engine in it, it's actually a lot of fun to drive an electric vehicle. The instant torque and the sort of, get up is actually pretty great. And I think avoiding, the gas pump right now is also a big positive. So I think they're really stuck in the situation of a lot of consumers still not being ready for this transition. And yet there is this sort of looming question over, is the rest of the world going to make this change more successfully? And will they be left behind if they don't figure this out eventually?
You just mentioned you moved back from London. I mean, looking at the cars on the road, it must be kind of a shock just to see the transition back to gas-guzzling SUVs everywhere.
I mean, the vehicles here, I grew up in Michigan, been around these companies a long time. Vehicles have always been much bigger here, but it is a sort of shock to the system to see just how big, even as someone who's covered this industry a long time, man, these pickups keep getting bigger. And I think it is also amazing for people who, go from here to London. What I hear from people, who do travel to Europe is, man, look at all of these Chinese EVs, crawling the streets of Europe and around London.
I know. It's us and the rest of the world. I don't know how it's going to play out. In these
Parallel
companies.
tracks.
Yes, exactly right. All right, Craig Trudell, thanks so much. Appreciate it. He's back in the States, everybody, for better or worse. The product of Michigan State University. How about that? This is good.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash on a day when the major averages lower again. S&P 500, 64 points lower. That's down 0.9%, 73.62 in the index. Dow Jones Industrial Average down 845 points. That is a decline of 1.6%. The NASDAQ 100, 375 points lower, a decline of 1.4%. As the war escalates again, oil pushing higher, Brent crude above $90 a barrel. Energy, the best performing industry group in the S&P 500. Two-year yield ahead of the Fed meeting today, up 3 basis points. That actually has more to do with inflation concerns related to oil, I suspect. 432 right now on the two-year. The Philadelphia Stock Exchange Semiconductor Index down again, down over 3%. And as we've been telling you, Meta and Microsoft opened their books to investors after the close of regular trading today. Spending on AI going to be a major focus. Dan Suzuki at iCapital says investors expecting quite a bit from the hyperscaler earnings.
And I think the way to think about it now is the bar is set so high. The new beat is call it a 10% beat on earnings and a lower capex guidance. I think that's the thing that's going to get stocks to rally.
Okay, I'll do this one time, and this is like, I want to be done with Cracker Barrel this quarter, but Cracker Barrel, and this is serious actually, they're going to continue to cover security for the outgoing CEO, Julie Masino, for an undetermined stretch of time after she exits August 10th.
She was literally chased out of that job because of her attempts to, change up the logo, refresh it?
Yeah, well, it's a pretty rare move, but comments over the company's botched image redesign. So that's still reverberating with some, I guess, crazies out there.
I mean, they scrapped that. They're back to the original one.
Yep.
Yeah.
So the people won.
Well, she's still apparently getting threats, which is pretty serious.
It's not bothering her.
We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you so much, John Tucker, with our Bloomberg Business Flash. We have the Fed meeting today. It began yesterday, but the decision coming out at 2 p.m. starting at 1:30 p.m. Bloomberg Radio and Bloomberg Television will bring you the Fed Decides, hosted by Tom Keene and their surveillance crew. So be sure to tune in for that. But ahead of that, we want to welcome in Danielle DiMartino Booth. She is one of our regular guests on these Fed days, CEO and chief strategist at QI Research, formerly with the Dallas Fed. And it's all going to be about what Kevin Warsh says and does, because he has brought in a new regime and he is not big on tipping his hand on how he's thinking. He doesn't really want to provide forward guidance. He doesn't want to include a dot. He claims to be about surprises. Do you think he will deliver one?
Well, he keeps talking about these good family fights. I mean, you would think that, think about Thanksgiving Day, bad family fights and badly, the uncle leaves early, but a good family fight should end well, right? So if a good family fight is ending well, then we won't see any dissents. And we're not going to see any dissents if there's a rate hike. We will see dissents if there is.
Interesting. So, I don't know, we just had, pretty big bond investor on right before you saying he thinks they're going to hold steady here today. But the market's pricing in pretty decent odds that there will be a hike. I mean, what do the fundamentals tell you, I guess?
I mean, look at Procter & Gamble. Look at Waste Management. I mean, waste volumes have a almost perfect correlation with GDP growth, and they fell yesterday when they reported. We're not seeing any kind of pickup. Apartment concessions are at the highest on record according to Zillow. So we're not really seeing the pass through to the core that would suggest that these energy prices are filtering down, and part of it's just a lack of purchasing power on the part of U.S. households, which they demonstrate one earnings report after another after another. But again, if you're talking about the element of surprise, there was a 50 basis point hike during Powell's tenure. And the weekend before that surprise hike, word leaked in the media that something big was coming. So at least the bond market was not absolutely shocked. But at least it got probability north of 50%. And that was kind of the new line in the sand, if you will, that 50% line. It used to have to be above 2/3 probability. And then Powell kind of lowered it to 50%, Now you're talking about possibly lowering it to 36%. But again, breaking the mold of if markets are expecting it, they better price in 50% or more. If he doesn't care about how markets are interpreting Fed policy, then he won't be sitting there staring at the probability for a rate hike on his Bloomberg terminal.
Are you one of the folks that believe that he needs to cut rates in order to fortify his inflation fighting credibility?
Hike rates?
Yeah.
No, but again, I think that that's somewhat irrelevant right now. The bond market has fully priced in a rate hike. He doesn't really get penalized for hiking rates today because the bond market's done all the heavy lifting for him in advance.
Is that what he wants?
I don't know if it's what he wants. Again, what he wants is for the market to interpret the data, not for the market to interpret how Fed officials interpret the data. So he wants bond traders to grow up. I don't think bond traders want to grow up at all, and that's why they're hanging on every single word, whether it's Lori Logan or Christopher Waller, every single word that every voter is saying they're hanging on to for dear life. But I don't think Worse cares.
I mean, again, the market, you say the market's done the work for it. I think it seems absolutely correct. I mean, the 10-year 464. I mean, we're there. I mean,
the danger is if he goes nuclear,
okay,
and goes 50 basis points or something, and immediately slams the 2's 10 yield curve into inversion. On the other hand, if you want to set up the Fed for an easing cycle and not say boo about it, when he was in Portugal recently, he said, we have the dot plot for now. Are we going to have a dot plot in September? He's not going to tell us one way or another.
Task force.
There's a task force for that. So if I wanted to shock the markets and set the markets up for an easing cycle headed into the midterm elections, today's your day.
Okay. All right. So what will you be listening for when he speaks? There are some who believe that this news conference, he's holding one, and there were questions about that a few weeks earlier, won't last very long.
I don't think it will last very long, but I will be actually, for a change, paying attention to the statement, because I'm going to want to see if there's a quid pro quo. If there's a rate hike today to make sure that the good family fight ends well, no dissents, unanimous decision, what's the quid pro quo? Does he get something on the balance sheet side? Is there something unexpected? Are the regional Fed bank presidents going to come out and make hawkish because they don't have a vote about the discount rate? I'm going to be looking at the statement today for the first time in a long time, because his baby is that balance sheet. And I know there's a task force for that too. I have great respect for Jeremy Stein. He's picked the right people, put the right people in the right place, Mervyn King, communications, et cetera.
But that's his priority, you're saying?
That the balance sheet's his priority.
What do you think he wants to do with the balance sheet?
I think he wants to make sure we never cross the Rubicon again of buying mortgage-backed securities, given the damage that it's done to the housing market, not once but twice. And there's, again, if you're talking about the element of surprise, why don't you just say, we're going to accelerate the roll-off of mortgage-backed securities, and we'll roll it into treasuries. Fine.
That's quantitative tightening, isn't it?
No, not if they roll it into treasuries.
Okay.
So they're holding the size of the balance sheet steady. They're not changing that aspect.
Just moving into something else.
Just delivering a message to markets. If you expect for us to buy mortgage securities the next time, and then corporate bonds the next time, and then the ultimate equities, he's saying, no, I'm moving the line back. We're just, if and when we're forced into a state of QE, it's going to be treasuries, and or treasuries.
All right, there we go. I might even pay attention on the train. Put down the movie I'm watching at 2 o'clock and pay attention.
Well, it might just be like a 15-20 minute news conference, so you don't have to pay attention for long.
All right, very good. Danielle DiMartino Booth, she'll be paying attention. She's the CEO and Chief Strategist at QI Research. We appreciate her coming into our studio. She is based down in Dallas, so we appreciate the effort, and particularly on these Fed days. I think this market's looking a little tepid right here.
Yeah.
The S&P's down 0.8%. The Dow off 820 points, 1.56%. I remember when 820 points meant something for this market. The Nasdaq down 286 points. That's 1.1%.
You have oil prices higher, so it follows
Yep.
that energy stocks are the group that's rising the most, up 2.5%. Then you've got consumer staples and healthcare in the green as well, so some defensiveness in equities.
Very good. More coming up. This is Bloomberg.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio in New York City. We're streaming live on YouTube as well. Okay, the World Cup is over. I think it was a fantastic World Cup. I think everybody was generally pretty happy. The fans seemed to be happy. The games were good. We had a great finals there. I don't know. I tell you, it's important for a lot of companies out there, none more important than Nike and Adidas. And let's break that down. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence. Poonam, just kind of scope out for us for the big name brands that were really associated with this, Nike and Adidas. Talk to us about what it means for them.
Yeah, so for both of them, the World Cup is a real big deal because it allows them to come front and center with their fans and consumers alike. So when you think about who has the ball, who has the kits, who has the teams, it matters. So when we got to the finals, Adidas had the win already, right? Because both teams were sponsored or wearing Adidas gear. So at the end of it, who won the World Cup? It's Adidas of the athleisure names, and that's great brand heat for them. In fact, they came out saying that they had expected in euros $1 billion from the World Cup kit sales and jerseys, etc., and they topped that by 50%. So 1.5 billion euros is what now the number is for the momentum they got from the World Cup on just kits and jerseys and gear ahead of it.
Yeah, I mean, we had so many games here in the New York metro area. that all throughout the city, throughout the tournament here, there were jerseys all over the place, and people were really into it. So, do these companies, did they break out how big soccer is for them amongst all their the sports that they are involved with?
I wish I did, but or they did, but they don't. And we don't know by sport how big it is, but just as you can imagine, when you think about the world of sports, soccer is one of the largest watched and played sports in the world. So it definitely does build momentum in terms of their sales, whether it's the cleats, whether it's the apparel, the jerseys, etc. The players they sponsor matter. Messi being in the game for Adidas was a big deal. Mbappe for Nike in the top 5 running was a big deal. And these players also against the teams that they sponsor really do raise visibility for them and get to draw traffic into their stores and their brands.
Do we have a sense of if Adidas wants to sponsor, Spain or in Argentina, what that costs them? Do we know that kind of number?
So those contracts vary and they change. And clearly, with Spain having won the World Cup, the price tag goes up once the contracts are up for renewal. Right now, what I can tell you is the soccer ball, which Adidas has owned in the World Cup for the last, I believe, 25 years. Wow. Is now being likely taken over by Nike in 2027, 2028. Okay. So it does. So things do change when contracts expire, but for many of the teams, for many of the players, they do have various lengths of contracts and prices do vary.
How about for Nike, an American company? How did they fare in the world of global football?
It would have been nice to see Nike versus Adidas in the final, I must say, but that wasn't the case. They still did well. They were up in 3rd place. So I think they do still gain the brand visibility. In fact, some data sources that we look at, Nike was the top searched kit through April through June, with the USA averaging more than 14,000 weekly searches. So we do think that even though Nike didn't win the World Cup, they were definitely in the running and they were very visible across the board. And having Mbappe and winning 3rd, 4th place does still go a long way for them.
How about for a brand like Puma? It feels like they've kind of, at least here in the United States, a little bit of a lagging behind, say, the Nikes and the Adidas of the world. Talk to us about Puma.
Yeah, so Puma, they're definitely much smaller, right, when you think about them in the world of sports. And I think they didn't have as many teams as Nike and Adidas have, so they do lag in that front. But I think what worked out well for them on the World Cup was Morocco and Switzerland's quarterfinals, right? I think that really helped them gain visibility, and it did prove positive for them. They're missed a big turnaround right now at the brand, and they're really trying to find their place.